Well, good morning, everybody. This is Simon Campbell speaking. It's just on 9 o'clock, according to my watch, and I'd like to welcome you all to Round the Clock Trader. This is the 12-hour live event that we're holding today, live webinar event. I'm delighted to have you with us. Fantastic to have you here. As I said before, a lot of familiar names. Thank you very much. And welcome to everybody that's new. We have reached out to hopefully some new people that have maybe never heard of the show before. This is a monthly event that we hold. We try and provide you with an interesting range of speakers to educate you on the various intricacies of trading, the different strategies that you might use, the different assets that you like to trade, the different markets, forex, stocks and commodities. Each speaker will present roughly 40-45 minutes, and then we have time for questions and answers. I will moderate questions and answers as we go, so please use the chat box that you can see just to ask a question. It comes straight to me, and I will put that to the speaker as we go through the day and go through the various sessions. Just as it always comes up, but just I'll keep reminding everybody that this is being recorded, and as a registered attendee, you will have access to the recording. It normally takes around about a day for it to process, being such a large recording, but you should have it by the weekend. So if you do need to nip out, take a break, do not fear, you can go back to catch up on anything you miss at a later date on the recording. So good morning, Maverick G in USA. Thank you for joining us. It is the wonder of these webinars. They've been around for a while, but they still amaze me how we can bring everyone together. By way of a background, myself, Simon Campbell, I've been involved in the private investor and trading industry since 1998, I have to admit. So I've got a fair bit of experience in hosting live workshops and seminars. Of course, we used to be all together in a hotel room, and now we're all online. I've run various trading expos in London for many years, and also helped one of the companies, in fact, that's speaking today, VectorVest, to get launched in the UK. And they're a private investor research software program. So I've been around, and throughout all that time I've met a lot of fantastic speakers and coaches and independent traders that I like to try and involve on these events. But of course it takes everybody to make the events a success. That's why I'm grateful for you to take the time out and join us here today. And please don't hold back with questions. Not only on the particular subject the speaker might be discussing, but anything else that you feel you'd like to have answered on trading. Today's the day to do it. So sit back, relax, and we will get started by bringing in our first speaker in just a couple of moments, Carol Harmer. But before I do that, I will just quickly give you a little introduction to Carol. You should be able to see Carol's website now, Charmer Trading Academy, and if I could just use her biography, I'll read just some of it out. If you can't, it might be a bit small on the webinar. One of the most respected and established technical analysts in the UK. I think that's very true. Carol Harmer, with a career spanning almost 30 years, Carol Harmer is undoubtedly one of the most respected technical analysts in the UK. Her career started in 1981 on the future trading floor of Life, which was the London International Futures and Exchange. In 1983, Carol began work as a senior technical analyst for Midland Bank, which was taken over by HSBC in 92. Again, headhunted in 86 for a role of manager of technical analysis for Nomura Bank, and then hired as head of technical trading at Credit Suisse. She's also appeared on Bloomberg, CMC, Reuters, Financial TV, and now Round the Clock Trader to provide her opinion on the financial markets. Carol formed a company in '96 to train independent traders in technical analysis and launched Charmer Charts to provide daily analysis reports for the established local traders on the live floor. She would be present on the floor so that traders could talk to her directly, and continued appearances on financial news channels from the trading floor. In '99, the live trading floor closed, of course, but Carol continued with Charmer Charts for future traders who moved to the screen trading. After moving to France in 2006, she was contacted a few years later by several traders to request her technical analysis service again to help deal with the very volatile conditions. So, what a background. We'll go over to Carol now and see if we can bring her in for our first session of the day with Carol Harmer. So, good morning, Carol. It's Simon here. Can you hear me okay?
Hi, Simon. Absolutely fine, thank you.
Wonderful, thank you. Just reading through your biography there for the listeners to get a little flavour of
few little errors, but you know.
an impressive career, nonetheless, very impressive indeed. And,
yeah, it wasn't so much a technical analyst, I was the technical trader. I've always traded.
You have, and you come, in fact, there's another of our speakers, Stephen Goldstein, who's coming on the show later on today.
Yes.
I know he knows you and couldn't sing your praises high enough, which is wonderful. But of course, we go back a few years ourselves, and I'm always delighted to have you joining us on the show. It's a great
Thank you, Simon. I appreciate that.
So what we've planned for today was to ask you to provide us with an opening view of the markets from your technical point of view, to look at the main markets and some of the main currencies. And I've asked everyone on the webinar to think about particular charts that they would like you to have a look at. So if we could go over to your screens now, we'll let you get started with that. We do want this to be an interactive session, everybody. So please do just use that question box to hit the questions through. We'll link it up straight with Carol so we can.
I won't be able to see that, Simon, will I? It will be you telling me.
I'll look at that and just stay on the air and transmit the questions directly to you, save you having to
Simon.
too many boxes. So I will now make you the presenter.
Thank you.
That's great.
Okay. What I like to do, hi everybody, by the way, my God, nearly 100 of you, good Lord. I've always been a trader. Unfortunately, in the early days of my trading career, I didn't know about charts or technical stuff or anything because it was 1983. Who did? No, we started off on the live floor. Nobody really understood about charts. Anyway, cut a long story short, one night I discovered them. Everything became clear to me. It was like a light bulb going off in my head. And to this day, I still trade off of charts and technical stuff. And I've been doing it now for 34 years. Must update the bio. 34 years. So I know it works. I am 100% committed to the fact that it does work. It's just how we interpret them. Well, first of all, I'm going to show you the FTSE chart because it is the stock markets that are making the moves as we speak. So I like to start off with a weekly chart so that you can get a view and a feel of where we're going to go. Now with this weekly FTSE chart, I don't know how short-term or long-term you trade. What I'm saying is this is what I do every Sunday night to gear me up for the trading week, so that come Monday morning or very early Monday morning, usually it's 3 o'clock Monday morning, I'm up, I'm trading. I like to do but I don't want to have, I do the work on Sunday afternoon so that I know where I am. The first thing that sticks out to you, to me, is the fact that, look, we have made an inverse head and shoulder pattern. It's quite a good one. You've got the shoulder there, the left shoulder, the head, the right shoulder. This I put in as the neckline. You could have put it anywhere, whatever it did, it broke. Now, you can see then that the market rallies up to the highs of 69.55. Now look at our weekly stochastics. These are a very slow moving indicator, but they come from extreme overbought levels of 102 down to virtually neutral on not a great move lower. Yes, we did come down. Yes, we came down to the magical, as people who work with me have known, of the 6665 in the FTSE. We held, and look, we're just currently breaking higher. If you take this measured target from this head and shoulder base, it gives you a measurement of 7,300 in the FTSE. Now, this isn't to say that we're going to have backing and filling, because we are. If you keep that in your head, a base pattern takes far longer to create than a continuation pattern. This was the break. This is what we've done subsequently. Now, this is not to be ignored, even though most of this was created over August. As anybody who knows me will testify, I don't like trading August. I think 11 months of trading is enough. And history tells me, both working on the floor and in these major bank dealing rooms, that really August isn't where you want to be trading. But I'll come on to that in a minute. Now, within this pattern, still having the 7,300 in your head, we've had a weekly continuation pattern. We'll call it's like a pennant or whatever. So you've got this to go. Now, the idea is that before we reach 3/4 of the way along the apex, we should break. Now, we can see that FTSE, just look at that hourly chart, you see there, that little double top there. So I look at the weekly, daily and hourly, but this is the weekly. So a break of this line here, nearly just over halfway along this pennant, actually gives you another measure target of 73.50. So you can see why people are getting quite excited about the stock markets at the moment. Now, this isn't going to really help the short-term trader by looking at this chart, unless he or she, and I say she because there's, you know, in 34 years we've got quite a few lady traders now around the world, and nothing could make me happier. But if you know the direction of what the rest of the market is trying to show you, or what they are doing, you are in that position where if you're taking a short in FTSE, you know it's only to buy it back. Your core position is to be buying into dips. We do that in uptrends. We sell into rallies in downtrends. So yes, of course, you're going to get the short-term scalper that says, well, I sold FTSE at 69.55 or 68.80 and I made money. Yes, you did. You may well make your 50 points, but if you position yourself, you could make 200 or 300, but you have to take yourself out of the noise. So that's what I do every Sunday. I go through, I look at the weeklies. If I'm feeling extremely excited, I might look at the monthlies as well. So then what I've gleaned from the weekly, I put into practice on the daily chart. Still see that pattern, but with much more detail. So we know that this 66.65 to 66.20 was an incredible level to go in and buy the FTSE, because you can see.
Carol, can I just jump in for a second? A few questions just coming in. We've got a mix of people on the webinar at the moment. Obviously, a lot of people I know, looking at the names, will be familiar with the chart. But just for the benefit of those that are fairly new to this, do you think we could just explain, first of all, what platform this is, and then maybe just quickly summarize some of the lines that we're looking at on the chart, just to bring us up, because we can see we've got various trend lines, we've got some Fibonacci levels, and so forth. Could you just take a moment to describe what we're looking at?
I was actually going to do that after this, but I can do it now. It's not a problem. No, it's all right. Don't worry about it. Okay. This particular platform is called Pro Real Time. Now, I like this particular platform because it looks lovely to look at. It does. It looks pretty and it's nice little colours and da-da-da. I do my analysis on, do I need to say that, or I do? I use a charting package that is pure, okay? So I use this, but I use it in conjunction with another two systems that I have that are purely basic charting packages. They're not basic charting packages. My point is they don't do anything else but charting packages. So although I cause myself an awful lot of work, as everybody will know the essence of technical trading is data. If you don't have the correct data, how can you make the correct decision? You're going to be going in at wrong levels. So I actually do a lot of work, possibly that the new retail trader wouldn't do, but for me, it makes me that when I do take a position, I am 85 to 90% have faith in that position, and that only comes from doing your homework and your groundwork. Whatever you do, be it any career, you have to do the groundwork. For me, I'm a data pain in the butt to people that provide me with data because I'm so anal about it. So you have the patterns and you have the does that clear that up a little bit, Simon?
And yes, I think so. I mean, we're looking at the from my own point of view, the green dotted lines. These are longer term channels.
They are. You've got them in sequence. If they're red and bold, they are very good. If they're green and a bit and this is on the, you have the green lines also, and you can set the parameters to where you want it to do. So it's very user friendly and it's very pretty, whereas some of the older systems that I've got, or two of them, are not as pretty as you like as this for presentations, but they are what I do my analysis on. I just find this one easier to show people.
Yeah, so you have this set up with various. What you're trying to do is to look for trends, sort of shorter term, longer term.
The thing is, Simon, it's like with anything. When you're technically trading, you should be able to eyeball it and see them. All this is for me. It's, you know, too many people take highs, lows, draw a trend line. There is now, as I've discovered, you know, as technical information has become so much better than what I had in 1982, then obviously there are more things to look at. So I keep it as basic as I possibly can, but am aware of, well, do you know what, if this did this, where would that line be? Put it on there, see what happens. I can confirm it with my other systems, which I can't show you now because I've shut everything down so that I have no buzzers going off, alerts going off at all during this particular webinar. So as for Fibonacci, what it does, I mean, I won't go into the whys and wherefores of Fibonacci. All it does is it actually tells you, okay, there's your high, there's your low, there's your high. If the market retraces, where will it come back to? And we use standard deviations of 23.6, 38.2, 50, 61.8. 78.6 or 76.8, depending on what system I'm looking at, and obviously the 100 line. Now this gives you a chance to say, if you're in a strong uptrend, you should go only as low as between the 23.6 and the 38.2. As you can see, it met in the middle there. So when you can connect those 2 points here, you can see it hit it a third time, bang, the market's going higher. This confirms it. There's lots of things you need for confirmation, but seriously, I know I've only got 45 minutes. You really do not want to get me into this now, because it is a subject so close to my heart that I've used for 34 years, and it's profitable. You know, there's no hidden agenda with this. It is pure looking at charts, understanding by being in the pit what the psychology of those charts, because all a chart does, show you where the price is, but it shows you who's in control, the bulls or the bears. Who's going to win, the bulls or the bears? Now, if you know the criteria to look for the pullbacks, you know, here, I really think that you would have found a lot of guys wanting to sell the FTSE. But no, do you see that it does follow a set of rules that in 34 years hasn't changed? That's my point. So I do use Fibonacci a lot, do use stochastics. I look at the MACD, and I use your standard RSI. I don't need to look at any more, because these studies that you have on these charting packages, you know, there's one I use, it's got 425 studies. To get them all to say the same thing is going to be pretty hard. So by being a trader on the floor for many years and being a trader in respected, very well respected bank dealing rooms, you get to know, you can portray the price to what you hear in these dealing rooms and the floor. You know, and these days people don't have that experience. They are given a platform, they sit there on their own, and they're supposed to make head nor tail out of a market that has gone back zions of years. What I try to do when I'm asked to speak is try and show you that it isn't simple. Trading never is. But you have to believe in what you do, you have to believe in what you see, and you have to sometimes bite the bullet. Something will tell you when you're wrong. I always know when I'm wrong. And as people will tell you, I'm not shy of getting out at a loss, because I'm wrong. And that's the key. If I'm right, if I feel I'm right, I'll hold it. I always know the point of, you're wrong, get out. First cut is the cheapest. I ignore the noise that makes up the old life floor, the manic dealing rooms, and the clients, hedge funds, institutions. You know, you have all that still going on. Not so much the life floor, because that's dead and buried. But everything else that runs our markets still has that. You just have to sit back and ignore the noise. You can't do that if you're a scalper.
What about Fibonacci pivots? Asks.
You know what? I don't use them. I don't. Sometimes I put the arc on. Sometimes I look at a ribbon. For me, I'm very keep it simple, stupid. I have always applied the KISS theory. This is what I was given way back in the 80s. Please don't think that I haven't looked at other things, because you are always learning. 34 years later, I still learn. But what I've done is I've gone, that tells me no more than what I use, history. That tells me no more than what I use, gone. So you can put all these pretty patterns and pretty things onto a chart. Is it actually going to teach you how to trade? And at the end of the day, I'm hoping that the majority of people that are on this webinar are here for one reason, and for one reason only, to trade profitably. You know, if you're just on here to do charts and be a technical analyst, and I don't mean that derogatory in any shape or form. I have trained some superb technical analysts, superb, who I'm very proud of for this day. But it's like being a chef, I always say. You can put all these fantastic ingredients into the mix, but at the end of the day, you've just got a bowl of fantastic ingredients. To actually make the most of what you are doing, you need to cook it, and that is all it is with trading. You've done your homework, you've got your ingredients. Now let's cook it, because cooking it makes the meal fantastic. Sometimes you get a duffed one. We've all done them. But the majority of time, and this is the key, the majority of the time, these won't put you wrong. So my quest, if you like, is to help people to trade, not even help, but to show people through doing things like this that you can trade profitably by using the very basics of what is available to you today. That's the thing. If you use too many, you could come out looking a bit silly, really.
So when you trade, Carol, are you actually buying and selling the stocks?
I'm actually buying and selling, Simon. Yes, I am.
Yeah. You're not spread betting or
good Lord, no.
No.
No. You know, I watched the pits down on the live floor. You'd have short sterling, and they would be doing spread bet. I mean, there are extremely profitable not spread betters, spread traders. Of course, there are many profitable spread traders. Whether they are now since 2008, 2009, I don't know. I think most of the people I know trade outright futures, outright FX, outright indices. Okay. The spread traders, where you used to be able to trade along the curve. So, for example, in short sterling, you would be buying the spread. So you'd buy the front month, sell it out along the curve. A contract has a market has 4 contract lives: March, June, Sep, and Dec. So if you were buying the spread, you'd be buying the front month, as is what we're doing now, buying the December. Say you bought 25 contracts. You could then get your other 25 contracts and spread them along the yield curve. So you would be selling some in March, selling some in June, selling some in Sep, selling some on the red month of December. So do I do that? No. The reason being is I don't like that. That seems to be contained to the interest rate futures markets. Do I do intermarket spreads on foreign exchange? For sure. You know, at the moment we have an Aussie Kiwi position running very nicely. We bought that at 102.80. It's now 104.47. So I do intermarket spreads, but not the way that you would think them to be, just inter-currency spreads. So I always put everything against the dollar. This time we're into Aussie Kiwi. You can do. We also have Euro Sterling. We also look at Euro CAD. We look at things like that. Not so much Euro Swiss anymore, for obvious reasons with the SMB. However, intermarket spreads like short sterling, Euribor, no, I don't do things like that. I don't even trade the short day interest rate contracts. Anybody that knows me will know that. Didn't like them on the floor, don't like them to this day.
Okay, so just when you're talking about shorting sterling, just to keep it.
I didn't say that. No, Simon. I said short sterling. Short sterling is an interest-based. It's a UK interest-based contract.
Right.
If I say I'm shorting cable, that's different, whole different ballgame. Short sterling is an actual futures contract. It trades on our platforms and is based against the 3-month LIBOR rates. Totally different to cable, or as people call it, GBP. USD. I call it cable because that's the only thing I've ever known it to be. So no.
Paul's asking an interesting question. He says, what's the main objection to spread betting for a retail trader using this method? What would you see maybe are the risks?
Well, if you're are you talking spread? See, this is spread betting or spread trading. What is the actual question? Because spread betting I associate with retail platforms. Spread trading is short date interest rate market. So
yes,
you're talking spread betting.
I think we're talking about spread betting.
Okay.
Using one of the sort of spread betting firms. What would you see are the risks? Why not?
I think the biggest risk using a spread betting company, and we do look at them here, and we check against our live feeds that we have from banks using our charting package to 4 retail platforms that we don't use, but we look at them. Okay, because obviously the retail market has grown in massive amounts since the last 8 to 10 years, huge, and will continue to get bigger, because don't forget, to be a professional trader, you have to meet certain criteria, apart from early days of life. But to be a professional trader, you have to trade on a professional platform, and you need money to do it. You trade in contracts as opposed to pounds. So for the spread better today, you can do it, for sure you can. Nobody doesn't have the potential to be like a professional trader. All you've got to do is know where you're looking at, adjust the stops accordingly, and you can get these charting packages. And I'm not going to plug anything because that's not why I'm here. But you can get charting packages that take a direct feed from 160 banks, also a direct feed from exchanges that are trading the various instruments that we trade. It's not, if you get delayed data, going to cost you a lot of money a month. But what it will do, it will make your trading so much better, because you'll look and you'll say, actually, that didn't trade at that price, it traded there. You may only be 5 to 10 pips out, but one of the biggest things I've learned with my little group of retail traders is that 5 to 10 pips can make an awful lot of difference when they're placing their stops. So on my system, I'll go stops in euro at, where would you put the stop in euro? Say we had a euro-dollar position now, where would you put the stop? Well, say I put the stop at 112.22 for argument's sake. I'm just putting that one out of the air. That's on my system. Theirs might have it at 18, 17. So they put their stop there. It goes out, it takes out that stop, and we're off and rocking and rolling. We're fine because we haven't been stopped out. They're not, because they have, in a market that isn't there. You've got to imagine what the spread betting companies do. They take the price of a bid and an offer, and they go in the middle. Now, at certain times of the trading day, and especially when Asia opens on a Sunday, these spreads can be really wide. So you can be taken out of a position because of the spread betting parameters, and the market, the real market, hasn't got nowhere near it. So what I've done in the last year, 18 months, is try and educate the guys to, this is where I'm putting my stop. You tell me what platform you're on, and I'll have a look and see where you should put yours. And that's working. It really is working well. So yeah, you can trade like a professional trader off of a retail platform, for sure. You just have to be aware of the pitfalls at certain times of the trading day.
Okay, fantastic. Carol, thanks. Could we go over to the currency markets now and have a look? So you mentioned the euro there. Shall we start with that?
We can.
It's a very good point you make about the spread betting companies, and
I think I don't like them. It's not that at all. It isn't that I don't. I think to open up the wonderful business of trading would benefit everybody. You know, my point and my distress purely comes from, are you getting stopped out on no reason? Once you can get your head around that, and because you've got another accurate charting package, for sure you can do it. You know, I can't imagine starting off my trading life now. I really can't. You are bombarded, as I said to you, 400 and whatever studies on a charting package. What one's flavour of the month? What one is the market looking at? What does this? What does that? And you're on your own at your computer trying to make sense of it all. It's only having the experience of the career, if you like, and I never knew back in 82 this was going to happen, but back in 82, as the years went on, you learn more and more and more that you can. I think on my experience, I can trade a retail platform now because I don't put the stops where it says to put the things. Do you know what I mean? I do it off of my system. And this is not my system. These systems are available to anybody who wants to pay out. Please bear in mind that the platform you are using is only giving you the price data from people on your platform. It's like taking Midland Bank, or back then, Midland Bank cable price. You wouldn't do it. You want to take, what are the other banks doing? What is the price it's really at? Do you see what I mean?
Yes.
Okay. So, we'll go on to the euro dollar. I'm sorry, look, I can chat. I spent 40 minutes talking about not a lot of markets. And there was really important little things, but hey ho. Right. You can see here, first of all, we're not really doing a lot, are we? So there we are in 2014, down we come, and basically the last year, 2 years, we've not done a lot. We've oscillated. So there's our weekly chart. So it's whatever. It's at the bottom of the range. You could go to the top. Then we click out to the daily chart. And look, you know that 61.8 is going to be an important level in technical terms. You know that. So even if you, over FOMC, which we've done, don't believe in the fundamental, or you do believe in the fundamental analysis that is coming out, please always check on your technical side. There is one thing I've learned on 34 years. Technical traders don't look at fundamentals. Fundamental traders should look at charts. And the reason they should is 98% of trading people in the world today are aware of specific chart points. They cannot be not aware anymore. Me, I don't look at figures, or anybody will tell you who knows me. I don't look at them. They bear no resemblance in my life whatsoever. I'm not saying that's right. I'm saying I wanted to be, back then, a pure technical trader. Now, I know you're all bombarded with 100 different buy-sell signals per day off of people like CNBC, Bloomberg, Reuters, whatever. You know, if you listen to everything and try to make sense of it, you're not. Listen to what the charts are showing you. At that 61.8, your downside risk was so minimal because you knew that if it did break here, you didn't want to be long of euros. But as long as it held, you will find that the technicals go first, not in major change of trends. I'm talking hourly, daily, weekly. These things will point you in the right direction, and you just go, oh, that didn't break that. Therefore, thus, you don't want to be short of the euro dollar. And that's how you can really look. I wish that I'd get off there. Where you can really maximize it. You might have to wait. You know, trading the infinite thing you need is patience. It really is a virtue. You should always get another bite of the cherry, okay? So there's no point chasing it like people do. There's no point running around or sitting at your desk like a headless chicken, which lots do. Sit back, look at what it's telling you, place your Fibonacci's correctly, not from the low to that high, from where the market started to rise, which is here. Started to rise here. Here, it went up, come down again. Here is when we started to go up. Now, these Fibonacci's are really important, not because they work really, really well. It's where you put them that can make the difference to being a successful trader or not. And books do tell you, that's why I don't write them, books do tell you the standard. A good trader will always be looking for other things to improve their trading performance. And your risk, you're always going for the risk reward, you know. There, it has more chance of going to there and there than it had going to there. And if it did break here, you're out of longs and into shorts, but still from a weekly, looking for it to go higher. You know, use the indicators that actually matter. Use the ones that people look at. If somebody doesn't look at Fibonacci ribbons or arcs, don't use them. If somebody doesn't look at Elliott wave theorists, don't use it. Look at what you're basing. And us traders, you know, pretty basic. We don't like to look at loads and loads and loads of things because of we like to trade. And that's why I take my quiet time on a Sunday and go through everything that I want to go through and look at markets that I don't normally trade, just in case something pops out at me as the Aussie Kiwi, and you then take that position. You know, it works, and there's absolutely no reason why any of you, if you follow a certain set of criteria, very simple, easy rules, no reason you can't at all become like a professional trader. It's your mindset, it's psychology, and Steve, who's coming on at 3 o'clock, he's got that tied up. So please listen to him. And when you do, remember my words on the technical side of it. It's all about psychology. It's all about mindset. And that's why you have to be patient, sit back, and wait for your opportunities. You know, a good trader isn't somebody that trades 30 to 40 times a day and comes out flat or small down. A good trader can trade 3 or 4 times a week. That's it. That's what you need to learn. It's not going to make you very popular with the spread betting companies, but then I'm not here for that. My job, if you like, my mission is to make or to get people to understand what the rules are to actually make money out of a market and not give it away. That's it.
Carol, thank you for that. Wise words. Loving this woman, says Hugh, provides so much clarity. Thank you for that.
I haven't showed you any of the markets.
We haven't even started. Could you make a comment? One or two people, David's asking about volume. Some excerpts say you can't possibly trade without looking at volume, but you seem to disagree. Can you remind?
I can, and I can tell you for why. Please understand something. Coming from a floor where volume was the be-all and end-all, all right? Because before I was a trader, I actually was a price reporter for the exchange. That's how I got into trading. Because I used to be a computer operator when I was 15, and it just so happened, blah, 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 I ended up on live. So volume was very, very important. So the idea is that as volume decreased, it was a good time to trade. If volume increased, it was a good time to trade. So this is based on the futures only. There isn't, as far as I'm aware, apart from currency futures, how do you gauge what FX is doing with the trillions of dollars traded per day? On an FX desk, you don't put in, I've traded at 64 $250 million. It's not, it just doesn't happen. So you have to gauge what is the volume in this particular market. Is it going nuts on nothing, or is it a genuine volume move? Now, my experience from the dealing rooms, I've near enough virtually got it sussed, but it's become much less important in these days of trading because they're not actually posted volume-wise. It's only on the futures, life, CBOT, IPE, the metals exchange. Do you know what I mean? Where you actually have physical contracts traded in volume. So in the T-bonds, you would have 15 trades 50 times, 15 trades 100 times, 15 trades 20 times. Do you see what I mean? These prices plus volume was being shoved out to Reuters, to Telerate, to ADP Comtrend, to Bloomberg. This doesn't happen in FX. So when I went back to the bank going, well, what about the volume? I was just stared at by the spot desk and said, really? You seriously think that doing what we do all day long, we don't care. We just know it's a lot. So it's very hard to gauge volume in FX. You could look at currency futures, but to be fair, that doesn't really tell you anything. If you're trading something, futures that has volume, for sure, use the volume indicators, but a lot of it's made up in some of these platforms on what they think people are doing. Okay, so suspect now, extremely suspect, unless it's coming direct from the exchange, which not a lot is anymore. So please be wary of basing your trading criteria around volume. The other thing we used to do was volume and open interest. Open interest was so crucial to what the pits wanted to do that was actually posted the next day and hidden away upstairs away from the floor so no one could get hold of it, because you use the volume and open interest to gauge what direction the market should be going into next. But you can get all of that information from just looking at a chart. Seriously, you can. Look at the things that people are looking at. Look at the things that the market, not the retail, the actual market in hyperspace is looking at. You know, I know yesterday in the Eurodollar that there was a lot of volume because the stochastics told me there was going to be volume, the RSI, right? Everything told me when it didn't break through there, people would go, what can't go down goes up. Always live by that rule as well. I'm saying this blandly, I don't mean to be, but I can't explain it in any more technical terms than what I learnt from. Okay? Look at it. They will tell you a story. It will speak to you. Cut away the noise. Sit in a quiet room. Go through the market that you want to trade. I would say don't get focused on just one. I think for any retail trader, 5. I know before you all scream and say I'm mad, but 5 markets. Because if FTSE isn't doing anything, look at the euro. If that's not doing anything, look at cable. If that's not doing anything, look at gold. Gold with our wonderful target of 1478 initially, with 1527 following. We are long of gold. Why did we buy gold? Because gold hit a fantastic level at 1310. You know, we're long of gold. Where is it now? 33, 34. Excellent. We're going to be buying more above 36 and we're going to scale in. You know, and if it goes down again, unless that goes below 12.95, hallelujah, praise be to the gold gods. I don't mean at all to come across as blasé. What I'd love is to take you back to how simple a chart and basic charting strategies are without being bombarded by lots of things that does not make you a better trader, that will actually confuse you. You strip it back, apply the KISS theory, keep it simple, stupid. Simon, do I have any more? Or have I bored them to death now?
Well, no, quite the contrary, Carol. Love Carol's approach, says Caroline. This is the best webinar I've attended so far, says Michael. Thank you for the feedback so far. It's great. We do have a
Oh,
huge.
thank you so much.
No, it's fantastic. The questions are pouring in. Let's
Oh
try
God.
and see if we can
The thing
get the.
is, you know how much I can chat, Simon, and I didn't want to put your webinar back by like whatever.
No, yeah,
But sure,
Caroline.
questions and
Carol,
answers for sure.
we do have a space at lunchtime today, which is about 1 o'clock, where I'm still missing a speaker from one till 2 o'clock, which would be an hour four for you. Carolyn's asked, would it be possible for you to come back then? I wonder. I don't know. It's a big ask. I don't know what your day's like. If that would be.
Well, for sure. I mean, if they want me to come back, I'll come back for sure.
Oh
I
well,
just
that
didn't
would
want to
be.
bore anybody.
No, I think it's quite the opposite. Where people are just wanting a lot more of your time. Woohoo, says Karen. Thank you for the suggestion. That would be great. We've got 10 minutes left still this morning.
Okay.
So if that's all right for you this afternoon, that will be 2 o'clock your time.
2 o'clock my time. Yeah, for sure.
Because we'll carry on. There's so many questions coming in. Let's try and see if we can do one of these. George is saying to trade 3 or 4 times a week, you need a large account size and high time frames, I assume. Is that correct?
No, not correct at all. You don't need a large account. In fact, totally the opposite, because you're taking a position. You can actually afford to run a smaller position longer time. Whereas if you are a scalper, no disrespect to scalpers, because I've known some of the best, if you are a scalper, you're in and out, in and out, in and out, and you miss the bigger picture. Okay, so you could actually use up your account. I've met more blow up their retail accounts through trading, through over trading. A trader's biggest mistake is over trading. If you pick these trades 3, 4 a week, that you are 85 to 90% convinced it's going to happen, then your stops are so near to your entry point, and I don't mean that when I say near, 50, 60 pips, but you're looking for more out of the market so you can do smaller size. And don't forget, as the market goes in the direction of which you initially took that position, you can add. So you scale in to a winner, not so much scale in to a loser. Does that make sense to you? I know what I'm talking about, but it's getting it across in trader terminology, which I know so many of you don't know the trading terminology of 30 years ago. Unfortunately, that's all I know. But you scale into a winner, so you can have a relatively smallish account, for sure.
No, it's all making sense. But I'm in the middle of reading through the reminiscences of a stock operator, the old book with Larry Livingston at the moment. Of course, he went through all these things even 100 years ago. It's fascinating to see how.
Oh, I'm not that old, Simon.
No.
Draw the line at 100 years ago.
The principles are the same, however. So, do you target session opening times or look at what time the banks are getting to their desks?
Oh, I do. I do. You can't not, with the experience that I've had, I can't not target those zones. Believe me, if I could get away with not getting up at 5 o'clock in the morning and working through to 10 o'clock at night, please believe me, I would do that. You know, we used to look for gaps, and but of course I know when Europe opens and when, you know, what is that Asia close, Europe opening, you know, you see moves, you really do. So I need to be here, God help me, at those times when I can maximize getting into a trade or getting out of a trade. Do you understand? Now, you know, this isn't a 9 to 5 job. So yes, I am totally aware of. You'll also know if you're trading FX, you can also see then or indices. You can see that because I've worked in New York and Chicago, and I know that they used to do their utmost to screw up London, you know, only in a jokey way, but screw us up nonetheless. That's what security is. But so if you look at when Europe closes and the States come back from lunch, okay, which is around about 5:30, 6 o'clock European time, these markets move. There's no secret in that. It's just knowing your market, knowing how it works and what it does. So I know they all go off for breakfast. I know they all go for lunch. I know when they come back, they can move the market because Europe shuts. The other thing that is really, really interesting in trading FX is this. We've always traded 24 hours on FX, always. But what we used to do is we'd shut, we'd pass all the orders over to our New York office. New York would shut, pass it back to Sydney, or try and bypass it, or on to Tokyo. So there you have it. You got the time zones. What you will find is now with these markets actually physically from you and me being able to trade 24 hours, if the States close on anything at a certain level and Europe or Asia takes it in the opposite direction, you watch when the States come in. 8 times out of 10, they will drive that down to where, or just in front of, or below of where they closed. So we don't have the gaps in the market that we used to have. But you can still picture your gaps by noting when New York shuts, when Asia opens, when Asia shuts, what Europe does. And it's the European time, what they drive it to, when the States come in. They'll take it down to where they shut it. They don't like being left out the loop. If it's gone up 150 points, they don't want to be buying it there. Now they're big enough to put, you're talking trillions of dollars traded per day. Trillions of them. They're not going to be left out. Why would they? They can push it down. This is not manipulation. This is, wow, this is high. Let's sell it. Just keep that in mind. There are little trading tips that somebody that hasn't worked on live, hasn't worked in bank dealing rooms, won't have the experience of.
Absolutely.
Any other questions, or have I bored them now already even more?
Not at all. What about the Fed? Stock markets are so dependent on Fed announcements. Do you factor that in, given what you were saying about?
You know what? Let me quickly show you why that's not the case. Okay. Let's have a look at the S&P, which is an absolute marvel of a market. What does run a market? Okay, it is people's anticipation of what the market is going to do. In August, nobody gave a thing when the market double topped. Double topped it did. There you can see August, board, down we go. We hit that 38.2 Fibonacci. There is no fundamental analysis, whether it's come from Yellen herself, that will tell you that that stock market on any piece of fundamental news is going to stop at the 38.2. What that does tell you is in an uptrend, which we're in, make no mistake, in an uptrend, and I can show you that here. Markets will find support at a level. Now, all that markets run on is anticipation of the next move. That is what traders do. We try and anticipate. So, unless that there breaks 21.95, that is the S&P cash, the market will come down. It can go here. I have no qualms about the S&P going to 75, 80, 85. For me, unless it breaks here, we're going to come back to this area here. Now, I have said, as you can see, from 2009, of course we have these things in the stock market, of course we do, but the key in the stock market was to break above 21.34, the all-time high ever. You know, when markets break all-time highs, they're not likely to puke out of sight. What they're likely to do is hold these other levels that we see coming around, and making moves to the top side, because that's the way market works. So as the Fed, does it have an impact? Of course, if it does something out of line, but if you think that the way the market moves is for people's interpretations of what may not happen, you'll see, we watched the Fed last night. Nothing come out, nothing was said, but we knew the market was going up because it told us. And now they're all looking at December, for before the end of the year, if this and this has happened. If you get 10 economists in a room working for the same bank and you give them the information that you're hearing on fundamental, not one of them will agree. Not one of them. They'll interpret it their own way. With charts, you can't argue with the fact that that is the 38.2, whether you like it or whether you don't. It's irrelevant. It's an irrelevance of life. That's what it is, and that's where it bounced from. Now, I've seen this time and time and time again. You know, I know these work. You ask anybody that works still with me, I don't take no notice. I don't even have it on. I don't have it on in the office. I don't care. The price is right. Well, there's just some spread betting companies, and then not so much. But the price is right, and it will tell you. And I'm out of time now, aren't I?
We sadly we are, but for the moment. But everybody is very pleased that you might be able to come back later on, and we can carry on. So if we can just press the pause button, if we can press the pause button, we've had a terrific response from everybody this morning. And
thanks, Simon, and thank you lot for listening. I'm really touched that you want me to come back.
It's very good. They were fantastic, says Bill. That's fantastic, says Carolyn. Fantastic. Okay, great. So let's press the pause button. So we'll just we'll resume this at what will be 1 o'clock UK time.
2 o'clock my time. Simon, do I still have to log in, or do I just keep this pause button on thing?
You can leave it open and running, or you can go out and just log back in with the same link. It's your choice.
I'll go out and log back in because I'm going to be quite busy from now till 2 now.
That's probably the best thing. So if you can come back in just about 5 minutes, 5 to 1 or something like that, and then we can carry on. 5 to 2.
All right, Simon.
That's right. Okay. So thank you very much indeed, and we'll look forward to speaking to you again in another few hours.
No worries.
Thanks. I'll take the presenter role back.
Okay. Bye bye.
So thank you very much again, Carol Harmer there. And just in case you missed what we were talking about, we have had a terrific response to Carol's talk this morning. She is a fount of knowledge and information and experience of the markets, and she has very kindly agreed to come back later on today at 1 o'clock UK time. So if you'd like to see Carol again or have any more questions for her, she's going to be here again at 1 o'clock until 2 o'clock UK time. So we'll look forward to that, and I'm grateful to her for doing that. Moving right along, welcome to Round the Clock Trader. We are just a few minutes behind schedule, and I'm pleased to say that our next speaker is waiting patiently to get started. Mike Hamilton, MD of TradeTheEasyWay.com, is a scalping trader, and he's waiting to tell you about his trading strategies. So I'll bring Mike in and unmute the mic and say, good morning, Mike. Are you there?
Hello, Simon, and hello, traders. Yes, I'm definitely here.
Oh, fantastic. First of all, apologies for we're just a few minutes over. Our first speaker, Carol Hammer, had lots of questions to cope with. She's coming back later on, but it's pushed us on just a few minutes, so apologies for that. Let's get started straight away. If you're ready to go, I can transfer the presenter role now.
Yeah, please do.
Great. So just as a short introduction to those of you that may not have heard Mike speak before, Mike's been on the Round the Clock webinar a few times, a good supporter of the events, which I'm grateful for, Managing Director, founder of Trade the Easy Way and Scalper School, as you can see on the slide there. And Mike has been a private trader. You've not been in the city. Very career, but you are a full-time trader now.
Well, that's not actually true. I have been in the city, not actually in a stock or a forex trading room. I have worked. Well, actually, when I left school, I worked on a trading floor on the Lloyd's of London market. So I had a Lloyd's ticket for a couple of years, and I've worked in financial services ever since, but not directly in an open trading room like that. I've worked with did a lot of work with FTSE 250 directors. I did a lot of work on annual reporting. All the time I was just trading my own account.
So, my apologies, I've got you mixed up.
Right.
I deal with a lot of biographies, as you can imagine, coming through, so my apologies for that.
No, that's fine, that's fine.
Fantastic. Well, let's get started. I'll be quiet, which is probably the best thing to do, and we'll go over to you now and let you get started. So, Mike Hamilton, thank you very much.
Right, thank you, Simon. Thank you for inviting me back. As usual, it's a great range of experienced traders talking. So thank you, Carol. I look forward to hearing one or two others as well. But I've got a lot in store for you. So stay tuned. We're going to talk about. I'm going to pick made, which is very valuable. But so as I get through my presentation, I'll pick up on a few points, and hopefully we'll get a lot of questions as time goes on. Okay, so Trade the Easy Way is, we'll come on to talk about Trade the Easy Way in a minute, but Scalper School has been developed over quite a while, a good few years now. The reason why I developed Scalper School is because I think a lot of people who come into trading who are still running small businesses or still working part-time, and pure and simple, I think there are a lot of people who don't want to spend too long at their screens. So I'm going to talk about my definition of scalping, not necessarily the industry norm of scalping. It's a variation of that. But I'll go into more detail as we get on. So I think this is a unique and profitable blend of tools, the likes of which a lot of different traders have talked about elements of this, but I've not seen this combined and used in the way that I'm using it. So I'm using the word unique in that sense. So disclaimer as usual, trading involves risks. I think the key is don't trade with money that you can't afford to lose. As we all know, or most of you know, this is a mind game. So trading with money you can't afford to lose is much tougher on you. So I would suggest you just don't do that. Presentation is for educational purposes only. I've got to say that because it's an important aspect of my work. Okay, so a little bit more about me. I've been trading since I left school. Obviously, as you just heard, I started life on a trading floor, not a stock or forex trading floor, but a trading floor. And it was that experience with my Lloyd's ticket that really opened my eyes to this idea that you spent all these years training in schools and colleges and whatever, but at the end of the day, when you walk onto a trading floor, it's about who's prepared to buy at a certain price and who's prepared to sell at a certain price. And that is, sometimes traders overcomplicate trading, but it's nothing more complex than that. And it's just a question of grasping that and using a few tools to get your head around that and make that your advantage. Okay, so I'm a pivot trader. Because I've been trading for so long, I've traded through a few cycles, a bit like Carol. Carol and I have been around a long time in trading, and so I even go as far as trading property as well. I don't tend to invest in property. I tend to trade it. So I was buying if you're a South Londoner like me, Bermondsey used to be the arse of London. Well, I started buying into Bermondsey in '98, just about 12 months before the Jubilee line opened, and it's just a radically different environment now around there. So I trade all sorts. I've traded commodity futures, forex futures, and of course stocks. But I day trade forex and indices. So I'm also managing director of Santander Direct. That's more of a disclosure than anything else. It's an excellent platform. The platform is based in London. The people who provide the platform are FCA registered. So take a look at that if you're interested, because it's a very efficient chart package and platform. But that's me. That's a photograph of me on the stage at Almaty. I was out in Kazakhstan a couple of months ago talking about chart patterns, and a fascinating time I had. If you've not been out there, it's 600 miles from the Chinese border, so it's very interesting. And they've just about finished a road linking them up to the Chinese, literally a physical road just linking up the Chinese market. So that's a region growing very, very fast. I hope to be spending more time out there, and of course, more time in UK and Europe when I launch my tours in the coming weeks. Okay, so Trading Easy Way was founded in 2009. We do not sell systems and indicators because systems work for some people. That's not to say you shouldn't buy a system, but I personally believe that if you are going to trade these markets, you need to know everything there is about the market. So you need to be technically proficient. And more importantly, you need to have good money management skills. I don't think enough time is spent on money management skills and courses. Just wanted to touch on that very quickly, but I think that is one of the reasons why some traders have problems, because they don't have great money management tools and skills. Okay, so scalping is not for everyone, and you have to be already a good trader. I don't think this is not for beginners. If you're a beginner, I don't think you've got just enough experience under your belt to be able to have the confidence to come in and out of these markets. So if you're a beginner and you're interested in scalping, it just means I think you just need a little bit more of a longer run into it before you physically start committing money into scalping. I think scalping it's got to be rules-based. Every trading is rules-based, but scalping more importantly, because it's so concentrated and so focused. And I think you can tell any trading, any aspect of trading, if you keep a journal, you can monitor your progress, you can look at your yield curve. It comes back to money management again. And then you can tell if this is for you very quickly, and you can tell, you can pick holes in some of your weaknesses and some of your strengths, and then build on that and train hard to develop, to increase your probability to the max. So the industry definition of scalping is 5 to 10 pips, and this is what Carol was talking about. You know, she said that she's known some of the best scalpers, and but she's also known people who, a lot of people who've blown their accounts up on scalping. So I'm not interested in 5 to 10 pips. I'm not literally just creaming off 5 to 10 pips. What I'm looking for is a 20 pip target. So my definition of scalping is not the industry definition. It's a slight variation on it. When I talk about scalping, I'm looking at just a good piece of one session, which I quite often trade around and hedge. I'll come on to that later. But I'm looking for just a 20 pips in and out, looking for a 30-60 minute period in the market, and then get out and then get on with some other work. Whilst I've got other positions on the boil. So I'm not just a scalper. I do, obviously I'm an investor and a longer term trader as well, a swing trader. So this is primarily about trading larger positions for smaller moves, and we are looking about trading the peak periods 3 times a day, the Euro Open, the US Open and the London Close. And I'll show you some examples as we go on. So best markets for scalping, obviously, by the nature of scalping, you're looking for momentum markets. So the most popular pairs with the highest volume is the euro versus the US dollar, and cable, so that's the pound versus the US dollar. They're the most liquid. Unless you've got oil really trending hard or gold really trending hard, currency pairs like Aussie and CAD are not as liquid. I mean, for example, the pound versus the CAD was in a 7-year box play, So when I did a talk on chart patterns and box plays, that was one of my prime examples of a box play. And of course, if you've got something like the euro and the pound are great because there's so much intervention that increases liquidity, increases volatility. So these are just great pairs anywhere. And I think these are pairs that you can base the development growth of your account on very successfully because of the sheer volumes and the opportunities that are presented every day. All right, the Fed rate cycle, yeah, I mean, we had a rate rise in the last year, and yeah, it seems to, I think every man and his dog expects the next rate rise to be in December. So we'll, if there's time, we'll talk about how we can play that one. One or two other coaches and trainers carp on a lot about traders not showing their account, and I think that's fair cop. So this is just a couple. I did a couple of screen grabs of my account yesterday. These, so 325, 101, 40. I think that 40 is a situation where occasionally I will scalp, and I think the bigger time frames are telling me that there's a bigger move on. So I would have got my stop just above my just to cover my spread and left it there. And on this occasion, it didn't work, so that's fine. On other occasions, that will work. This is just my scalping account, by the way. I've got 4 accounts in all. This is just my scalping account. So there's 325, 101, and then of course there's a loss at the end. And then I did a second screen grab of another period, minus 30, plus 479, minus 105, etc. Okay, so I thought it was useful just to show you what money you can make out of this. And that is actually a small account. I put £3,000 in an account, and I'm measuring and monitoring and recording, of course, how quick it's going to take me to get up to 10,000. So I'll and then ultimately multiply that. So I'll update you on that on my blog. Tools. So I said way back in the beginning that Scalper School is about a unique collection of tools and using tools in a slightly different way. Not a drastically different way, but just a slightly different way than a lot of people in the market. So we're looking at ranges, we're looking at the open range, looking at the data range. I'm going to show you what I saw in the Dow last night at the Fed announcement and how you could have traded that had you gone to Scalper School. MACDs in weekly, my favorite method of looking for key reversals. Any divergence in a weekly chart I think is very, very adequately picked up most of the time in MACD. 200 EMAs in these time frames. Obviously naked charts and pure pivots are the key, but it's occasionally, well, every now and again these markets will do a swift move off a big 200 EMA, and it's useful to know where that is. They're good guide ropes. I call them guide ropes rather than hard and fast walls. Fibs. Most of us experienced traders will talk about fibs, if not all. I mean, how can you? I don't think you can use. You can get in and out of the markets without using fibs. Personally, I know Carol believes that, and there's a lot of other traders who will talk about fibs off and on. But I use it again in a slightly different way on each of those time frames, and that allows me to find the support and resistance and the key pivots. Weekly and session pivots, come on to that in a minute, and timing. I've already touched on this a couple of times, but sometimes, particularly if you are not trading full-time, you are trying to run a business part-time or full-time, or maybe you've got a family to look after, your timing is, to me, it's just another pivot. So I don't want to spend a lot of time on my screens. If I want to grab 20, 30, 40, 50 pips in 1 or 2 sessions a day, then I need to know exactly what are the best times of the days, when the liquidity is there, and when the opportunities present themselves. Strategies. Any questions, just chuck them in, and I'll, if they're relevant at the time which I'm talking, I'll pick up on them. Otherwise, I'll save them for a little bit later.
Mike?
Yeah?
Just one question waiting at the moment. George is saying, can you elaborate the details on the hard work testing strategies you mentioned? You mean complicated Excel wizardry?
So don't quite understand the question.
So I
In
think
terms of,
previously, I think you mentioned a lot of hard work in testing strategies.
I
Which is done.
see, right. Well, yeah, I think in terms of testing strategies, I think it's about taking a strategy like this and using a journal. I think very, very few traders I find actually use a journal. Whenever I mentor anybody, the journal is absolutely central to the mentoring process. And so backtesting and using a journal, recording your trades, maybe if you're newer to trading or new to trading, then some people used to say, don't paper trade, you'll never learn from paper trading. Well, I would contradict that. I think you'll learn a lot from paper trading. It's a question of whether you're able to transfer that into a real account. But the bottom line is, in answer to the question, it's primarily about keeping a journal so you not only understand your technical skills and your trading skills, but you understand your money management strategy and the money management strategy that should be in your trade plan. So that's what I mean by hard work and testing. It's applying it to a journal that becomes your Bible and your leading indicator as to whether whether you've got a future in trading.
Okay. What about scalping? Do you use an automated system or do you like to feel the market mood? Asks Carolyn.
I have specific rules. I'm a discretionary trader, a pure discretionary trader. As I said very early on the slides, I don't personally believe in systems. That's not to say you shouldn't buy a system, but I don't personally believe in systems. What I do believe in is that you should operate your trading account with a very specific set of rules. You've got to be rules-based trading, and that is what Scalper School is about. It's about giving you a set of rules, leaving you with a specific set of rules that you can apply day in, day out for a specific strategy.
Okay, thank you. Tom says a question about your positive expectancy in the scalping strategy. One, what is the win-loss percentage? And two, what is the risk-reward ratio?
Very good questions. I like those two questions. As you can see on a quick sort of screen grab of my account, my hit ratio is about 70%. It does vary, but I aim for a 70% hit ratio, which was shown in those couple of screen grabs. And so what was the other aspect part of the question? What's my hit rate and
the win-loss ratio and the risk-reward ratio?
Win-reward ratio. Good, yeah, very good question. I go for a minimum of 2.5 to 1 risk-reward ratio. Very, very minimal. That's the very minimum. So I do look for because of the way I'm looking for pivots, because of the way I set this system up and the way I use this strategy, the potential, the risk-reward ratios are always generally higher. And I'll talk to you in a minute about why I'm only looking for 20 pips in when the potential expectation could be much higher. And that's because I'm not a pure, as I said earlier on, I'm not a pure scalper. Some people do not like holding any futures contracts or do not like holding a position at all, and they will constantly open a position, close a position, whether they're scalping or just looking for intra-session moves or intraday moves. They will not hold anything over. I'm not like that. I actually use this strategy. I use scalping as a hedge or a position building, depending on where we are in the cycle of a particular trade I'm looking at. For example, if I think the Euro-US dollar, Carol was just talking about the Euro-US dollar in the last presentation. If I think the Euro-US dollar has hit a major level of support and it's got the potential to do 300, 400, 500 pips, I will have a core position and then I will scalp around it. On occasions, if we're quite advanced in the move and there is a sell opportunity, I will short that particular instrument in order to enable me to still make profits when I've got a core position. So obviously that's advanced stuff, and that's advanced trading. But what I'm trying to say to you is, it's up to you what type of trading you want to do. It's down to your personality. There are many people out there, and I've mentored somebody who didn't actually initially didn't set out to be a scalper. Initially, he came to me for long-term mentorship, and he primarily wanted to be intraday and a swing trader. But he decided, he's quite a young chap, he had a very big account, 6-figure account. He decided that his personality was better suited to scalping, and so we developed this scalping strategy with him, and he showed me his account every week. But 3 months down the line, he had made a 40-45+% increase on his account, because he was just diving in and out, going $50 a point. Really enjoying scalping, really refining his moves, and just closing his account quickly, and a very happy man, and running his other businesses and so on. In fact, I spoke to him the other day. He set up a supermarket and still trading, still scalping. So it's down to your personality, and it's about developing, as with any aspect of trading, any type of trading, any strategy you use, it's about developing your own trading plan, fitting trading into what time you have to trade, how much time you want to give to this, and where you want to take it. But what I'm suggesting to you here today is that if you want to get in and out of these markets quickly with a specific set of rules for a specific 20 pip target per session, then Scalping School is for you. Okay, I'll carry on. By all means, interrupt me with any questions as and when they come up, Simon. That's fine.
Okay, thank you. Carry on just now. Thanks.
Okay, so some basic Scalper School strategies. I'm going to show you a live example. Of what happened in the Dow yesterday. I have a strategy for a momentum move that's greater than 70 pips and one that's for less than 70 pips. If it's greater than 70 pips, I will actually look to fade it. This is a very counterintuitive setup, but it's one of my favorites, and on occasions it's generated hundreds of pips. Last night we had a 3-wave move, and I'll come to that in a minute. If it's less than 70 pips, all I simply do is I bracket it and then look for it to break one way or the other. Open range breaks is the most common way in which I scalp. If we are in a quiet period of the week or quiet period of the year or month, you can simply use scalping with a small time frame, and you could, for example, stick a stochastic on a 5-minute chart, and if it looks as if this general momentum is to the upside, just buy dips when the stochastic is low. It's as simple as that. Breakout fades in the next session. What I mean by that is, if you've got a break in the pound US dollar, maybe it's broken down very hard, sometimes that can, the US market wants a piece of the action. It doesn't, it wants to short at a high price, wants to buy a low price, depending on where the breaks come from. Quite often, if you've got a 20, 30, 50, maybe 100 pip break in one session, it will retrace. The US will want a bargain price. They'll want to get in on the action. And so the market makers will bring that back up and fade it into sometimes the breakout rate zone. And we talk about that. We do a whole section on that. And that's very interesting. A gap, part fill or total fill. And that's what I'm going to give you an example of that in a minute. So they're the basic strategies. If you take this to another level, further on down the field, you could use this in hedging, what I call swing and sing. If you've got a core position, but what I mean by that, if you've got a core position, I gave you an example earlier. If you're really ambitious, you've got a high target for something like the euro or maybe a yen pair, whatever it is, you could scalp around that to build your account up in addition to the core position. I'm going to give away one of the the core setups on this. This is the momentum. This is the setup. If you've got a position, sorry, excuse me 1 second. Let me just get my teeth in properly. If you've had a move that's greater than 70 pips, then this is a very, very common setup, and it's counterintuitive. This is where, this is an example on, this is a Fed day move. Can't remember, I think this is the Euro, I can't remember now. Oh, it's the Dow, sorry, I've just seen it at the bottom left of the chart. It's an old chart I just dug up. This is the Dow, this is 15 minutes after the announcement. If you've had a move that's greater than 70 pips, what the market tends to do is it tends to retrace. It tends to go right back to where the breakout came from. It's counterintuitive, so you need to really sort of fine-tune this non-exposure account to any great risk that you can't afford, and so on. But this is a fantastic move, and it can be the start of a very, very big reversal in the market on occasions. I think there was 2 or 3 years ago I did this on a Dow trade. I think it generated about 2,000 or 3,000 points in literally about 2 weeks, I think. It was a fantastic move. So it's counterintuitive. So if you've got something that's flown up 70 plus points, the assumption is from perhaps less experienced traders that's just going to keep going. Wow, that's a fantastic move. Volumes come in, the market it's closed above all this resistance. That's surely going to go another 70 points, another 100 points, whatever. But if you know what you're looking for, you can use this setup to retrace back to the break up area or the breakdown area, and if you are really experienced, you can manage your trade, use money management skills to actually capture the rest of that move. There's another example. This is the pound yen. So 15 minutes after this move, it's moved from it's moved about 100 pips. It's closed 80. Let me see. It's closed 80 pips lower. So this fulfills my criteria of 70 plus pips. And you literally enter on the 15th minute after the data announcement, and you put your stop under the low of that 15-minute period. Sometimes you need to give it a little bit more wiggle room, and then it often pulls right back to where it broke out from, and on this occasion it kept running. Okay, so that if you'd used this setup, you would have got in at 180. 180 on 08, and the top of the chart is showing 182.24.25. Okay, again, this is counterintuitive. You need to know the criteria for this, and you need to know what that can do for you. Right, let's go to just have a look at what the Dow did yesterday. Right, this is a 5-minute chart of the Dow. And although I do take my entries and scalp off the 5-minute chart, as I want to just emphasize that I am very, very clued up on the big picture and all the bigger time frames, as I've indicated in some of the earlier slides. But what I'm doing here is showing you the move on the Dow last night. Okay, so the initial move, you may recall I said that some of these moves are, if they're above 70 pips, they're a 3-wave. So this is where we broke out from, and this was the initial move. This is wave 1. So less experienced traders will probably think, yeah, all right, there's a 200 EMA down here. I'll come in at 180, and I'll see if I can get that higher. Well, what it's done is, typically, as I said a couple of times, it's completely retraced to the breakout area. So that's wave 2, and then wave 3, if this is going to work, it's going to be the powerful, it's going to be the way forward. So you're basically trading it back in the original direction. That's all you're doing. You're trading it back in the original direction, and the risk-reward ratio is extremely high, because if you've got the low of the range here at 138 and you put your stop just under 130, you're looking at, if you're getting in at these levels here, well, there's 160 is where you get that's the first positive bar, first higher close at 7:35, which happens to be 5 minutes after the press conference started, which is a great time to be trading. Once you've got the announcement out of the way, you've got the press conference underway, and the initial reaction to the press conference is positive, and you've got your three-way, but technically you've got your third wave potentially starting. So your risk-reward ratio is high. If you've gone in at 160 and your stop is under 30, and you're looking for that to break that level there and go beyond, then to me that's a pretty good risk-reward ratio. If you could, if you're a fib master and a fib nut, I wouldn't mind betting. I haven't checked this, but I wouldn't mind betting that is actually a fib level. Yeah, we go up to the 161. At 10 minutes on the close, we finished at the 161 extension. So if you prefer to use fibs, then that's something you could do. I'll take that off because it's obscuring a lot of the detail on the screen. All right, but the three-way move is very, very potential. So if you stayed out of the market all day, you did nothing, had a nice dinner, don't drink alcohol on a trading day. That's one of my little rules. Have a nice glass of water, come back, have a nice dinner, and then look to see what's happened after the data, after the press conference has started, and see if you can make a move out of it. Right, so that's one good example. If you're a forex trader, let's have a quick look at the euro. Let me just quickly grab the euro up, because pretty much the same thing happened with the euro. Let me see. So we had, unlike the Dow, we flew up but quickly flew back down again. So that's the low of the initial announcement. That was the initial reaction. That was the pullback as the press conference started. This is not as liquid, not as, obviously because the London market was shut. If you want to trade the Fed day, I would suggest you stick to the Dow, because we're after a good volume, and the Dow would like to have much, much more volume. And of course, then we basically just retrace back to the highs, and then eventually, overnight, we break out. And just as the Central Europeans come to their desks, they pick it up from the point at which it broke out, and then run it up to a big number. Well, markets love big numbers. Okay, so just back to any questions from that, let me know. But that's just one of the setups that is involved in Scalper School. And you can see from that example, I said to you, I emphasized early on, it's about being at your screens less and making more, trading less and making more. So my definition of scalping is not, in for 5-10 pips here, literally firing away, risking your capital, throughout the session or 2 sessions or 3 sessions. It's about picking my spots, having smaller, precise targets, either getting in and out as a pure scalper or operating around a core position. And on a big day like the Fed day, this is one opportunity where experienced traders will be getting positioned. So you could have had a position trade and scalped around that. But the whole idea is Scalper School is to limit the time you're at the screens, get you in and out of the markets, make your money, pick your time, pick your spot, make your money and build your account. I just want to finish off with a couple of slides, so any questions I'll answer them a little bit later. Right, I've now got to, there we go. So Scalper School, why should you sign up? Because you're a good technical trader and you want to spend less time at your screens. You want to watch how a professional trades. So it's a live trading room. So we have 3 2-hour sessions where I just lay out all the rules, I lay out the strategies. We do simulated trading, of course, and then we talk about how you can develop a trade plan around that, and then why else should you sign up? Because you're looking for bigger moves, but perhaps want to just build your account around the core position. You want to maximize the position. I personally, if I've got a core position and I've got 300-400 pips, and something's pulling back 100 pips, I always, it doesn't matter how many years I've been trading, I still feel a bit sore about giving back 100 pips. Well, if you scalp around the core position, you can still be making money as that's pulling back. And we all know, if you're an Elliott Wave fan or a FIB fan, that a good trending market will retrace at some stage in a significant way. So if you want to hold that core position, you don't want to mess around that core position, this is one way of building your account. Otherwise, if you want to be a pure scalper, and there are a lot of pure scalpers out there making good money, if that suits your personality, just to get in and out, not sit there with a position, then this is for you. So what do you get for your money? So it's £450 for the course. It's a 3 2-hour sessions online. We start on Monday. We've got to start at 11 o'clock because I've got a lot of people on Eastern time. I've got a few people on Eastern time signed up already. So I will ordinarily start a bit earlier than that, but I'll let them get out of bed first. So it starts on Monday, 11 AM, online. And what you get for your money, you get clear setups and clear chart preparation routine. We then have 3 live trading sessions, 3 Euro trading sessions, where we're going to make your feedback, or depending on the size of your account, of course. And then if you still need support, and I often find hardly anybody ever takes me up on this, but I will offer you a 20-minute one-to-one after the course, just to clarify anything, just to iron out any questions you've got or any issues you've got. But I always offer that on a course, or if it's a longer, more expensive course, I offer more than that. And I'm always constantly surprised that hardly anybody ever picks me up on that. But you're more than welcome to do that. So it's £450. Yeah, I'm not a salesman. I'm not going to start discounting it and dangling carrots in front of your eyes. All I will do though is I will offer you a month's full membership. There's a little bit of a carrot, so that you get daily videos of my full weekend preparation. And were you a subscriber, you would have heard me talk about the potential setup for the euro to do what it's done today or yesterday, whereas a lot of people were very bearish on the euro. And yeah, I'll drop the links into the room so you can go straight to the Scalper School page. If you want to have a chat with me or drop me a line, then you can pick me up on Skype or drop me an email on mike@tradetheeasyway.com. So what I'll do in the meantime is probably look at a couple of other examples and take questions. But that's the main part of my presentation. But I'm happy just to elaborate on a few current charts and go into more detail.
Okay, Tom says your stop loss is at around 8 pips with 2.5 to 1 risk-reward ratio.
Yeah, I talked about on that Dow example. I said, if you really want to keep your stop out of trouble, then keep it right underneath, a support level. But if you if you don't want to risk that, then just literally pop it underneath the. Let me go back to that example. Pop it underneath the low of the announcement. You don't have to have a stop that deep. So let me just pick it up. Here it is. Yeah, I think if you've got something that's come, a lot of traders, you can see a lot of traders have just front run the low of that announcement. You could literally just keep your stop under I would have no problem at all with trading on a big size. I would have no trouble at all just trading under 130, putting a stop under 138 and leaving it. If you want to really keep your stop out of trouble, maybe just lower your position size and give it a little bit of a wider berth. But you know, it's a momentum setup. You know, I do not want to give myself too big a stop. That's a very good point. I mean, I'm glad you picked me up on that. You know, you don't have to sit there with big stops with you know, big exposure. This is you know, a good setup, and it's entirely up to you what you want, you know, what you feel comfortable with. But you just need to know in your own mind, your own trade plan, exactly what you're going to do, so you're sticking to your rules every time you trade.
Tom goes on to say, how do you deal with spread, bad fill, and so on? Do you use market order or limit order or a buy stop order? Do you?
I do tend to just, before I trade this, I've got a very fixed plan in my head of what I'm going to do with this. So, as an experienced scalper, you know, I've sat through many Fed days. I will sit there with a naked chart like this. I just let all the main volatility, the initial volatility, get out of the way, and I will sit there and pick my spot. So I will actually go in on that low. So I've got a very tight stop from the outset. If you're less experienced and you want to wait for confirmation, then you're going to have to go in higher and have a bigger stop. But I personally will go in at the low of that second wave because I'm experienced, because you know, I've got a fixed plan in my head. I'm prepared to put X amount of money on the table on a setup like this and risk losing it. And that's, to me, that's the essence of this type of scalping. If you're not prepared to do that, or if you're not experienced, not happy doing that, whatever, you've got two options. Either you don't scalp, or you go in the smaller positions with bigger stops. So, like I said, I think in all, in a lot of people's, a lot of courses you go on, money management is all nearly just about 99.9% in most people's courses. But money management is never, in my mind, never given enough time and space in training courses. And if you are to be a professional trader and manage your emotions, then you need to have a very fixed plan before you go into a situation like this. So it's my experience that leads me into that. I can ask somebody a general question about this, actually. Can anybody, let's see just how much somebody listened to the previous presentation and see how much they watched at one of the slide I did. Who in the room can suggest why the market dipped to that low in the Dow that's shown on that screen? What? Anybody suggest why that low of the session, not the low of the announcement, but the low of the session, was bought? Let's just see how many. If we've got some experienced traders in the room. Any answers coming in?
Alan saying the previous low. Arthur says the profit taking, stop hunting, pull back to the previous day's close. Says Christopher.
Christopher's on the button. Christopher gets the gold star. That was a gap fill.
Fib levels says Tim.
I did mention that in strategies in one of my slides. So I actually shorted that and then left it and then picked that up on the second wave. But that well done, Christopher. You're smack on. That was a gap fill. And as you saw that on my strategies. That's a key part of what I do. In fact, let me just show you this other slide. Sorry, this other chart. That's what my chart looked like on a 15-minute. Okay, just to make the point. Now I have two gap strategies. This is just one gap strategy. The other gap strategy is much more profitable than just a intraday gap or previous day gap. But that's part of the Scalper school. Any more questions?
Yes. Now, on the course, how long does the course run for?
It's Monday to Wednesday next week. It's 3 2-hour sessions from 11 till 1, and then we have well, basically what you've got a month's worth of Euro sessions. Because I'm giving you full membership, you get a month's worth of Euro sessions. So the absolute answer to the question is the course runs for a month.
Okay. Will all the sessions be recorded?
Yes. The teaching, you'll have access to your own part of my website. Here it says my account, and on that you will. So this website is not finished. I don't like all these pictures, but anyway, what you can see is if you've been on the Scalper School course, you'll be able to get access to your course, get access to the recordings, and then go and revisit them.
Okay. Where do people sign up for the course if they want to move
Right.
on to that?
The best thing to do is to go to the Scalper School page. I'll send you the link. If you want to sign up for the course, just go onto your pay through PayPal here. So click on the register it. I will pick up your email address from there, and then I'll send you all the details, confirmation, and preparation, and so on. And then you're signed up.
So this is quite a personal approach. How many people typically are on the course? Just out of interest.
I cap it at 20.
Okay, so it's a very small.
It's a small. I never do. I don't like big courses because I'm offering post-course mentorships, albeit 20 minutes. What's happened there? I don't run big courses. I don't like big courses. So there's plenty of time for you to ask questions, plenty of time for interaction. And I have to say, I've already sold 7 slots. I've got North and South Americans coming to the course already. So it's the first time I've done a proper announcement in the UK.
Fabulous. If you can post me that link, I'll repost it.
I'll do that now.
Everybody that's here. Just while we're doing that, if we can go back to the trading, George says, what does discretionary trading mean compared with system trading in your interpretation?
Discretionary basically means, I'm pressing the button. I'm not. I've got an automated system that's or A, sending me an alert, or B, filling my looking at my entries. I'm literally making the decision. I'm pulling the trigger. I'm in control. It's my discretion whether I trade or not.
Okay. Do you trade outside gaps to look for an extension of the gap?
I'm not 100% certain what's meant by that. All I would say to that is...
he has followed it up. He says, for example, outside a gap up, expecting further upside during the day.
I think what I would say to that is, I did mention on the strategy slide that I'm interested in gap fills and part gap fills. If otherwise, I think that the simplest way I can answer that question is if just basic support and resistance. If a market is holding a certain level and looks as if it's not going to fill a gap or part fill a gap, and there's some buy signals there, then yes, I will look to get a position at that higher level. I still don't. I think in this environment, I can't fully elaborate on that because I'm not certain what's in your mind when you're asking that question. But hopefully that helps.
That's fine. We'll move on. Can you show us another setup on forex with stop loss taking profit you've already taken recently? Asked some. Do you have any?
Taken recently? I've traded. I have to say, I've traded quite lightly over this week because of Fed. Yeah. Okay. I'm a great fan of the yen pairs. I love this. I'm actually looking for a lot of upside in this pound yen. But I won't go into details now. But you can. What I did was I did actually. This is bottom picking, I have to say. I did like the way in which this was performing yesterday, and I did scalp this off of this level. I think I just took that move there. I just took it up to that resistance level. I think from memory I got about 30-40 pips out of it. I was thinking, I was looking at the charts, but I didn't want to take a position on this because I'm so busy at the moment. I don't want to trade when I can't focus. I looked at this chart and I thought, yeah, when I come back to my screens tomorrow, that is going to be up to this level, up to this level. Like I said, I'm actually a big pound yen bull. I can't get into that here. Anyway, that was a position I took yesterday lunchtime at the US Open into US reversal time. Because I'm a big, I'm just very briefly, I'll just throw this in. Because I'm a big fib fan, as are most of us as experienced traders, I like three-wave reversals, and this to me was a classic three-wave reversal going on in a small time frame. But I had other reasons for being bullish in the bigger time frames as well. I thought that was a nice chart pattern. There's great structure in that chart, even in a small time frame. But that is bottom fishing though. Be very, very wary. This is pound yen has had a really tough time. Sold off from 138 down to here. So don't start bottom fishing unless you really know what you're doing. I knew what I was doing, so I was happy just to sit there for a short period of time and just grab a little move out of that.
Okay, maybe just time for one more question. Do you trade the news at all?
Well, yeah, the example I gave you of the Fed is obviously my favourite period in the month or the quarter. Yes, I do. Yeah, one of the strategies I mentioned was if you've got to move. Let's have a look. Let me give you an example. And on the strategy page I showed you, I said if the move was less than 70 pips on a data announcement, I would bracket it. And this is the pound US. Where are we? Let me think back to early in the week. I will bracket that period literally the 5 minutes after the data came out. For example, let's say, for example, I can't think of specific times. I'll just grab a slice of this chart.
What do you mean by bracketing, Mike?
I'm just showing you. If this was, let's say there was a piece of data at this period here. Doesn't matter. Forget what time it is, the specific time. If that was a data announcement, that's my bracket. So I bracket the high and the low of that data announcement, and then wait to see which way it breaks. That's a very old-fashioned, primitive way of handling data that a lot of traders use. So you're not looking for what the data is. You're not interested in what the data is. It could be a wonderful piece of news. It could be a very negative piece of news. But you know, all you and I have got to be interested in what the market thinks of it, and whether the buyers are coming in or whether the bears are coming in. So that's why you just bracket it and just watch where it moves.
Okay, Mike, we're just up almost at 11 o'clock now, so I think we'll pause there if we can. So
Okay.
I've posted that link into the chat box, tradetheeasyway.com/scalper school. So if you want to learn how to become a scalp trader, courses starting next week, online courses, series of online courses over 4 weeks with my small group only. We'll follow up as we normally do with the emails following the event with all the various links. So if you don't get this down now, we'll be able to you'll be able to catch it on the email tomorrow that we send you. In the meantime, I think we'll wrap it up there and say Mike Hamilton from TradeTheEasyWay.com. Thank you very much. Mike's just posting his email address there.
And all hope you have a good day. Thank you very much, and great to be here. Thanks.
Okay, I'll take the name back now.
Bye for now.
So thank you, Mike Hamilton from Trade the Easy Way, Scalper Trading. That's the style that Mike's found successful for himself, and he's open to teaching you how he's done it as well on the online courses. So moving right along, welcoming everybody who is here in the webinar. I presume just a quick check. It's Simon Campbell here. Welcome. This is Round the Clock Trader. I know we've had almost another 50% of people joined in the last hour. So you've been listening to Mike Hamilton, our second presenter, and we are now just about to move on to our third presenter of the day, our 12 speakers who are going to be talking to us live today at the webinar. If I could just ask one or two people saying they're having problems with sound this morning, would it be okay to ask you to get a straw poll of just using the letter Y as a yes to confirm if you're hearing me okay at home just now? Okay, wow, thank you very much. Well, instant poll there. Ian, I think the sound must be localized with your system, unfortunately. You probably won't be able to hear this, of course, because you're having problems with your sound. I will message you back. Everything else looks as if it's running okay with the technology, which is good news. For those of you that were in earlier on, Carol Harmer, just to remind you that Carol is going to come back at 1 p.m. today. We had a huge response to her talk. She is full of great information and insight, so happy to say that she's coming back to continue that talk at 1 o'clock till 2 o'clock, so check back in for that. But moving swiftly along, delighted to say George is back again, George Hallmey from Click Events, regular contributor to the events and always a very popular speaker. I can tell from the response and from the uptick in attendance that we get when George comes on. So let's go over to George and welcome him into the event. Hello George, I've unmuted the mic now, so good morning, are you there?
Good morning, Simon, good morning everybody. Good to be with you. Hopefully you can hear me reasonably well.
If we can just let's ask people to use that. Thank you. Yes, I think everything's working. That's great. Lovely to have you back. I know you were with us last month as well, and just nice to have you back again. The swing trading. We've just heard from a scalper, but you would be more of a swing trader. Is that correct?
Well, yes, I am these days. Absolutely. Yeah. Now,
well, that's what this day is all about. It's all about looking at all the different flavors of trading, the different styles and strategies, and once people get an idea of all the different strategies, you settle down, don't you, to a rhythm and see what works for you. So we'll go across to you now, and I will make you the presenter if we can confirm the checkbox.
Very well. Yeah, I just need to click on this. And hopefully you can see my screen.
We can see the screen fine. We're looking at the traderclass.net website.
Right. Jolly good. And my mugshot over there on the left. Now, I've been around it for a few years, and I've been around the tracks a few times. And my mugshot actually is now. I must update it because I've actually got a few more grey hairs now than you can see on that little picture. And as the as time moves on, the years advance, then we sort of look back on what we've been doing, particularly trading-wise. And there was a time when I was a fast and furious, not exactly a scalper, but certainly an intraday trader. And I was putting in the hours in front of the screen. Then after a little while, I started to sort of think, well, is this what it's all about? And there was a turning point for me, actually. I did some work with a presenter over a couple of years, American guy, and he would come across from the States to London, and I sort of sat down with him at one point. He said, I'm thinking of giving all this up. I said, well, what are you going to give up? He said, I'm going to give up this trading game. And he did. He actually gave up trading. He gave up sort of seminars, although he was a successful trader. And the turning point for him was that in the basement of his house, he had his trading room. It was an airless room. He didn't have any natural outside light, and he would spend his time in this room trading. And he was okay. It was good. He was making money. His wife gave him an ultimatum. She said that ever since you've been a full-time trader, you've got no time for me. You've got very little time for the family, and she said it's going to be the trading or me. and that was a turning point. In fact, it certainly struck a chord with me at that time, and it struck a chord with him. He then took a much longer term perspective on his trading, as he decided he didn't want to leave his wife or her to leave him, and he did all sorts of things. In fact, he enrolled on various programs which sort of run in the States, and he went across to all sorts of places offering his services as a tutor of all sorts of things. And he was a business tutor and would show people in sort of Eastern Europe how to sort of set up and run businesses and so on. And in between it all, he then converted himself to longer term trading. And it turned his life around because he got out of that little garret, he got out of that little basement room, that airless room, and he got his life back. He got his life back. Now, I hear stories of people who get absolutely hooked on intraday trading, and they find themselves almost a hostage to it, in that there they are trading away, feeling that they've got to do more. They've got to do more. The sorts of things that worked in sort of real life, in work life, where you make more phone calls, you work longer hours, you do more of this, you do more of that, and you do a bit of politicking to climb the greasy pole, only to find that the world of trading doesn't actually work like that. It doesn't necessarily make you more profitable to put in longer hours and to do more trades. And I've certainly experienced this myself, in that you can end up getting cabin fever, and the judgment starts to go if you're not very careful. So what I'm actually, I still do a little intraday trading, but not so much. And I actually realized that, well, why am I trading? Well, I'm trading to make money primarily, but I absolutely love it. I enjoy trading like crazy. I don't want to stop trading, but I do want to have a decent life. And since well, I've been sailing for many years, and since I want to spend more time sailing, then I'm going to spend less time trading, and consequently, you know, all the fast and furious stuff of wanting to put in sort of 12, 14, 18-hour days looking at the markets. Well, I found it was becoming counterproductive. So I've switched more to a swing trading mindset. So I'm taking longer term trades, and I am not locked into needing to look at the screens. I can just go and shoot off any day that I want to. If I feel that I don't want to get involved in the markets on a particular day for whatever reason, then I don't feel the withdrawal symptoms. I just go off, go sailing, go walking, go off to wherever I want to go, and it's my work-life balance now is excellent. It's excellent, and it really came about from that conversation a good many years ago. It took me a while after that conversation to really see the light, and what I actually found when looking back on my trading account was that less trading equals more profit. I am less frenetic in my trading than ever I was, and I don't think my broker's entirely happy because they're not making as much money out of me as they used to, but I am making more money out of the markets. So scalp traders can very often get into a spiral of where their brokers love them because they're trading like crazy. They kid themselves that they're really doing exceedingly well because, you know, they're catching every little twist and turn, but they're also catching every little loss and so on. And I would ask you all folks just to look at what you're doing, and if you're finding that you're getting a little bit like that guy, you're getting a bit of cabin fever from time to time, and your significant other is not at all happy with you being buried away looking at the screens for far too many hours a day, then perhaps it might be an idea to look at a different way of doing it. And that's certainly what I found. Anyway, let's get to the markets. Let's get to the markets. Now, what have we got at the moment? Well, we had Janet Yellen talking to us last night. In fact, if you pop over to Bloomberg, you can pick up, certainly the main points of her discussion, her talk that came after the Fed funds rate, which was not going to be moved, of course, as most expected. And it's a fascinating sort of discussion that you might want to listen to. Others are going to find it a little bit of a bore. But quite simply, what we are in at the moment, we are in an election year. And in an election year, what traditionally happens is that of the 4-year cycle, we find that the markets are going to be strong. And we've certainly found it this year. This is the S&P 500. And as we know, the market has been going absolutely crazy. The monthly chart, you know, since the crash 2008, then it's just been a one-way bet, and then we've got QE, etc., which has obviously pushed an awful lot of money into the markets. But let's just come down to in the recent history. If we just look over the last 3 months, then the volatility in the market has just dried up. In actual fact, it's been, in terms of volatility, the quietest 3-month period that there has been in the main markets. Now, the market then has been encouraged to stay up, and one of the things that is encouraging it to stay up is the absence of interest rate rises. Now, we've had a lot of talk from Yellen. It happened right the way through 2015. It's happening right the way through 2016, in that there's been watching the Fed statement, and the Fed statement that comes out sort of every month or so has been will they or won't they, and they had one little sort of rise of interest rates, and then they haven't, So this year has been a real, again, an expectation that the US economy, they tell us, Janet Yellen and crew, that the US economy is going great guns and it's reaching liftoff, quite whatever that means, and employment numbers could be better, but they're looking really quite good. This is the story, this is the narrative that we are being sold. And all we need to remember is we are in an election year and the market will not be allowed to tank. It will not be allowed to collapse in an election year. Now, we are getting towards the end of the election year because it is now not all that many weeks away. And in fact, you know, by the end of November, it'll all be done and dusted. So what happens following the last year of the election cycle? Well, the markets tank. They usually do. Why is that? Because the new president can blame everything that is not right in the economy on the previous president. Happens every time. And consequently, all the excesses that were built up during the latter half of the election cycle then can be purged. So look forward to 2017, folks. And I guess we're going to find the stock market starting to tumble back somewhat. So that's the way it works. Now, there's always plenty of news out there to frighten us, and of course, a lot is being talked about the banks. What's the next crisis going to be? Well, Deutsche Bank is in a parlous state. Some of the Italian banks are just totally insolvent, and all we need is something of a tick up in interest rates somewhere, and it might be a technical tick up that starts to increase interest rates, and when that happens, that's when we probably really do need to worry. And then what about China? Let's not forget China. China, which has got, let's just look at a chart of the yuan, or the US dollar against the CNY, and there's been an awful lot of talk about China devaluing, and that's what happened. If we just look back on here, we can see that the rate, the US dollar rate against the China rate, has really gone up. So that's effectively a devaluation of a currency. And a lot of hedge funds were on this, and there we are, we move in 2016. It reached a peak, then it came on, but the narrative, the talk has been that there will be another big devaluation. And the number is, I think there was a number banded around, if it gets up to, if this rate, which is currently, as we can see, around about 6.6 to 6.7, if it gets above 7 and 7.2 is where it will have a major effect on the rest of the world economies. So it's marking time, and I'm just watching this chart, and do you know what? I'm really skeptical about the fact that it just might go up to 7, and so we've just got to keep watching this. So the China problem hasn't actually really manifested itself yet. Could still do it, but the longer we find that this chart is moving sideways, the better for the rest of the world economy. So as you can probably guess, I sort of take quite an interest in money flows that there are, and you know, I'm a bit of a bore when it comes to listening to Janet Yellen and what comes out of Japan, etc. But I find that it gives me just quite an interest and a little bit of an insight into what is actually going on with the currencies, and that's what I predominantly trade. Do trade one or two other things, but these days it's probably sort of 90–95% of my trades are going to be on the currencies, and the remainder of them will be things such as these indices. And I've had to train myself not to short the stock market. indices, not to short them. The markets go up and they're being massaged up, and so it's the upside that we need to trade. I mean, that said, I've taken 1 or 2 short-term trades in the DAX, which is a wonderful shorting market from time to time. But also, when we get this sort of move, where we get a big gap down, all that happened in July, and we then get some wonderful runs that move on up. Now, this one yielded, a good many points. And by using a couple of simple indicators, which are really just picking up what the momentum of the market is doing, then we take the trade. And I've got a little indicator down here which tells me once it's above the zero line, then we're predominantly in an uptrend, and that's the way that we should be trading it, on the upside. And then it turns turtle, it gets in front of itself, and then it starts to tumble down. And at the moment, it's telling us that we could well be in something of a downtrend. So we just follow this activity index, plus what is going on with price action, and we use this very simple swing trend. And when it's green, we want to be long. When it's red, we don't want to be long. Simple as that. And just by following a little bit of common sense, understanding what is going on with price action, and this is one of these classic higher lows. It's a little multi-point reversal, or a 1, 2, 3 pattern, where we get price that goes to a low, it takes off. We get the first big breakout. Never trade the first breakout. Wait for the pullback. We get the pullback. We get a nice little candle price action set up, and it tells us, well, yeah, we really should be taking the long. Despite the fact that all those so-called news commentators are saying, no, it just gapped down, it's going to collapse, going to collapse, going to collapse. But no. The market tells us something else. And there are so many times when we've got to completely and utterly ignore what those gurus, what those soothsayers, those Bloombergites are telling us, and the various financial journalists who so often really know nothing about finance. Good journalists, yeah, but just ignore them. Just ignore them. And you can catch moves like this. So there we are. That's the DAX, one of the best trading vehicles that there is. The other stock market one, in fact, I've just been listening to the end of Mike's talk. Excellent talk, by the way, Mike. And it's the, Mike calls it the WS30, the Wall Street 30. But the Dow is an excellent trading vehicle. And again, there are umpteen moves which we've managed to catch from time to time, and it runs in exceptionally good trends. Now, what else do we trade? Well, I'm looking here not at any currencies at all, so I'm really just starting sort of backwards, as it were. But the other thing I do trade from time to time is WTI, and you can sort of see these moves on up. It's the standard US oil contract. It's West Texas Intermediate. It's a light, sweet crude oil. It's lighter than Brent crude, and so it's a very popular one. And this is the contract to trade. And obviously, over the years, we've seen some massive moves in crude. So crude responds very quickly to the various crude oil inventory numbers, etc. And of course, what's going on with OPEC, and of course the general world economic downturn that we've had. Now, let's move to a currency, which is the dollar index. Now, the dollar index has been moving on the weekly chart. We can see, has it really gone anywhere? No. Let's move out to the monthly. Well, it had a big run up. It had a big run up, 2014-15, but then it's been going predominantly sideways. It can't make its mind up whether it's going to be really strong and go back up to these previous peaks, or indeed if it's going to collapse. So we're we're in an interesting area, and those who've studied chart patterns and so on will look at this and think, oh yeah, you know, that's is that sort of double top, or could it be a head and left shoulder? It seems to be a combination of two there. That's the peak, that vertical line. And could we be experiencing a top forming? Well, yeah, for about a year, just over a year, we've been looking at this. There will be a breakout at some point. At some point. Now, which way it's going to break, who knows? Who knows? But it will in the fullness of time, and then we will get some really, really massive currency movements. Now, something that responds to the dollar, and of course, we had the announcement yesterday that they were not going to increase rates right away, and predictably, the dollar has come off. It's come off. And when the dollar drops, the likes of gold and silver take off, and what we're waiting for right now is this overall pattern that looks on the monthly chart going right the way back there to 2010. It's looking very much as if it is building a base and is ready to really take off. Now, well, looking at the weekly and then down to the daily, we've had one or two moves on up. Now, this is very recent. This is just last month, where we had a signal that came through and said, right, buy it. Bought it. Now, it was short-lived. It then came back, and since then we've had another buy signal. So, bought some silver, and we'd run it for a series of days. Sometimes these trades go for weeks and months on end. Gold is very, very similar, but they are both precious metals. That's looking out to the longer term, and we can see that we've had this big run up. This was the run up to just shy of 2,000. It's come back, came back to just above 1,000, and we're now stuck in this sideways range. Again, we're just waiting now to see what is going to happen. But when I'm trading precious metals, then you know what? I much prefer silver. You get much more bang for your buck, and the trends really do run. Silver, once it gets moving, it's got enormous potential. There's a ratio called the gold-silver ratio, and at the moment that ratio is at a very high number, and that suggests that silver is very undervalued in relation to gold. So if we do get a really big move up in precious metals, silver, without a doubt, is the one to be on. So let's just go and look at some of the potential of these currencies. Let's move back, and let's just move back to those that I probably trade more than any others. Let's start with the euro. Now, the euro against the US dollar, well, let's put a longer term perspective on it. We've had it tumbled right the way on down. There was a lot of talk that it would reach parity with the US dollar. Hasn't happened yet, but again, if we go way back to the end of the tech boom, you know, remember the old tech boom there, where stock markets, the tech stock markets seem to be just going in one direction only, and a lot of people made a lot of money as it was going up. And then we get the year 2000, the market tanked, and those people who made a lot of money thought that, oh, just a little correction. And do you know what? The majority of people just lost a lot of money. So anyway, that's a low. It ran up, and we're at a bit of a halfway house now. Nobody's really too sure as to which way it's going to go next. But this overall chart suggests that there's quite a bit of downside potential. However, we're not particularly worried about that. All we do is to follow these indicators, and when we've got this activity index pointing up, blue histograms, and the swing trend turns green, plus we identify some real simple price action candles, and we look at the overall pattern and think, oh yeah, this is one of these multi-point reversals where we've got a low, price does a breakout move higher, it then dances lower, catching, everybody's getting confused, and then it puts in a higher low, and the higher low gives us a buying opportunity. Candle action confirms, and we run it up, and we run it up for a few days, and there we are, it comes to an end. So we take our profits, and then we do it all over again in exactly the same way. In fact, it even gave a short-term trigger this morning with this move, which has taken off as a result of yesterday. So these moves, they're not difficult to find, and it's a very, very relaxed way of trading. In fact, I've been away a couple of days this week, and I've just been monitoring this on my phone, what's been going on. And when I'm away, I can just make adjustments to my stop losses, stop profits, and it's very relaxed. I do not need to be a screen watcher. Now, what about cable? What about pound against the dollar? Let's just look at this for a moment. We've had a number of runs that have worked really quite nicely from the lows. Now, along came Brexit, put the fear of bejeebers into absolutely everybody. And the great and the good. How many economists was it? Every notable economist, or at least those who had sort of all sorts of vested interests, went along with what our dear old central banker, Mr. Carney, Mr. Canadian Carney, sorry, I mustn't be at all pejorative, but and as for our wonderful Chancellor Osborne, it was all going to be total mayhem. Of course, it didn't happen. So whenever there is a cacophony of the great and the good and every commentator under the sun telling us that something is definitely going to happen, it's not. just think the reverse of what the majority are telling us, and that is most likely to happen. So it may well still decide that it's going to tank pound against the US dollar. In fact, it's quite a useful thing in terms of economics to have a weak currency, because it helps our exporters. It discourages imports because they become a little bit more expensive. It helps the balance of payments. And boy, oh boy, does the UK need to improve its balance of payments. It is dreadful. It's dreadful. That's one of the reasons why the UK desperately needed the inward investment on the recent nuclear power station from France and China in order to help our general balance of payments. We needed that income, we needed that money coming into the UK because our balance of payments is so dreadful. I think it had very little to do with the fact that we needed the power station, because as we know, this power station is unproven technology. Not one of them, this design, has actually managed to work successfully yet. So there was certainly plenty of red flags on it. However, what we've actually got here is a pattern. We had several little runs, nice little runs that we managed to pick up. Again, not overly difficult to get. We don't get it right every time. In fact, I'm hard pressed to get 50% of my trades in profit. In fact, I'm just under 50%. But what we make sure is that we make an awful lot more when we get it right than we lose when we don't get it right. That's the secret to good trading. Applies to scalping, whatever sort of trading that we're doing. We've always got to make more when we're making when it's moving in our direction than we lose when we're not winning. And there are several ways of doing that. We have got rock solid money management, which means that if ever we got a loss, we're going to take that loss. We just take it, and we don't second guess it. We don't think about it. We just take the loss. We don't internalize it. We don't get emotional about it. We just take the loss. And then the other side of this coin is that we don't take a profit too early. Now, scalpers tend to take a profit when they got a profit. With swing trading, we just let it swing. And the indicators then tell us when it's no longer swinging, when it's just about to come back the other way. Now, I just want to point out a pattern, and this is going a little beyond the basic swing trading, but if you look at this, we've got a zigzag zig move up, and we've got a zigzag zig move down. And look at this, just this week, we've got these two candles that could be bottoming candle days at, and you note that it says GART. Well, that's the Gartley level. So in addition to just looking at those basic indicators, I always also keep an eye on what is going on with Fibonacci and the waves and how these patterns are forming through. This, at the moment, is a valid Gartley pattern. It's a valid Gartley pattern. Now, if this follows through, then we can expect price to run up to this sort of 34.30 level and considerably, well, a fair way beyond it. We'll know that it's not going to happen if price drops down below the low of this week. But we're just keeping an open mind. Depending upon where this closes today, it may well have triggered a long. We've got to wait for that. Might have to wait till Monday. And that's what a lot of this style of trading is actually about. It's sitting tight and waiting and not jumping in. So there's a bit of sitting around. You know, there are times when I'm completely flat of the market for days on end. And you know what? It's the most difficult thing to do, doing nothing, just sitting there waiting for the right setup to present itself. And if we've got the wrong mindset, in fact, if we've got that mindset that we would have in a normal job, you can't just sit there. The boss is going to say, do something, get on, and this, that, and the other. Things will be found for you. And that is the most difficult thing, certainly for intraday traders, to do. And that is nothing. But I'll tell you what, it avoids me taking trades which turn into losers. So in that respect, it can be very profitable doing nothing because I'm just preserving my account. Now, euro against the GBP, been in and out of this. Look at this. We've had some fantastic runs, you know, 800 pips, another sort of 600 or so, and it's given us, and it's still giving us. We're in this trade, and I say we are in it. In fact, the main account that I'm running, which is sort of various little sub accounts, but I've got some family money just running on this at the moment, and we're just running the trend. We're just running the trend, and as the trend runs on up, you know, green line, activity index, pointing upwards, we just stay with it. We just stay with it. Now, this might turn at any moment. We just don't know. And in order to preserve our sitting profits, you see this red line at the moment. That's where my stop currently is. It rolls up with the price. It's a trailing stop, which I just run up behind key days. And quite simply, if we look at yesterday, look at that. That is an harami day. It's an inside day. Now, inside days are a little like dojis, where it sort of opens and closes without any really strong indication of trend. and the following day frequently will show us where the trend is going. At the moment, it has now broken above yesterday's high, and it's moving up. If it were to break below it, then I would be out of that trade. My stop profit will trigger, and I'll be out of it. Because if it went, now that it's gone higher, and if it went lower, that would be a bearish engulfing day. Could still happen, of course. Could still happen, of course. So that's why I've got the protection on. So there we are. There are one or two markets that go absolutely like crazy. And one of the things we really have to do, I just really want to doubly emphasize that we just have to let these run until we get the signals. This is the Australian dollar. Now, I'm just going to run this out so we've got this monthly chart. Now, if you just remember back, one of the first charts we looked at was the Chinese currency. Now, Australia is very dependent upon what goes on in China, quite simply because the big boom that China had seen was on the back of aggregates, largely, where China was buying up fantastic numbers of building materials, etc., aggregates and so on. And, that was one of their closest trading partners. Plus, it's a gold currency, so we tend to find that the gold price will also affect it. So we've had some massive swings higher. And then we get this massive move on back down on the back of what was going on with that Chinese currency deciding that it was going to maybe devalue. And so people were starting to get frightened about the Australian economy, thinking that it could be a big problem there because of the China slowdown. Well, we then had the recovery this year. There we are. That's towards the end of May. We've had price sort of meandering up, but it has now faltered. And again, anyone just looking at this pattern will say, oh yeah, are we looking from this point to the right at a potential head and shoulders? Possibly, because this uptrend has started to falter. And if we look at the bigger picture from right the way over here, then let's put a Fibonacci grid on. Oh, look at that. It's come up to not just the Gartley, but the bat level. A bat pattern could be at play here. And so I'm just keeping a very open mind. While it's running on up, I'll do what the indicators are telling me to do. And then I'm also keeping in the back of my mind what I've just been looking at and thinking, yeah, but this might at some point turn into the short of the year. So I'll run it, I'll respect price action, I'll respect the momentum moves, but I'll keep in the back of my mind that there could just be a bit of a problem with price trying to get itself much above the 77 region. But anyway, the Australian is an excellent charting market. It respects Fibonacci. It's also very good intraday. Very good intraday. Now I'll just mention the US dollar CAD. This is an oil currency. The Canadians, as we know, they produce, or at least they find an awful lot of oil coming out of their shale sands, tar sands, etc. And of course, they've got there's a lot of encouragement which has been held back by the low oil price to dig some very deep wells off Alaska. However, anyway, it's an oil currency. So if the oil price is coming down, then that's going to be not good for the CAD, but it's going to be good for the US dollar against the CAD. And consequently, we look at these runs, just kept on running, running. Some massive moves. And then once the oil price starts to falter, what do we get? Well, we get a bit of uncertainty. So we get it catching every little twist and turn and just coming down now to the daily charts. That's exactly what we've been getting. Have been long. It took a run up. And yesterday it said, right, no, this run has now come to an end. It's come to an end. Overall, we're waiting for a longer term breakout. Now, let's just mention a couple of other currency crosses. In fact, I was chatting to various people recently, and they say, currencies? Oh, no, they're going nowhere. I said, well, hold on a minute. Have you not been looking at some of these markets? We have had a fantastic year on currencies. Now, the Australian crosses have been around nicely. Again, we've got figures going long. Just a question of just jumping on this, respecting what the indicators and the candles are telling us, and we can get these moves of, well, sometimes massive numbers of pips. The Australian against the New Zealand runs extremely well, and well, the signal over here. On down just over 300 pips, came to an end. It triggered along. Let's look at some other crosses. And the pound crosses have been fantastic. Absolutely fantastic. Let's look at pound against the AUD. You can see that was had a run on up. Long term, we've had some massive moves. We obviously have these swings. We've been in and out of these swings on the night, but just look at how they go. Well over 1,000 pips on some of these runs. And again, what are we got to do? Nothing. We just have to sit tight and let the market do what it's going to do, and just try to keep us out of the way. Because so often traders, we're our own worst enemies. How many times do you think, oh, yeah, it's really taken up, oh, it's got a profit, oh, I like that profit, I'll take the profit. Or you listen to one of these people who say, yeah. Now, what you do, you make sure that your trade is going to produce 3 times whatever you're likely to lose. So if your stop loss is, say, 50 pips, we will have a 3 times trade, and when it gets to 150 pips, we'll put a limit order and we will take our profit. Oh no. Well, there are those who slavishly follow that. Well, I like to do things a little bit different. I wait for the market to tell me when I should be taking half profits and when I'm going to take my final profits. And do you know what? Sometimes we get some of these moves that end up considerably more than 3 times whatever the initial risk was. And anyway, there we are. When the indicators change and price action tells me that now is the time to close the position, that is when I close it. So, what do we get? Pound against the Swiss. Nice little run up and a nice little run down. Still running. That's where the stop is currently. That's where the stop loss is. The stop profit, as it now is. That's where it is. And we always want to take risk off ASAP. Pound against the... I'm not personally into this one, but one of the members, I've been following what he's doing. He's actually in this one at the moment. And again, I don't know if that's actually done it, but did actually have a bit of a chat with him that was the most sensible place to put the stop. But the stop profit at the moment. But look, these runs, we get the pips. Granted, things like the GJ, pound against the Australian dollar, etc., they are high ATR ones. So, our average stop loss is going to be considerably larger than it would be with, say, the euro against the British pound. But trading these correctly, we can get some absolutely amazing swings. So I guess now's the time. If you've got a few questions, do sort of wallop them across to Simon. I'm sure he'll mention. But I also just want to just talk a little bit about money management, because what we like to do is to take risk off as soon as possible. And well, if I can just demonstrate with this move, this was triggered on this day, and in fact the previous day gave us a very strong indication that maybe a top was put in by virtue of the fact that this is a bearish engulfing candle, and despite the fact the price had been going to a new high, the activity index did not go to a new high. Divergence, and you can get this using more or less any oscillator. And so a stop was put in to, you know, act as a sell stop, and it got triggered and it ran on down. But by the end of this day, we found ourselves actually sitting on a profit which was actually just about the same as what the initial risk was. And so the sensible thing to do was to take part of that profit and then bring the stop loss to break even, so we could not lose. And then for the remaining part of the trade, we just let it run, and of course protect the position by bringing the stop loss progressively down as price moves down. And eventually that stop will be taken out. But when, I've absolutely no idea. I do not know. I just do not know. So we let it run. We let it run. So we take the risk off ASAP, and then we just leave the market to do what it's going to do. Simple risk management. Simple risk management.
George?
Yeah.
Hi, we do have quite a few questions waiting, so I've been waiting for the right time to just jump in. Most of the questions, more than half the questions we've got so far, are on this topic of the EST activity index.
Oh, right, okay.
Related to that. So maybe we can just go back to that.
Sure.
That says, what exactly is it? David says, presumably it incorporates volume. Is it a proprietary indicator? So lots of questions. Maybe you could revisit that for a few minutes.
I'll sort of fill in on it. It is actually an indicator that we've sort of adapted, and you're quite right. It uses volume activity. Now, volume activity is a little bit different to regular volume, because in forex there's no central clearing house, and so you never quite know exactly how much currency is changing hands. But some of the larger brokers will produce figures. But what I use as a proxy for volume is tick activity. So a tick is one single movement up or down. And quite simply, what this does, it aggregates that tick activity. So if there is more tick activity with up moves than down moves, this histogram is going to be, it's going to be blue, and it's going to be moving up. And then the opposite, of course, is also true. So all this does is to aggregate, take one from the other, the tick activity, and it applies one or two little smoothing methods. And it's also something of the calculation is rather like a momentum indicator. So if price today is above where it was yesterday, and depending on how much above it is, then of course it's going to be moving up. So it's volume activity. And what we will occasionally find is that even though price is still going up, we find that the tick activity is actually tailing right off, and that will quite often give us a heads up on where it's going. But we've also found by applying it to trends and comparing it to things like the ADX, which is a sort of a trend following tool quite widely, this is a very, very good broad definition of trend also. So anyway, hope that helps. But yes, it is a proprietary thing that, you know, the programmer has actually played around with it and has sort of optimized it for me.
Okay. What other indicators do you use?
Right, okay. Well, the only other indicator is this one, which is the swing trend. Now, this is based, it's an ATR-based thing, so it adjusts to volatility, in other words. So if we've got a whole series of really big days, then this will move a little bit further away from price. But if we've got a whole series of very, very sort of narrow days, it moves a little bit closer to it. And I found it is an absolutely fantastic little momentum indicator, because you can see at a glance what is going on. And certainly on swing trading, then we just really wait for it to change color, and it catches. Look how it catches the swings. It absolutely catches these swings. And I add to that, going beyond just these two indicators, common sense candles, things like that inside day, that Hallmey I mentioned, things like, in fact, well, we have this as a shooting star. Gave the heads up, and I thought, oh, well, yeah, want to be a little bit careful. Shooting star, let's put the stop profit just under the low of that shooting star, because shooting stars can lead to reversals. So we just sort of, we're a little bit careful from time to time and try to use common sense as much as possible. Plus, you know, certainly aware of the standard chart patterns.
Okay. When you do get a big profit, Tosin's asking, do you move your stop to break even?
Yes. Oh yeah, absolutely. Yeah. Now, one of the things I am absolutely passionate about is trying not to lose money. It's an obvious sort of truism, but I'm quite happy to take any number of losses. I don't really mind what my win-lose ratio is in terms of number of trades, as long as I'm keeping my losses to an absolute minimum. And you know, I've got a talk that I do, which is never let a profit run into a loss. The number of traders that I speak to say, oh yeah, we had a whacking paper profit, and do you know what? It ended up, it came and hit our stop loss and we lost money. Well, it's a bit like the fisherman talking about the one that got away. Well, it's no good. If you're sitting on a shed load of profits, which are unrealized profits, you have a bounden duty to yourself, your family, and your future to protect that profit. It is your money. It is your money. Do not give it all back to the market. And as a rule of thumb, if I've got an unrealized profit, I never ever want to lose more than 20% of that unrealized profit. So I will, you know, take partial profits, and I will set a stop to break even.
Okay.
Hope that helps.
Just the last couple of minutes. How many trades do you have open at one time? What percentage of the account do you trade?
Yeah, one of the problems with this trading, and the number of charts I've shown you, I sort of look at. I've got about sort of 20 odd charts that I look at regularly. Of those, I probably trade about sort of 15 of them. But how many do I have open at any one time? Well, probably no more than about 4 or 5. There are times when I'll have sort of 6 or 7, but if I go anything more than about 4, do you know what? I find myself thinking, worrying about them, and thinking, oh, yeah, what's going to happen overall on my account if something dreadful would have happened? Well, one way of avoiding that is I'm very, very careful that I will not have, for instance, we had umpteen of the British pound crosses showing buys and sells recently. And so I had to discipline myself to never having more than one of the British pound trades on at any one time, and that helps to reduce my overall risk profile. So I'd be quite happy to have something, be trading the US dollar, Japanese yen, British pound, US dollar. So the correlation between them is not going to be that great. The only exception to that was that I did actually have also a Euro GBP trade on as well. So always want to be a little bit careful about having too many correlated trades on at the same time.
Okay, lots of questions coming in about setting stop losses and you trading with a stop order. We're just about on 11 o'clock, so I think I would pass these questions on to you directly outside of the webinar.
Well, I make a suggestion.
Or
Let
indeed,
me just I'm going to just pop into the chat box my email address.
Yes.
And please do get in touch with me, and I'll be more than happy to answer all of the questions. So, yeah, let me see if I can send this to all. No, I don't think I can. I'll send it to you, Simon, if you could send it on.
I'll repost it. What about the extreme swing trading course? Is that running
right,
still?
now let's just get to this. Yeah, 20-minute extreme trader. That's more or less what I've been describing to you. You can find it at tradersclass.net, or you can go straight to Click Events and find it over here. So this is going to be, if you just go to www.clickevents.co.uk, there will be a link to it. Take a look at the info. There is, in fact, I was going to bring to an end, there's a special offer on it actually, which I'll mention very, very briefly, and that quite simply is that the whole deal is 279 quid, and you get with it, not only we send out this little CD package to you, but you've then got access to me by sort of email and so on, but also for 3 full months, used to be just a 30 days, you get free membership of Traders Class. Now that's £97 quarterly, but you get 3 months of it where I send out videos at least twice a week of the trades I'm looking at and the reasons why I'm looking at them. And the whole deal is $279. But there's a payment plan, £139.50, followed by the balance, $69.75 in 33 days' time, and then 66 days' time after that. And if you get it and you think, oh, no, this is not for me, send it back, instant refund within 30 days. So there we are. That's the deal, folks. That's the deal if you're interested in taking this further.
That's great. I know we had a few people sign up from that last month.
Absolutely, yes, indeed. I've done quite a bit of work with 1 or 2 of those guys who are really cottoning on to it.
That's great. Okay, so George, we'll wrap it up there. We've just run over a wee bit. We're just a few minutes behind on all the talks this morning, but that's fine. I can see that Corvin is in the wings, waiting for his talk to start. So, George Hallmey from Click Events, thank you very much again for joining us. It's always a pleasure to have you, and we'll follow up the links on the email. So, if anybody has time, we'll be really good to be with you, folks.
Bye for now.
Okay, thank you. Bye bye. So thank you very much, George Hallmey there from Click Events, taking us on up to midday here in the UK, and welcoming all those people who are still joining us. I can see another 40 or so people joined in the last hour, so welcome to Round the Clock Trader. My name's Simon Campbell. This is the long 12-hour webinar where we're featuring lots of fantastic trading educators and speakers to teach you, give you an insight into the markets at the moment and how you might be approaching the markets. So we will carry straight on with our next speaker, Corvin Codirla from FX Masterclass. We'll go across, unmute the microphone and see if we can speak to him. Hello, Corvin. Good afternoon. Are you there?
Hi, Simon. How are you? Yes, I'm here. Can you hear me?
I'm very well. I can hear you fine. That's great. Can everybody at home hear Corvin as well? If we could just use the
little chat box. While we're doing that, we'll pass over the presenter to you as we're talking, because I've fallen a little bit behind the schedule, so we don't want to waste too much time. I can see everybody can hear you okay, which is great. And yes, we're looking at successful speculation, how to really make money from your FX Master Course class, which is great. So, Corvin, I'll let you introduce yourself a little bit more, but just to the people who may not have heard you, you've been on the show a couple of times, which has been great before. A hedge fund manager really is your sort of full-time occupation, but clearly you're private trading your own account as well. Anything else that people should know? I'll hand over to you.
Thank you very much, Simon. Yes, we'll get to that in a sec. And first of all, let's just start out with the intro to this presentation. And thank you again, Simon, for having me on again today. And I'm very happy to be part of the round-the-clock trading community. It's a perfect environment to learn and absorb a lot of information. Now, for all those out there who have joined today, you probably have asked yourself in the past a couple of these questions. And really, that's the topic of the presentation today. Is speculation a mystery to be successful in it? Do you have to have some sort of magic holy grail? Or do you ask yourself, how is it that the best hedge funds out there do perform, or the pros, or the guys that you read about, or maybe have read about in the market wizards? What is it that they do, and why aren't you performing like them? Or do you struggle with finding the factors that drive the markets? In essence, edge. Do you understand what edge means, or do you think that edge is something that is hidden away forever and ever? Or you have sometimes emails in your inbox saying, here's a 97% hit rate trading system, and you have to get it. So the main point of the presentation today is to address those questions. And the main takeaways are that to have trading success is driven really by two components, and we'll cover those. And what you'll find is that they're made up of risk management and having an edge. But actually, it's not what people usually tell you about those. Risk management isn't about not losing money, and having an edge isn't about finding a holy grail. Then we're going to cover the factors that drive the FX markets. So my background is predominantly in foreign exchange and has been like that for the last 12 years. That's what my hedge fund does. And I'll show you exactly how you can take that idea of finding an edge and applying it to the FX markets. And ultimately, I'm going to present you with 3 exercises that you can take away today, do at home, and if you do them, you're going to set yourself in the top 10% of trading people out there, and they're going to cover the basics from what does it mean to have discipline, what does it mean to trade fundamentals, and how do hedge funds really go about making money, and you can replicate that at home very, very easily. And if you do stick around until the end of this presentation, I'm also going to give you access to my FX Video Master Course. And if you want to ask questions, feel free to raise your hand throughout the presentation, and we'll have a bit of time for questions and answers at the end. So, right into the first point. What's the message for today? You can make money, and you need, as I said already, edge and risk management. And I'm going to keep on hammering that point throughout the entire presentation, because that's ultimately what it's all about. But as Simon said, first of all, a bit about me. You probably haven't come across me up to now. I came to the city in 2001, and then from 2003 to 2011 worked at big hedge funds, such as Brevin Howard, Peloton Partners, investment banks, JP Morgan, Deutsche Bank, etc., developing trading systems and trading their capital. And ultimately, it was a very interesting path of doing what every person who starts out trading does. You have information overload. You chase systems such as neural networks and wavelets and pattern recognition and God knows what's out there, and sexy ideas from academia, which usually turns out not to work. And you make rookie mistakes. You over-leverage. You run your losses. And then in 2011, after a very long journey, as you can see, I decided, hey, I've now got it pat down. I'm going to set up a hedge fund. And hedge fund was called CCFX. It trades the G10 currencies in a systematic way. So let me qualify systematic. It means rule-based. I'm not very much of a believer that you should have some sort of heuristic and wishy-washy approach to the markets. And today I feel bad, and tomorrow I have an insight, and the day after, God knows where I'm going. No, it's black and white. I am either going to buy and sell, and that's based on data and history and evidence. And we actually last year got a top 10 award from Barclay Hedge, which is the big hedge fund database. And there you can see the track record from 2011 until the end of 2015. So, what is it that makes the pro successful? Yes, risk management and edge, but most importantly, to implement those, you need discipline. And again, I'm going to go back to this. A lot of stuff has to be rule-based and don't break the rules. And rule-based means understanding, once you form the hypothesis, exactly how the markets behave. And it's not a secret, it's not difficult, and we'll cover that. With regards to cutting losses, obviously Buffett's favorite motto is never lose money and never forget that particular rule, is what he says. But losing or cutting losses is not about preserving capital. Yes, that's part of the story, but the real part of the story, especially for private investors, is to understand the consequence of cutting your losses, which is actually to make a lot of money, and you'll see how. And with regards to edge, edge is a very misused word. Every time I had investors come in and wanting to invest money with me, they'd ask, well, what is it that you do? And if I just tell them, you know, the obvious thing, like look at this guy who bought the S&P in 1982 and held it until now, he made a lot of money, they would have not invested, because investors, big institutional ones, pension funds, etc., they want to have a reason to pay you the 2 and 20 fees that they're paying you, and the reason has to be something sexy, something new, something outlandish, such as neural networks. But that's not the case. To make money, and good money, is very straightforward, and we're going to cover that. So let me recap. It's about risk control and edge. And both of them are not as obvious as you might initially think in terms of interpretation. Risk control is not just about losing money, and edge is much easier than you think. So let's go over to the first one, risk. So everybody, when they talk about risk management, they talk about cutting losses. And why would that be the case? Well, the reason is because a lot of people are dead afraid of losing. When they trade, they want every trade to be right. And you probably have sat in front of your computer looking at price charts, trying to devise some kind of indicator or way of approaching the markets. And when you eyeball these charts, every time you find a trade that didn't work out, you probably bin the idea and say it's not worth it. Because that's how humans are built. They're risk averse. But remember, trading is like breathing. You can't breathe in without breathing out. You can't win without losing. And ultimately, by accepting that and by understanding what cutting losses is, and it's not just about preserving capital, you understand that you can actually utilize it to make much more. And so that's the whole point of the second bullet. Cutting losses doesn't actually make you more money, which is the ultimate point of trading. But what it allows you to do, it allows you to leverage. You see, if you have a line in the sand and you know that you're not going to lose more than that because of stop losses or whatever portfolio mechanisms you have in place, you can pile in more money and ultimately make more. So let me show you a very specific example of how that works. Here, right in front of you, I've drawn out two lines on a chart. One's blue and one's red. And so let me explain what they are. This is an example of a very classic strategy that has worked really well until around about beginning of 2015. It's been choppy a bit since then, as you can see on the red line. It's the London breakout strategy. So the entire idea in the FX markets, this is applied to the FX markets, actually applied to the euro-dollar currency pair, is that in the morning when everybody gets out of bed London time, that's when a lot of volume goes through the market. And so that volume that gets set around about between 7 and 8 o'clock, that comes to the market, sets a price range. Price goes up and down. Once you've determined the price range at the London break or at the London open, you then follow price through if it breaks through the upper or lower bound. And you have anecdotal stories from heads of desks at banks as to why that should be the case. Imagine you are Daimler Chrysler and you want to hedge out cash flows that you're expecting from US sales of cars, and so you have to go into the market and transact euro dollars. And let's say that you have a particular price point in head and you call up the dealer on the desk, because you're not going to do it electronically because this order is probably worth 5 billion euros or maybe 10 billion euros. And so the guy on the desk thinks, well, I've got lots of time, I've got, you know, all day long, I'm just going to job this order, try to scalp it, try to make the money on the bid ask, because I'm a market maker and that's how I make my living. And so all of a sudden, as this order comes in and he jobs the order, all of a sudden, let's say that price moves to the upside for whatever reason, and he realizes that the client's probably not going to get as good a price as he wanted to, and he's got to accelerate the buying. And as he puts in these bigger orders, it accelerates it even more, and it goes through the range that's been set in the morning when the order came in. So that's one anecdotal reason for why this strategy should work. Ultimately, you have to test it, and here is a back test of the strategy going back to 2010, and it works very well. I myself traded the strategy as part of my hedge fund going from 2012 onwards, and it was a phenomenal money generation tool as well as a good hedge to the mean reversion components we utilized. But let's get to the point of this slide. The red line is quite jiggity-jaggedy. It oscillates a lot. The reason for that is that there are no stops imposed on that system. The only stop is the other side of the range as it gets set in the morning. Now, you could ask yourself is, rather than if you have a 100-point range in the morning, you would say, well, you know what, I don't want to risk that much. I don't want to risk 100 points. I'm just going to risk 50 points. So I'm going to put a hard stop on every order at 50 pips away from my entry. Now, if all of a sudden, if I do that, I get the blue line. So the red line is without stops. It's just the other side of the range that's set in the morning that stops me out. Whereas the blue line is with a 50-pip hard stop. And as you see, all of a sudden, both of them running the same position size, it's much smoother. But forget about much smoother. Is it actually making me more money? No. Implementing the stop loss strategy or this obsession with capital preservation hasn't actually gotten me the effect that I wanted, which is to make more money. That's the big problem here. So what can we do? What can we do about this? How can we actually use our risk management that has produced a smoother line to extract the value out of the market that we want to? This is where we get to. So let me talk you through this slide. Remember before we had a smooth blue line and a red jiggity-jaggedy line? Well, what if we actually leveraged up the blue line so that we get the same kind of oscillations, the same kind of risk in terms of P&L as the red line? Well, if you do that, you can see that the blue line all of a sudden massively outperforms. Because I've reduced my risk and I've made my P&L smoother, I in essence allow myself to leverage up. And through the process of leveraging up, I make much more money than the original system. So that is the whole point about money management and risk management. It allows you to leverage. And now as an ultimate comparison, we put on the green line, which is the S&P buy and hold strategy from 2010 onwards. And we've adjusted all the risks so that both systems, the 50-pip hard stop and the no stop system, have the same P&L oscillations and swings as the S&P. So everything adjusted to the risk of the S&P, you can see that the London breakout strategy does actually massively outperform. So ultimately, risk isn't just about money preservation. It allows you to leverage more. And ultimately, it allows you to make more money. And in the famous words of George Soros, it takes courage to be a pig. It takes courage to ride a profit with huge leverage. So that's the whole point about money management and risk management, to control your downside so you can leverage up and actually hit the targets that you have in mind. And we're going to see how that applies to actual strategies further on in this presentation. Now, remember, there was a second principle I talked about, not just risk, but also edge, to understand what you're getting paid for. The market is not this magical beast that doesn't allow you to understand how it works. There are fundamental underlying factors that drive it, that makes the money flow around in this market. And in hedge fund parlance, what you're really looking for is something called beta. You're getting paid for holding that beta. So what does beta mean? It means that you're purchasing something risky in the market, and for that risk that you're purchasing, you need to be compensated. So for instance, equities pay you more than just holding bonds, because equities are more risky than bonds. You know, a company can go bankrupt, but a government can always print its money to pay you back the debt that you've given it. So from that perspective, understanding what the factors are in the market, you can start to create a portfolio that extracts that juice. So in equities, as I said, you can, for instance, buy stocks. If you're in the bull market. In commodities, it's trend following, and there are very big trend following funds out there. So the question is, what happens to the forex market? And ultimately, myself, I'm a forex guy. I have been for the last 14 years. And in the forex market, it's very interesting because imagine this: foreign exchange tends to be seen as a transaction that's secondary by a lot of people. If you go on holiday to Greece, you transact the euros, but the main picture you have in your mind is the beach on the Cretan island. You're focused on the actual asset you're purchasing, and this exchange of currency tends to be secondary. It's just an exchange of cash. So how can exchange of cash give you value? How is it that, for instance, doing currency trading can allow you to participate in the same kind of value that buying an equity, where you're buying bricks and mortars, or commodities that go through cycles of supply and demand, summer versus winter, or people need to consume more food. That's understandable. It's something tangible. But what happens in FX? Well, it actually turns out that within foreign exchange, you do have these factors that drive it. And this is what I want to highlight to you today. And you go think about this, and you can then implement them. Factor number one is interest rates. So when you enter into a foreign exchange transaction, what you're really doing is you're taking your cash in your hand that you have right now, and you have to make a decision. Do I want to put it in my bank, where I'm earning at the moment, let's say I'm in Euroland, I'm earning minus 0.2%, minus 0.3%. I am actually having to pay the bank to hold my money. Or do I want to stick it somewhere else, like in New Zealand, where I'm getting paid 2.75% a year for depositing the money with the bank? So that's, to a certain extent, a no-brainer. So ultimately, currencies or cash tends to go where there's high yield, and that's called the carry trade. Pillar number two, it's about value. Why do you need foreign exchange transactions? Well, if you live in England and you want to buy a kimono from Japan, well, that guy isn't going to accept sterling. He wants yen. So you're going to have to take your sterling and transact them into yen. So from that point of view, you have to look at the goods across various borders. And ultimately, that's what drives value in currencies. Just like in equities, where equity has a book value. If you were to liquidate the company and sell all the assets, you'd have a particular value. And then you can look in the market at the share price and see a difference. You can do the same with FX. How? Well, imagine this. Imagine that you've just been on holiday to New York City, and you've bought yourself an Evian bottle. It's water, it's in a bottle, plastic, it's produced in France, exported over there, and let's say you buy for $1. And let's say now that you haven't opened it, and you end up back in London, and you go to a newsstand, and there's an identical bottle sitting there. And wow, so you compare these two guys, and you bought the New York bottle, actually, let's say for $1.20, and the bottle here in London, which is identical, is for £1. So if I look at the two bottles that are identical, I could swap them. And from the swap, you get an implicit exchange rate, which would be $1.20 to £1, which would make the currency worth sterling 1.2. So that would be the implicit, the value of the currency. And then I look in the market and I see it's trading at 1.3, and that would imply to a certain extent that sterling is overvalued in this particular case. So I'd sell it. So that's how you can generate value trades out of the FX markets. And ultimately, you have flows. How do you have flows? Well, as an example, the UK is still part of the European Union. At the end of the month, it's got to move a lot of cash and pay the European Union. So you have, like clockwork, at the end of every month, big sterling flows into the European Union, and that'll obviously have an effect on your sterling. Similarly, in Japan, you have on a quarterly basis, due to accounting reasons, a lot of cash that has to be repatriated and accounted for, and that cash comes predominantly out of the US, which is a big trading partner for Japan. So you have these flows that happen on a regular basis. You have also speculative flows, mergers and acquisitions. Now, the point is that you don't have to read the newspapers and know all these things. All you can do is look at price action over the very short term to understand what's going on. So these are the three factors for foreign exchange. There's value, which is a long-term concept based on fundamental economics. There's the medium-run impact by interest rates, which is set by central banks, of course. And then there's the very short term, over 1 month, 2 months, which is derived from momentum and flow. So if you were to combine these three factors, which you can do in a very rule-based fashion, and look at what happens when you combine them and trade them, you get an FX benchmark. And that's one of the big takeaways. Just like in the equity markets where you have an equity index like the S&P 500, or in commodities you have the Goldman Sachs Commodity Index, you have your FX benchmark, which is made up of these G10 currencies, the big developed economy currencies, and it looks like this. And this goes back to 1996, so that's the last 20 years. You can go back even further. The data tends to be a bit patchy. So let me repeat what this is. At the end of every month, you rebalance your currency portfolio in accord with the rules from these three factors, and you get a performance, you get P&L. And this is what the P&L looks like over the long term. And when you look at this chart, you all of a sudden realize, hey, just like in equities or commodities, I can extract value out of the FX markets based on fundamental principles, based on macro, value of goods, based on interest rates and central banks, and based on short-term price action. And it's very rule-based. What does this do for you? Well, it says I can either trade the benchmark itself, because it's got long-term performance, or I can trade around it. Remember, like the S&P that has lots of constituents, a benchmark like this has lots of different currency pairs, and I can choose the one that's best performing, trade around it, for instance. So we've gone through these two ideas of risk. Risk management is there to allow you to leverage like a pig, and we've gone through edge. Edge is not difficult. It's something that is well documented. You can read about it. I can tell you about it. The whole point is if you apply these two in conjunction, you can make tremendous amounts of money, which is ultimately the whole point of trading. I mean, if you read the Market Wizards and you look at Tudor Jones, he was regularly in the 80s hitting 100% a year, and that's something that can be replicated. So, what does it mean to combine these two ideas, edge and risk, leveraging it like a pig? So let's take the benchmark we just saw and leverage it up 8 times. Why 8 times? Because if I look at the drawdown of the FX benchmark, I'd like to have a drawdown that's similar to the S&P, which, if you remember 2008, had a 50% drawdown all the way down to 666, the number of the beast, in March of 2009. And so what do the results look at when you leverage it that high for the FX benchmark? Well, annualized you make 41%. With the S&P, you only made 7% a year. So actually, FX markets can provide a tremendous amount of benefit to your portfolio and to your income over the long term, much more so than equities if you use the right leverage. And so this is what it looks like if you were to have applied that kind of leverage to your portfolio. $1 in 1996 would have turned out to be around about $800 now, which is a tremendous multiplication of value. Remember, this is not about intraday trading and having to hit the right levels and worrying about bid-ask spreads and commissions and, oh my God, where's my slippage? This is about rebalancing on a monthly and weekly basis, where if you are off by a couple of hours because you went out on a party, it does not matter. So let me repeat. Success in trading is about risk control, which allows you to leverage. And it's about edge, which is documented to no end all over the place. I mean, let me just ask you again, who here bought the S&P in 1982, leveraged up and held it? Because if you didn't, you would have lost out on a lot of value, which is exactly what Buffett did. And if you look at his performance since 1982, it's absolutely phenomenal. And going back to the concept of winning and losing, Buffett is advertised as the guru, as the sage of Omaha. And when you bring up a stock price chart of Berkshire Hathaway, which is his holding company, what you're going to find is he had lots of 50% drawdowns on the way to making a lot of money. So risk control is not just about not losing, it's about making it on the right leverage. And edge is about using the factors in the market out there, which are very straightforward to grasp. And we're going to go through that actually right at the very end of the lecture. I'm going to show you how you can combine across all markets a very simple portfolio to give you a phenomenal performance without a lot of hassle. So now if we come to the second part of this presentation, I'm going to show you the exercises that I think will actually put you in the top 10% of all traders out there. And they cover the ideas of risk discipline, of what it means to look at fundamentals in the currency markets, and what it means to combine and construct a portfolio like a hedge fund manager. All these exercises don't take you longer than 10 minutes. And yes, I know it's, oh my God, you know, I'm going to get rich in 10 minutes. No, it's not like that. It's about if I do these exercises, I understand them, I internalize them, and then I go ahead and I'm consistent about them. In the long term, I will be profitable. So let's go with exercise number 1. I call it the random coin flip exercise. It's very, very straightforward. You take a coin, heads or tails, you flip it. If it's heads, I go long. What do I go long? This is for all you intraday traders out there. Choose your favorite currency pair, such as euro dollar. And if you go long, just buy euro dollar. It doesn't matter what price it's at. If you have tails, go short. So you sell euro dollar. And in both cases, put an initial stop of 20 pips on the trade. Now, if the trade is showing a loss after 5 minutes, close it out. If the trade is showing a gain after 5 minutes, let it run with a trailing stop of 20 pips in your favorite trading platform. And if the trade is still in profit by the end of the week, close it out. Now, keep an accurate log, and you'll see in a minute why. And the last one, that's where the real discipline comes in. Stick to these rules without exception. Now, you're going to say, oh, does this thing make me money? I'm going to answer, no, this is not about making money. This is about, can you stick to these rules? I don't care if after 5 minutes you're showing a loss of 0.1 pips, and it could possibly go into the green so that you can let it run. No, if it shows a loss of 0.1 pips after 5 minutes, close it out. And I'm going to let you know already, if you actually go ahead with this exercise, the emotional aspect of it will be quite mind-blowing. I've seen people do this exercise who get so angry about the loss they incur in the first 5 minutes, it's unexplainable, especially if they trade nano lots, which I recommend you do, so that you only lose maybe 10, 20 cents after the first 5 minutes. These people get as angry as if they've lost $1,000, and on the other hand, they're quite happy an hour later to go down to Starbucks, buy themselves a maca and a muffin for $5 and spend those $5 without even batting an eyelid, but then get really upset about the 20 cents they just lost half an hour ago. The point of this exercise is stick to the rules, get emotions out of your system, and stop getting angry about the losses you make, because that's ultimately going to stop your discipline and going to stop you make money. And so here's the feedback from a couple of students who have done this exercise for 50 consecutive trades, also 100 consecutive trades, and what they've said is that they've actually gained a tremendous insight in terms of what it means for them to win and to lose, what it means, how emotions are just chemical responses, and by just getting rid of them, they overcome the anger that comes along with losses. To the extent that the student whose feedback is on the right-hand side, he more or less now has realized that the secret for him to success in trading is to lower his position size to the extent that he doesn't actually care if he wins or loses, and he's now become incredibly profitable on the back of that. Do this exercise. I really urge you to do this one. Okay, the second exercise is about understanding what the FX markets are all about. So if you go back to the original 3 pillars of what drives FX markets, you'll remember I said interest rates. So interest rates are interesting because they don't just magically appear out of nowhere. There's somebody that has to set them, and probably all of you followed Janet Yellen talking last night, or trying to listen to what she was saying. And so we all realized that central banks set interest rates. And so here's what I'd like you to do. Pick up a price chart of your favorite currency pair. Here you see euro dollar going back all the way to 2010. And on this price chart, mark it up. And here you see blue boxes. Now, these blue boxes happen on particular dates. Which dates are they? In this particular case, because I'm looking at euro dollar, I'm going to focus on ECB announcement dates, which tend to happen on the Thursday of a week, every couple of months or every month, depending on if it's summertime or not. And then I want you to have a look at exactly those days on which the ECB talked, and look at what happened to the price at that day and how did it continue afterwards. And you'll find that it's either an inflection point. I mean, the very famous one was in January of 2011, when everybody was afraid that we're still in the middle of a financial crisis, and Trichet came out in January saying he's actually concerned about inflation. The guy had never mentioned inflation for the last, I don't know, 6, 12 months. All of a sudden he mentions inflation, and Eurodollar goes from 120 to 140 all the way up. It was actually quite a fun day. For some people, quite a bad day because they weren't prepared for that. So the whole point is, go on the price chart. If you do Aussie dollar, look at the Reserve Bank of Australia announcements, mark them out, and start looking at what happens to price action shortly after. Now, once you start doing this, you're going to ask yourself, how can I actually trade this? And here's the thing. Remember, I said I'm rule-based. I'm going to give you some rules for this. On your price chart, mark out on the day of the announcement, when that day closes, the highs and the lows, and use those as breakout levels. And then on the next day, if currency breaks out either side, trade it in that direction and keep it until the end of the day. No stop losses, remember, because we have stop orders both to the upside and downside. So if the currency does whipsaw, goes to the downside and hits the other edge from the announcement day, you're going into the opposite position. So effectively, that's neutralizing it. It's like a stop. So in essence, set your highs and lows on the announcement day, and then follow through on the upcoming day, the next day, and keep that position until day end. So if you do that for Eurodollar, this is what it looks like, all the way back to 2009 until recently. Actually, yesterday, of course, was FOMC. It turns out that the Eurodollar is quite a nice currency to trade FOMC statements today. If you look at the price chart, you will see that Eurodollar did break up out through its high from yesterday and is at the moment in profit if you were to implement this strategy on Eurodollar. So, to recap, get your favorite price chart, mark out the central bank meetings, and use those levels, the highs and the lows on that announcement day, as your breakout levels, and trade it only for the upcoming day. And actually, don't just trade that for one currency pair. I urge you to go do this exercise for all the major currency pairs, actually predominantly against the dollar, so Aussie dollar, Kiwi dollar, dollar yen, euro dollar, and check out historically what would have happened over the last 10 years. And I tell you, you'll be very pleasantly surprised. And the great thing about the strategy, again, It's rule-based. I can test this. I don't have to tell you I feel good today and tomorrow I feel bad, and look at this indicator and the stochastic did this, and I have to interpret it here and I have to put this level over there. No, it's crystal clear, black and white, very simple. I urge you to go and do this exercise, because the first thing you'll have to do is understand, what is a central bank? When does it get announced? What impact does it have on the currency? What happened to the interest rate? Do I understand how this works out? You'll get a lot of knowledge that 90% of traders out there in the FX markets just don't have. It's really going to take you to the next level. The third exercise, which is also very straightforward, is to actually trade it like a hedge fund. Now, a hedge fund, or the really big ones, such as Bridgewater, which manages 150 billion, or AQR, which manages 120 billion, they don't just trade one currency pair, they trade assets. They trade lots of them in aggregate in the portfolio. And Bridgewater, even though it has $150 billion under management, has consistently made positive returns over its lifetime, around about 20% annualized, which is unbelievable if you think of the fact how much money it has to manage and where it has to stick it. So by talking about trading a lot of assets, I'm talking about trading equities, bonds, and commodities, which are these tangible things we talked about earlier. So you're going to ask, first of all, oh my God, does that mean I have to trade 1,000 equities and I have to think about futures and God knows what, and I'll never be able to do this? No. You see, we're living in the 21st century. There's something called ETF, Exchange Traded Fund. You want to trade equities, you buy the SPY, which is the ETF that tracks the S&P index. If you want to trade bonds, for instance, in the US, you trade the Barclays US Aggregate Share, which in essence tracks all bonds, be they local government, corporate, junk, whatever else, with maturities longer than 1 year. You have access to the entire bond universe out there. If you want to trade commodities, trade either the Goldman Sachs tracker, which tracks the GSCI, the Goldman Sachs Commodity Index, or the Deutsche Bank ETF, which also tracks the Goldman Sachs Commodity Index. So for clarity's sake, here they are. You trade these three instruments only, the SPY, the AG, which is the Aggregate Bond Index, and the GSG. Now, equities, how do you trade that? Well, you go long equities. You know, as we said before, equities tend to go up. You can be more funky about it and actually look at 12-month momentum. So if equities have been up in the last 12 months, you buy them. If they haven't, you short them. That actually works tremendously well, makes a lot of money, much more than just buying equities. But let's keep it simple. Just go long equities. Number two, bonds. Bonds go up. Yes, there's been a phenomenal bond rally, but remember, the AG also allows you access to corporate bonds, which have 2-3% yields, so you're going to benefit from the carry by holding these bonds to maturity. And with regards to the the commodities, the Goldman Sachs Commodity Index, actually, I put on a chart because there going long commodities doesn't make much sense. These things aren't like Yahoo stock that go from 0 to 100 in 10 seconds and all the way back down again. They tend to go in trends due to cyclicality, supply and demand. So the idea here is simple on this ETF. If it's been up for the last 3 months, you buy, and if it's been down in the last 3 months, you sell. And you apply these rules at the end of every month. So you only put this trade on once a month, you keep it for a month, and then you rebalance your portfolio. And the only rebalancing you really have to do is the ETF, either long or short, depending on its last 3 months' performance. So if I actually put these three together in the way I've just described, which is just 3 ETFs, and according to this unit sizing, which is important actually to get the performance I'm talking about, and this is really the concept of risk parity, but forget about the details, just buy it in these unit sizes, you'll get this kind of performance going back to 2007. Unfortunately, some of the ETF prices aren't available, but this is something you can easily test yourself by downloading the data from Yahoo Finance for free on a monthly basis for these 3 ETFs. Now, this is on a 1x leveraged portfolio where the maximum drawdown was just 5% or 4.5%, which is absolutely phenomenal. So let me actually then do the same exercise as I did for the London breakout strategy and leverage this up to get the kind of comparable drawdown I've had with the S&P. Because, you know, if I'm going to take risk, what do I care about just making 6% a year and only drawing down 5%? I want to take proper risk, just like an equity investor. Okay, so let's leverage it up. Look at the maximum drawdown of 40%. All of a sudden, I get 60% annual returns, which is tremendous. I've just shown you how with 3 instruments that represent more or less the entire asset universe out there, and with some very simple rules, I can combine them to extract tremendous value out of the market. This is something that you can test. This is something that you can have access to. And if you want to get that kind of leverage of 10 times, remember ETFs are shares. If you just trade them outright with a broker, they'll probably only give you 2 times leverage. You can go to a CFD thing such as IG index, where you can trade these things on 10 times leverage and gain this kind of performance. So let me recap the 3 exercises. They were: discipline yourself, do the random coin flip, then look at the fundamentals of the markets, which ultimately for FX are interest rates and central banks. And thirdly, here's a very simple strategy to implement hedge funds. So long equities, long bonds, and trend follow the commodities. So more or less, we've come to the end of this presentation. And thank you very much for attending this free webinar. So I have a question for you. Why did you actually attend this free training today? You're probably wondering how to finally implement trading strategies that work, like some of the examples we saw today, and strategies that are being used by the pros out there, like some of the names I mentioned. Bridgewater, AQR, of course, went in the big trend following fund. And so in that case, I'd like to introduce you to the FX Master Course Academy, as Simon briefly mentioned at the beginning of this presentation. And the whole point of this academy is to get you to implement the methods we outlined in today's presentation, to get you to a professional level of trading that has provided long-term consistent gains. Remember, I have run my hedge fund. I have had track record 73% over 4 years, and it is possible. And one of the biggest kind of things about looking at investment is this concept of Peter Lynch's 10-bagger. You know, that stock that goes up tenfold and you're so happy you found it? Well, a lot of people talk about this like a mythical unicorn. The reason they never find it or capture it is because they don't have the discipline to do it. Exactly exercise 1 that I showed you today. So, what is the FX Master Course Academy about? It really focuses on 6 bullet points that are classified in 3 pillars: the foundations, the business of trading, and the profitability and performance that comes along with it. The biggest issue that people have in trading is they don't know how to measure themselves. I have a student who said to me, oh my God, I just had like a 10% drawdown a couple of days ago, and I'm really bad and I'm useless at trading. So I said to him, show me your trading logs. And he actually made something like 100% over a period of 6 months on high leverage. And I said to him, are you stupid? Of course you're going to lose that kind of money because you're using leverage, but you've already made tons, so you shouldn't be too worried about that. Stop looking in a silo, in a blinkered way of what you're doing right now. The whole point is he didn't know how to measure himself properly. To be able to be successful in trading, you need to be able to measure your profitability, and I'll show you exactly how to do this in a way that you don't beat yourself up. Then you understand the FX markets, which are the factors I discussed, plus some more in terms of policy shifts and macro environments, as well as price action, not just momentum, but mean reversion, which is an incredible component that's important, which I actually exploited in my hedge fund. And finally, how is it that you can use the right leverage, Kelly betting, to really extract value? So now, right now, I'm selling the Academy course, which has just come online for $597 as a one-off payment, or 4 times 167 monthly payments with obviously the usual 30-day money-back guarantee. But if you sign up within the next hour, you also get 2 free half-hourly consultations with me. Any questions you answered. I say half-hourly, but I usually tend to talk a lot and listen a lot as well. If you live in London, we can meet up. I mean, the time constraints aren't that. I had to put something down there, but it's really up to you. And of course, at the bottom, you've got the link. Now, this course is the outcome of live classes and seminars that I have given in the past at multiples of this price. And right now, what I realize is that a lot of people say to me, well, you know, the prices you did charge in the past are not necessarily affordable. And there's a big desire in me to actually put this knowledge out there, because as you've seen throughout the presentation today, it is possible to extract value. And so then a lot of people ask, well, if you extract value, why teach it? And I gave this some thought in terms of what's a great answer. And I think the best answer to give is like, you obviously all saw Star Wars, and the Emperor went and found Darth Vader. I've been in the very fortunate position of having students sign up who then go out and develop their own systems. One of them at the moment is in the process of setting up a hedge fund. And you know how much I learned through students joining me? It's just tremendous. And I'll tell you what, running a hedge fund is very solitary. Being able to generate a community of people who participate is a tremendous experience, which is probably one of the big reasons for setting this up, is to engender a community of people who are really looking for Peter Lynch's 10-bagger out there. Now, here's some of the feedback that I've had over the last 6 months in setting this up, doing the live seminars, doing the one-on-one training and coaching. And obviously, this is about the material that is right now in the Video Academy course that I'm offering today. And the people who've taken it are students from economics courses, IT professionals, business people, actually one guy who does import-export out of England to the UK, of conservatories, professional traders, investment bankers, as well as Air Force engineers. So it's open to more or less anybody who is numerically able, can understand, add and subtract numbers, and has a keen interest in the markets. Okay, and now I'm going to give it back to Simon and to you for any questions and answers that you might have with regards to any of the content we covered today.
Well, thanks, Corvin. That's fantastic. Very concise. So you're looking for Darth Vader then?
Yeah, more or less. You know, it's interesting. No, it's not just about the dark side. I suppose. Well, hey, Darth Vader's a cool guy.
He was very. Yeah, he had a lot of influence on people. Let's say. Well, fantastic, Corvin. I think you've again gone through rapid fire a lot in there. I mean, clearly this is stuff that you've gathered yourself from your own experience of running the hedge fund. How do you? I mean, this is just from me. How difficult is the transition from running a hedge fund? Obviously, you're managing much larger sums of money compared to what the average retail trader will be. Do the strategies change? Is there anything significant in sort of the size of positions you're managing, whether that affects your trading decisions? How would you say that?
There's 2 points that immediately come to mind. One is P&L anchoring. So I'll tell you what, when you're in a hedge fund and you're in a losing streak, what senior management tends to do is to reduce your capital and your risk. So all of a sudden, rather than swinging maybe $50,000 or $100,000 a day in terms of P&L, you swing $10,000 of P&L. And then as you want to move it back up, because maybe you're doing well and senior management has increased your capital, you're anchored to $10,000. And all of a sudden you become incredibly scared of swinging $100,000, which is just psychological gobbledygook. And when that drives the point home, people tend to think in numbers, which is useless. You need to think in percentages. I don't care how many dollars you've made. If those dollars are just like 0.5% of your actual capital, it's useless. If they're 90% of your actual capital, you're crazy. You need to think in terms of percentages. I don't care about pips. I don't care about dollars. That's all useless garbage. You need to think in percentage terms. And anybody who doesn't think in percentage terms is going to lose. Point number 2 that immediately comes to mind, you asked about strategies. So my hedge fund was very much focused on intraday, medium frequency strategies, holding periods from like 5 minutes to a couple of hours. We had infrastructure to deal with slippage. We had to reconcile our positions between our front office systems to back office and systems at banks, and then reconcile that with what clients saw on their trading platforms. It was a nightmare. And I can tell you that I don't recommend intraday strategies for clients. I'll give you a very classic example. I'm not talking high frequency market making. I'm talking about here the kind of usual stuff that people are told about in terms of 2 or 3 minute scalping. The big hedge funds out there like the Tudor Joneses or the Tower Researches or the Jump Tradings that have invested tens of millions in their infrastructure make 70 to 80% of their P&L on intraday strategies out of good execution. If you're sitting at home with an MT4 that has a latency of 100 milliseconds and the broker probably quotes you garbage anyway because he doesn't want to be taken to the cleaners during news announcements, you're playing the wrong game. You need to step back. You need to ask yourself, are there any kinds of things out there that will make me money in the long term in a consistent way? And the answer is obviously yes. And that's really what I'm all about in terms of teaching people. And that's really what the difference is between a professional setup and being at home. But I'll give you an example. Buffett. Do you think Buffett sits there buying, selling every 2 minutes? There was a very interesting paper out of MIT back in 2007-8, and some guys asked this question. You see, when somebody buys a big equity size, he's got to report it via SEC 13F filings. Now, in Buffett's case, when he buys something, he doesn't want to be front run, so the SEC, which is the Securities and Exchange Commission in the States, allows him to delay his publication or announcements by 1 or 2 months. So the interesting question was, if Buffett trades today, but it becomes official and public 2 months later, and then I act upon that information, do I get the same performance? I mean, usual market lore would have it that the information is old, it's stale, I can't do anything. Well, it actually turns out if you go back and you test the strategy, which again, black and white, you test it, there's no ifs and buts, you actually have the same performance as Buffett. And that tells you something about the markets. It tells you that if you're looking for long-term profitability, trading within the first 10 seconds of whatever is completely irrelevant. And that's why I really like this approach, because it takes the onus from having to worry about technology and operations into looking at the markets and understanding them. Now, obviously, I understand that people have this desire to interfere with systems. So what I say to them, well, at least generate the FX benchmark I teach. And then, of course, you can trade around it. But be careful. Don't blow yourself up on whatever discretionary trading you do. At least leverage off the technology that I'm teaching you to generate long-term profitability.
Okay, thank you. Peter's asking, how do trade costs with rebalancing affect? How do trade costs with rebalancing affect performance?
That's a wonderful question. That's exactly the kind of question that investors tend to ask as well. You see, because you're trading once a week and once a month, so some of the strategies I look at trade once a month and others once a week, you can imagine that the rebalancing costs are completely irrelevant, to the extent that, you know, what does it mean to trade at the end of every month? If you look at the back tests that I provide and the data that I provide, it's usually literally the last calendar day, business day of the month. But I can tell you, you know, sometimes you go out, or you're don't have access to the internet, or for whatever reason you have to transact a day late, or you transact a day early because you just want to be on time. It does not matter. This is the point about having continuous value come to you out of the market. It's there, and you have to just execute and implement. It's not about obsessing about 2 pips here or there.
Could you just explain what's meant by rebalancing for anybody that might not understand?
Very easy. Let's say I bought 100 shares of Facebook. Let's say I'm a tech freak and I buy 100 shares of Google, 100 shares of Facebook, and 100 shares of Amazon. And let's say that the reason I've done that is because I'm looking at their price to earnings ratio or whatever other fundamental factors that drive equities. And let's say that a month has passed, and all of a sudden these factors I'm looking at have gone out of kilter, and it's telling me that I should have maybe twice as much Amazon and only half as much Google, but Facebook I can keep the same. So that change in portfolio makeup, the actual execution of trades to get to the new portfolio, that's called rebalancing, or also known as churn if you do it very regularly. And you can imagine if you're an intraday guy or a guy who rebalances daily rather than monthly, you have to change your portfolio on a daily basis. And once you go down that route, of course, you will incur transaction costs. But if you only rebalance, i.e. trade, change your portfolio much less frequently, those costs, just like, you know, you can forget about them.
Thank you. Saz says, can I see the leverage numbers on the hedge fund mix again?
Yes. Actually, what I think I probably should do is, well, look, I can make this presentation available via Simon later on as well, but for instance, on this particular slide, you can find it at my website. I've got a blog article that goes actually in great detail together with a spreadsheet as to how to construct it. So if you're really keen on understanding this, now it goes better rather than just looking at the slide with a picture. Go to my website, look for that blog article, and it's in great detail there together with a spreadsheet, and you can track it yourself.
Okay. Tom says, is your AUM assets under management in your hedge fund?
So at the peak, it was $50 million. I mean, just to be clear, I exited that fund on December 31st, 2015, and just to be upfront, the reason I did that was I had other business visions than my business partners, and we all decided amicably to move in separate directions, and I sold out, and I'm doing my own thing, trading my own capital. And at the peak, we had $50 million under management, which, yeah, it's a lot if you think of it from a private investor's perspective. We probably could have sold better to big investors and gotten more money, but also that, yeah, that's the way it is.
One final question from Peter. On Kelly betting, is there a risk to hit a margin call from the broker? And how do you avoid that?
So that's interesting. The way Kelly betting works is you look at your distribution of historical returns from the strategy you're trading, and there you end up asking, what's my average loss? And it's this average notion of average loss that ultimately influences what your leverage is. So because you're very much tied into your average loss, and your average loss isn't your maximum loss, you usually tend to be in that kind of situation where no, you're not going to hit your margin. And trading full Kelly, now people talk about full Kelly for the reason that if you trade anything bigger than the Kelly leverage, you can more or less show mathematically that you will go bankrupt with probability 1. People therefore tend to trade less than Kelly, probably half Kelly or a quarter Kelly. Even the hedge fund portfolio I showed there wasn't trading Kelly at all. It was trading probably a third or a quarter Kelly. In those kinds of situations, you won't hit your margins. And predominantly because you're never going to take that the kind of leverage that brokers offer. And that's certainly true within the FX space. It's something that you then have to validate with any other offering. For instance, if you look at Reg T in the States where you can only use twice leverage for equities, obviously Kelly betting will be out of the question. So you do have to find the venue that allows you the right leverage, and then you do have to understand, you know, what the impact that has on my margin. But if you trade a third or a quarter Kelly, hitting your margin calls won't be an issue. Why? Because remember, Kelly makes you trade bigger size as you make money, and it makes you trade less size as you lose. So your position sizes are never actually fixed. This is what people don't understand. They think that twice leveraged means that rather than trading $10, I trade $20. No. On Kelly betting, you have to recalculate your position size at every point in rebalancing, because the more money you make, the more risk you take. The more money you lose, the smaller your position sizes will become.
Okay, fantastic. What going back to your course, the FX Master course, can you just explain again, just in the last couple of minutes, what can people expect to find there by signing up? How long does it typically take you to complete?
So the course tracks these pillars, and it's really around about 18 hours of videos, together with spreadsheets, tutorial videos on how to set up your MT4 platform. There's a bonus section in there for people who are curious to know MT4 in slightly more detail. It takes you right from the basics to how do I program the dollar index up in MT4 for dummies, so that, you know, people want to see the dollar index, and then you can apply that and create your yen index. You can do lots of different things like that. The other one that you can do with this kind of situation is you can look at. Sorry, there was a ringing in the background. Let me ignore that for the time being. So you have lots of different elements, and they really focus on these 3 pillars in terms of how do I start out understanding trading, measure myself, understand the factors, combine the factors, and generate something that's long-term consistently profitable. We also talk about tactical methodologies for those people who are really keen to trade around the strategy and around the benchmark itself, because as I said, you don't just have to trade the benchmark per se, you can trade the underlying constituents as well.
Okay. Who's this course pitched at? Do you need lots of experience? Should you have a strategy already, or would it be better just to know nothing really and start?
That's a good question. Look, I mean, I'm not going to explain bid-ask, and I'm going to assume you know what a chart is. Everything else more or less gets explained, but if you're familiar with the markets, you know where the buy-sell button is, you can follow along. Now, yes, there are sort of requirements in terms of if you want to dig deeper into the data. I make all the data available in the back tests, but you have to understand the back tests to actually implement the strategy. No, because there's a difference between implementing rules and trading and actually going and digging deeper. It really depends on what kind of person you are. The one thing that I found very useful for my students is to actually have a model portfolio where I trade the strategy actively and implement it so that people can look. Because one of the biggest issues that people tend to have is they get information and then there's this big kind of overwhelm, how do I implement it? So in this strategy or this course, I do have a benchmark portfolio that I have set up. And for people who join, I'm in 2 minds now if I were to set up this portfolio again from scratch, just so that they can follow and see exactly what are the trades and when are they put on, and to actually see what it means for people to do fat fingers. In the previous portfolio, I did have a couple of fat fingers, which led to some losses, but you know, that's more interesting from an educational point of view. You know, this is real life trading. People do make mistakes. How do you deal with them? So you can see the live portfolio as it follows and tracks these rules.
Okay, that's good news. Tom's asking, do you fund an FX trader consistently profitable? Tom, I'm not sure. Can you improve on the question? There, I don't know where you're coming from with that question. Do you find FX traders consistently profitable? Or are you thinking get funding? I don't think you fund, Corvin, do you? I don't think you.
Oh, if I fund personally,
Do you take on? Mhm.
that's an interesting question. You know, the question is, of course, how much? I mean, you know, I'm not an institutional investor that has $100 million lying around for somebody to be funded. It's interesting. That question, I think, goes back to the idea of, you know, if you as a private investor think you have track record and you want to set up a fund, how do you go best about doing it? Now, if you think about wanting to set up a business, and let me give you an analogy, you'd probably go to your bank and get a business loan. Now, obviously, in trading, that doesn't work. There's nobody out there that's going to give you a loan to set up a fund. The best way to do this is to go to friends and family and try to raise as much money as possible. Then spread it via word of mouth and try to actually get yourself to a position where you're managing several $100,000. And once you're doing that consistently, I guarantee you money will flow in. But what you're going to find with trading, with running a hedge fund, it's a business, just like a shoe business or potato business. You got to sell the shoes, you got to sell the potatoes. If your hedge fund doesn't have a marketing department and doesn't have a sales guy that dials for dollars and pounds the pavement, you're not going to go anywhere. I'll give you a classic example. Winton, which is one of the biggest hedge trend followers out there, until 2004, managed barely $1 billion. They hired themselves a very good hedge fund sales guy out of UBS, and more or less they took off like a rocket and had several billion just a couple of years later. It's about selling. It's just like another business. So if you're really asking, do I need track record or what do I need to raise money, you need to be able to network, to talk to the right people. Of course, you need the goods, but you need to have the right audience. And your initial audience is really about friends and family. Then it becomes around hot money, which is known as money that likes to invest in people like yourself. For instance, you tend to find them in Chicago or Australia. And then you go to the institutional guys, such as Jeffries and Jeffries and others out there who are willing to invest in you once you've been around for 3 years and have track record and have some money to show for it.
Yeah. There's also some of the brokers are offering this idea now. Brokers like DarwinX and Iondo, where you can trade as a trader, and other people can actually sort of look at your track record and place money with you as well.
Right, that's a phenomenal idea. That's a very, very good suggestion. But one needs to be sort of mindful of the fact that in situations like that, you see, your investors, and that's true for any kind of sized investors, they tend to have very short memories. If you've made money for 3 months but then lose in a month, they're going to be out. So you just have to live with that. But actually, social trading, as it's known, is a very, very good idea.
Corvin, I think we'll have to leave it there. We're just on 1 o'clock. But thank you very much for a fantastic presentation. You've covered an awful lot. Again, there's questions coming in. If there's more questions, please, perhaps we can just direct them straight to you. What email address would people use, Corvin, to get hold of you?
How do I make that available? Do I just put here?
Is it corvin@codirla.com?
No, no, it's trader. It's trader@fxmastercourse.com.
Trader@fxmastercourse.com. There we are. So anybody can get in touch with you. We've posted a link as well a few times for the master course. So go on to there, have a look. Failing which, there's Corvin's email address. For any more questions about the course. But in the meantime, Corvin Codirla from FX Master Course Academy, thank you very much for joining us. I'm going to take the presenter role back now.
Thank you very much, Simon.
Thanks again. Thank you very much to Corvin there. Somebody just asked about the various links that we have been putting into the chat box from the presentations so far this morning. There are 4, so if you missed any of these, I will pop these into the chat box now for you. Just have the times next to them so you can distinguish the various sessions that the links correspond with. So there they are there if you want to go and revisit some of the websites that the speakers have been talking about this morning. So thank you very much to Corvin Codirla. It's now just gone 1 o'clock, and I'm delighted to welcome back Carol Hallmey. Carol, of course, started us off this morning and did our 9 o'clock session. and was deluged with questions, which was fantastic. Some great questions, and of course such a lot of material to go through that we had a great suggestion from Caroline to ask her if she could come back, and she's agreed. So delighted about that. So we'll go back over to Carol now and see if we can resume the presentation that we were doing. We were looking at all the different markets and reviewing it, not just the technicals, but also some insights that only someone with a career that Carol's had, I think, could enjoy. So I'll take the microphone off and say, hi, Carol. Are you back with us?
Yes, I am, Simon. Hi.
Well, welcome back. Thank you so much again for coming back. We did send an email out telling people that you were coming back, which is great. So lots more have joined us since then. So we covered a lot on the first hour this morning, which was great. And we were just starting to look at one or two of the markets. And of course, we've got the US markets opening up shortly as well. So perhaps we could maybe start off with looking at some of these markets, and then we'll ask people to put some questions to us again, and we'll start the conversation.
For sure.
I'll go to make you the presenter. If we go through the process again, you should have a little box again asking you to confirm the presenter. Wonderful.
Okay. What I haven't got is that little box that showed me how many people were in.
Okay,
Do I need that or not?
We don't need that. We've done everything's just the same as it was.
Perfect.
I can tell there's about 165 people in the room.
No, it's okay.
Okay.
Thank you. No pressure.
We're all very happy to have you back. So let's go. Does anybody have any questions or particular markets that you would like Carol to start off with? Well, our first question from Saz. Do you use any hedging strategies?
No.
Okay.
Blunt and to the point. No. The trouble with using intermarket correlations is this. They go away from each other many times. So we used to have the old adages that stock markets went up, gold went up, currencies went up. Well, we knew that fell out the window around about 2011, 2012. So we're now on 2016. Now we have seen gold move up now with the stock markets, but as you can see, for a long time we didn't. So just because one market is going up doesn't mean to say that its counterpart will be going down. It doesn't work like that. The intermarket correlations that used to be change flavour of the month, flavour of the year. And the thing is, I prefer, if I'm looking at the S&P, I'm going to look at the S&P. I'm not interested in what anything else is doing. If I look at cable, I'm going to look at what the cable crosses are doing for sure, but it's not going to influence me that much. And as for hedging, you know, you depend on, let's say your euro-dollar position is going horribly, horribly wrong. What are you going to do? Are you going to go into the Bund market? You're going to go into the DAX? You know, where are you going to hedge? What market is going to offset the loss that you're getting in another one? You're much better off going, do you know what? I was wrong, out, start again. So I tend to look at every market as complete individualistic markets rather than stock markets go up, bond markets go down. Yeah, you know, that's been the case for many years, but there have been periods of time in my 34 years that hasn't happened. So your normal things that you were taught all those years ago have not applied so much as 34 years have progressed. So I much prefer to not hedge, not do anything, just have, you know, some outright positions on and see where we go.
Okay.
I'm seeing where we're going on something now.
What about gold and oil? Could we take a look at the gold and oil charts?
Yes, we can. Gold is particularly interesting. and it's actually one of my favourites. Can you all, let me just pull that down, can you see if you can push that back up. Right. So, as I said, you start off with, you have a look at your weekly chart, your monthly chart, and you get to see, oh, let me just get that for me. You get to see.
There's two charts here. There's one.
You are. So I'm going to pull, I want to show you the both of them, because what you do is you actually look to the weekly to get your primary and secondary trend, and then what you do is you work that into your daily strategy. Well, look, if you can see this, I can assure you last week it was very rare to actually find anybody that wanted to go in and buy gold. But you know, you have to look at what the overall picture's been doing of gold. Yes, we've come down. If I put that onto a monthly, you're going to be able to see that a little easier, I think. You know, from the dizzy heights of September 2011, you see this descending wedge pattern that we've had for, like, it seemed it went on forever. And don't get me wrong, of course you could make money within this, but you needed it to break either way to actually get on the back of it starting to trend, which it did, as you can see, back only this year, you know, February, March time this year. So this descending wedge pattern, I thought was bullish, and we didn't break any levels on the downside, and we did have enough there to break it on the downside. So it's like anything, isn't it? What can't go down must go up, and that was the case with this. So you can see this monthly chart of it going really just edging down, off we go, we break. So you take it back to the weekly chart, you can see that we've been making this little pattern here. Now when I say it's a little pattern, because it's on a weekly chart, this has actually taken 2 months to progress to this level. Now on Friday we hit lows of 1310, 1308. I think is the low of gold, and as I'm sure there's a few of my guys on there at the moment, and they will tell you we bought gold at 1311, you know, and it was a bit hairy. Why would you buy into a sinking market? Because you're looking at the overall picture of it. If you go into a daily chart, you can see you've got the same little pattern, but with more information. Can everybody see that? So although it looks like the bottom of the world is falling out in gold, unless it broke through some really good weekly support, it was going higher. Now, after doing this for 34 years, I have to tell you, even I sometimes cross my heart and go, oh my good Lord, and I take the position and I go away. You know, I don't sit there and look at it all day long because it drives you nuts. And sometimes we have 4, 5, 6 positions, not that we take daily, but that are running, that we've held for a few days. I mean, it can add up. When I said previously that 3 or 4 trades per week, good ones, will actually get you through, what I didn't tell you is that that's fine, but if you're running them, sometimes those 3 to 4 a week turn into 5 or 6 or 7 that you end up having on a Thursday afternoon, you know. So there are times when I even say, that's it, going downstairs, doing something else. Because if I sat there all day long, it would drive me insane. And if it drives me insane, I would drive my little band of traders insane, and I'm not prepared to do that. So we know where we're going in, we know where we're looking for it to go, and we ride with it. Now, as yet, we haven't broken out of this line here, which is coming in at around the 48 to 45 area. If you look at that weekly chart, okay, the projected, even the minimum measure target on gold, by taking your 176 points, which is what this pattern has made, off of the baseline, takes you up to 1478. Now, if you do it as you're supposed to, off the upper bound line, trend line. Comes in at 15.27. Now, with anything, as I've said before, you can always add into a winning trade. You know, we have got a trailing stop loss. We're locked in a profit now, whatever we do. So we're quite happy to run it and add to it above 36, above 48. Do you see what I mean? Do you see where I'm trying to get towards? Hello?
Hello, yes, sorry.
Hello. Do you see what I'm trying to explain? Is that these patterns, you know, here looked a bit toppy, didn't really do a lot, therefore you go, do you know what? You haven't broken that 38.2, you've held that trend line, there's got to be something in it. Look at the weekly chart, you can see the support, there's a rake a bit, go with it, you know.
Fantastic.
And I'm not saying I'm going to run gold till 15.27, but what I am saying is that at 13.10 to 08, it was a very, very lucrative buy.
Indeed.
And must have been because it's gone up a lot.
What about the Japanese yen? Can we turn a couple of people asking for...
Oh, do we have to?
Look at that. Spot FX, Japanese yen as a quote currency. Do you have a prediction based on the recent policy by the bank?
Well, you see, working, I have to say, for a good few years at the wonderful Nomura Bank, the one thing, oh good lord, the one thing I did look at is the fact of the BOJ was great, but they were quite predictable. But let's look at the dollar yen overall. Now, with anything, always remember this, is that topping and basing patterns take double the time of continuation patterns. So when something like this dollar yen, okay, unfolds, and you've got this top. Now, it doesn't matter what their strategy is, the market was going down. Now, they had a measured target of 108. It reached 108. We went back up. We now then took a dive bomb. Now, if you look at that weekly chart, there isn't really a lot in there that makes me want to rush out and buy it. Not until we get down to here. Now, the other thing that's really, really important, so this is the 99.50 to 40 area. The other thing that is really, really, really important is being the only Japanese bank in the UK at the time. Nomura was the first Japanese bank to get its banking license. So there's only 8 of us that actually started Nomura Bank way back in 1986, 87. The one thing we did learn about the BOJ is they are chart fanatics, and they come in and they read these charts unbelievably amazing. But they would tell us, obviously, the central bank is going to tell its bank what it's doing and why it's doing it, because it doesn't want to see its bank get buried. Same as the Bank of England used to tell the 4 clearers. Exactly the same happened at Nomura. Exactly the same happened when I was at Credit Suisse with the SMB. It does it. It doesn't come out and tell you exactly. It says, I would not be long of this at this level. You know it's going down. Do you see what I mean? So the Bank of Japan are not stupid. They saw this. They knew it was going to tank. What they didn't want was it for it to tank out of sight. So they tried to get in what they did with interest rates. So you had a lot of the fundamental traders going, well, look, it can't go any lower because the BOJ have done this. Well, the BOJ, same as any of the central banks, put a plaster over an open wound. So they know where it's going to go. They just don't want it to go down in a straight line, and markets don't go down in a straight line. So as for the dollar yen, yes, I think we could see it down quite a bit lower than where we are now. As I said, 99.5 to 99.40. Now, if that don't hold, eek. You know, and when people tell me that can't happen, well, it did here. Look at where the dollar yen's come from. you know. And if I put a monthly chart on, it would surprise you even more. So these things do happen. The world doesn't end if the dollar yen went to 94. It won't. Same as it didn't end when it broke through 116. It's just the way that markets are. Our weekly charts look negative. That's for me, the hourly chart. And then what you do is you just try and incorporate what you know into what the daily chart is doing. So here I've put on my little trend line down up just above parity there. Okay, I know it's been down there before, but just about here. So I would be looking to buy into dollar yen from this level down to that 99.5 level. Okay, below that I'm out. It's wrong. But for the moment, whether the BOJ are going to do anything else or not, because they left rates unchanged, whether they're going to do it again, the market will always find its own ground, and the fundamentals will follow it. It does. It really, really does. So have I answered the question on the dollar yen? Because after working at the Moor, I have to tell you it's not my favourite currency.
I think so, Tom. I think that should answer the question. Now, Bill,
You're buying into weakness, but you're going to be very cautious of doing it. The one thing the Bank of Japan likes to do is come out and trip you up. 4 years of working for them, I understood that, okay? Because they didn't try and trip us up.
Okay, thanks. Yeah, Tom says thanks. Now, Tim, Bill, David, Steve are all asking questions regarding time frames. Which time frames do you prefer? Do you trade multiple time frames? Do you have a comment on that?
Yes, I do. Trading at multiple time frames, of course you can, because your weekly chart will tell you your primary and secondary trend. So you've got to have an idea of where it is, where it's going. You know, I'm always looking for a pattern to emerge, or whether it's severely overbought, oversold, blah, 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 blah. And I try and work in the weeklies to the dailies. The lowest time frame I ever go on, if I'm a bit bored and nothing's really happening and I want to take a little bit out of the market, would be an hourly. I think anything less than that, you're going to get patterns develop and overbought stochastics, indicators, whatever, thrown at you a million times a day. So I tend to, the shortest time frame I will use is 1 hourly. And even that I find is too short term for the way I like to do something. But if they're all showing the same sort of thing, which they can do, make no mistake, then I'm quite happy trade off of an hourly chart. I like the 4 hourly because that gives you more information than the daily. But I do like the weekly charts, as I said previously, through going through the trading strategy for the coming week. Because, you know, even experienced traders do get sidetracked. You know, the internet man turns up, something, the cat's done something or else. So unless I personally, I'm very visual, so I need to write things down, you know, like we did training on trading card. You know, my first ever technical trading was actually done on pivot points because it was easy. You just got the high-low close, divided by 3, multiplied that, took that away from that. You had 4 levels of support resistance levels and the daily pivot. So I've always written things down on the back of bits of paper, trading cards, blah, blah, blah. So when I go through and do things on a Sunday, I write them down so I can refer back to them all the time. What did I say there? What was my weekly pivot for the euro-dollar, for cable, for the S&P? Where are we away from it? Where's the first R1 on the weekly? So I'm always, I'd never remember that on a day-to-day basis, Simon, because I look at so many markets and answer so many questions on a daily basis, I'd forget. I know I'd forget. So I write them down. If it's important, it's on my trusty pad.
Yeah, for those of us that remember pens and paper, of course, it's come up a few times
already.
Well, I know,
sadly, Listen, it's very lucky I haven't got a chalkboard with a bit of, a blackboard and a bit of chalk. However,
fantastic.
oh,
Can you tell us a bit about the Charmer Trading Academy that you've established
God.
as well?
Well, I think I've always been, those that know me, right, I've always been a very, very low-key trader. I have. Although when you're younger, you do like to go on the CNBC, Reuters, my love is trading. That's trading using charts and technical analysis. That's my thing. So anything else, selfishly, I thought detracted me from that. And it's only when you've done it for a good few years you actually think, you know what, I have got something to say. And I think my being involved with the retail market, and it's only been a very, very new thing for me. In fact, I think my first ever dip of my toe into the retail market, we was actually at the London Olympia show, Simon.
I remember that.
I didn't even really know too much about it before then, apart from those people I knew that were starting up these retail platforms. Now, probably I've been involved with retail traders now for about 18 months, but mostly this year, since January. And what I've come to realise is that as I've got to know my little group, and I do keep it small, I don't want loads of people joining, so please don't think that I'm trying to sell you to come and join my little group. That's not the case. But what I thought was, these guys that are sat at home on their own are being bombarded with, I'm not saying bad information, but they're not being helped in any way. And I'm basically reaching, after 34 years and being 60, the end of my full-on trading life. There's only so many days up, so many more years I can get up at 5 and finish at 10. And that is my life Monday to Thursday. Fridays, I take the afternoon off. But what happened was, the more I was getting involved with my little group, the more I realised that, I had something to say. And you could only have that something to say if you'd lived it and worked in it and done it. Everybody's got something to say, but unless they've actually been on the live floor from day one, been on the live floor at the end, done the screen-based trading with the futures guys who bless their little hearts, which is why trading arcades, professional trading arcades, was set up. Been at, I've been at 3 really terrific banks, Midland, Nomura, and Nomura was probably my greatest coup because it was a new bank. Japanese banks were not allowed in England, and Nomura got the first ever UK banking license. So when I was asked to go and be manager of technical trading, hey, we were told we were the best in the world because they could pick the best in the world. We dragged in our dollar-yen dealer from California. I'm sure he wasn't happy, but he came anyway because he was made an offer he couldn't refuse. Now, although we giggled about it, that we were great, all that aside and joking apart, unless you've actually lived through that sort of thing, and you've seen, I'm sure everybody's read the book, The Rise and Fall of the Nomura Empire, please for the love of God, unless you've actually lived through that, stock market crashes, bear markets, bull markets, some guys are out there trying to say that they are this, that, and the other, and you ask, well, how long have you been? Oh, about 8 to 10 years. Well, have you actually been in bear markets and bull markets? The bottom line was, I thought before I shifted off to a far, far, far better place, I wanted to see if I could help. And the more I've gone into writing this and getting it up and running, the more I've really loved it. I'm sure you can all appreciate I do love to talk, but only about something I am so passionate about. And I'd like for everybody, in an ideal world, to be able to trade profitably. Too many people make hedge fund managers gods, bank treasurers gods. Oh, I've worked with them all, and they're not. They've got the same insecurities as you out there. The difference is they've done it for a lot longer. That's the problem. But traders are by nature wary, suspicious. They're not, you know, is it wrong? Isn't it wrong? Am I right? Aren't I right? That sort of thing. So you're not alone. And I just wanted to put that across. And I wanted it to be in a really nice, relaxed setting down in southern Spain where I would get to know them, they would get to know me. They're coming to my home, and it's small. I don't want big classes. I don't want to stand in front of seminars. Good Lord, Simon, you know me at the London Olympia show. I was absolutely shaking before I went into that seminar. But once I was in it, the people's faces disappeared. I was talking about what I know best. And that's what I'm hoping to achieve with what I'm setting up here, what I've set up here.
It sounds fantastic. Our previous speaker, Corvin Codirla.
And the thing is, it's going to be a lot of fun because it's all right doing, I'm very visual, as I said, worked on the floor, worked in dealing rooms where there are hundreds of people, thousands on the floor. Although I'm quite happy to do a webinar with you because I know you, in my head, I'm only talking to you and a few on my group that are listening in, bless them, to give me a bit of courage. I don't want to know how many are listening. It's just me and you, or me and Lars, or me and Chris, or me and Rebecca. Do you see what I mean?
Yes.
So I'm good in front of people. I'm not good at putting PowerPoint things on a webinar and being parrot-based. It's not me.
It's not the only way to do it. In fact, our previous speaker, Corvin, was saying he's been running a sort of a hedge fund with some of his colleagues up until the end of last year. He's now trading his own capital and offering a similar type of video program course where he interjects it with mentoring as well. And he was asked why does he do it? It's a question that I hear speakers being asked all the time, of course, being in this position that I'm in, and he just went back to this idea that it's this fairly solitary role to be your own trader, to be either a trader from home or even running a hedge fund or whatever it is, and he gets a lot of enjoyment just out of the community and being able to sort of talk and interact with other people in the group. And I guess that's what you're alluding to as well. There's a certain sense of it's not just about selling courses, but it's about creating something and actually enjoying that whole process, because this sort of process of trading and making money is completely personal. But,
and I will say this to you, for me, the courses are not about the money, because the money you can make for trading, rather than have one person in your home for 5 days, it's a no-brainer, So it's certainly isn't money orientated for me, because, as I say, I'm a trader. But the idea of wanting people and show them what it was like, how we did it, what are the little trading tips that a lot of the time I've remembered writing it. I mean, I'm not going to do it parrot fashion. It is a presentation, but it's a funny presentation. It's a 5-day. You ask me what you want. I'm yours for 5 days. I'm going to cook for you. I'm going to drink wine. We're going to have a great time. Blah, de, blah, de, blah, de, blah. It is a very solitary life now, being a trader, which is something I'm just not used to, because it wasn't. For 20 years of my trading life, it was a phenomenal buzz of different people. I mean, you imagine when I left the live floor in 2000, there was 4,000 people worked on the floor. Get it into perspective. What room would you have now that would have 4,000 people in it? Wouldn't. And to this day, we have a huge majority of that 4,000 that keep in touch. We have 2 life reunions. I've now been elevated into what they call the old git reunion. Now,
an honoured title, if ever there was one.
Isn't it? That's the life humour, I'm afraid. I have to say that, there's many from our life family who have died They're getting more and more actually as the years go by. But I was quite young down there. You had kids of 16. You could be 16 when you started on the live floor. I wasn't. I was 23. But that's what I'm saying. I grew up. My trading career started in this hub of a mass of people. To start out now, me and a computer, I don't think it would hold me like it holds me now.
So you need to connect with other people online and
you do, although I'm very selective of who I interact with online, let me tell you. You know, I've got the balance just about right where I can mentor. They're all at roughly the same level and they all come in at different levels. Now, where they're getting, do you know what I mean? I'm so proud of them, I could burst. So if you start putting others into the mix, it's not going to work. What I'm saying is that these courses, academies, rooms, they're great. They really are great where you can bounce ideas off of each other. And it gives them and me a sense of community. And trading is all about camaraderie. You work hard, it's serious business, but you've got to be able to have a laugh and a giggle while you're doing it.
That's right, that's right. Well, we sort of set a de facto community up ourselves with the Round the Clock Trader, and there's a nice regular attendance. It's always nice to see the familiar names that come in and join me every month and listen to me droning on and presenting things. But it does help.
Simon, they're lucky. Mine have to listen to me droning on every day.
We've got another sort of 15-20 minutes really. Tom is dragging us back to the markets. He says, do you think the pound will break out the range
I'm glad you asked.
Since Brexit?
Let me look. And that was another thing, wasn't it? What a kerfuffle over not a great deal. Brexit, for the love of. Cable, sorry, I call it cable because that's what I know it as. Let's get away from that hourly chart and let's look at the weekly, which funny now I'm looking at. Let's put it into perspective, first the monthly. See this is my trading era, okay? That's how I cut my teeth. You can imagine, can't you? When you look at that. So what we've had recent times for traders, when somebody tells me they've got 10 years experience, I'm like, well, that's great because it hasn't really done a lot. However, we could be. So there's your monthly. You can see that, you know, down here, not such a bad target for cable. And if, I'm not political, but fundamentally, if cable needed to rally, there's no way they would have hiked rates. That was just like red rag to a ball, and down we came. However, let's look at the weekly. So I just wanted to show you this because you can see that we had turbulent times back then, and we all had to learn basically at the same time, which was a bit upsetting. Right. See this little bit here, okay? This is like a continuation pattern. Now the difference is you've got this top, so you've got a static top and a rising thing there. Can you see that? That little rising trend line, which is lower, higher lows. You can just, right, let me put that out a bit. Is that better?
That's better, thanks.
Fantastic. So when you've got something with lower, so when you've got something with rising lows, that normally means it wants to go up. Now, we've got this, we're not taking a lot of notice of that at the moment, not while we're down here, because this pattern here, okay, you can draw a little flat top along there, and it is around the 134.60 to 134.80 area, okay. So if the buyers keep pushing it up and the sellers are static at that level, what happens? Well, there's only so many they can sell with a tirade of buyers. So at one point, they want that to break. And when it does, and it's going to break only on a break of 135.5. That's when we can see cable come back up. We say high, but you've got to remember it's not that long ago that 138 was low. So let's get everything. The thing that people don't say is you've got to get things into perspective. For example, my God, cable's really high, it could go to 138, as opposed to 8 months ago going, oh my God, look how low cable is, it went to 138. Do you see where I'm getting at? Are you following me? It's people's interpretations of what is high and what is low. So at the moment, I think, apart from this, which is the little stochastic here, that this is quite a good area, and we've actually got orders in, correct?
Yeah.
We've actually got orders in to buy sterling down at these lower levels. Now, we missed it yesterday. It got within a whatever, and it went up. So I'm either going to raise the buy order or buy a break of 131.5. Okay, I think that we could quite easily go back to the top of this band here. Now, technically, what we do at this band here is that pattern is one that should break to the top side, giving you 138. Only time you're ever going to be looking a bit naughty on sterling is if we break below. We've got a low, remember, of 127.95. We can take that up even a bit more now, because if we break that trend line here, the chances are at this 129 and a bit level, the market will come down to 127.95 and probably down, if I move this up to this area here. Now this takes me out, I do like doing this. This takes me out to December, because I like to see the time frame of when we came. We can forget June from here to here, and then how long it's taken for this to form. And that gives you time as well as projected targets. Now for those that are shorter term, that's my longer term strategy. Look, you know, we've made this base pattern. We are seeing higher lows. We do have the technical indicators telling us that it's ripe for a long position on weakness. There's where we didn't have it. And there is no reason why we can't go up to here and even to here or here. Okay? Historically, that is not that high. So don't get people carried away. The one you really want to watch is the euro sterling. You know, that's going to show you the direction of, you know, if you're trading euros and you're trading cable, you can't not look at the euro sterling. That's another thing. Here, I think sterling goes higher. Not forever and ever, but I do believe that at the moment, more people want to buy sterling than to get rid of it. And for very good, solid technical reasons. Next.
About the equities, bonds, and gold markets. Could you comment on?
Gold I've gone through with you, did I not? I went through gold with you, like.
We've been through gold, but how are the markets behaving in relation to one another? Asks Corvin.
Well, at the moment, they're both going up together, which is as they did way back pre the crisis, the recession. You know, you have always, not always, but in that period of time, you had gold going up, currencies going up, stock markets going up, and the bonds going entirely different. That has been seen. That went away. They decorrelated for a long time. Seen it come back a little bit now. So maybe now the world is as it should be, and these correlations that have been in place for Zions come back. Remember, things go through flavour of the month. You know, who doesn't remember sitting there for the trade deficit figure out of the US? Who bothers to look at it now? It's been non-farm payroll for God knows how long. And now you're seeing FOMC coming through as because everybody's focused on interest rates because they've done nothing for 10 years. So markets get what I call a flavour of the month, flavour of the year. So now we're seeing them act as they've done in previous decades. Gold up, stock market's up, currency's up. No one likes the dollar. You see what I mean?
We looked at, I think you looked already at the euro dollar this morning, but Darshan may have just joined us recently since then.
It
Do you
really
have,
isn't doing a
you have
lot.
the view on the euro dollar?
I have. I mean, I do think if we look at the euro dollar very briefly, it's not a brilliant market at the moment, I have to say. You know, because it's not doing a great deal. It's, as I showed you this morning, you know, traders love a trend. We do love a trend. Now, if you look at what it's done in 2014, okay, it was like slam dunk, down, 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 and since here, you know, so we're going on for nearly 2 years. You can see it hasn't done a lot. Now, that brings me back to my base patterns and top patterns take a lot longer to form than continuation patterns. So if this had been a continuation pattern, I think it would have gone down before now. The fact that it hasn't leads me to believe that we have seen the low in the euro dollar. And even though we are looking towards the top of our range, if you look at these Fibonacci levels, and you know, whether you like them or you don't, unfortunately you have to be aware of what they are and where they are, because they are heavily used in the market, and they are. So whether you like them or you don't like them, just be aware on great big weekly long-term charts, they are used. So even if we come back to the 38.2 at 112, you've still got a lot more mileage in to the top side, coming in at like the 18.5 area, 50%, 122. Do you see what I mean? Even this great big long 200-day moving average comes in on 200-week moving average at 123 and a bit. Now, you have to be aware of them, and this looks to me like it's a base pattern and not a continuation pattern because of the length of time it has taken to form. Normally, when you get a continuation pattern, this goes down, you've got a year and a bit, you know, or just on the year. So a continuation pattern, in my experience, should take no more than 6 to 8 months to form on a weekly chart. This has dragged on there for 2 years. So this is why this isn't the most impressive chart I've ever looked at, but it does tell me something that's gone sideways for 2 years, not in a continuation, is it? Doesn't want to go down. It wants to go up.
When you say continuation pattern,
well, in pattern recognition, there's 3 things. You have a top pattern, a bottom pattern, or a continuation pattern. Okay, so markets go up, down, or sideways. That's the way it is. They don't go anywhere else. They're either up, they're either down, or they go sideways. When they go sideways, we call it a continuation pattern. Okay, now the thing is with continuation patterns and base patterns is the timing. Continuation patterns take half the time to form as what the prior trend took to get to that point. So that bit there should have been a continuation pattern, and down we go. That there should have taken out that low there. It didn't. In fact, that low there was lower than that low there. And so you see it's gone up. So we look at that now as a base pattern, not a continuation pattern. A continuation pattern is a pause for breath. It's running up that mountain, getting out of breath, standing there, drinking your water, having a chat, eating a Twix before you do the next leg up. Do you see what I mean? It's the only way I can describe it. You stop, you take a breath. Continuation pattern is a pause for breath before the previous trend resumes. The previous trend was down. This should have been enough. And then down again. Didn't. There was no fundamental reason at all why that held that double bottom. There wasn't. Just the fact it didn't break below there. Now, technical traders were only selling a break below here. They weren't selling. Now, look, it wasn't just technical traders. The rest of the planet wanted to buy the euro. Yes, we had our up days and our down days. But look, it just went up. We had higher highs, higher lows. We've come back. We've held trend lines. We've gone up. We're at the midpoint now. 112 is slack back in the middle of the top of the range and the bottom of the range. Personally, I think we break to the top side. The interesting thing in the euro is going to be a break of 18.5. Here, I think you're really safe buying into weakness unless we break 110, and I don't think we will. If you want to do it even more short term, okay, unless we break 111, I think you've definitely got more mileage to here on this particular, another little continuation pattern within a pole. It's another story. But for the moment, you're longer currencies, short of the dollar.
Thank you. Okay, what about, there's some more questions coming in. What about the euro pound?
Yes.
Sorry, not what Tom's asking, why watch the euro pound?
Because if you're trading the outright sterling and you're trading the outright euro against the dollar, why not watch it? Because what you're watching in the euro sterling is what one's going to move the most. If the euro sterling is at 86 and looks like it's going to 87, you know either euro is going to, whatever happens, euro will outperform sterling. They can all go up, they can both come down. But at the end of the day, if that cross is going higher, the euro is going to outperform sterling, therefore giving you a slight edge on which one you trade. Okay, so if you think your outrights are going to go lower, but your euro sterling is rock solid, you'd sell sterling. You wouldn't sell the euro. Could you understand that?
Yes.
Great.
Sorry, I'm going back to the euro dollar. Sorry, Rob's just come in. I think what we were talking about, the chart that you have up there, he says he thinks a lot of the action there was traders exiting short trades.
Where? Here?
I think that's what he's referring to, that point there where it started to go up again.
That's not my take on that time, no. It wasn't. The thing was, yes, you may well have seen short covering, you know, or also profit taking. Don't forget, markets work both ways, okay? If the markets, you don't know, unless you're on the floor and you can see the buyer and seller and you know what position they've got, unless you're actually looking into their eyeballs, you don't know what position they've got. So don't be misled that because it's going down and when it goes back up, people are buying it. They're not. They could be taking profit. We do it all the time. We're short here, we buy it back here. We sell it again here, we buy it back there. The key to these weekly charts is look at that little, not a lot of action week. Look at when it first did it. Bang, straight down, bang, straight up. Do you see what I mean? This was running out of steam on the downside. Look at where our stochastics were on the weekly. Less than 5%. Now, if you have the extremes of 80-20 ratio at 4% with this, look, you can see down, 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 up. Then this bit, down, yeah, great, down. Not so much. Bit overdone. See where it starts to get overdone and the downside run out of steam. Can you see that? And on that week, there was very little action. So I don't believe that it was people short buying them back. You probably got a percentage of people that were mainly, God forgive me, in the retail market. But in the real outside in Forex land, you can see these tell you a story. No interest. Why didn't it push lower? What possible reason did it have for not going lower? What made these turn? What made this bit here look like the downside was running out of steam? You've got to remember also that the people that trade this have teams of researchers looking just for these things. How do I know? Because I have actually personally trained 5 of them who, I'm sure they're still going, but are now head of research at prominent banks across the globe. And that's not being, you know, I don't say these sorts of things, but they're trained to look for something like that. And it's not just the ones I've trained, it's the ones that have been doing it as long as I have, the ones that have been brought up looking for this specific thing. So you can read what you like into a chart, as long as you're reading it how the rest of the world is reading it, absolutely perfect. But there are 2 sides to every trade. Whatever you buy, someone's selling it. Whatever you're selling, someone's buying it. Be it on a spread betting platform, be it on the futures exchange, be it in Forex. You know, when the dealer goes on to sell a huge amount of currencies, we used to ring round various banks and sell it to other banks. We used to hit them so they were long of it. Do you see what I mean? You've got to understand how the market works before trying to rationale it in just what you've looked at in, say, 1 year, 2 years, 5 years. You need to understand Forex, trade it, and that's how it works.
Well, Carol, thank you. I mean, this is the second time saying thank you for joining us today.
You're welcome.
You've spoken
so
for
I haven't said this program.
Well, it's been very, very good of you to come back and do that.
That's all right.
So we do appreciate it. So if you fancy getting onto one of Carol's courses, they're not all the time, but I think I think you have one in October where you can.
They're fully booked, Simon. Our October ones.
Okay,
We've actually got bookings right through to December.
Okay.
And we haven't advertised it yet. This is just we haven't advertised them yet, but we are. Our first 2 are fully booked. But you know, please, you've got the email address. Go have a look on the website. Simon will put it up for you.
The website posted.
As I say, I'm not one for putting myself out there, but I do like to. It's something I'm quite passionate about.
If you want to join maybe early next year and get in touch with Carol, that's the place to do it, charmertradingacademy.com. But listen, thank you so much. Thank you, says Carolyn. Thanks, Carol. Excellent stuff twice, says David. Brilliant, says Michael. There we are. Thank you. You're a gem of knowledge, Carol, says Tom. So there we are.
Thank you.
That's just
Thank you, everybody. Thank you for listening to me for 2 hours twice in one day. I really appreciate it.
In our benefit. Thanks, Carol. Take care. I'll take the presenter back.
Enjoy the rest of your day, eh?
Thank you very much. Thank you.
Okay. Bye.
So there we are. So thank you for Carol Harmer for coming back and running up. We've just run out of time this morning. Lots of issues that Carol has been able to deal with and answer questions. But visit her website if you want to get any more. We are almost coming up to 2 o'clock. Getting on for halfway through Round the Clock Trader today, 22nd of September. Welcome everybody. If you've just been joining us, we do have a rolling attendance on this event, which is great. My name's Simon Campbell, and I'm the host for today's event. In fact, I'm the host for all the events. I'm delighted to say that our next speaker, Rogowski, is from Societe Generale. Societe Generale are one of the companies that make this event possible as a sponsor.
and Ryan is joining us today to talk about their ETP products, which are growing very quickly in popularity with traders and private investors. Before we go over to Ryan, we're going to take a quick look as a refresher at one of the introductory videos that are available that make a very good explanation of just exactly what short and leverage ETPs are. So we'll spend just a couple of minutes watching that, and then we'll be able to go across to Ryan and get into the live presentation. So if you bear with me for just a second. Okay, sorry for the delay, everyone. The video is just taking a little longer than anticipated to open. I guess I'm using a lot of programs at the moment on the broadband link. Well, apologies, everybody. I did test this. I'm afraid the video, the very short video that we were going to play you doesn't seem to be working. I'm afraid the video is not opening up and running. So this is all part of the fun of doing live events and live webinars. I know that the video is something that does take up a lot of memory, and perhaps that is causing the problem. When we tested it before, we didn't have anybody on the link. So yes, good idea. Thank you, Dan. I'm going to send you all the link to the video so you can watch it yourselves. But I'm not able to open it up. So I think what we'll do is we will just go straight over to Ryan and see if he's here in the room with me. Ryan, can you hear me?
I can hear you.
Oh, good afternoon. Now, you'll be listening to me sweating away. Good afternoon. We're having a bit of an issue with the video, unfortunately. It's not playing as scheduled. So I think what we'll do is we've emailed people the link to the video so they can watch it in their own time. But I think the best thing we could do perhaps is just to go straight into the presentation, if we may, and we'll come back to the video later. Unfortunately, it's not going to play ball with us today. I think maybe it's perhaps the memory that it takes up, or the bandwidth. So we're now looking at the front slide of your show. So Ryan Rogowski from Societe Generale, rethinking leverage, short and leveraged ETPs. Can I hand over to you to get started?
Perfect. Thank you for having us today. Why don't we do the following? If we jump, I guess, to slide 4 to kick things off. I guess slide 4. Slide 4 is kind of almost taking a step.
Okay. Sorry, Ryan. There we are. Slide 4.
Super. So yeah, I guess taking a step back before we jump into the product itself, what I think is very important when you're investing in anything is obviously to know who's behind the product, who is backing the investment that you're making. And it's of particular importance, obviously following, let's say, previous financial crises where we did see some banks or financial institutions get into trouble. And so what slide 4 is recapping here is, I'd say, the size and breadth of our institution, SG. So although we're not necessarily a high street bank in the UK, we are in France and we are a global bank. And this slide is just recapping and reminding people that we've got approximately 150,000 employees worldwide. We've been in the UK, in fact, for over 150 years. You've got brands like SG Hambros, which are part of our group. And on the top right as well, you can see we have approximately 30 million customers. And so I guess to start things off, when you talk about products offered by Societe Generale, you're talking about a large and established global bank. And what I would highlight is when we talk about investment products, you're almost talking about what's at the core of our global markets offering. So important, and I'll highlight later on why I think it's important. But the way I like to think of it is when you talk about the products that we typically offer, we don't typically just offer one component. So for example, we don't just offer the investment that people can put their money in, but we will also typically be providing liquidity as a market maker as well. So I don't know if you like to think of the tech world and you like to, let's say, compare Apple to, I don't know, Google. If you talk about you buy an Android phone, so the operating system is run by Google, your phone can be from Samsung or from HTC or from any other provider. I'd like to think of SG as the Apple of the investment world in the sense that not only do we provide the actual products themselves, but the market making, hedging, and trading behind is also fully supported by SG. If you flip to slide 6, so I guess we pop over directly now to introducing short leverage product. There's really 3 key points we'd like to get across. One, these are leverage products with the aim of enhancing performance. Yeah. So first and foremost, people will look at our products, our short leverage products, as a way of leveraging and amplifying potential returns, either long or short. Secondly, there's a wide range or a multitude of investments that people can make. So we're not just talking about equities, but actually we have products in commodities and foreign exchange as well. And last but not least, it's a directional exposure. So as I briefly mentioned in the first point, these are products which allow investors to express a long or bullish view on a particular underlying, or if they're confident that the underlying may go down, they can express a bearish or short view, i.e. they can profit from a fall in value of the underlying investment. And on the right-hand side, we've put a couple of points which we think are also important. So even though these are leveraged products, contrary to some other types of leverage investments where you may lose more than you initially invest, by definition, our short leverage ETPs are floored at 0. So the maximum you can lose is the money that you put in. Secondly, they can be traded in your ISA and SIP. So if we contrast again versus the leverage world of CFD spread bets, these are securities. They can be put in ISAs and SIPs. Thirdly, they're listed on the LSE. And I guess more and more these days, with all the regulation coming into play, with certain firms moving in and out of markets, it brings a level of comfort and confidence to know that when you're making an investment in a short and leverage product, you do so via an instrument which itself is listed and traded on the London Stock Exchange. So all the benefits that come via that, the price discovery, the continual quotes, investors do benefit from. And last but not least, because it's traded on the LSE, these types of investments are bought and sold like a regular share. So you open an account with a stockbroker, you don't need to open a new account, and you can buy and sell these investments just like you would a share in a company. If we flip to slide 7, please. Slide 7 goes into a bit more detail on the types of underlying that you can invest in. So around the top and the bottom, we mentioned that we're not just talking about equities. So you can invest in things like oil or gold as well. So on the commodity side, you can invest in natural gas, precious metals. You can also invest in the currency pairs, which we offer here. And of course, still tend to be some of our more popular underlying, the equities themselves. So the FTSE, the Euro stocks for Europe, and the DAX, so the German index, which we found a particularly popular underlying index that people would like to gain exposure to. If you look at SG or Societe Generale's range of product, we tend to focus on the 3 times or 5 times leveraged investments. So for all these types of underlyings, our products will provide, depending on which ones you choose, either 3 times the daily performance of the underlying or 5 times. Now, again, investors can choose the direction that they want to participate in. So whether you want to go long 3 or 5 times or short, we tend to offer both of those directions. Now, how do they work? If you pop onto slide 9, we'll get into a bit more detail on the nuts and bolts. How they work is relatively straightforward. On a daily basis, and let's take the 5 times leverage as an example. On a daily basis, if you invest in a 5 times long product, your product will perform 5 times as much as, let's say, the FTSE. So if the FTSE goes up by 1%, the product will go up by 5%. Conversely, if you're invested in the 5 times long and the FTSE goes down by 1%, you will lose 5%. So the product simply provides, on a daily basis, 5 times or 3 times the leverage of the underlying market or index that you're choosing to go long or short. So that's, I guess, how they work in a nutshell. A particular point about that mechanism, so if you flip to slide 10, is the fact that what I described was the daily exposure of our short and leverage products. And that's of particular importance because we're explaining how things work day to day. In other words, the leverage is reset on a day-to-day basis. So what we do is we look typically on a close-to-close of the market in order to calculate our performance. So again, if an underlying asset increases, you will on a day-to-day basis increase by 3 or 5 times the leverage performance. Slide 11, I guess, is almost a kind of explanation in a bit more detail about how we construct the product. So how I describe the leverage, we're effectively providing a 5 times or 3 times leverage. So that's your economic exposure on a day-to-day basis. But it's not, at SG, it's not just a trust us approach. What we've done is we ensure that we work with independent calculation agents. So for example, we work with FTSE on our FTSE index, or Selective or stocks and some of the under indices. And actually those firms are the companies calculating the performance on a day-to-day basis. And so the short and leveraged notes that people invest in, the SG notes that are offered, are actually tracking these indices which are calculated by independent index providers in order to provide an additional layer of comfort and transparency to investors that the 5 times or 3 times leverage is being adhered to exactly. So to summarize what I just said, the note tracks a leverage index. The leverage index is calculated by a third party. So whether it's a 3 times or a 5 times leverage investment, investors can be reassured that the calculation is managed through an index. And that's actually summarized again on slide 12. What I would highlight, obviously, with this and any other investment product is that, of course, there's no free lunch. SG charges a fee in providing these products, like all the other providers. And so your daily leverage might be 3 or 5 times, but your net performance at the end of each day will be equal to the performance of the underlying asset. So for example, the FTSE, multiplied by the leverage factor. So let's say 5 times the FTSE on a daily basis, minus any of the associated fees or costs. And in terms of fees or costs, there are generally 2 types of fees or costs you can find. One is the annual fee that we charge, and that's specified on a product-by-product basis. And 2 is what we call the gap fee. I like to think of the gap fee as an insurance cost. When you invest in our products, say a 5 times leverage product, in theory you have a situation where the market could collapse and go against your investment decision. Now, there are theoretical scenarios where the market falls by so much that actually with 5 times leverage, you could lose more than your investment. Now, since that's not possible with the products we provide, i.e. we effectively underwrite the investor to have a hard floor of their initial investment, so the product cannot fall below 0, it can't go negative, SG charges an effective insurance fee for that. Yeah, so that's an additional cost which people need to be aware of. Again, these are daily leverage products, so the fees are taken out on a daily basis. So although we quote some of these fees on an annual basis, if you were only invested for 1 day, you would only be charged 1 day's worth of that annual fee. Now, slide 14, if we pop over there, we want to zoom in, if you like, on the daily compounding, because this is an important point. On one hand, our products floor investors, so they can't lose more than their initial investment. They do provide leverage, whether 3 or 5 times. Now, the way we provide that daily leverage, the way we provide that is via daily leverage. And what that means is if an investor were to invest in one of our products, every single day, the leverage is reset on the value of the short and leverage instrument. So for example, day 1, if the short and leverage security is worth £100, you have 5 times leveraged on £100. Day 2, if that underlying investment goes up or down, your leverage is refreshed or reset on that prevailing value. So for example, if the market goes up 5%, if the value of your investment, should I say, goes up by 5%, so it's now not worth £100, but £105, you're now 5 times leveraged on 105, and vice versa. And actually, what we did was we put that, I guess, a bit more clearly on a graph on slide 15 to really emphasize the fact that over time, this compounding effect means that your initial 5 times leverage investment will change over time. So if you look at the green line, we started £100. Day 1, the underlying investment goes up, day 1, the short leverage security goes up by 5%. So if we were invested, for example, in a 5 times leverage product and the FTSE went up 1%, we make a 5% gain. So we're now worth £105, which is your bullet point in the middle of the slide. Now, day 2, your investment is £105. You have another 5% gain. You're actually now worth 110.25. So you're not making 5% each day, or you're not making £5 each day because of the fact that every day we reset the leverage, and therefore the 5 times leverage or the 3 times leverage is dependent on the prevailing value of your short and leverage security. And so profile-wise, what you find is in an asset that's rising day by day, you're effectively making more and more money. And conversely, in an asset that's falling day by day, your 5 times leverage is on a smaller amount. Now, on the face of that, it looks like it's a win-win scenario. But in reality, what we want to stress or highlight is the fact that if you suffer a fall of your investment, so you fall 5%, for example, from one day to the next, and now your investment might be worth 95, you're going to need more index performance to claw back your losses. And so these rises and falls over time are very important for investors to be aware of, because the profile that you're investing in does change from day to day, which is why we generally see investors holding these types of products for reasonably short periods of time. Now, if you flip to slide 16, we've got, I guess, another concrete example of that, as I briefly described on the downside. You have two columns here. You have your leverage performance, and you have the value of your short and leverage investment. And so what we're showing here is day 1, the leverage performance is showing a 10% fall, which means your security falls to a value of £90 from 100. So £100, 10% fall is now worth 90. Now, day 2, that underlying market bounces back, and you make 10%. Now, if you were invested directly in that underlying market, ignoring fees for a moment, you'd have a net performance of 0, i.e. you lost 10%, you made 10%, you're back to square one. Now, in reality, when it comes to short leverage products, and even most investment products, when you lose 10%, even if the underlying market has a 10% gain, what you find is it's a 10% gain on a smaller value. And so as you can see here on day 2, we fall from 100 to 90 day 1, but day 2, even though we have 10% gain, that 10% is on a smaller number. We're making back 10% on £90, not 10% on 100, which takes us back to a value of £99. And so it's really important that we highlight, I guess, that both sides of the equation when you're talking about daily leverage, because in this scenario, even though the leverage performance completely rebounded, an investor would still be down 1% on the short leverage investment. If we jump to slide 17, two safety features, if you like, we wanted to highlight. One is the airbag mechanism. So again, our products are floored at the money that is effectively invested. So investors don't have to worry about margin calls or going negative in terms of how they invest. And the airbag mechanism, what that does is it helps protect investors during steep market falls. And so essentially what happens is in a fall above a certain level, and that's dependent on the leverage of the specific short and leverage product, what we do is on an intraday basis, we effectively reset the leverage of the product to 5 times. So for example, if you have a day where the market falls, let's say 15%, and your short and leverage investment falls 75%. Depending on the product, the airbag mechanism may kick in. Your value of your short and leverage at that point is worth £25. So you've fallen 75%. It's been, say, make an extreme equity market fall. The airbag kicks in, and what it does intraday, as opposed to on a daily basis, is it then goes in and again resets your leverage to 5 times. So you are now exposed to 5 times the market, with a critical point that it's now 5 times from a value of 25 in my example. And so the reason the airbag mechanism is effectively built to say, wait a minute, the market has really collapsed. Let's freeze the product for, I think, again, depending on the product, for a period of time, for a short period of time, wait till the market calms down ideally, reset the leverage, and we're off to the races again. Now, again, very important point, if you've invested in a product that has fallen substantially, we're now 5 times leverage on a much smaller number. What that means for investors is it's going to take a lot of positive performance to claw back their initial capital or gains, depending on when they invested in. So that's the airbag on one side, and I guess the video from the beginning of this call, I mean, we have a few videos on our website, go into a bit more detail on how the airbag works. The right-hand side is the second safety mechanism that I wanted to highlight. Again, as we stressed at the beginning of the call, any investment you make, it's critical to know who's backing the product. In addition to the fact that Societe Generale is a global player, a large global player, what we do is we post collateral assets. So we post additional collateral in a segregated account in order to help protect investors in case something should happen to us as the issuer of these notes. So in the adverse scenario where something happens to us as the issuer of the product, investors have a pool of collateral in a segregated account, in an escrow account, which can be liquidated to repay them. Now, of course, in an adverse scenario, the value of the product itself is going to be changing regularly, but the collateral feature is meant as an extra mitigant in order to help protect investors should something happen to Societe Generale. If we jump to slide 19, I guess a quick recap on what we mentioned a bit earlier. Trading short and leverage products, or ETPs, is just like buying and selling shares. They trade on the LSE, and literally you buy and sell them via your stockbroker. It's quite neat for investors who want to maintain their current brokerage accounts with whomever they use to deal in stocks or ETFs. You don't have to open a dedicated account to trade short and leverage products, as you do with some of the other types of leverage products on the market. And again, you're trading these directly with your broker, not with SG. The products are listed on the LSE, and last but not least, these products do have costs, so please be aware that performance, whether it be 5 times or 3 times leverage, following the calculation of that performance, the cost will then be deducted. Slide 20 is a recap of the types of markets that you can trade in with us, whether it be equities, commodities, or foreign exchange. What we tend to find is investors investing in our products. A lot of them can be momentum driven, so where there are particular big moves in certain asset classes, we coincidentally tend to see volumes increase in those particular instruments. And again, I would stress that although these products are listed on the LSE, SG provides, or we stand behind our liquidity on the LSE as a market maker. So that's not preventing other market makers from also setting themselves up and market making our products, but it provides what we hope is a nice backstop to know that we're not just a provider of the short and leverage product, but we can also stand behind and add liquidity and act as a market maker on the exchange. Slide 21 is again a quick recap. 3 key points. We leverage the daily performance of these products, whether long or short, and again, it's daily, so every day we reset that leverage. 2, the maximum loss is limited to what you invest, and I guess many of the people on this call who have spread betting or CFD accounts would have seen situations where, for example, when the Swiss franc had their big overnight revaluation, or certain instruments might revalue overnight when markets are closed, a stop loss is not necessarily a hard floor. So our products, they have a hard floor in the sense that your maximum loss is limited to what you invest. And last but not least, you buy and sell them like a normal share. What to be aware of? These products are all capital risk, of course. These products are leveraged, and therefore your losses, so let's ignore the gains for a second, your losses as well as your gains will be magnified. You invest in one of our, or any short and leverage product, they are capital risk, and your losses as well as your gains are magnified. And last but not least is the daily compounding of returns, which we've discussed a few times. So what I would suggest is we can end on slide 22, make my compliance department happy. I guess a refresh of all the risks one more time, just for you to have a read through. The daily compounding, the leverage, the capital risk. We We put a counterparty risk on there as well, so on and so forth. Again, I mentioned to you how we mitigate that, but these are important risks that investors should be aware of. At this point, I guess I tend to be short and punchy with my presentations. Very happy if any questions.
Ryan, thank you. It's Simon here. Thank you for that. One question, just on the last slide, Paul said, could you just reiterate it says the maximum loss is never more than what you invest, and yet the losses are magnified with leverage.
Yeah, so if we take an example, let's say an investor invests in one of our short and leverage products and it's worth £100. So if we address the first point, the maximum loss is what you can invest. If you buy an instrument that's worth £100, it can only fall to zero. It can't go negative. So first and foremost, the minimum product value of any of these instruments is zero. And therefore, whatever value they are when you purchase them, the maximum they can fall to is zero. Now, and of course, that's contrasted, say, versus CFDs or spread betting, where you might have a stop loss, or for example, but maybe the market moves so fast and your leverage is so high that actually you have a margin call. Here, that's not possible. The airbag will kick in, but when ignoring the airbag for a second, the security itself cannot be worth a negative value. So first and foremost, whatever you invest, if it's £100, £200, £1,000, £10,000, it can only fall to zero. I say only, that would obviously be not a good scenario. Now, in terms of the leverage, the speed at which you can lose money, because these are leverage products, is magnified. So if you invest, in my example, £100 on a 5 times leverage product, and let's just take the example that you're 5 times long a market, and the market starts to fall, every 1% fall in the market will cause a 5% value fall in the short and leverage instrument. So the speed at which you make or lose money because of the leverage is magnified. So taking only the downside, if the market is falling, you are falling, or the value of your investment is going to fall at a faster rate. Again, the maximum fall it can have is down to a value of zero, not negative.
Okay, fantastic. Ryan, thank you. That's really cleared that up. Thank you, says Paul. Yes, Paul. Great. Jay Hallmey says now these are listed on the London Stock Exchange. I think the answer is yes.
Yeah, they're listed on the LSE, and for those people who are interested to know the tickers and for further information, www.sgetp.co.uk. So SG for us, Societe Generale, ETP.co.uk, has further information with the actual tickers of each of the investments.
That's right. Well, the next question was asking actually what is the code for FTSE long and short. So they'll all be there on the.
They'll all be on the website, yeah. So for whichever ones they fancy, and we do encourage investors, should they not be readily and easily displayed on their broker's webpage, to drop us an email again on our website, and we'll happily give the brokers a call and try and make sure that they can see the products on that specific broker.
Fantastic. Fantastic. Yeah, a question about the brokers. Just clarifying, I think you mentioned that before. You don't buy the UTPs from Societe Generale directly. They come through the brokers. So you just use your own broker. Is it all brokers? Yeah.
You use your own broker because there's securities that we're talking about. So you just like buying and selling a share, you use your broker to buy and sell a short and leveraged ETP. Whatever, if we're talking about fees, obviously depending on the setup and the charges you've agreed with your broker, one would assume that you'd pay that same fee as to buy a share as you would to buy a short and leveraged ETP.
Okay, so a slightly longer question coming in. Trying to trade warrants through self-trade, SG20, SG30, and SG37 not possible. Why is that? Data for 2 of 3 Glencore warrants missing from the website. Okay, so this is an issue with someone that trading through self-trade.
Yeah, again, for particular, so I guess they're referring to some of our listed warrants. For those types of questions, please ping us a line on our website. We have a specific dedicated team who can actually come back to you and can also try and liaise with the relevant brokers that you trade with to make sure that the process for trading is as seamless as possible.
Yeah, so we can't answer questions on these particular shows. That's the place to go, is the SGETP website.
Yeah, I mean the email address is etp@sgcib.com. So etp@sgcib.com. I guess I can't address the specific points now, because what I'll do is I'll get into our terminals, get the broker on the phone, and obviously we try and work out what exactly the situation is and rectify it via that route as quickly as possible.
Yeah. Okay. Does anybody have any other questions? Okay, I don't think there's any other questions coming in right away, Ryan.
Welcome to Societe Generale's educational video.
What I am going to do
exchange traded product
is we are just about to launch the video where we didn't get a chance to play it at the start. Unfortunately, the system wasn't allowing me to play it, but we have got it opened up now. So what we'll do is we'll finish off with that short video addressing the basics again of short and leverage. But I think in the meantime, we'll say thank you very much to you.
Thank you
for joining us live. And we'll go over to watch the video now. So about short and leverage. So Ryan Rogowski from Societe Generale, thank you very much indeed for joining us.
Thank you.
Also known as short and leveraged ETPs. In this short video, welcome to Societe Generale's educational video on short and leveraged exchange traded products, also known as short and leveraged ETPs. In this short video, we will look to guide you through the key features of short and leveraged ETPs, from how they work and what they provide investors, to how they can be traded and some of the risks you should be aware of. Short and leveraged ETPs are exchange-traded products which are designed to multiply the daily performance of an underlying asset by factors ranging from 2, 3, or 5 times. What this means is that for every £1 invested, you can generate the same profit or loss as investing £2, £3, or £5 respectively in the underlying asset. When you purchase a short and leveraged ETP, your capital is at risk. However, unlike other leverage products in the market, like CFDs and spread bets, there are no margin calls, so you can never lose more than your initial investment. Always remember that leverage means you can lose your money faster than if invested in the underlying asset. Short and leveraged ETPs are available across equity indices, such as the FTSE 100 and DAX, foreign exchange pairs like Eurodollar and Euro GBP, and even commodities like gold and oil. They also allow you to potentially benefit in rising or falling markets. If you expect an underlying asset to rise, you can invest in a daily long. If you expect an underlying asset to fall, you can invest in a daily short. A daily long will generate a positive leveraged return if the underlying asset rises, and a daily short will generate a positive leverage return if the underlying asset falls. Short and leveraged ETPs are listed on the LSE. They can be traded much like a share via your standard broker and can be held within your SIP or ISA. They are not subject to stamp duty. So to summarize, Short and leveraged ETPs are designed to provide investors with 2, 3, or 5 times the daily performance of a particular underlying. They can be linked to a variety of underlyings and asset classes, including equities, FX, and commodities. They allow investors to potentially benefit in rising or falling markets via daily longs and shorts. They are designed to be held intraday due to the nature of the performance calculation. They can be traded via your broker, and whilst they do put your capital at risk, there are no margin calls, so you cannot lose more than you initially invested. Short and leveraged ETPs can be a useful trading tool for investors. However, you must be aware of the risks. This video has provided a brief introduction, but for further information you are advised to read the full product brochures or other literature which can normally be found on product issuer websites or the London Stock Exchange.
Okay, so there was the short video. We should have had at the start of the presentation, but unfortunately we weren't able to, about short and leveraged ETP. So thank you, Ryan Rogowski from Societe Generale, for that presentation. And thank you for joining us. If you are just joining us in this Round the Clock Trader event, my name's Simon Campbell, and this is the 12-hour trading webinar event that we're working our way through. Our fantastic speakers. We have next up, 3 o'clock, Alejandro Zambrano from Londinium FX. What FXCM taught me about trading over 6 years. He will be starting in just over 20 minutes from now at 3 p.m. Following Alexandro, 4 o'clock, worry-free wealth building strategies using VectorVest's unique tools from Dr. David Paul at VectorVest UK. Then into the evening schedule, we welcome Stephen Goldstein from Alpha R Cubed, Emotions in Trading, How to Avoid the Emotional Hijack. And at 6 p.m, welcoming our new speaker, Christian Fromhertz, founder and CEO of the Tribeca Trade Group, Three-Pronged Attack to Trading ETFs. So closely related to the presentation we've just had. Thank you to Douglas for recommending Christian to come and speak at the event. Looking forward to that presentation. 7 o'clock, Bo Yoder and his partner Roger Curry joining us at 7 p.m, the 3D Apex Probability Analysis Layer. Don't be put off by the name. It is simpler than it sounds. This is Bo's and Roger's system for analysing the markets and testing failure analysis. So he'll explain all that at 7 o'clock. And then again at 8 o'clock, another new speaker, Matt Golden from Vantage Point in the US, using global confirming markets to increase profitability. So looking forward to that. Still got lots to come. So if you need to take a break or would like to take a break, now is probably a good time, since we have around about 15 minutes or so before the next speaker will be getting started. I could probably use that time by telling you a little bit more about what we're doing, or I'm doing rather, here at London Investment Week. We are continuing to host the Round the Clock monthly webinars, as we do. We also have a special week of webinars coming up at the beginning of October, the London Investment Week Live, which will be a full week, Monday to Friday, with lots of different speakers involved on that, and we'll send you details of that, of course. And then in November, we're doing our first Round the Clock Trader Live. Not a webinar this time. This one will be a proper live event We are holding it at the Grand Connaught Rooms in London, just outside Covent Garden. 5 seminar theatres, 30 plus speakers, many of whom have attended the round-the-clock webinars, certainly from the UK. They'll be coming down on the Saturday to spend the day making a talk, but just generally meeting everybody that's there and answering questions and just getting to know each other. A good opportunity for everybody that's here on the webinar. If you are able to get to London, it's a good chance to get to meet everybody else who's been attending these webinars. So we've spent a long time conversing through the chat box. It'll be a nice opportunity. So if you can join us, then that would be fantastic. Obviously, as a attendee, you've got a code there for free ticket to the event. So just go to the website roundtheclocktrader.live and use that code RTC001 for your free ticket. So looking forward to it. Should be fun. We've got about space for, there's going to be about 12 or 15 companies there, but also just really the chance to get to know some of the speakers, find out more about their mentoring, and hopefully you can enjoy that. Dan, the event on the 5th of November, will it be recorded? The honest answer is I don't know at the moment. I have broadcast these events in the past via webinar, but not when I've been also organising them. So it's a resources issue to be able to live stream at least one of the halls would be my preference, but I need to see if I can find someone with the sort of technical know-how and of course willing to give up the time to come and do that, because I would be otherwise engaged running the live show. So leave it with me. I will try to make that happen for those of you that are not based in the UK. But for the moment, I couldn't make any commitment to that. If anybody has any questions for me, please just tap them into the chat box. As I mentioned earlier, we're welcoming a few new speakers today, and it's been nice to be able to get these recommendations from some of you from last month. And again, equally, if there's anybody new that you would like me to contact to perhaps bring onto the webinars in the future, please do just see if we can put me in touch with these speakers via email, and I'll do my best to see if we can bring them onto the show. It's not always possible, unfortunately. Obviously, it's restrictions on time and availability and so forth. So we'll look into all the speakers recommended. Hubert Centers isn't someone that's been recommended yet, so I will get on to that. Dan, if you have an email address. So yeah, so coming back to you in just under 15 minutes time with our next speaker, Alejandro Zambrano. What trading 6 years with FXCM taught him. He is now the founder of Londinium FX.
Fantastic. Wow. Oh, that's a nice slide. That's a
Yeah.
nice. I think it's dawn breaking over the city, or it could be late afternoon sun. I don't know, but we can certainly see that. If people at home could confirm that you can see that slide and that you've also been able to hear Alejandro speaking, that would be great to let us know that all the technology is working. Fantastic, great. Oh, super. Okay, we're all working. So how the time of day can help to predict market behavior. I'll hand over to you, Alejandro, and we'll sort of take some questions as we go.
All right, beautiful, great, thank you. Okay, good, guys. Thanks so much for joining. I'm gonna share with you guys today some interesting statistics, some stuff that I had a hunch about, and something that I eventually actually did some tests on and discovered some really interesting things. And it is how, depending on what time of the day it is, how we can use that to predict what the market is going to be doing. Of course, though, unfortunately, before we start, I'm just going to show you this. So let's just spend about 10 seconds to go through this. As you know, trading financial markets is extremely risky. Okay, I guess you guys already seen that 1,000 times now anyway. Okay, all right, good. So obviously I already introduced myself, but let's do it again. And this is me over here, Alejandro Zambrano. As I said previously, I used to work for FXCM. I was the head analyst at FXCM's London desk. I was managing a team. I had two analysts with me in London, and then I also managed one guy in Texas. And I used to work for Daily FX, and I did that from 2009 to 2016. Obviously developed educational programs. You know, we had a lot of people in the office, met a lot of traders, a lot of pros, a lot of people that are new, a bunch of different people that you would meet for a broker like FXCM. And then of course I would, participate in the CTM active trader conferences. FXCM themselves would do big events. We would have like 500 people, and it would be me and a few of my colleagues, and we would, host a full day of just education. I also spent a little bit of time at an investment bank, which is Swedbank, which is Sweden's biggest retail bank. And I spent some time at the FX and fixed income desk. So I was, trading spot FX on behalf of the clients, and also, if people wanted to buy, bonds or short-term interest rate products, we would offer that. Okay, so let's get into what we're actually going to talk about today. So let me explain to you how I actually figured this out. And it had to do with the way I actually started to trade forex. Because you see, in 2006, that is when I started. And I was studying at university at that point. I had finished my first year, and I was on my second year of a bachelor's degree. And I was trading with a real account. And because I had class in the early morning, the first lecture would start about 9 a.m. That meant that I would go up about 7 or 8 a.m. in the morning and would look at the markets, and with the help of what I was seeing in the early morning, I would try to derive some trading ideas. And obviously this had to be fairly good, because this is in an era before any of the major brokers offered any mobile trading. So what I would usually do is that I would take on a position maybe 7, 8 a.m. and then I would adjust the positions at lunch break. I would go to the university library and update any positions I was holding. And the idea I developed was obviously something I read online, but also I did a little bit of background research about it. But what I'm doing is I'm trying to capture surge and volatility, which you're going to see in the start of the London session. So this funny looking chart here shows you the difference between the high and the low in pips per hour. And this is London hours. So you can see here at 5 a.m. the average hourly volatility is a little bit more than 5 pips, maybe 6 pips. As a matter of fact, throughout the night, the so-called Asian session, and the volatility tends to be very, very low. You can see here we're talking about, what is it, 6, 7, about 8 pip. So 8 pip on average, that's what you can expect if you're trading the Asian session and you hold the position for 1 full hour. The market tends around 6 a.m. London time, obviously pick up in pace, and we go from, you know, what seems to be about 6 pip to almost 16, 17 pip, and then it maintains a high volatility. And then when New York joins about around midday, 1 o'clock, 2 o'clock, and when we also have all the data from the US, that is when volatility tends to peak. At that point, we're talking about 25 pips an hour. And this is based on data collected yesterday. I used 10 weeks of data, but this chart hasn't changed the first time I look at this data many, many years ago. Now, what is interesting with this is that, as you probably know, if the markets move a lot, you need to have a wider stop loss. And when the markets move less, you can have a narrower stop loss. And that is exactly what I was trying to take advantage of. I was trying to take advantage of the fact that in the Asian session, there is very, very little activity. And it's first when Frankfurt and London opens, that volatility would spike. So the idea would be to enter a position in the early morning and try to capture this volatility, and obviously try to get out in the afternoon when volatility is at its highest. So how would this simple strategy look like? It's actually very, very straightforward. So what I would do back in 2006, 2007, and 2008 is that I would just try to identify the range that prevailed overnight. And this is about 2 a.m. and this is late in the evening the day before. And this is just a 30-minute chart. And you can see how volatility is really, really, really narrow. And the idea was just to try to capture and see, okay, which is the key resistance level, which is the key support level. And then I would wait for either a bearish break or a bullish break. And here you can see again how volatility is very, very low, and then how things just pick up. Now the benefit of this, as I said before, is that the range would be very, very narrow. You can have, like in this case, the difference between this high and this low is 28 pips. So if you risk 28 pips and you make twice that, or just what you're actually risking, that is actually quite good. And that is what appealed to me when I started trading. Here's another example of the same thing, how volatility is really, 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 really narrow. And then in this case, the range is about 32 pip. And about 6 o'clock, as you can see here, is still sluggish, but at 6:30, the candles become bigger, and then they just expand and become bigger and bigger and bigger. So it's a very, very simple, some people call it a London open range breakout. Very, very simple strategy. Here's another chart showing you the same thing, but when it did not work out good. Here is a 30 pip range. You have a high here. You can see down here is created about 1 a.m. and then you have a low here, I guess created 9 p.m. the day before. Then you have very, very narrow trading range, and then you have a big bullish candle to the upside. Now, obviously, this is a market that moves really, really quickly, so you could, in essence, enter a long position on a breakout, and then 1.5 hours later find yourself stopped out. Because the simple strategy is just to go long on the break to the upside and put a stop loss on the other side. And here's a setup where it didn't work, whereas here is a setup where it did work. We could have gone short here with a stop on the other side, and then for this 2 to move down lower. another example of the same thing, really. Here, though, incorporating a few more days of data. I think it's 1.5 day, so you can see here. The key point is this, though, is that the market was in a fairly tight, narrow range, and this is the Aussie dollar just 2 days ago, 30 pip range, and the idea is to look for a break. Now, what I knew about this, or what I had studied, I knew that if we would have a break, it would usually be a solid break, and it would either deliver an outsized gain or a small loss. So it's very, very simple, very, very straightforward. And what you do at that point is that you just reduce your trading to a simple numbers game. There's not too much, there's no macro fundamentals involved. It's more just doing this and doing this many times, trading this 100 times, and grab a little bit of gains on a week-by-week, month-by-month basis. And then 3 months, 6 months later, all of these small gains would accumulate to something big. Now, I knew about this, that you could have a breakout and that the market would actually continue in that direction. But I didn't have any data, had nothing at all to kind of support this until a few years later when I started to work at FXCM, because I started to trade in 2006, but it was first in 2009 that I started to work for FXCM. And I think this was in first 2010 or 2011, where I made friends with a very clever programmer at the office. And I asked him to run a few tests for me. And this is the data that he was able to pull out for me. And I'm finding this extremely, extremely interesting. So this is data I derived myself with the help of my colleague that did the programming. So what are we looking at? Well, here's the hour. So 5 a.m., 6 a.m., 7 p.m., all the way until 8 p.m. Here are probabilities. So you can see what we did here is I asked them, take 300 days. So we took data and we took 300 days. The actual sample is 600. So say sample is 600, and from the 600 I said take all the bullish days. So from the 600 days he took all the bullish days. And then I asked him to program a code that would ask the following question. When is the low of a bullish day created? And then the software would do this and obviously look around, accumulate about 300 bullish days. And if the low would be at 5 a.m., then we would assign, one for 5 a.m. If we would have two lows at 6 a.m., then we would assign 2 to this, and so on and so on and so on. And what we can see here is that the majority of all the bullish days, price were created slow before 9 a.m. At 5 a.m., 4% of all lows are created. At 6 a.m., about 11% of all lows are created. At 7 p.m., we are slightly higher than 16, maybe 16.5. And then at 8 p.m., we are at about 15% of all the lows are being created. After that, as you can see here, the amount of lows drop dramatically, and the rest are distributed over these hours. So if we take these, then the cumulative probability of a bullish day creating a low from 5 a.m. until 8 a.m. is 46.5%. What does this mean? Well, if you see a bullish breakout, if you look here, it says 8 a.m., right? Now we happen to be here. If it's 8 a.m., well, say almost 9 o'clock, right? And we have a bullish trend like this, then there is a 50% likelihood, or 46 to be exact, that this is going to be the low of the day. So here, for example, probably even a better setup. You see here's 6:30, 7 o'clock, 7:30, 8 o'clock, 8:30. So around 8:30, 9 o'clock, if the market has been going down, as is here, it breached lower, there is a 50% likelihood that this is actually going to continue to move down lower. Now this is really powerful and is very calming, because especially when you're new to a strategy, the strategy might be working, but obviously if you don't try it enough times, you're never going to fully understand or appreciate how it works. And it's very easy to be scared. But with this information, for example, and this is something I apply not just to this strategy, to really any strategy. If it's 9 o'clock in the morning and the euro dollar or the pound dollar is moving up higher, then I know that there's a 50% likelihood that this is going to continue to move up higher. Now, obviously, if we know what happened the day before, we know a little bit about the trend, then we can easily make a fairly fair assumption that, you know what, today is going to be a bullish day. And that is what I do in my webinars. I do a webinar at 9:15 a.m. London time, and if the trend is bullish at 9:15 and I say, okay, the trend is bullish and euro can head higher today and here are the levels, then it's very unlikely that I'm going to be wrong on that outlook. And that is kind of the first way how we know how to use time and the time of the day to predict market behavior. Now, with that information, what can you do? Well, you don't necessarily have to trade the breakout. Many times the breakout can break down and then it goes to the other side. That will be a false breakout. So it could happen sometimes, obviously, especially in the beginning of the day. If you start to trade breakouts really, really early in the day, then it's quite likely that that's going to happen. But when it's past 8:30, 9 a.m., if you have a breakout, it's quite likely that that breakout is going to hold. And with that information, if price leaves the area and then tries to go back into the area and it's past 8:30 or 9 a.m., then it's unlikely, well, obviously you can get stopped out, but you have more or less a 50% likelihood that you're not going to be stopped out, which means that on a pullback like this one, you could sell with a stop on the other side. Alternatively, you know, depending what's going on, maybe it doesn't look like this, but any type of pullback, you could usually look to sell that. And this information about the low in the early morning applies to bullish and bearish trends, because this data here is just based on the euro dollar and it's just based on bullish days. But the data for the bearish days is symmetric. So we didn't really gain too much more information by looking at the bearish days. I have that table somewhere, but it looked the same. So another great benefit of the study that we did at FXCM is the fact that something I didn't really know too much about. I mean, I knew that you have a breakout in the morning and you can go long and you can hold on to that, but I didn't know exactly how long we should hold on to that. And this is something that the data actually revealed. This is the way the data looks. Again, at the lower end, you have the time of the day, and then you have the probability on the y-axis. So what you can see here is that a majority of all the highs 12% of all the highs in a bullish day are created at 1500 hours. And what is also interesting is when we combine the information in the previous slide with this one. So if we say we go along a market and it's 8:30, we know that there's a 50% likelihood that that's going to be the low of the day. The question is, when should we book profits? Should we book profits at 9 o'clock? Well, the likelihood that you have a high in a bullish day at 9 a.m. is less than 4%. Well, maybe we should book profits at 10 o'clock. Well, no. The likelihood of getting a high at 10 a.m. sharp or during that hour is 4.1%. How about 11 o'clock? You know, we've been holding positions for a few hours now, you might say. Well, the likelihood that we have a high at 11 a.m. is about 3%. So as you can see here, if the market is bullish at 8:30, there's really no point booking any profits before midday. At midday, the likelihood of hitting a high rises is at 6% here, then at 1 o'clock, so 3 o'clock is 8, and 2 o'clock, 10, 11, and then 12. And obviously, if you look here, and you look at the accumulated values here, a majority of all the highs are created 2 to 3 o'clock. And many times it works like clockwork. Here, for example, this is 3:15, so this would be 3 o'clock. So the candle opens up here and then moves down. Here you can see this is 1500 hours, and this is the dollar CAD, and this is just over the last few days. 1500 hours, a high, 1500 hours, a high. Obviously, it's not going to be exactly at that time, and that is exactly what this data is telling us, because you see it's spread around. And I would guess that the reason for this happening is because at that time you have all the macroeconomic news coming out from the US. At 1500 hours as well, you have all the option expiries. So if there's anyone trading options in the US, they will expire many times at 1500 hours. But what is also more interesting is the fact that is 30 minutes of the US stock market being open during the same time as the European stock markets. So any of these stock market traders that want to buy and sell, and as you probably know, a lot of the volume is just executed in the early morning, and most of the volume is just executed in the really first hour of the stock market open. And then you have by the end of the day as well, many times. That's when all the volume is executed. So during that period, you have all these arbitrage people and people, you know, in the UK that wants to buy Apple, and maybe someone in the US wants to buy a share in a UK company or a German company or vice versa. So at that point, all these money flows during the first half hour is being executed in combination with the news, in combination with these option expiries. And obviously, when everyone has done their trade for the day, then there's nothing else that can push price around. So with this information, again, we can look to book profits in the afternoon. But that's not just the only thing we can use. We can use this to avoid getting into trouble. Say that you don't like to follow the trend, or you actually believe that a strong move in a currency is just a little bit too strong. Today, as an example, because of the Fed rate meeting yesterday, the euro has been rallying, the pound dollar has been rallying, the dollar CAD declined a great amount. Now, because the euro dollar, as an example, and the pound has been bullish since the early morning today, what this chart tells you is that, okay, you don't really believe the euro dollar is going to rally higher, but even if you think that is the case, don't go short in the early morning. Don't short at 10, 11, 12, or 1300 hours. Wait until the evening, or the afternoon at least, like 2, 3, 4 o'clock. So now it's actually the perfect time to get involved and fade some of these moves. As an example, something I traded myself, this is the dollar CAD, and here's the Fed rate meeting yesterday. That itself pushed the currency lower, and then traded a little bit sideways, was on its way up when London opened and Frankfurt, and then the Europeans decided to sell. And you're looking at this and you say, well, gosh, the currency was trading at 132.40 yesterday, and now it's at almost 130. And you think this is just too much. Your RSI is all telling you it's oversold. You look at the ATR indicator as well, it's oversold. You look at your pivot points, everything is oversold. And you read into the statement and you said, well, she's probably going to raise interest rates in December, so you want to be a buyer here. Now, if you look at this, and if you can see that it was actually moving down lower in the beginning of the day, well, take it easy. Do something else, and then it's first in the afternoon at 3 o'clock or 3:30, so about now, that you will actually look to fade this, because there's a higher likelihood that because this is a bearish day, that around this time of the day, we're going to have that low that you're looking for. Here's another example that I used, and you can see here how at 3 o'clock sharp here, the candle opened at this level and then rallied higher. And this is a recent, this is from the 14th. Now, it's not that it's always going to be ending around this time, but again, as I said before, look at the actual table here. It's quite likely that it will be. So how can you leverage on this information? Now, you don't have to trade with the system I showed to you guys, because to be honest, I don't use that any longer. I've never been a real morning person, and going up trading short term is nothing really that I do any longer. But I still use this information. So if it's past 8 or 9 a.m. in London, you see a bullish market, then there's a 46% likelihood that's going to be bullish for the rest of the day. And if you want to get involved with your scalping and you see a pullback to against, say, a bullish trend, then it's actually okay to try to fade that with a stop loss on the other side of whatever range prevailed in the Asian stock market, in the beginning of the session. If you are long either with the breakout in the early morning or you bought the pullback, then you can hold this position until about 1500 hours. Obviously, if you have a nice gain and initial jobless claims is coming up, or maybe something else that is published at 1:30, then you maybe want to book that. But we know that most of the time, the highs are going to create about 1500 hours. And at 1500 hours London time, that is when you can become someone looking for the currency to pull back, or you're looking to fade strong moves. That's when you become the swing trader. The swing trader obviously tries to sell, looks for the swings and the reversals, or the mean reverter. That's when you start to look at that. Another thing that we highlighted today, which you probably already knew about, but let's look at it again, is this, which is the volatility per hour and how we can leverage on that. This is the euro dollar. The data for the pound dollar looks pretty much the same. In fact, most Eurocentric currencies are going to follow this. Now, some currencies like the dollar yen is going to also follow this to some extent, but sometimes what happens is that it's going to be influenced by whatever happens in Japan. And it's the same thing with the New Zealand dollar and the Aussie dollar. They're going to be influenced what's going on in Australia and New Zealand. But what tends to still happen is that any trend or any reversal, you'll see either at the end of a trend or the beginning of a trend in dollar yen, Aussie dollar, New Zealand dollar. Something tends to happen around 8 a.m. London time anyway. It doesn't have to necessarily be, again, the beginning of a trend. It can be the end of a trend. What does that mean? Well, say that at 2:30 a.m. The Aussie employment data is out. So the data is better than expected, so the Aussie dollar gains from 2:30 a.m. and then it will continue to gain and could potentially gain until 8 a.m. and then at 8 a.m. if the currency has rallied a lot, some people here in Europe might say, well, you know what, the currency actually rallied quite a bit. Maybe it's time to fade this move. So things happen around 8 a.m. for these currencies as well. And that's something to bear in mind. And again, the case with the volatility is that the volatility is lower in the beginning of the day, which means that you can usually have a narrower stop loss. And then as volatility pick up, obviously you look to make more than whatever you're risking. And then on the other hand, the hour of the day where most people lose most amount of money is here as well. That is these studies we did with FXCM and Daily FX. We looked at the results of our clients. We looked at many millions of trades, and the hour of the day where people tend to lose most amount of money is around this time. Okay, that is the complete presentation. Let's see if we have any questions. And as well, if you want to know more about me, I do have some stuff coming up here. If you want to attend one of my free live webinars, then we do offer that. It's at 9:15 a.m. Just go to londiniumfx.com. I think Simon is going to send the link to all of you guys soon. And in that as well, I do offer premium content. I offer videos, articles, and my training journal. And exclusively for you guys, we're doing the same thing as we did last time, and that is that we're going to offer you guys a 20% discount on my premium content, which we call the premium newsletter. So instead of paying £291 per quarter, you get this at a 20% discount. So for £232 instead of 291, and this is a offer that is valid until 25th of this month, so on Sunday, and the discount for this is just 20 premium.
Okay, Alejandro, fantastic. We've got a few questions waiting. We might take you back a few slides.
Yep.
First of all, Josine was saying, how far back do you do the range for?
Like how much data we used? Oh, okay, no, I know what you mean now. Okay, so in the case of this, okay, so some people, like if you look online, they're going to say, well, look at a specific hours. I don't agree with that. What you want to look at, levels that matter for the market, if that makes any sense. So in this case, you can see here that this is a high. If you look here, this was created at 4 p.m. in the afternoon, this high. And then during the ASIN session, we never really managed to break that high. And about 6 a.m., you know, if you wanted to, you could draw a line. You can say, well, this is the Asian session high here, and you'll use that. But the difference between this high here and this high here, we're talking about maybe 5 or 6 pip. So obviously, if we break this level here with another resistance level just up here 5 pips away, it's better to take the bigger key level. Here as well, you have a low, and this is usually what you want to look for as well. Here, obviously, it's fairly flat, so we don't really know exactly which one is kind of the most relevant. Is it this one or this one? So because we don't know that, we take both of them. Sorry. Here you have a nice little swing like this, which means that maybe the Asian session people, they didn't do too much, then they declined, and then obviously they bought and they pushed up higher, and then when it comes down here, you would guess that people have their stop losses just below here. So you can think about that, like where do people have their stop loss orders? And this kind of highlights which one to look at. If we look at another example, this is very, very different, because this is actually a full day of trading plus the morning of yesterday. Here the range is very wide, and you wouldn't be able to say, well, what's the Asian session range here, because it's something like this. So here you would take the whole thing here, and it's okay to do so as long as you're talking about maybe 30, maximum 45 pip range. That's when it's okay to do so. But if the market on a normal day moves 100 pip, and the stop loss you need to use for your calculated range is 45 or 50, then obviously you wouldn't trade that. So maybe if the range is 100 pip in one day and you can get away with a stop loss of 35 or 30 pip, then that's good. And the best way here to actually learn is, or to check this out, is to load your charts, and then you look at the currency pairs start from about 6 a.m. until 7:30, 8 a.m. And then you look at past 20 days in the currency pair, and then you do the same thing for maybe another currency pair. And then you will quickly realize which levels are relevant or not. I hope that answers your question.
Thank you. What about the volatility? George is asking, how do you measure volatility?
So this specific volatility measure, the way this was calculated, is that they would look at the difference between the high and the low for that specific hour. So here is 6 a.m. and it is, I guess it's 16, 17 pip. So they take all 6 a.m. hours, like what was the range at 6 a.m. every day for the last 10 days, 10 weeks.
Mm-hmm.
They take that and then they derive an average, and this is what we're looking at. But the data here has looked the same for many, many years. So there's really no change. Yeah. And what is interesting here is not the actual level of volatility, is how the volatility is low in the Asian session versus how volatility picks up as London starts trading, and how volatility peaks when New York opens. It's that relative volatility that we're trying to profit on.
I see. Yeah, I see that. So your entry time frame is 30 minutes, asks Marcello.
That's correct. If you want to trade with this system, it will be 30 minutes. So what you do, you load your 30-minute chart, as you can see here at the bottom end. It says 30 minute on all the charts. Now what you do is that you try to identify the highs and the low using the 30-minute, and then you will look for a break. But you don't have to wait a full half hour for this to close. You could, for example, use a 5-minute chart, and then you wait for the 5-minute candle to close outside of the range, and you can open your position. If you do that, then you wait 25 minutes to see how the 30-minute candle closes. And obviously, if it doesn't close outside and it proves to be a false breakout, and then you could take action if you wanted to. In other words, you can cut the position or you can just keep it open. The reason why it many times can be better to have just a 5-minute is that what's going to happen many times is that the currency is just going to leap and it's going to exit with force out of the range. So the actual range was here, but maybe your entry, if you will wait for the close, is going to be 15 pip away. Now 15 pip plus a 30 pip original range is 45 pip. And if you need to risk 45 pip for a market that is only moving 90 or 100 in one day, then your risk-reward ratio is not going to be there. So again, load the 30-minute, look at the highs, look at the lows, and then you can load the 5-minute chart. And then you just wait for a breakout to each of the sides here. Now, another tip here that you can use here, which I didn't show to you guys, because the purpose of the presentation was more how to use time. So I wanted to keep the focus on the actual tables showing you the time of the day, and I didn't want to talk so much about a strategy, but something you could do, which I do and what I teach, is that if you want to trade with this, if you're trading with the pound dollar, then what you want to do is you want to load the pound dollar on one screen and then you load the euro dollar on the other screen. So to have better chance of success, if you see, say, the pound dollar moving up, then you want to see the euro doing the same thing. If the pound dollar is breaking up higher, but the euro dollar is breaking down lower, then you wouldn't trade neither of those currencies that day. What you would do at that point is you would maybe focus on maybe the Aussie dollar versus the US dollar and the euro Aussie, or maybe the euro yen and the dollar yen, or maybe the dollar CAD and the euro CAD, or maybe the New Zealand dollar versus the euro New Zealand dollar. And that's what I would do. And if you actually want to know more about this, I am actually going to host a seminar in December. And what you can do, again, you can just add me on Twitter or just reach out to me. But I'm going to host a seminar there. What we're going to do is we're going to scalp the markets live. And when I join the seminar that Simon is hosting in September, I'm going to talk more about it at that point as well. But what you can do, again, you can just follow me on Twitter or just go to londiniumfx.com, and I think I'm going to have information about this in about 2 to 3 weeks' time.
Alejandro, I think you answered Anna Maria's question when she said, does this timing of the lows in a bullish day apply only to the pound dollar, the cable?
No, it applies to the actual data was derived from the euro. But as you guys probably know, the correlation between the euro dollar and the pound dollar is extremely high. So it applies to the euro pound and to the pound dollar, the euro dollar, and it also influences heavily what's going on with the yen and all the other currencies. You will see something happening, either the beginning of a trend at 8 a.m. or the end of a trend at 8 a.m. Usually, the European markets, there's really no activity going on. Why? Because we're asleep, our banks are closed. Whereas, obviously, in Asia and in Australia, the markets may move because people operating in those countries will trade. I remember when I was working for Swedbank, which I highlighted before. So I was there working for about 6 months between my bachelor's and my master's. And I was working from Gothenburg, which is the second biggest city in Sweden. And in Gothenburg, you have companies like Volvo Cars, and you got Volvo Trucks, and you have Scania, which is another big, huge truck producer. And then you have SKF, which is a ball bearing company. You got Stena Line, which is a big shipping company. So you have all these big firms in this town. And all of these people, what they do good in Gothenburg is they do good at exports. So we will come to the desk about 8 a.m. and starting from 8:30 until about 10:30, all of these big guys would call. And everyone wanted to buy or sell, not because they needed to speculate, but because they needed to pay someone maybe in Asia, or they wanted to exchange earnings from abroad to Swedish kroner and so on. So it's very quiet in Europe. But then all these people come and they place their orders, and these are the guys that push the market in one direction, either up or down in the beginning of the day. And then obviously at 10 o'clock, 11, they already did their trade, so they don't care. But for us that are speculating, we can try to join these guys in the beginning, and then obviously try to keep this for as long as possible. Well, $1,500.
Okay, what about defining a false breakout? George is asking. How would you define a false breakout?
A false breakout with a system like this is obviously when you get stopped out, unfortunately. A false breakout is, per definition, you see here's the break to the upside, right? And some people say just because we go back to the range, that's a false breakout. And that's what most people say, but if we look closer into the textbook, this is just a pullback, and it's just a false breakout when we indeed break the trend. I think if you would like to pursue a system like this, you need to understand that it's a pure numbers game thing. It's something you just wanna stick to the rules, and you wanna do it over long periods of time. So, in other words, don't worry so much if it's a false breakout or not. Just do it, and then, you know, in worst case you'll have a few losers in a row, but then you might have a few winners in a row, and then it's going to be a random outcome, and then by the end of the month or the end of the quarter, you'll see that you actually have managed to accumulate some return on this. But it's a pure numbers game, and you just need to have the mental strength to wake up every morning and do it every day all over. So it's nothing that is really, it's nothing for the faint-hearted or people that are very emotional, because you're not going to be happy. You put on a position and you have a few winning trades and then you have a few losing trades. You're not going to be, if you have problems with that, you don't want to do this. And that's what scalping anyway. I think all scalping is like that. You know, you win, you lose. If you don't like that, trade slightly longer term. That's what I do. I mean, I did this when I was very young, when new to the market. You know, you have a lot of ambition, and because you have a lot of ambition and energy, you know, you're happy to do things even if you have, you know, losing months or whatever. But then after a few years doing this, you know, you don't want to have that any longer. And also, you maybe want to sleep in the morning, like I do. And that's when you start to trade slightly longer term.
Yeah, of course, you're being in your old age that you are now. Don't mind me asking, are you 30 even yet?
I am. I'm 31.
31. Well, an old bull. Paul says, is there any trade that you will not take using this strategy, though?
I mean, trades that you don't want to take are, for example, a trade when the, say, pound dollar gains and then the euro dollar declines. Let me see if I can load. Can you see my screen on my charts?
Yeah, we're looking at, yeah, it's fine.
Okay, so this is just one way of doing it, say with FXCM. So this is, I do it like this. I do euro dollar like this. Flip to a 30-minute. And then down here, up here, I can click on Insert, Price Overlay, and then I'm just going to choose the pound dollar. And if you're using FXCM, you can just display the area, and you can just display the pound dollar and the area below. If you with IG, sorry.
These are tools that you get when you're an account holder with FXCM, do you?
Yeah, this is something you get with FXCM, but you can, you know, I obviously, because I was working for FXCM for so many years, I'm so used to the charts, but I actually trade with CMC markets. I don't like CMC's charts, they just hurt my eyes. So I'm still using these. So the idea here is, for example, to try to identify that range. So, for example, this wasn't necessarily the easiest, but here is 5 a.m. You can read the time here, right? So this is 7. How would I have done this? Okay, let me see here. I guess this one is easier. This is, look, if you look here, this is a high at 130 for the euro dollar. Then it goes down. And then you could technically have done something like this. This is the range for the euro dollar. You would have done something like that. So either here, you either want to be long or short. And then you would try to do the same thing here if possible, which unfortunately it's not, because it's not as well behaved. But how can I say, this was actually, it's a tricky because the market rallied yesterday, right? But it never really pulled back. Okay, let's make it, how can I say? Well, we would just need to make some simplifications, okay? You can argue that this is bullish, right? You can argue here at 7 o'clock. No, sorry, yes, sorry. The fact that they break out at the same direction is something that you could have used to your advantage. So both break higher and higher. So it's quite likely that both are going to head up. So the question is, which one can you buy? You wouldn't necessarily buy the euro here unless you really wanted to, but you could have concluded that because it's higher here and higher there, that maybe this low here would hold. And then maybe on this candle here or this candle here, you would go long like that. The reason why you would do this, you will go long here, is because the euro is well behaved and just continued. So the euro is definitely bullish at this time. And because you know that the euro dollar is bullish at that time and the pound dollar is struggling, but the fact that this is bullish means that even if this is struggling, it's more likely that it's going to head up higher. As well, obviously, because you read the news on Daily FX or Forex Live or any other website, Bloomberg, you know that the Fed was dovish yesterday. So you would have known that it's more likely that it's actually going to head up a little bit than plummeting. So it's a little bit of a detective work. So, and here, because they moved up higher at the same time, becomes complicated. But sometimes what happens is that you can actually see one currency break out maybe 15 minutes or 20 minutes before the other one. So you would say, see the euro dollar break out, and then 10, 15 minutes later, this one breaks out. So when you see that this is clearly bullish, then you would only look to book, or only look to trade the long side here. If this one breaks out first, then you only look to buy this to the upside as well. Now, you don't trade if one market is moving up and one is moving down, and not at least here. And this will be one group of currencies. If you then what you do, you load another group. Say that you load the Aussie dollar, US dollar. So that's the Aussie dollar. And then what you do, you would load the Euro Aussie. Now these markets are going to mirror each other, and it just has to do the way it's written. Here's Aussie versus USD. Here's Euro versus USD. So they are mirror image of each other, more or less. And then you load the 30-minute, and then you try to identify, the trend here as well, which again in this case wasn't really that easy. Let's see here. Here is the actual, not that easy. And it's just because it's a special day yesterday. Let's see if we can find some good setup here. I think we'll skip it for now. It's gonna can take some time, but I think you get the drift, right?
It's fascinating, Alejandro. Yeah, it's just when you think you've seen most of the strategies, here's another one we haven't seen. Yeah, fascinating. Clearly, this is what you did working at FXCM. I mean, this is the sort of
strategy that you guys would have been doing as part of your daily trading?
Yeah, I mean, with FXCM, obviously, I was hired to produce research for the clients. And so we developed all these systems to help the clients to turn more and more profitable. So we used things like this. But this specific strategy, obviously, I set this up before I started to work for FXCM, and I was using it for quite some time.
It's interesting as well. You said that it works, but you have to have a certain mental agility to keep on, a discipline to keep on doing it over the long term. And that's something that we keep hearing over and over again throughout all the presentations that we have today, is that it's the psychology, the tools, learning the tools and strategy is one thing, but it's the psychology that seems to make the difference between winning and losing at this trading. So,
well, what you could do like this, right? It's like this. There is some truth to it. I mean, there's definitely truth to what they're saying. But how can you? But even if you have, what you need to have is you need to develop a good strategy to begin with. So, simple thing is just, you find a strategy, maybe like this one, and you back test it and try to understand, like, if I would have traded with this 30, 40 times, what would the outcome look like? Is it like a valid strategy or not? So that's what you need to do. And when you've done that homework, then it's going to be easier to stick to the system. So that's what you need to do. And also, the better your system is, the more likely is it that you're going to make money. And if it's more likely you're going to make money, then it's more likely you're going to stick to it.
Yeah, stick to it. That's right, indeed. Well, Alejandro, it's just a minute to 4, so we'll have to wrap it up there. But thank you for coming and joining us again. Fascinating talk. Thank you for producing the new material. It's been interesting learning about that. The link is in the chat box for anybody that wants to go ahead. Please get signed up for Alejandro's morning webinars. You do that just at londiniumfx.com. And there he's put his details up as well, the email address and the Twitter. So we'll follow up with these in the email that we send out after the event as well. So thank you very much, Alejandro. I'm going to take the presenter role back from you now, and say thank you very much indeed for coming and joining us.
Well, thank you so much for having me.
Pleasure. Okay, so just about 4 o'clock, we are moving right along. Welcome everybody. If you're just joining us, Simon Campbell here, round the clock trader, and we are about to go across to Dr. David Paul, Managing Director of VectorVest UK, for his new presentation, Worry-Free Investing. We'll take David's microphone off and say, good afternoon, David. Can you hear me okay?
Yes, Simon, you're coming through great. How are you doing?
Oh, that's great. I'm very well, thank you. Yes, we're having a nice day today. We've had a few new speakers and new faces, new ideas, always some new strategies that come up on these days. So it's fascinating, good fun, and a nice crowd of attendees who are helping me along with some great questions and good tips as well. So really enjoying it. How are things with VectorVest?
Oh, things are going great actually. A nice move up, and we've the product VectorVest called this run up 3 days ago. I'll show that in the presentation. But
wow.
So we caught this quite nicely. Very humid in London today, so it sounds like Florida on a bad day here. Incredible.
That sounds nice. We're on 4 o'clock, so we've been running to catch up all day. We've had Carol Harmer, of course, who you know quite well,
Yes.
joined us this morning, and such a great reception she had. She came back again at 1 o'clock to do some more, which was very good of her. So we've just been using up all the time available, and there we are. I can see your screen. Great. Shall we just ask maybe if people at home can use the chat box as we normally do to put a little Y just to check that you can hear and see David's screen okay before we get started. Wonderful.
Great. Thanks, Roger. Thanks, David, Carolyn. Great. Everybody's in. Okay, well, David Paul, Managing Director of VectorVest. For those of you that don't know, VectorVest is a research software program for private investors analyzing the markets, putting technicals and fundamentals together to provide you with signals on the trends. I will hand over to David, who's the MD for VectorVest, to make a better go of it than that myself. And we'll take questions as we go, as we normally do. But I'll let you get started now, David, just when you're ready.
Okay, Simon, thanks for having me. Good afternoon, everyone. Simon, something happened there.
Sorry, that was myself. Sorry.
Okay. Good afternoon, everyone. David Paul speaking. Great to be here. Thanks for having me, Simon. My background is checkered. I've got a degree in engineering. I've got an MSc in metallurgy. I've got a PhD in mathematics all along the way. I've been trading in the stock market since October 1982. I put on my first trade, and I've been a full-time trader since April 1988. I cut the corporate umbilical cord in 1988, and I've been trading on my own ever since. Along the way, well, one night by pure accident, I took an investment meeting by pure accident because the speaker had laryngitis and he just couldn't utter a word whatsoever. So they asked me to stand up and talk about what I was doing. At that meeting, there was a group of stockbrokers, and they asked me, based on that, to come into their offices and actually coach their young traders in how to become consistent in the stock market. As you may know, it's very easy to make some money, but it's an art form to keep it. Anybody can put on a winning trade or an investment. You can pull a drunk off the street and they'll be able to put on a winning trade every now and then. But to do it consistently is an art form. That led to a second career in fact, coaching traders and doing seminars along the way in South Africa, where I was living at the time, and in the UK. And while I was in the UK, trading with my trading partner, Tom Hogarth, I went along to a VectorVest presentation, and Simon, our host today, was running VectorVest in those days. Based on that, I managed to get the South African agency for VectorVest, and I built myself and my son. I built VectorVest, or we built VectorVest South Africa up into a reasonable size of an entity. My son, in fact, got hooked in markets, and he is now a portfolio manager at a hedge fund in Johannesburg. I'm doing very well, I'm glad to report. Simon was running VectorVest in the UK and decided he wanted to focus totally on this media business that we're within today. And when he left, VectorVest asked me would I like to run VectorVest UK as well. So at the moment I'm running VectorVest UK, and between myself and my son we run VectorVest South Africa as well. So I think that we're probably the only organization that's here today, and certainly I don't know of any other organization that in fact shows people how to go about building capital in the stock market that is authorized by the FCA. So VectorVest is fully authorized by the FCA, and based on that, I have to put up this disclaimer. I'm not allowed to give one-on-one financial advice. Before I could do that, I would have to sit down with you and do a very detailed and long fact find. I'm allowed to talk about what I do myself, and that's in fact what I'll be presenting this afternoon. In these presentations, I've looked at VectorVest for very short-term trading, which is something that I do myself. And today I'm actually going to look at using VectorVest's unique tools for worry-free investing. A mechanical approach to markets. We don't know what's going to happen next, but we have got a set of tools which will allow us to react to the market and take the stress out of it. And it's mostly automatic, as we'll see a little bit later in the presentation. So what we're going to look at today, we're going to look at the VectorVest system itself. We're going to look at how to go about timing the UK market, or any other market for that matter. There's a good time to be in the market, and there's a lousy time to be in the market. When the general market is rising, pretty much everything rises with it. When the general market is falling, then it's very, very difficult to find something that's rising. And those of you that, in fact, have got the experience to sell something you haven't got could easily be tempted to short the market in that period. Then the third thing we're going to talk about is worry-free investing, and I'm going to do my best to try and show you the program in action. Okay, how we can make some money in action. So, as Simon spoke in his introduction, the VectorVest Edge is fairly complete. First of all, it's a stock market trading program. It's not for trading gold or trading currencies because it integrates the fundamental position of a company, which we get from the annual reports and the interim reports, with the technical position of the company, with the technical position of the overall market. Now, if I was doing this at a physical seminar, I would actually go around the floor and ask everybody their opinion and their definition of fundamental analysis. Unfortunately, in this particular forum, you're going to be stuck with mine. I believe, and my definition of fundamental analysis in the stock market is the search for the true value of a share. And I believe that the technical position of a share, or the technical position of the overall market, I'm using a definition put forward by the technical analyst called Martin Pring, who's written a lot of books on technical analysis. And he defines technical analysis as a study of trends and turning points. I think that's quite cool. So at VectorVest, we put together the fundamental position of a company. We want to be trading in the very, very, very best stocks. Stocks that are undervalued, stocks that are growing their earnings aggressively and safely. And as we'll see later in the presentation, in the worry-free portfolio, we actually highlight the safety aspect. It's a long-term approach, and we want shares that are rock solid. And we're prepared to give up a little performance for that rock-solid guarantee. So Bart DeLillo, who's the founder of VectorVest, puts it so well when he says and makes an analogy between a football team and making money in the stock market. He says that our job as investors is to buy the very, very best players that we can afford and manage them well. Buy the very, very best stocks that we can afford and manage them well. So we put together the technical position of a company with the fundamental position of a company with the fundamental position of the overall market. And when all three are saying yes together, then the future can be predicted with a certainty that's unusual in this line of work. Now, the previous speaker and some of the speakers that I talked about this morning talked about the strength and resilience that one needs to become a trader. Now, if you're in a system, you've got a system that's right 50% of the time. For example, trend following systems, breakouts of new highs, moving average crosses, all that sort of stuff, they have a hit rate of less than 50%. Now, in a 50% system, if you're going to be wrong 1 and 2, I think you would agree. Believe it or not, you have 5 bad trades in a row, a cluster, every 32 trades, which is a half times a half times a half times a half, if I got that right. Now, being wrong 5 times in a row is, you need to be hellish resilient to handle that, and most people haven't got what it takes, and they move to the next system. By putting all these 3 things together, then we can push the hit rate of our system up significantly. Now, for most of my life, I was a technician, and only when I discovered VectorVest was I, in fact, able to put the fundamentals into the picture. And that's largely because I tried to do the fundamentals very, very early on in my investing career, and I found that I just didn't have the tools. I'm a mechanical engineer, okay? I still have, apart from those ghastly FCA exams, no formal financial education. So the annual reports and the interim reports would pile up in the corner, and I never got around to doing anything with them. Now, when I added the fundamentals to the mix, my hit rate went up considerably. And at the moment, my hit rate is about 80%. And if you do the sums, you'll find that the clusters go away as the hit rate rises, and that makes the system easier to trade emotionally. I hope that makes some sense. So what every investor should know, what's a share really worth? And I always quote my dear grandfather at this stage. He told me, a long time ago, he died in 1968. He said that the only way to make money in anything is to find the value of something and then pay less for it. Okay, so at VectorVest, our number one concern is to work out the value of a share. Okay, and as a default, we favor shares that are trading below their valuation. We want to look at the earnings stream, and we want to look at how safe is this earning stream. We want to look at all those ghastly accounting ratios and make a quantitative determination as to whether these are getting better or these are getting worse. And then we want some idea about the trend, whether to buy, sell, or hold. Putting the fundamentals and the technicals together. It's a style of investing, ladies and gentlemen, that I have named value momentum investing. We're looking for value, but we want the bus to be going our way. So, value. Every evening, and I'll show you it in a second when we get into the program, every evening VectorVest puts a value to every share in the marketplace. Now, the algorithm that Bartolito put together to calculate value is fully shared in his little book, which comes with our product called Stocks, Strategies and Common Sense. It's in chapter 3 of the book. It's loosely based on Benjamin Graham's valuation model, and it puts a robust valuation to every share on the London stock market and on AIM, and at a glance, or we can search for it, we can work out which shares are trading below the VectorVest valuation, and that's where I want to be most of the time. Now, another measure of value is relative value. And you're going to have to think for a second. In relative value, we project the earnings of every company on the London stock market for the next 3 years. We make the following assumption. We assume that those earnings will be discounted into the price at some time over the next 3 years, not when. So there's absolutely no timing in relative value apart from a 3-year window. So let's say a share is trading at £10. We project the earnings flow, and if the earnings flow is rising, we project that at some time over the next 3 years, this share will be worth £15. The upside is £5, and we take that upside and we divide that by the risk-free rate, which is at VectorVest UK a AAA rated corporate bond, and the resultant is relative value. If your company has a relative value of 1.4, for example, that's saying that in a window of 3 years into the future, we expect this company to outperform the risk-free rate by 40%. Anything above 1.3 is good. In fact, excellent. If your share's got a relative value of 0.8, that's saying that we expect this share price to underperform what a AAA rated corporate bond is going to pay over the next 3 years. And you've got to question the merit of taking a risk in a share if you're going to get more money in a risk-free, relatively risk-free environment. So I firmly believe that relative value is one of the most important numbers on VectorVest. Now the next number is relative safety. And relative safety, as the slide says, is a measure of the consistency and the predictability of the financial performance. So we look at the balance sheet, the income statement, the cash flow statement going back for many years. We buy all that data and we suck it in from Thomson Reuters every single evening. We look at 17 inputs A little bit later in the presentation, I'll go into those in a little bit more detail when we get to worry-free. We mathematically massage those 17 inputs between 0 and 2, like everything else in VectorVest. Above 1 is good. Above 1.3 is excellent. Above 1.3, here's a company making money, making lots of money, and all those ratios are getting better. Okay, very, very important number relative safety, especially in the context of this afternoon's presentation. Now, what I've done is that I've done a simple test, ladies and gentlemen, with nothing apart from value. And I've looked and I've gone back to the start of 2015. And I've looked at and asked the computer to actually do a test between then and now. And at the start of January 2015, these shares were the top undervalued shares on the London stock market. And in the last 18 months, with no extra input whatsoever, no timing whatsoever, these 10 shares have outperformed the London stock market by 3x. So just trading and finding shares that are trading below their valuation is a powerful edge in markets. The third metric is relative timing, and here it's an indicator of the direction and the magnitude of the trend. So quite simply, on a scale between 0 and 2, if the RT is above 1, the share is rising. RT below 1, the share is falling. The further above 1, the faster it's rising. So it measures both the direction and the magnitude of the trend. Okay. And then what Bartolino did, and we're using this a little bit later, is that he put together value, safety, and trend into the one indicator, the master indicator, and thus, as flows right through VectorVest, we combined the fundamentals, relative value and relative safety, and relative timing, which is a technical measure, into one single number, and I'd never seen that done before. And as a default, all of the shares on the London market are in fact sorted by descending VST. We can sort by whatever we wish, but by descending VST is the default sort. We have a proprietary indicator called the comfort index. Now the comfort index measures a long-term trend, whereas RT measures the short-term trend. It is a secret weapon because it measures the trend over the last 3 years. And if the trend's getting stronger, that marks very well. We measure the volatility of the trend, and clearly if the volatility is low, that marks very well. And the fundamentals, relative safety, getting better. Now I think you would agree, if you've got a share that's trending and the trend is strengthening with little volatility and the fundamentals are getting better, surely that should give you some comfort, and that's why it's called the comfort index. And a simple scan on VectorVest sorting all of the shares by the comfort index finds some really wonderful trending shares and trending investments. We calculate a stop loss for every share in the market every single day. It's an adjusted 13-week moving average. It's adjusted for two things. It's adjusted for the average true range of the share. Some shares are intrinsically noisier than others. And it's also adjusted for the fundamentals. If the fundamentals are good, we widen the stop loss. We give the share more room to move. If the fundamentals are poor or getting worse, then we tighten the stop loss up. It's doing its best to put a balance, not getting stopped out in noise, keeping the stop loss out of the traffic, and still protecting your capital. It does it reasonably well. We put a buy, sell, or a hold criteria to every share in the market every single day. The buy, sell, and hold can be used to time the market for sure, but its main use, ladies and gentlemen, is to work out the breadth of the advance. And every day we work out the number of shares that are on a buy recommendation divided by the number of shares that are on a sell recommendation to work out the breadth of the advance. And as we'll see in a moment, the buy-sell ratio is a very, very important part of the VectorVest market timing model. Okay, so you'll be glad to hear that the definitions are over. It's very difficult to do the presentation without doing the definition. We'll be moving to the front page of VectorVest in a second, but now I want to look at and go to the stock viewer. Okay, now right at the top, and as I say, everything as a default in VectorVest is sorted by value, safety, and trend. We're following 2,154 shares on the London market anno name. And I've loaded the top 50, although at our office at St. Paul's here, the internet is superb. But nevertheless, I've just loaded the top 50 to take the grunt off the internet. At the top, as rated by VST, is a share that's been in the top 10 for us since it was about £5. It's now at £14. And I've added to it quite a few times many times along the way, and I have that problem in JD Sports at the moment that I've got actually too much of my portfolio in the one share because it's appreciated as a percentage. It's appreciated, and I've added to it, and that, although annoying, is a really good thing to have. It's trading at £14.35. We believe it's worth £20.68. So we still believe the share is significantly undervalued by the market. That's our first proprietary number. Now, as we'll see in a second, we can scan for that easily in Unisearch, but there's an eyeball of it. It was down 5p yesterday. I see it's up. The last time I looked, it was up 7p today. And that is 0.35%. Clearly, these are not proprietary numbers. You can get that for free out of the Evening Standard. Now, the second proprietary number is relative value. Now, remember, relative value measures the earnings upside in relation to the risk-free rate over a window of 3 years. And relative value at 1.54 on a scale between 0 and 2 is better than excellent. Above 1.3 is excellent. Above 1.5, I have my own expression for it, is bloody marvelous. Really, really great number. The relative safety is 1.4 on the scale between 0 and 3. That's clearly excellent, and this is a company making money. Now, I am a mechanical engineer. I have no formal financial education, as I mentioned, but when I look at the balance sheet and the financials of JD Sports, you can smell the money. Okay, it was magnificent results the other day. I don't know if you've seen them. RT 1.55 on the scale between 0 and 2. This is flying up the page, and as a result, the VST is 1.5. It's on a buy recommendation with a stop loss at 12.71. We believe it's going to grow its earnings at 24% next year. And these is our best shot, ladies and gentlemen, at the future. Earnings per share, earnings yield, PE next year. So when you look at the Financial Times, the Financial Times will have different numbers here. They're looking back. We're looking forward. This is our best shot at the future. The future, as Mark Twain said, is a very slippery commodity. Nevertheless, this is our best shot at it. And if we go to the right-hand side here, we can see that we believe there's the dividend it's going to pay. And a really, really important number, if you are a conservative investor, is not the dividend itself. That's important to some people, but the dividend safety. And how safe has this dividend been over the last in years? And on a scale between 0 and 100, the dividend safety of JD Sports is 99%. That's saying this is a company that's paying, okay, a small dividend, but in fact has a history of growing and paying that dividend regularly. Very, very important. Dividend growth 11%. And this is a number that I haven't spoken about. It's called YSG, which is in fact the master indicator for those people that are interested in income. If I would I could, if I wished, sort by those companies that have the best combination of yield, the safety of the yield, and the growth of the yield. And I go right to the right-hand side, I can see CI. CI, the comfort index, a measure of the long-term trend, is sitting at 1.61. Excellent number, a really excellent number. And just by clicking on this, we can find the top trending shares on the London stock market. Really useful to do. We have a gentleman up in Scotland who tells me that CI, with one click, does what he used to take a whole Sunday to do with a previous piece of software. Okay. So that is VectorVest. If I look now, let's see, something at Victoria. Now, Victoria is a company, I had a great run in it a couple of years ago. It had a 5-for-1 split the other day. Trading at £3.20, we believe it's worth £5.60, so we believe it's significantly undervalued. It was flat yesterday. Relative value 1.57, which is again is that bloody marvelous number. That relative safety is, however, 0.84. So somewhere in the history there is ups and downs, and there has been surprises. And RT 1.72. Now, this is the sort of company that my son loves. He likes the undervalued shares. He loves high RV. He doesn't worry about relative safety because he sits all day in front of 6 monitors and he watches those stop losses like crazy. So he manages risk proactively. And for that, he finds many shares that move from 1, in his case, rand to 3 rand. And you rarely find that with companies with high relative safety because they're much, much more stable. They don't move nearly as fast percentage-wise. Although JD Sports is up 3x since we got involved with it. Similarly, here's another little company, Sophion, that's had a cracking run, and we forecast that run easily. Trading at 276, we believe it's worth 452. Again, up massively yesterday, 11%, and it has an RV of 1.58. Relative safety, 0.97. Okay, and that's had a great run. I'm a shareholder in Hill & Smith and have had a good run in it since Brexit. Trading at 11.77, we believe it's worth £15, so still upside. Relative value 1.45, relative safety 1.35. Now, I am a trader, but in terms of my investment portfolio, I keep it fairly safe. So the JD Sports of this world and the Hill Smiths of this world and Hastings Group I have a position in as well. That's the sort of companies that I'm looking at for my longer term investment portfolio. Shares that are undervalued, shares that are growing their earnings aggressively, RV, safely, RS, that are rising, RT. And for the next part of the presentation, I want to buy those shares when the general market is rising. So I want to put the fundamentals of the company together with the technical position of the company, together with the technical position of the overall market. I think you would agree that intuitively it makes sense. So I'm now going back to the PowerPoint presentation. We're going to talk about timing the London market. Simon, any questions at this juncture? Okay.
There are no questions at the moment.
All right, okay. Let me go and talk about timing the market, all right? So timing the London market for consistent profits, again, that word again. So the mantra, we want to buy rising shares in rising markets, and if you've got the stomach for it, to sell something you haven't got, to sell falling shares in falling markets. Now, we've been timing the market for a very, very long time, and we've perfected several systems that identify market trends with accuracy and precision. We have long-term systems for investors and short-term systems for traders. Now, I've talked about the short-term systems at this Simon's forum on numerous occasions, and today I'm going to focus on long-term systems which are a part of our worry-free investment model. So all our systems are rule-based, and there are no subjective input. And as we'll see in a second, the computer puts a little green triangle when it's time to put your hand on your wallet and buy, and a little red triangle when you need to be careful and watch your stop losses carefully. These things are computed out of, one, the price of the VectorVest composite. Now, what is the VectorVest composite? The VectorVest composite is a composite indicator of all 2,200 shares that we're following on the London Stock Exchange and on AIM. It is an equally weighted index. Bartoledo firmly believes that an equally weighted index reflects the sentiment of the market, much better than a market cap weighted index. So the VectorVest composite for the UK, South Africa, USA, Canada, Australia, all the markets around the world that we're active in, is an equally weighted index of all of the companies that are in fact listed in that market. Now, it's the broadest measure of the London market that I know of. We look at the breadth of the VectorVest composite, and to actually calculate market breadth, we look at the proprietary VectorVest buy-sell ratio, the number of shares that are on a buy recommendation divided by the number of shares that are on a sell recommendation. And the third thing that we look at is that we look at the momentum or the relative timing of the VectorVest composite. So we look at price, we look at breadth, and we look at momentum. Short-term trading systems, which we call the primary wave, are based around a 5-day rate of change of price, momentum, and breadth. And the longer-term systems, which we call the underlying trend, are based around a 21-day rate of change of price, momentum, and breadth. Okay. To minimize chart watching for those people on the move, and our customers are busy people. As I write, the trend on the LSE is up and up. And this is recorded on the front page of VectorVest. I'll show you it in a second. This means that the primary wave, or the short-term trend, is up, and the underlying trend is up, and that's reported on the front page of the program every day. So you don't have to do any chart watching whatsoever. The short-term trend would be used by swing traders, and in fact I have a position long for the last 3 days now on the FTSE 100 spread bet based on the primary wave. Okay. The underlying trend is used by position traders, and the underlying trend is what we use for the worry-free investment model. So there's the front page of VectorVest, and that's where we were a second ago. And I hope you can see this, but the trend is up and up, and we can see a green here. This is a confirmed up. The longer-term trend has been up since the end of February. The short-term trend goes back and forward. For the last 3 days now, the short-term trend has been up, and this is diagrammatically shown by the little pointer being in the green. And as you can see, VectorVest advocates buying safe, undervalued stocks that are rising in price at this time. Now, as I say, our customers are busy people, and VectorVest fits on your phone these days, Android and iPhone, and all of this you can see on the go. Okay, you can keep your portfolio running very, very nicely on the go when you're traveling. So let's have a look at the charts. This is a chart of the VectorVest Composite UK for 2016. I mentioned that the longer term trend is a 21-day rate of change of the price, breadth of the market. Now, the indicator down below is called the market timing indicator. It's a very special composite indicator which puts together the 21-day rate of change of the price and the 21-day rate of change of the breadth of the market into the one single indicator. Again, it mathematically massages it between 0 and 2. Now, when the underlying trend, when the MTI goes up through 1 and the market has traded up for 2 weeks in a row, we get the longest signal on VectorVest, the most conservative signal, which is called a confirmed call. And that confirmed call is what we're going to use in the worry-free portfolio, and that has been in place since the end of February this year. Even Brexit didn't kick it out. So it's kept, that longer trend is still going. Interestingly, ladies and gentlemen, we had a down on the second trading day of this year. If you remember, the market sold off aggressively in January this year, put the fear of God into us on the way down here, and we got a confirmed sell on the second or third trading day of January this year. And that lasted for about 6 weeks, and we've had this confirmed up since, I think, the 22nd of February. Okay, so done a fairly good job in telling us when we want to be in the market and when we want to be exceptionally careful. Now, the market timing indicator has got some very useful overbought, oversold conditions. And when we get down to about 0.6 on the market timing indicator, that's invariably a great place to be getting involved. And when we get up to about 1.55, 1.6, that's invariably a place to be careful. The market wants to pull back a little bit. And we've seen this over and over again. Again, market got up to a very oversold position here, overbought position, should I say, and pulled off a little bit. Similarly up here, and that pullback, a little bit of a sell-off there, was certainly no surprise because the MTI was sitting up at a very high number. The one thing that worries me a little bit about this market at the moment is this potential divergence. Now, we had the price falling into the 14th of February, but the MTI rose. And that divergence invariably calls a change in trend. I think, ladies and gentlemen, that if we see this breaking to the upside and the MTI not being able to follow, that would be a worry to me. I would be very surprised if we don't get up to here quite soon. Okay. But if I saw the price making a new high, but the MTI not being able to make a new high, then that's an advance warning to be extra careful. And I found over the last 6-7 years now using VectorVest that if you get a divergence on the MTI, which precedes a confirmed call up or a confirmed call down, then that in fact is quite a potent signal. Anyway, I talk you through all of this stuff at VectorVest. If you become a VectorVest customer, we have education after education to talk you through all of this, I assure you. The MTI calls the market exceptionally well. So that's just put what I've just said. Less than 0.65, there's a strong probability of a bounce. Above 1.5, the market invariably either goes sideways or it pulls back. And just beware of that divergence on the MTI. If you see the price rising and the MTI can't follow, and then you get a confirmed down, that's invariably one to watch very carefully and to actually watch your stops exceptionally carefully in that period. So, worry-free investing, folks. This is something that our research department have put together, and I have in fact written with it in the UK, but I'm going to start with the American market. it's based around relative safety. And relative safety, as I said earlier, we look at the balance sheet, the income statement, the cash flow statement. We look at earnings consistency. We build in a little bit of the company size. We actually look at volatility. We look at how long the company's been around. We look at dividend history. For example, dividend safety, a very important part of the relative safety. And we look at all those ratios, of which the debt equity ratio is paramount. So in the worry-free investing, rather than in fact rating our stocks by VST, we rate the London stock market by relative safety. And we in fact buy in our model the top 10 relative safety stocks when the market gives a confirmed up. So here's the model, how it works. When we get a confirmed up, which you can see on the front page of VectorVest, or if you have the time, you can pull up the chart and look for the little triangle. You can see it easily on your smartphone, and our weekly strategy of the week points it out, or at the weekend. We get a confirmed up. We then search all the companies in the London stock market, and we buy the highest RS stocks. Okay. We use the VectorVest stop loss. The VectorVest stop loss is a 65-day moving average, which is adjusted for the average true range of the share and adjusted for the fundamentals. As long as the share stays above its stop loss, and that's invariably what it does do when the general market is rising. Remember, high relative safety stocks, there are rarely surprises. When we get a confirmed down, like that's what happened on the first or second trading day of this year, we simply don't buy any more and we watch our stops. So let's say that we get a strong confirmed down like we got in January or February. We've got 10 high RS stocks, and in that sell-off, let's say 3 of them hit their stop loss. We get out. We've got 7 shares left. When we get the next confirmed up, we run the scan again and we replace those 3 with the 3 highest shares on the list that we don't own. And that's it. Okay. Has everybody got that? I don't think it could be much simpler. What we're after in worry-free is that we're after capital appreciation, we're after dividends, and we're after income by selling covered calls. Now, if you sell a covered call, you are getting paid for the possibility of missing out on some upside. It is the most conservative options selling strategy that exists. The worst that can happen is that if you write a covered call above the price, that you can be called out. You still make a little bit of a profit and you get the income. So before you can write a covered call, then you need to own 100 shares of that particular company. So it's probably going to be difficult to write covered calls in Berkshire Hathaway, for example. If you don't own 100 shares and you write a call, then you're naked, okay? And that's not a conservative strategy. Now, earlier on, I showed you the MTI. When the MTI is above 1.5, 1.6, that's where we want to write our covered calls, because there's a very low probability of the market going any higher, especially within the 6 to 8 weeks where we would write the darn things, so that you won't be called out of your shares and you'd simply get the income. So you could quite easily have some shares that are appreciating nicely, that are paying 3 to 4% dividends, and you could write covered calls a couple of times, maybe 3 times a year on them, and generate another 8 to 9% income. And that's the objective of the exercise. We've tested this over the last 20 years in the US. And very simply, it's called the sort is RS descending. And we started on the 17th of May 1996 to the 17th of June 2016. We placed 177 trades, of which 10 are still going at that particular date. Along the way, we collected 554 dividend checks, and that in fact gave $51,000 worth of dividend income, which I haven't in fact calculated or compounded in the next exercise. So we have strategies of the week every weekend, and this is all done on a special presentation which was done on the 17th of June, done by one of the people at the VectorVest research department, Kathy Onan. And here's the results over the last 20 years. This is using $100,000, and we've turned $100,000 into $683,790 over the last years. And as you can see, there was long periods where it went nowhere, and then we had a bit of a pullback. I presume that's 2007, and then we've had this run up, and over the last 18 months or so, pretty flat. But nevertheless, a very credible performance, and I think that is a compounded rate of return of about 23%. Now, that's not counting the dividends. If we had added the dividends in, as you know, by adding in and compounding the dividends, that has an enormous effect on the bottom line, and there's no writing of covered calls, and covered calls are incredibly useful devices. Not used that much this side of the pond, but certainly in the US, grannies are writing covered calls. God bless them. Any grannies listening? I'm just joking. I'm just messing with you, all right? So I was very impressed with this, and I did the same thing in the UK, and we're going to do this in a second. I started in 2009, with £50,000, and between that day and a few days ago, I don't know, I did this last week. No, yeah, end of last week, I think. That's what's happened. You can see Brexit, you can see the Euro crisis, but nevertheless, the run up the page is not bad, and that, ladies and gentlemen, is about a 22% compounded rate of return over those years. And that's using the top 10 relative safety stocks on the London stock market. When we get a confirmed up, we buy the top 10 using the VectorVest stop loss. When we get a confirmed down, don't buy any more. Again, watch your stop losses. If you get stopped out of 2 and a sell-off, then next time we get a confirmed up, we run the thing again, and we replace with 2 shares that we're not holding. Now, you may be able to see this down the left-hand side here, but this tells us exactly what to do on a day-by-day basis. And as you saw on the American thing, that was 20 years. There was 174 trades in 20 years. So 20 years is 240 months, 170 trades. That would mean that you're trading, you've got something to do every 6 weeks. So you can do an awful lot of fishing and play an awful lot of golf with this particular strategy and still make some money. I haven't added any dividends into this, and I certainly haven't done any covered calls. So with a little bit of extra work, you can build a 10% a year income and still get the capital growth with very little or no risk to your capital. Okay, in the UK's safest stocks. So, Simon, any questions at all?
Hi, David. Yeah, we've just got about 8 or 9 minutes left. Now, Mo is asking, can you show again how you set up to see the top 50 companies with RV, RS, and RT? So I guess that's something in the program on the.
Well, you just type 50 and it's there. Okay. So. Any other questions? I want to do the back testing. But
does the education program within VectorVest show you how to do this options idea? I think you mentioned options earlier on.
The strategy of the week will talk you through the options. We have a separate options course which comes with the product. Okay. I think that writing covered calls, there's very little to it, and we certainly talk about it at the user groups. Under training, there's a full 5-week course, and if we go down a little bit further, all of that is done within the VectorVest University here. So an enormous commitment to training. It comes at you thick and fast. So what I've done, folks, is that within the UniSearch module, under conservative, I've written a search, and that search is simply worry-free investing. And there's nothing more to it than this, is that the computer looks for all the stocks with a relative value of greater than 1 and sorts them by RS. That's it. So if I run that search today, that's what we would get. Cranswick, Reed Elsevier, Diploma, WPP, JD Sports, Reckitt, HomeServe, Servco, Bellway, Unilever, Hillsmith. So if there was a confirmed up today, in worry-free, we would buy the top 10 of these. That's it. So if I go to the back tester, and I've been running some of these now, I can build this really easily. Create a new backtest. My son normally does this, but I'll do my best. Build a trading system here. We're using the confirmed calls as market timing, okay? And that's the definition of the confirmed calls. Next, I want to fill it from a search. And if I go down to conservative, and that should open up that search. And there's my worry-free. Okay. Stops. Now I'm going to do what I was taught to do so many years ago. I use a trailing stop and a target, and this is what I do myself. And I'm only happy about talking about what I do myself. I use a 25% trailing stop loss and a 50% target. And that's what my first mentor taught me how to do, a 50% target. So we trail the stop loss up behind us at 25% below the last highest high, and when we make a 50% profit, we bag it. And I've found that opening up 2 positions a day, when you get a confirmed up, on the first day we buy 2, second day we buy 2, second day we buy 2, second day we buy 2. Okay, and I invest the average portfolio value, which initially is £5,000. As the portfolio goes up, then it averages that out. Now, when we sell short, I'm taking. Okay, maybe next. When I sell short, no action. So if I finish now, I should be able to say, so, no, I've done this, I've got, been practicing this all day and I've got it wrong. Customize the trading system. So next, fill from search, buy long, Wi-Fi, okay, stops. Trailing stop, 25. Okay, and target, okay, that's good. Next, sell short, no action. Leave existing positions open, and okay, I think I've got that right this time. Yep, buy long, Wi-Fi, stop. Stop criteria 25, trailing stop 2050 target. Try and maintain 10 positions. Automatically place close positions. Okay, want to go back now to 2009, and I go back to 2009. This is just my way of doing it. You can put together lots and lots of ways of doing this. The first confirmed call was on the 20th. We'll start it on the 23rd, and I press OK. That's it. And now we run it. And you can run these searches, and you can build your own trading system that suits you. But this is the worry-free trading system. And now we're running. And there's the greens are confirmed up, the reds is confirmed down. Remember, when you get a red signal, you in fact don't buy any more, and you just watch your stop losses carefully. Then you replace when you get the next confirmed up. So there we are. And down the side here are all your daily actions. And most days there's nothing to do. That was the Euro crisis. Now this is a very simple model. We can have a much more aggressive model.
David? Christopher's just saying he's on his VectorVest UK at the moment. He's looking for the worry-free search in the UK version, is it?
No, you have to write that yourself. It's just RV is greater than 1 and sort by RS. You just need to write that. It's not. You need to write that search for yourself.
Okay, so it's not actually
not a standard search. So it's just so simple that it is not a standard search. So you got to write that for yourself. And that is the worry-free portfolio, and that has a 20-year track record and a very strong track record in the UK as well. And at the minute, it's, where are we? There we are. It's turned £50,000 into £173,000. And that is a compounded rate of return of 18%. Okay, and that is not counting any dividends. And as you can see, it took quite a smack at Brexit. Now, at the top here, I've got a test where it's made £240,000, and here. I'm going to run out of time now, but the £240,000 from the £50,000 was in fact using a sort just VST. Now VST is a more aggressive sort because within the VST you could have a share that in fact has got a very low relative safety. So the worry-free uses relative safety. It's a very simple search to write. It's just RV is greater than 1 and just sort by RS. We can show you how to write that in 2 seconds. Okay, that is our worry-free portfolio. I think that if you're trading aggressively, as certainly I do on various instruments, it's absolutely wonderful to actually build up capital in the background with virtually no effort whatsoever. Rake in the dividends, reinvest the dividends, and when you're feeling confident, write some covered calls for extra income. So, that is the top VST stocks. A smoother graph, and it rose an awful lot faster towards the end because it caught the gold mining stocks during the course of this year. So try it for yourself if you wish. Happy to offer you full access to VectorVest UK and VectorVest USA for 5 weeks, and that's £5.95. And then it's £39 a month on a month-by-month basis. If I can't make you money, you stop at any time. I don't think I can be fairer than that. That is the link. Simon, I think I'm correct there, vectorvest.co.uk/RTC.
That's correct. It's in the chat box.
Okay. That includes full access to the 5-week VectorVest Quick Start course, all the stuff on the VectorVest University, which certainly gives a very good introduction to writing covered calls. Any questions, or have I completely run out of time, Simon?
No, that's fine, David. You were a few minutes. You didn't get to start till a few minutes after, so that was our fault. Caroline saying, what were the WFI, the worry-free investing settings again?
It's couldn't be simpler. Let me get it for you. It'll be in Unisearch. Relative value is greater than 1, and then just click on the sort and just RS in this primary sort. That's it.
There we are. RV greater than 1. Thank you very much. Superb as always, David, says Gordon. Okay, lots of customers on, which is great here. Lots of people already using VectorVest, which is fantastic. Well, I've put the link in the chat box. The 5-week training course still available with the trial, is it?
Yes, the 5-week training course is in the trial, and anybody that takes the 5-week trial, if you click on training, you'll see the 5-week course just there. Okay, and that will show you exactly how to use the program to build wealth. If you go to the VectorVest University and click on that, and why it takes me to this Microsoft Edge, I don't know. And you'll find that in the VectorVest University, I think that a lot of the stuff is much more nuts and bolts. How do you circumnavigate the home page, the viewers, how to pull up all the charts, how to actually write searches. So if you wanted to write that search we talked about and you're not quite sure how to do it, then this will actually show you how to do it. There's a big portfolio manager, how to in fact make the portfolio manager work for you. And within the portfolio manager, ladies and gentlemen, there's a thing called the Genius. And the Genius can be set up with a worry-free so that it, in fact, emails you every day and tells you exactly what to do. And so no thought required at all. I think that if you are an aggressive trader and you're short the euro as I am from an hour or two ago, it's nerve-wracking stuff at times. It's really good to have a dozen safe companies grafting for you, paying a nice dividend, and then maybe augmenting that dividend when the MTI is really stretched in the upside around 1.5, 1.6. Very small chance that you'll be called out of those shares when the market's up there, and that will mean that you can just grab that income, and you should be able to do that 2 or 3 times a year. And we're talking if your timing's out by a day or two at the top there, or a week or two even, not going to make any difference whatsoever. So relatively low stress environment, lots of golf, and you can chill a bit. Okay.
Worry-free, in fact. Thank you, David, from Joanna in France. Caroline's already using VectorVest. Fantastic. David Paul from VectorVest. I think we'll have to stop there if that's okay.
Good.
And
thank you very much.
Thank you. No, thank you for joining us again. It's all good. I'll take the presenter role back for you because we're just about to go straight over to David Goldstein, who's waiting patiently to join us. So thank you very much, David Paul at VectorVest.
Cheers, everyone. Bye.
So there we are. We have run over just a few minutes into Stephen's presentation. We're welcoming back Stephen Goldstein from Alpha R Cubed to join us now. I can see that he's already checked in the room. How to avoid emotional hijack.
emotions in trading. Let's just go straight over to David now. If you're just joining us, welcome to Round the Clock Trader, start of the evening sessions. This is Simon Campbell. We've been live since 9 o'clock this morning with fantastic presentations and lessons on trading. It is all recorded, so if you're just joining us, you will have access to the recordings to catch up on anything you've missed previously today. These will be ready normally by the end of Friday. It takes about a day for it to process itself, and we'll get that out to you as soon as we can. So let's go straight over and welcome our next speaker, Stephen Goldstein. Good evening, Stephen. Are you there? Can you hear me okay? Okay, well, I'm presuming Stephen can't.
Can you hear me okay?
Oh yes, now I can hear you now. Good evening.
Right, okay. Is that coming through loud and clear?
Yes, it's okay. I think we can all hear. Why don't we go across to your screen, and then we can check that people can hear and see you okay before we get started. So we'll make you the presenter now.
Okay.
Excellent. Human emotions in trading. That's
Brilliant.
fine.
Okay.
So
am I good to go?
if people can just let me know with the chat box that you're able to hear Stephen and you can see the graphics okay. Stephen, I'm sorry, we just sort of started to lose our schedule a little bit, which meant we were just a few minutes behind there to give David Paul his full time. So sorry to keep you waiting. Thank you for coming back to join us. I know you spoke with us before, and this is another presentation on the same subject of human emotions in trading. It's the trading behavior that is your speciality. And without going into too much detail, I know that you've been a sort of a coach to a lot of the traders in the banks over the years, offering institutional coaching to the traders, and you have a lot of material there that can be helpful for retail traders as well. So we'll hand over to you without dilly-dallying anymore, and I'll let you get started, and we'll take some questions as we go.
Okay, lovely. Well, I'll try and get this done in about 40 odd 45 minutes. So maybe we can do 10 or 15 minutes of questions towards the end. But anyway, thank you very much for the introduction, Simon. And good afternoon, everybody. Welcome to this webinar. My name is Stephen Goldstein. I'm going to be talking about human emotions in trading. Firstly, a little bit of an introduction about who I am. I was a proprietary trader, started in the mid-80s, traded for nearly 25 years at banks such as Credit Suisse, Commerzbank, Standard Chartered Bank, in FX rates and fixed income. Made quite a change, which I'll explain a little bit about as I go through, because it's necessary for some of the context which is going to follow. I started coaching in 2009, gained some qualifications around coaching, around how to be a coach, how to enable yourself as a coach to be able to help take people through transformations. In that time, I built up a business where I now work with banks, hedge funds, asset managers, energy traders, energy firms, and private traders. I've got clients at a number of leading institutions, pretty much all over the world, clients in Australia, New Zealand, Hong Kong, Singapore, throughout Europe, the UK, of course, and in North America. So just to talk about, firstly, what the goal of what we're doing today. This presentation is probably on a slightly different theme from the other presentations. I know there's been some terrific presentations about approaches to trading, about methods, techniques, using charts, technical analysis. So this is slightly different now. We're going to look at talking about a subject which is very dear to most traders' hearts, which is really the subject of trader emotions, how that affects your behaviour, how that impacts your trading, and hopefully we're going to bring up some themes. I'm going to talk about some stories that I've got from my coaching experience and from my own experience as a trader, which bringing in certain techniques or to create some thinking and self-awareness to help you understand emotions and how you can use them to improve your profitability as a trader. So a little bit of context first. I think it's quite important to understand what it is I do as a coach, because as I go through this presentation, it'll become necessary to understand that. And like I said, I work as a performance coach with individuals. The term coach it's rather an overused term these days, particularly with traders, and it's used by pretty much anyone that's in the performance development sphere. Just to try and sort of just delineate between some of the different types of performance development that a lot of people call themselves coaching. There is teaching and training, which is really what people impart their knowledge of their system or technique, or they train you, or they teach you. So they're passing their knowledge, what they know, to you. That's what teaching and training is. The next one is mentoring. It's similar to coaching in some ways, but there's quite a difference. Mentors are often people who are either involved in a role in the job or were involved in the past, often very successfully, and they kind of take you under their wing a little bit. They give you guidance, they give you invaluable advice, and I think every successful trader and investor at some point has a mentor that they can look at, and I know a lot of the most successful traders that I've worked with, both as a coach and a trader, have had their mentors in the past that have been instrumental in their success, and equally they've had many teachers and trainers. Now, as a coach, really the sort of coaching I do comes in at a higher level, where you're working with someone who really has a high degree of skill, a high degree of competence. Think of a coach in terms of the more familiar term, a sports coach. They work with people at the top end of the profession. The higher up you go within the profession, the more professional coaching you have, the more coaches you have. So you're helping to refine people, you're helping to fine-tune them, you're helping to provide feedback to them. The coach isn't necessarily of a higher caliber than the person they're coaching even, but their skill is, as a coach, it's how to get the most out of them, how to take them forward from where they are. You would help people by helping them self-assess, self-examine, reflect, try and understand what they do, help them try and do it differently, and help guide them through that process of habitualizing better and improved behaviors and not letting them slip. So a coach is what I would call a more higher level. And then you come down to two types of coaches, really. A coach who works on the technical aspects of someone's game. Think of a batting coach in cricket, or a goalkeeping coach in football. And then you get the more general coach who works more holistically with a person or with a team, helps them with their mindset. You help with the whole person, so you will be doing some skills coaching, but you do a much broader sense. And that comes back to where I am as a coach and what I do. So as a performance coach, I'm very much that latter form. In terms of what I do, it's incredibly powerful. It helps traders, it helps investors move to a much higher level of performance. I experienced it myself as a trader back in 2001 when I was fortunate to be offered coaching, and now I see the benefit my clients have. And it's not common for us to see big improvements in their performance, in their level of profitability, in their returns. Years, and that's sustained performance, and it's not common to see 50% or 100% improvements in performance, even more. And in many cases, these are worth millions of dollars. When I'm dealing with banks, when I'm dealing with hedge funds, when I'm dealing with investment firms, and we're talking the size notional they have, these performance improvements are worth literally in billions of dollars or millions of dollars to the bottom line. Perhaps not billions of dollars, but certainly we see performance improvements and feedback from our clients highlighting that they're seeing those sort of increases. So the coaching takes place face-to-face. We usually meet every few weeks, spend roughly 90 minutes with an individual. Before the coaching, we would do a personality assessment, risk profiling, get feedback sometimes from clients, managers, colleagues to try and get a more objective perspective on the individual. And then we work with them to help them grow, to explore their growth areas, their obstacles, the challenges, understand what it is that leads to their success, helps them leverage that even more, and help them try and find the derailers, the things that throw them off. And then how can we try and help them offset that to a degree, to help lead to greater performance. Now, during my coaching, I often use a practice called, I try and introduce people to a pre-mortem. Now, pre-mortem is a kind of tool, it's a technique often used in project management, but I've applied it to try and get people to think around the idea of a pre-mortem. Quick explanation, it's a technique which I originally heard of from a behavioral finance professor called Gary Klein. And the concept relies on subverting the normal planning process. So the normal planning process for a project is come up with an idea, put it into action, run that project through, hopefully the goal will be achieved. There will of course be a risk assessment at a planning stage, but that'll be all part of the moving forward towards the goal. If you think of it in trading terms, when you come up with an idea, you do your analysis, you find some value in the market, you look for a trade, you look for a level to go for, and then you move forward towards that trade, hoping to make your goal or towards a series of goals. Now, the pre-mortem works alongside that process, but subverts it, where you start with what you want to achieve, where your goal is, and then you work backwards. And you think of all the things that are going to try and stop you, that will stop you getting to that goal. You would draw back on your past history, previous behaviours, and you'll bring in other aspects as well, behavioural biases that you're familiar with, that you fall victim to, and then you try and construct a more robust process once you have that. Now, I encourage a lot of the traders that I coach to adopt some form of pre-mortem thinking. It's not always very easy to actually run it through in a full format. You can with your longer term trades. With shorter term trades, I just like it to be part of the process in their head that says, you know, is my stop right? How much do I want to lose on this? Am I, you know, a lot of the behaviours, am I getting too big on my size? What is it that comes into my work? Do I suffer overconfidence, confirmation bias? So all these different aspects. Now, in a sense, what I'm going to do now is to try and ask you to engage in a little bit of your own pre-mortem thinking, just for a small exercise. Very simple. I'd like you to try and think of a point in the future and how much money you're estimating to try and make by that point in the future. So if you're thinking maybe 1 year from today, and you're thinking, I've got to set myself a target of 100,000 profit, or maybe a 20% return on capital, that is where you are. Some people might have larger budgets and targets. Some people might have smaller. Some people might be hobbyist traders where they're looking to make 10,000. Obviously, this all depends on your resources, how much capital you have, how much time you can devote to your work. So try and think. You'd like to bet. So let's stick with 1 year, £100,000. Okay. Now, what is going to stop you getting to that point in time? What is going to stop you achieving that goal? What stops you achieving that goal most years? You know, most of us set a goal, whether consciously or subconsciously. Think back to a year ago. If we're using this example, let's say you decided a year ago you wanted to make £100,000 in that time, but you fell short. I'm guessing roughly 90 to 95% of people fall short. Most years, if we have it every year, actually closer to 98 to 99% over many years fall short. So what is it that causes that? What gets in the way? Most of you here have systems, approaches, methods that actually enable you to realize that value, but you don't actually realize that value. What gets in the way? What stops you there? Where is your pre-mortem coming up with areas that are stopping you? How realistic are your goals? Now, I'm going to stop there and I'm going to bring in an example of a trader that I worked. It was a portfolio manager at a hedge fund. Okay, I'll return to this pre-mortem shortly. But I want to just tell you about this guy. Let's call him Alex. I'm not going to give you his real name. But I coached him a couple of years ago. He came to me in early 2014. Okay, now in front of you here on the screen, you can see a summary of Alex's performance, which was taken from his own trading journal. Now, he joined as a very successful bank trader. He'd been working for about 10 years in a major investment bank, incredibly successful, was hitting the ball out of the park every single year. He estimated that his performance level was equivalent, if he was working in a hedge fund, equivalent to roughly an annual return of 30%. So that's what he thought he could achieve in the hedge fund. Now, as you can see, in his first year, his actual performance came in at 9%, 2010, 2011. Not terrible, not ball out the park either. Okay, Sharpe ratio. But what he'd done, what Alex did, was he was very rigorous on his record checking, on his record keeping. He didn't, every time he had a trade idea, he wrote down what he where it thinks it should go, what his goal is going to be, where his stop's going to be, what would take him out of that trade. Okay, and every year he constructed a virtual performance, what he would have made if he'd have followed his performance and done what he said he was going to do. So as you can see in year one there, 2010, 2011, his virtual performance would have been 37%, with a very strong Sharpe ratio of over 2%. So, you know, relatively volatile free, considering the size of the performance. Now, in his second year, though, that was the biggest disaster. He returned just over 3%, with a very poor Sharpe ratio. But if you look at his virtual performance that year, why that was such a disaster, his ideas that he called, if he'd have followed them exactly as he had planned, would have returned 68%. The next year, very similar, just over 4%, just under 5%, very poor Sharpe ratio. But if you actually look at his return, it would have been 29%, with again a strong Sharpe ratio, close to 2%. So he is calling the market brilliantly. And this is very common. I'm sure a lot of you recognize this. I see this, a lot of people come to me, they tell me how they call the market, how they put their trade ideas. Most people have a system that can help them generate good returns if they can stick to it. Most people have the technical analysis. This guy was actually discretionary. It wasn't a system. He based it on a mixture of technical analysis, fundamental analysis, sharing ideas with people, to a degree some gut feeling there as well. That he brought the whole lot together. That was how he's constructed his trades. So he came to me, you know, he was now clinging on by his fingertips to this hedge fund. 3 years of subpar performance. I mean, I guess those numbers wouldn't have looked too bad the last couple of years, but over those 3 years, that was really subpar performance. This was a very, very high achieving hedge fund with high standards. So somebody recommended that he should see me to help him with this problem. And we started a series of coaching over the course of 2014 that actually went into 2015. And I'm glad to say that his numbers have significantly improved. The big problem were the emotions. You know, he actually thought he was not affected that much by emotions in his trading. But when we talked about it, when we examined it, when we looked at where the difference was between his virtual performance, his actual performance, where the key turning points were that was happening for him, it was down to emotional factors, and not necessarily emotional factors that he was conscious of. Now, I was a trader for nearly 25 years. I was actually quite an emotional trader, and I can tell you that it can wreck, emotions can wreck your trading performance. It can even wreck your analysis, because it doesn't stop at trading it moves backwards. You start changing your analysis. You start trying to make situations fit what you want them to look like. In other words, to try and prove yourself sometimes. Your ego gets involved. It's incredibly difficult to just extricate, really, sometimes, to just separate them out. So Alex's dilemmas were his emotions were interfering with rational process. At the bank, he had achieved a high status. He had a huge support network, probably overestimated the value of the news flow, or maybe underestimated, rather, the value of the news flow and the insight this gave him. So that may have caused him to be a bit too bullish on his expectations when he joined the hedge fund. But when we examine this, his performance has seen a sharp improvement. In fact, last year was a very bad year for his hedge fund, but he was actually the top PM of that particular firm, producing a return of, I think it was closer to 14%. But his virtual performance numbers actually came down a little bit as well, because we were helping him be a little bit more realistic on it. So he actually closed both down a little bit. And actually, the point here was that his performance improved. We worked on lots of areas. We worked on risk management, sizing, money management, distancing himself sometimes from the noise, but other times actually even embracing the noise a little bit more. Now here's the point. Let me go back to the pre-mortem now. What is it that gets in the way? What is it that got in the way of Alex achieving the success he felt he could? What is it that gets in the way of most people from achieving success? What is it, if you think about your pre-mortem, is stopping you receiving those numbers? It's probably not your analysis. It's probably not your system. It's almost certainly your emotions. But it's almost certain that you spend virtually no time on your emotions. Key point one, I'm going to raise a number of key points as I do this talk today. Key point one, superior emotional management is probably the biggest differentiator between success and failure in trading. But, and here's the kicker, the amount of energy and effort people commit to improve their emotional management is at its best negligible and its worst non-existent. And I'm going to put my hand up here and say guilty. I did it when I was a trader. I was like Alex. I was like a lot of other people. I thought I could solve these problems myself. I read books. I've got all the books. Market Wizards, the Mark Douglas series, probably some of the best books on trading. And I recommend a lot of people who come into my coaching go and buy Mark Douglas, Steenbarger. Books that aren't necessarily about trading, but are related to trading. The Malcolm Gladwell books that will make you think of different aspects. And many other ones, behavioral finance. It's great reading. Reading is important. Do this stuff. It's got a limit, though. Once you read the book, you put it away. You maybe make a few notes. I'm going to change a little bit. 1 month, 2 months down the line, you're not looking at that book again. As someone said to me, you can read a book about swimming, but you can't learn to swim from a book. There's a lot about that that's very similar to trading. Anyone's ever done read a technical analysis book, and then gone and sat and spent a little bit of time learning technical analysis from a master technical analysis, you learn a whole different ball game of how to read the markets. There's only so much you can do in a book. So the pre-mortem idea, use that, bring that in. There's a lot more to explore about the pre-mortem than just this. It's one of those things that stops you suffering from emotional hijack. Emotional hijack is where your rationality and your ideas are taken over by emotions, where the buttons are not being pressed by you as you'd like to, but by your emotional self. That's kicking in. So, let's move on a little bit. Coming back to the subject of emotions. Okay, I said just a few minutes ago, it's probably the biggest differentiator between success and failure. Alex's example, the game had changed significantly for him as he came into it. So there's a point I want to make here. We think of trading as an intellectual activity. We put an awful lot of energy into the intellectual side of trading, into analysing markets, in trying to find value, in trying to see where the market's going to move to next. That is mostly an intellectual part. The actual activity of trading, though, it's a performance activity. It probably shares more in common with sports and other performance activities. All those things, you have the technical skill, you have the ability. On the big day, in the big moment, on the big stage, it comes down to emotions. It comes down to ego. It comes down to how you use them, how you control them, how you manage them. Think of any performance activity. Think of acting. People go on stage, they lose their nerve. Think of poker. Think of endurance sports. Think of mountain climbing. Trading is a performance activity. I'll just tell you a little bit about my own story with regard to how I came to coaching, because I think it's relevant here. And it's also useful to understand perhaps your own development. So I went to see a coach in 2001, 15 years into my trading career. Actually, I'm probably exaggerating a little bit. It makes it sound like I woke up one morning and decided I needed a coach. I was quite fortunate. I worked in a bank. I was on the management process. The bank I worked at, they brought in executive coaches, which is coaching, which I don't know if you're familiar with, any of you, but it's large corporations, large firm, use them to help raise the quality of their management and leadership, to help support them. So I was lucky that I was given executive coaching, okay? But the experience of executive coaching had a very profound effect on my trading. There was a lot of guided self-reflection in the coaching, which led to a much more elevated level of self-awareness. And I grew increasingly conscious of the gap between my technical analysis, which I had learned some years earlier. I was very fortunate. Here's an example of having a great teacher, and I'm going to mention someone now who's actually given 2 of these webinars today on this round the clock trader. The person who taught me was Carol Hallmey. She was the technical analyst, the lead technical analyst at Credit Suisse at the time. I was a trader at Credit Suisse. Probably, and I worked with, and I know many great technical analysts. Carol is probably unique. She's probably the best person I've ever worked with as a technical analyst. It's probably a slight exaggeration, but she's not just a technical analyst. She knows markets. She knows them inside out, back to front, and she brings in other aspects of her experience of markets and trading. So it's not just looking at the price action. It's reading it, interpreting it in terms of market behaviour as well. So I was lucky. Great example of having a great teacher. That was Carol Hallmey. But I became conscious that I could read a market brilliantly. I could recognise, I could call the market well, had great ideas. I brought in fundamentals. I brought in data analysis. I understood momentum. I brought in my own intuition. But I wasn't necessarily monetising that. Rather like Alex in that example, he wasn't monetising his ideas. That is where the performance part is coming. It's very different from the analysis part. The analysis is much more intellectual, not totally intellectual, and I'll come back to that soon. Monetising it, that's a performance part, similar to sports, acting, dance, poker, mountain climbing, football, cricket, you name it. It matters on the day. Now, I want to now introduce you to another trader who I coached a few years ago. He's an amazing trader, probably the best trader I've ever worked with. He worked for an investment bank in their Hong Kong office, a major US investment bank. But he also was one of the world's top 250 ranked poker players. And that was quite incredible because he was a full-time market maker at a bank who was competing against the world's top poker players. He regularly went to Macau for tournaments on the weekend. And a lot of these guys were pros, semi-pros. He was completely part-time. Although, saying that, the fact that he traded every time and the similarity between trading and poker meant to a degree he was playing poker every single day. Or he was going through the same mindset, sharpening his game and his senses to risk and uncertainty. So in our coaching, we often discussed emotions. During the coaching with him, and this guy was so acutely aware of the impact of emotions as a potential derailer, but also of how emotions can actually help him, could actually provide an upside to his work. This guy was a real student of emotions, a very humble guy, which made it possible for him to read his own emotions without wrapping his ego too much into it, to read the market's emotions, and to read it all within a context of the ambiguity and uncertainty that exists within trading. Of course, he was not perfect, but then this is part of it. There is no one who is perfect when it comes to risk. The best you can do is be optimal. And this is key point 2. And I'd like you to take note of this. There is no perfect when it comes to risk. The very best you can do is to be optimal. That is it. All the successful traders who I've worked with, they know that. More importantly, they factor it into their thinking. Perhaps they don't carry it consciously in their thinking, but it sits there in their subconscious, which, by the way, is where most successful trading occurs, subconsciously. And that's actually why the coaching works, because the coaching supports the individual to make something conscious and then takes them through so that becomes part of their subconscious. It becomes an extended series of meetings, and you're constantly refreshing, reminding that individual, keeping them on track, so they're habitualizing some of the attitudes, behaviors, philosophies that we discuss and explore, so they eventually become part of their unconscious. So, as an example of how this poker player used to use emotions, or this trader in his poker, you know, he didn't know all the permutations, all the real probability. It's nice to have the probability there. That's probably like the analysis. It's the academic side. The problem is that with poker, like trading, the moment the first post-ante action happens, the randomness disappears. The success of those permutations change. Human effect, human input comes in to affect the game. It now switches from a matter of randomness to being a combination of luck and skill. The two are intertwined. You can't necessarily take out one from the other, but because skill is involved somewhere in that process now, there is a very good chance you can affect the outcome. And it's the same in trading. Now, this guy used to tell me, you know, it's about also how you stay, how you are during the game when you're playing poker. Managing your emotions, not letting your emotions get the better of you. You know, in poker, so since skill comes into it, it now comes to a big part of your cognition abilities, cognitive abilities. That's not intellectual intelligence, that's everything. That's all these different intelligences: emotional intelligence, risk intelligence, behavioral intelligence. So we'll be drawing on logic, we'll be drawing on your knowledge, you'll be drawing on your experiences, but you also have factors which affect it will be your personality, your tolerance for risk, your senses, feelings and emotions. And these will influence the decisions you make. And there'll be other factors, there'll be environmental factors, combining that to influence your decisions. So there'll be, for example, the amount of money on the table, the size of your pot, the size of the opponent's pot, your reading of others' emotions, your knowledge of others, your own feelings and emotions, your subjective estimates of the probability of winning from what you know and what you can see in front of you. You know, I had one fascinating discussion with this trader where he told me that, in his opinion, what makes him successful and better than the others, considering he's playing against very high-level, high-stakes poker players, was actually his ability to walk away, his ability to lose well. Those were probably his greatest assets and what probably differentiated him from the other people around him and led to his, over time, outperformance against other rivals. Now that's fascinating, because if you think about it, his winnings created value, but it was how he managed his losses that made the difference. And it was how emotions affected how he managed his losses as well as his winnings. This individual saw losing as part of winning. For him it was a necessary evil, but not an evil in itself. As I spoke to him, I realised he'd already adopted and absorbed pre-mortem thinking into his mindset and way of working. And all of this enabled him to contextualise his losses, and thus stop them from controlling and shaping his actions, or the emotions that resulted from that, from shaping his actions. So this is key point 3, which I'm going to bring up. You may have heard this phrase before: the best loser is the long-term winner. Think about it for a minute. Losing is beautiful. Learn to love your losses. Now you might be thinking at this point, what the hell is this guy talking about? I hope none of you are nodding. But please don't exit the webinar. There's a point to this. The question is, do you want to be in control of your emotions, or do you want your emotions to be in control of you? If the former happens, you have a far greater chance of achieving success as a trader. If you want them to control you, at best you will have underperformance, like Alex was in those 3 years. At worst, you'll be one of the unknown millions of traders who have failed and fallen by the wayside, but yet had the potential to succeed. So what this brings me on is to the last point I want to make in this talk. What this poker player has done, this trading poker player, is to set the context. The context is where losing is part of winning, a necessary part. Losses are not an unexpected shock. They fit into his plan. Even if he had a series of losses, that's accepted. That's part of it. Randomness is part of it. Luck is part of it. But you can make skill the actual defining factor in the long terms. I'm not going to say losses don't stir emotions. For him, they do. He's not a robot. No one's an emotionless robot. But it's how he manages them. So that's the level of emotional arousal, which doesn't happen, is not debilitating for him. Debilitating. In fact, by setting the context, it is highly liberating for him. Now this brings me on to the next point. It's about understanding the context of trading, uncertainty, risk, investing. I want to introduce you to a model which is adapted from systems thinking. And I want you to think of I want you to think of 2 different systems. I want you to think of everything we see in the world and we experience as 1 or 2 systems or an environment. And on one side you've got a complex system, complex environment. On the other side you've got a complicated system or environment. So start by looking at the complicated environment system. Now within this we have definitive answers which are obtainable and provable in advance. Solutions may be extremely complicated, but we, or others who we know, can calculate them and identify solutions up front. This is the domain of science, technology, maths, engineering. Expertise and intellectual intelligence is highly valued when we're talking about a complicated system. The approach to finding solutions is to sense what's happening, analyse, and then respond. Now this is the predominant philosophical approach we have to problem solving in our Western education system. And the problem is when we don't get outcomes which match our expectations, this gives rise to very strong emotions. And often those emotions then take us over. So I'm now going to move to the other side and introduce the complex system. Now the complex system is where definitive answers are extremely difficult to ascertain without the benefit of hindsight. The situation is always evolving, it's always changing, it's ambiguous and uncertain, it's highly volatile. There's just too many unknowns and non-consistent variables and ever-changing variables to actually formulate a definitive answer or solution. Now, this is the domain of people factors, of humans. It's the domain of emotions. It's the domain of behavior. We cannot predict human behavior, human emotions. The market is a collection of people. It's a collection of thousands, millions of people, all making decisions. That affects price. Price affects the decision they then make, which again affects price. We kind of have an evolving process here. People do not think, make a decision, that's going to be the price, because the price then affects your decision. It's that Keynesian loop. I don't know if you're familiar with the Keynesian beauty contest theory, where people make decisions based on what they think other people are going to make decisions of. That is the example of a complex system. Now, in a complex system, what is highly valued is skill, ability, emotional intelligence, probabilistic thinking. Expertise, obviously useful. Intellectual intelligence, useful. Can actually sometimes get in the way. That is why sometimes we see highly intelligent people struggling in financial markets. I'm always minded of the phrase accredited to Isaac Newton. I can understand the motions of heavenly bodies, but I can't fathom out the minds of people. That was at a time where he had supposedly lost his entire fortune in the South Sea bubble. So the approach to the complex system is different to the approach for a complicated system. It involves probing. It involves probing and then sensing and then responding. Doesn't mean analysis isn't part of the process, but that's the primary three things: probe, sense, respond. And then you go back to probing again. There is no answer, it's not a solution. So financial market trading and investment problem solving fits on the left-hand side of this diagram. I delineate it, I don't delineate it clearly, because actually it's not easy to see sometimes where the gap is between the two. There's a lot of overlap, there's a lot of pushing into areas will sometimes move between both. Financial market trading actually probably does straddle the dashed line in between. You can think of examples of structuring where you don't own the risk, but you create a product at a point in time, probably fits around on the other side, the complicated system. Writing options, as long as you're not managing the risk, probably fits on the right-hand side. Running the risk, managing the risk, it's definitely on the left-hand side. Now, strong emotions will still arise, but you can contextualize them, you can understand them, you've allowed for them, and thus you're better able to control or aware these emotions. So this is key point 4. Accepting randomness and luck are part of the process. No matter how skilled or expert you are limited in how much you can know. Keep this in mind, because that can be emotionally liberating. That then starts to give you better control, more self-control. I've pretty much reached the end of this. I'll leave that up there, that key point 4, if anyone wants to just look at it for a little bit. I'm happy to take some questions, some Q&As. I want to leave you with one key takeaway. I've talked about human emotions from a derailing perspective, but actually once you start getting on top of your emotions, they are also an opportunity. They provide opportunity. They will provide you with clues. You know, a lot of people want to shut down their emotions as much as possible. Trouble is, you shut yourself down to input, to sensory input. One last story. I met a trader a number of years ago. The guy who was backing him asked if I could work with him to help him improve. He thought he had a lot of potential. You know, he should be making more money. Could I go and work with him? So he gave me an address to go and visit him. It was up in Islington's, so I thought it was going to be in the design centre, where there's a number of small trading outfits. Actually, as I got to the address, I went down some back streets, found myself at a factory, a clothing factory, where this guy met me at the door, took me through the clothing factory to a small dark room at the back of the factory, where he was sitting on his own with a few screens trading. And I said, what's going on here? You know, so I used to work on a big floor up in London, in Broad Street, big trading floor. Too many people around me wanted to know what I was doing, affecting my trading, affecting the decisions I was making. I wanted to lock myself away where nobody else's emotions and input could affect my trading. So I said, well, has it helped? He went, no, not at all. He's sitting there in a dark room. He's metaphorically tried to move himself away from the market as much as possible, away from the human side. It didn't work. Closed himself in a small room. Now you think of that. When you, as a metaphor, you close yourself in a small room, you close out the light. There is enormous value from having people around you. You can read them, you can share opinions, and there's enormous value from opening yourself up to your emotions. I coach traders of all types. Some of them are highly emotional, brilliant traders, make an absolute fortune. They are completely open to everything going on emotionally. Other ones shut themselves off, trying to rely on logic, but also using their emotions as part of the process, aware that they are a key input into the process, that sometimes you have to move from logic and make that leap of faith. You know, if the market's turning, you know, you don't want to get caught joining the market too late, so you have to listen sometimes to your emotions. With regard to risk tolerance and risk awareness, the most successful guy I've ever coached, I wouldn't necessarily the best, but the guy who makes the most money, partly because he's got the most capital behind him, is one of the most risk-averse traders I have ever met. Uses his emotions brilliantly, makes sure he stays away from the place where bad emotions happen, but reads emotions of himself, reads emotions of the markets, put in a process where he doesn't allow emotions to take over his decision making. There is so much you can get out of emotions. I'm going to sort of leave it open. If anyone's got any questions, Simon's moderating this. Please feel free to put them on there. Here's my contact details if anyone wants to know more about my coaching programs. Myself and Simon are looking at doing a series of webinars at some point. We haven't planned it, but I know it's in the pipeline somewhere, which might give people greater access to some of this kind of sort of online coaching, which we're talking about. But I'm going to hand back to Simon now.
Well, Stephen, thank you for that. There are a few questions. Just waiting for the right time to sort of jump in. Saz, he says, how can I determine whether I have an emotional issue or is it an actual skill deficit?
How can I determine if I have an emotional issue?
I think it might be your key point 4 if you go back to one of the slides where you had the key points.
Is it a skills deficit? Okay, so very difficult question to answer. As I said before, the difference between the skills, the emotions, some of the logical aspects, they are intertwined, but emotions runs through everything. Often, sometimes, if your skills are suffering, there's likely to be an emotional factor. You cannot make a decision without engaging your emotions somewhere. Your emotions are a response to what your senses pick up. You know, you cannot help that. You cannot make a decision without emotional input from your senses into the decision-making process. What I'd say is where your skills are, you know, you have the skill, you know the skills needed, you're not able to actually put that skill into practice, there is something going on. There may be something emotional happening, maybe, and I do this with a lot of people, I say cut down your size sometimes to develop the skills. I'm going to use an analogy here, which I bring into a lot of my coaching conversations, the analogy of the tightrope walker. So as a tightrope walker, you learn to cross the tightrope, or let's think of a bar. Let's think of a 2-inch wide bar. You learn to cross it pretty much on the floor, maybe 6 inches off the ground, so that you learn the skills, the technique, without any emotional aspects affecting it. And you keep going up and down that bar till you cross it without ever falling off. and then they start raising the bar. Now imagine that bar being raised to 50 feet. You know how to cross that bar. You've got all the skills. You've got the technique. But do you know what? That fear of dying or seriously injuring yourself, even if you have a harness on or a safety net, is going to make the way you cross that bar very, very different. Your emotions are going to play a big part in it. Now, the more and more you practice at a lower level, the more confident you will eventually be in crossing that at a higher level. So I say to people, if these skills need developing, develop them when there's less emotional impact, emotional effect. Keep a journal. That helps as well. Look back at the journal. Don't just write everything down and never look back at it. I encourage a lot of people, most people, not everyone agrees with me or listens to me, keep a journal. It's not just the blotter of all your trades. It's what you thought about the trade. It's your planning. It's how you reacted to the trade when it was in there, how you got out, what your thinking was about that. Keep that. It builds up a record. It's the closest thing you can have to having video performance to watch you if you were a sports star. And then you can look back at it over time and look for patterns of behaviour that are affecting you. So yeah, I would say, you can't always know where it's an emotional impact affecting you, but develop your skills when the bar's 6 inches off the ground. Try and see what the difference is. If there's a big difference when the bar's raised off the ground, it is something emotional happening. That's without question.
Okay, thank you. Just another couple of quick questions. Darsham saying, can you roll back 2 slides from the end? I don't know which. Here we are. Key point 4. I think that's the one we were. Darsham, is that the slide we wanted to see? And Zoltan says, oh, sorry, Darsham, one more back. I can't remember what. This is the slide, yeah. Okay, Zoltan says, I'm aware that I need to control my emotions since it's not possible to kill them. Could you share some techniques for controlling your emotions?
Okay. Controlling your emotions is very hard. Creating a process which limits the effect of your emotions, a framework and a structure, is probably the best way. Reminding yourself of the context. If your emotions are coming in at key moments, then rather like the previous answer, you need to roll back your trading a little bit, maybe size, maybe duration. It could be that you're doing the wrong sort of trading. I mean, one of the subject matters which I could bring into a future talk would be the subject of personality. I've done a lot of work, a lot of analysis of trader personalities. And most traders, when it comes to risk personality, we've identified 8 different major risk personality groups. And each one of them attacks the market differently. And each one of them is affected by the way the market works in different ways. Now, what we find sometimes is we find people using the wrong approach or the wrong system that's not congruent to their personality. And when we try and push them, and that could be because they've learned from someone with a very different personality, or they've adopted a model which isn't right for them. And we find that when we try and get people starting to work in a way congruent to their personality, that then the emotional impact is a lot less. You're never going to not have emotional impact, but you can then contextualize them far more. You can find a way of working. One of the things that sometimes happens is, and again, I'm going to come down to size. Size really matters. People are trading too much size, perhaps they're running it too long. Money management and risk management. That's the other thing here. Most people do not put enough energy and effort into a proper money management approach. You need to get that right. I talk to people who have been trading 20 years, 25 years. They are still not getting money management right. They could be performing at a much higher level, and they're not. It's almost, in fact, in some respects, more so important than trying to identify market direction. and it's not. It's not. It's all linked to the market direction. The risk reward that the trading opportunity offers you, that's linked to money management, risk management. You have to bring that together. You can't just sit there thinking, you know, I'm going to buy. I'm going to buy the S&P today. I think it's going higher. I'm going to put on, you know, 20 lots, whatever. There has to be an awareness between where's the stop, what's the maximum amount of money I'm willing to lose, how much does that affect the size I take. That's all part of risk and money management. That then affects your emotions, because if we go back to the pre-mortem, the idea is to bring in factors that you're not going to be aware of at the time. We think every trade is going to be right. The moment we put a trade on, we think it's going to work. We think, hey, I'm buying it here, I'm going to be taking profit tomorrow, next week, whatever. We just think we're over-optimistic at that point. So we need to bring in buffers that bring a dose of reality into our trading. And actually, there's a lot of guys I've worked with who I've got them to actually downsize their risk, and they actually start making a lot more money. There's a feeling with some people that you need to have a lot of risk on to make a certain amount of money. So it's a conversation for another day. I could bring that in, but it's probably connected to that in some way. I hope that helps.
Fantastic. Thank you, Stephen. Okay, we are just waiting to go over to our next speaker, but I think we've just gone over the 6 o'clock time. Alpha R cubed, Stephen Goldstein. Thank you very much indeed. These are the details. I'll post the website into the chat box as we said, and we will take the presenter role back from you now and say thank you very much for joining us.
Absolute pleasure. Thank you, Simon, for putting such a great event on.
Thank you very much.
Thank you.
Okay, sorry about the delay. Now our next speaker, I'm delighted to say Christian from Hertz is already checked into the room. I'm just trying to locate his login, however, so we can actually make him the presenter. For those of you, some of you just joining us for the evening session of this Round the Clock Trader event, my name's Simon Campbell. Welcome. Thank you for joining us. Everything is being recorded, so if you've just joined us now, you will obviously be able to get a copy of the recordings when we have them processed tomorrow, so you'll be able to catch up on everything that we've had already today. But of course, we do hope you can stay with us live as long as you can this evening. We're going right on with Christian from Hertz at Tribeca Trade Group, starting in just a moment. Then over to Bo Yoder, Roger Curry at RBJ Financial at 7 p.m. and then over to Matt Golden using global confirming markets to increase profitability. So still 3 fantastic speakers to come, all US based from here on in. So it's the afternoon time in the US. Obviously, markets still open there. Christian, I know that you're already in the room. If you can hear me, I need you to make yourself known to me so that I can find out your. There we are. Thank you very much. Now I can bring you across. I was just looking for your full name. That's my mistake. So let's go ahead and make you the panelist first of all. Now I have my thanks to one of our regular listeners, Douglas, who put me in touch with Christian a couple of weeks ago and suggested he would be a great panelist on the webinar. And I'm delighted to say Christian's found the time and he's joining us right now. So let's unmute the mic, which is unmuted, and say good afternoon, Christian.
Hello, how you doing? So
very well. Sorry.
Just need to share my screen here, which I do not see the.
Yes, I'm going to do that now. I'm just making you the presenter now.
There we go. Beautiful.
It was my mistake. I couldn't locate you. I was just looking for, obviously, for your full name there, and that was.
Well, it wouldn't be fun if I didn't make it difficult, right?
That's the fun of live webinars. It's been a great day. Well, it's good of you to join us. This is the first time that you've joined us, but it's great because we do enjoy new faces and new ideas and new topics. We have 12 speakers every month, and we have a lot of people that come onto the shows. So it's great to always hear some new ideas. So Tribeca Trade Group is your own company. I know you mentioned that there's a live trading room as well, which you'll tell us about later on, which is great. What other things do you do?
Sure. So I just want to make sure, I guess, audio is okay. How about the screen? Is you guys can see the screen okay?
Yeah. Could we just do the usual chat box? Everybody at home, if you could just do a little Y in the chat box to let us know that we can see the white slide, Tribeca Trade Group. Great. Yes, and we can all hear.
Cool.
Fantastic. Yes, all systems go. Now I have the questions here. I moderate the questions.
Okay, great.
One of the things about doing the multiple speaker event is that to get the questions you have to be an organizer, and then there's the risk of someone shutting down the webinar once they finish speaking.
Yes, I've seen this happen before. It's an interesting drill. So yeah.
So I'll just jump in every now and again when we have several questions, but let me hand over because we don't know each other very well, so I'm better to let you introduce yourself, if that's okay.
Great. Well, so thank you very much for having me on. I'm delighted to come on, and I think it's a little bit of a different audience. So I'm very happy to come on and talk about what I'm passionate about and what I'm excited about. So I can give you my quick background, and that'll kind of just dovetail right into what I'm going to be talking about today. So. So I'm the CEO and founder of the Tribeca Trade Group. Just started this company back in March, so it's new. And my background is I've been an institutional trader for a number of years. I actually started off my career. I hate to kind of date myself, but prior to right before 2000. And I started right before the tech bubble, or as that was going off. I was a financial at Morgan Stanley Dean Witter. Back then they just called it Dean Witter, so also dating myself a little bit. So I was a financial advisor for them for a while. I went back to school. I went back and got my MBA at Rutgers, and then I moved over to Merrill Lynch's institutional trading. And I wore a couple of different hats there, which trading a lot of different products really kind of gives you a nice base and knowledge, depending on where you want to go into trading. So I started off on the Delta One desk. The Delta One desk, for those of you who are not familiar with the Delta One desk, but a lot of equity swaps, futures, ETFs, a lot of trading baskets, trading sectors, a lot under a swap umbrella. Back when I started trading this particular product, there wasn't a lot of ETFs out there. So hedge funds were making their own ETFs. And so I ran the customized index platform for a number of years. That was a book that was well over $3-4 billion in the height before the financial crisis. And then as the market kind of changed a little bit when the growth in ETFs coincided with the financial crisis, where funds didn't want to have credit exposure, so they started trading ETFs a lot more because they're traded right in the marketplace. And with swaps, you have counterparty risk. So started to see a kind of a move away from, you know, the customized index program and right into ETFs as more and more of them became listed. So I moved over to, we actually carved out ETF trading at Merrill Lynch, and we made it a standalone desk. So I had the previous experience of working with, you know, futures trading and swap trading, basket trading, program trading, and I moved over to ETFs, and I was a senior trader on Bank of America Merrill Lynch's Delta One, ETF trading desk. So I was at the director level there. And what really, you know, got me interested in ETFs is the growth has just been tremendous, right? The growth has just been tremendous in the U.S. It's also been tremendous in Europe as well. Excuse me, I'm going to talk a lot more about U.S.-based listed ETFs. So if you're new to this product, I'm going to be talking, you know, some of which the basics and some pointers that you can use in trading, but I'm also going to be talking about the nitty-gritty, because I have that experience of being able to kind of sit in the seat of a market maker and know how the ETFs function. And I think that's very important when you get into, you know, the growth in ETFs has not just only been in equities in both U.S. and international, but also in you know, fixed income ETFs, which have been a huge growth area over the last couple of years, and commodities and currency ETFs. And this kind of migrates. They become popular in different segments just as the market kind of moves along. So every step of the way as ETFs have grown and the market kind of changes where, you know, what's been very in vogue to trade, you know, ETFs have been right there every step along the way in developing new products and really getting the retail trader or the retail investor involved in products that they could not trade before, only that institutional traders can trade. So I'm going to get into a little bit of that. And you know, my Twitter handle is @CFromhertz. You can follow me on Twitter. I'll talk a little bit later as I go through the presentation about what I post on Twitter on a daily basis. So Simon, I hope that helps. So let me know if you have any questions at this point. If not, we'll jump into the presentation.
Christian, that's fantastic. Thank you. Yeah, just go straight along. We're all fine.
Okay, cool. Okay, so you know, going back to my style of trading, and you know why macro hedge funds will use ETFs, is because you can get into any nook and cranny of the market. So it's really a beautiful product that you can go into these areas. So a couple examples of that, and what a lot of institutions will also trade is, you know, gold has seen just huge, massive inflows this year, and one of the best way to trade gold is through the GLD ETF. Now, there's other ways to trade it, but there's not a lot of difference. You're not losing a lot by trading the product that's in the market over futures. You know, there's very little arb there. But it allows you to get exposure into those places. So as gold becomes popular, as it has been and was very much in the beginning of the year, you know, huge rally in gold this year. Gold was something that saw a tremendous amount of activity and inflows in the beginning of the year. Emerging markets, you know, emerging markets have been an area as well where investors can get into, where they're not picking up, you know, individual securities. If they just want to get involved in that space, they can quickly get in and out of these markets simply by just purchasing the one security, the one ETF. Then you get into little niches of the market as they become popular. You know, the China internet names have just been on fire the last couple months. So, you know, as I mentioned in the beginning, if you're new to ETFs, I always try to bring a couple new products that will kind of open your eyes. You know, names like Baba, Baidu, symbol YY, Wuba, WB. These names have just been on fire. These China internet names. So there is an ETF that covers that. That's a name that we've been trading. That's called KWEB, KWEB. You know, and then there's other areas of the market: AMLP, HYG, LQD. These are high yield bonds. They've been a lot in focus in the headlines because some of these have gotten. It's become so easy to take big positions for hedge funds in these products. It's actually outsizing the market that it actually trades in. So, you know, you hear various different people come on the television and say, you know, these ETFs are getting out of control. They're getting too large. which, I know the mechanics behind the ETF, so, I have rebuttals for them. It only gets as big as the underlying, market. As long as you can create and redeem under severe pressure, you can be able to get out when everybody else is trying to get out. Okay, so one of the main functions, why use ETFs? You talked a little bit about this with a couple of the examples, but the ease. You can get into and out of these segments of the market quickly and easily, rather than, with if the market's going to have, not last Friday, but the Friday before, there was a decent move down. I wouldn't call it a correction, but a pretty, heavy downdrift. Well, you could quickly get out of your positions, rather than getting out of a whole portfolio of names, 20 names. Now, you could do things, of course, to hedge, which with an ETF as well. But rather than get out of 20 names, if you just own EM, you can basically just hit sell EM and get out of your positions very quickly. So it allows that ease and you could be very nimble in this type of trading environment if it turns quickly. Same thing, you could hedge yourselves very quickly by buying SPY protection or IWM, which is small caps. Liquidity. So I'm going to give a couple of examples. When one of the misnomers in ETFs that I always come across when I was an institutional trader and I was training people how to use ETFs, people who were new to ETFs, they would look at an ETF and say, oh, this name doesn't trade that much. The ETF doesn't trade that much. I'm never going to be able to put on a big position. Well, there's something called implied liquidity, and which is a reason why you should use limit orders. So during this presentation, I'm going to go back and forth between Bloomberg, and I'm going to go back and forth between a couple charts. So, we saw this monster order in IWD yesterday, and if you look, the average 30-day volume, it's pretty good. It's 2.5 million. You can trade this very well. You can see the spread's pretty tight. But if an institution really wants to put on let's say they want to put on a trade of 5 million shares, similar to what happened yesterday, which I'm going to get into that, you could see something called implied liquidity. So first of all, what is IWD? It's very, very, it's a basket of very, very liquid names. It's the largest names in the U.S. market, and it's the value ETF. So you could see the biggest holdings: Exxon, Johnson & Johnson, AT&T, JP Morgan, Procter & Gamble, GE, all very big, liquid, large cap names. So in this sense, being that this ETF only trades 2.5 million shares for whatever reason, the liquidity can be found in the underlying basket. You could see that the implied liquidity, what it measures is how much of the underlying basket trades, given, let's say, 25% of the average day volume. So you could see that, which is the gauge of how to gauge the liquidity, what the ETF tracks. And you can see that there's a ton of liquidity there, which makes sense when you look at names like GE, Procter. These are the most liquid names, the biggest cap names in the U.S. So there's huge liquidity. 42.9 million shares can be traded of the underlying basket without really affecting any type of liquidity. So how can you get over that obstacle when you see, okay, this name doesn't trade that much in terms of the ETF volume, but the implied liquidity is very high, which you may or may not know. You can use limit orders. A lot of times you can go mid-market. You don't have to pay above the ask when you see a spread that's very wide, and you can get in and out of an ETF by doing that. So that's a little bit of a tip. Like I said, I like to provide a few tips for people who are new to trading ETFs, how you can kind of be able to execute and not pay the ask price or not pay above the ask, but going mid-market and using limit orders. You never really, most orders you never really want to use market orders. You always want to use limit orders to get a better execution, especially in a liquid name or something that you may think doesn't have a lot of liquidity in it. Another, another tip I always try to give people who have never traded ETFs before, know what the product is. XLF just recently split away. If you look at the components of XLF, they haven't updated this yet, but you could see, a lot of people, in the U.S. or on CNBC, Bloomberg, they'll say, what are the banks doing today? Let me look at XLF. Well, XLF is not completely all banks. It's not the right ETF. Just because it says financials, you have to look to see what the components are to understand why the price is moving as such. And sometimes it's like, oh wow, I would think XLF should be up more or less than it is. That's because it doesn't just contain banks. It contains insurance companies. It contains REITs, a lot of other, and some of these will have a lot of cross currents, especially with the move in interest rates. We just had, the FOMC meeting yesterday. When and if you look at today's performers, banks are underperforming a bit because, no rate increase is not going to be good for the banks in the short term. However, no rate increase, meaning that some of the yield replacements, things like REITs, utilities, are going to do good. And if you look at today's performance, you look at REITs, IYR is the REIT ETF. It's actually it's one of the best performing sectors today. So that's why you could see XLF is not really moving too much today, because it kind of negates the performance when you have banks doing poorly and REITs doing bad. So my point is, you always want to make sure that you don't just go through the label. And the classic example of this is there's two big home building ETFs in the US. One is XHB, and it's actually called the Home Builders ETFs, the Home Builders ETF. And people on Bloomberg and CNBC misquote this all the time. If you look at the holdings, top industry groups, it only has exposure to 30% home builders, and it's got a lot of exposure to a lot of other things: building material companies, retail, home furnishing, textiles. So those home builders only have a 30% weight. Very important, because some people think, hey, I want to just own the home builders, and they're really owning Williams-Sonoma, Mohawk, Lowe's, Masco, Home Depot. The biggest home builder is until the number 6 on the holding screen. Now, this is where it gets confusing, right? So XHB is the home builders ETF. ITB is called the home construction ETF. You would think, okay, that must have Lowe's and Home Depot in it. Actually, no. This is the one you want to play if you want exposure to the home builders. It has 62% and only 16% of those smaller groups. And if you look at the holders, you have D.R. Horton, Lennar. These are the home builders that people want to get exposure to if they're looking to just strictly trade the home builders. All of those names, Toll Brothers, Pulte, NBR, Lennar, D.R. Horton, are the biggest holders in the group. So the reason why, again, I bring this up is, always make sure the title of the ETF doesn't necessarily may be what you are trying to get. So you always want to look, and you can find this on the internet. You could Google XHB, and you can get the top 10 holdings, and that'll at least tell you, hey, I'm owning, I'm getting a piece of the right thing. A lot of people make that mistake with IYR too. They'll say, oh, this is real estate, because it's called the U.S. Real Estate ETF. It's actually just pure REITs. No home builders at all in that. So those are a little bit of the misconceptions with ETFs. Other reasons, so you always want to know what you own. That's the bullet I have here. Diversification, I think we talked about that, touched upon that a little bit. I can't see the questions, but who's had owning a single name, and there's a downgrade that happens that day, or specifically in the drug space, it fails to, Bristol-Myers had a miss in terms of, a major drug that it had, and all of a sudden, especially if you're trading options, something that you purchase for $1 premium is all of a sudden marking at 20 cents, and it's gone. So what you could do in this sense, and I tell traders in our room all the time is, if you want exposure to biotech and you don't want that single drug exposure where one thing could basically ruin your day. If something like that with Bristol-Myers happens, or a small cap biotech who's just dependent on one drug, you could get exposure to that group through XBI or IBB, to the two major biotech ETFs, and you don't have to worry about one particular drug failing or a downgrade, if it's in a different sector. Okay, so that's kind of a top level. Now I'm going to get into the nitty gritty, and I'm going to get into how I use ETFs to trade. So Simon, if there's any questions at this point, kind of the high level presentation, let me know, as I'm going to really start to get into the nitty gritty and why I kind of bring value into trading ETFs. So what I'm going to be talking. Sorry, Simon?
I'm just saying, okay, that's fantastic. Thank you.
Okay, great. Okay, so typically what I'll do is I'll analyze buying and selling by looking at creations and redemptions. So this is a whole, I can go on for like a half an hour about creations and redemptions. I don't want to do that, but just as we were talking about, and I'm going to give you an example, but this is evidence to buying and selling. Sometimes when you look at a print, whether it be in options, whether it be in a big block that hits the tape, sometimes you don't know if it's being bought or if it's being sold. Sometimes the market maker tries to disguise it so that everybody's not chatting about it on Twitter and on CNBC. Wow, this big trade went up. So a lot of times, even when I was a market maker, I would try to disguise a print, especially if the client had a bigger order to do. So you never really know during the day. You can make a conclusion based on how the trade goes up, whether it's a buy or sell. But you could look at this creation and redemption area of the market and say, that was a buy. The outstanding shares in the ETF went up. So I'm going to drill through. I'm going to give you a couple examples about how I spot this. And I always like to give real life examples. There was a big trade that happened yesterday. This was prior to the FOMC, prior to when Janet Yellen and the Federal Reserve came out and said, we're not going to do anything. And once she had finished the speech and the Q&A, the markets rallied. Well, there was a very interesting trade that went up right around a couple hours before that rate decision in that IWD. So I specifically mentioned IWD earlier because we had this humongous order that went up. So I'm pretty sure my trained eye of being an ETF market maker knows that this trade was a buy. Why is it a buy? Because it was marked IS, intermarket sweep. I could go on the chart and I could say they actually printed this above the ask, which the market makers now have to do in the U.S. They have to basically print this. They can't print this out of sequence, so they have to print it right then and there. They can't really hide or take inventory of the trade. So it is transparent with a couple of regulations that are in the U.S. So it was a colossal order, and I know, and my trained eye is pretty 99% sure that this is a buy. Huge $467 million order. So what I could do the following day to prove that this was a buy, if I wanted to, because not every print is going to look this clear on something that's a $467 million order, you're going to see that blip on the screen. Now the market, we talked about the implied liquidity and what this ETF is, and it can absorb it without having any major price. It's not going to move the market because it's an ETF that is built on GE, Procter & Gamble, all the big large caps. So let's see, where did I want to go with this? So I could see, so what I do on a daily basis, and I was talking about Twitter and what I post on Twitter every day, I talk about inflows and outflows because they're the evidence of what happens. So when I would be executing that trade as a market maker, I would source that. If somebody said, hey, I want to buy 4 million shares of IWD, what would I do as a market maker? I would not only hedge myself with the ETF, but I would hedge myself with the underlying basket. So what happens is there's this mechanism called creating and redeeming. So as a market maker, as I'm facilitating, let's say, the hedge fund's order of 4.4 million shares, a $467 million order, what I would be doing is buying that underlying basket that I talked about, because that's where the liquidity is. So at the end of the day, what happens is, I sell the IWD to the client, I go in the market and I buy the underlying basket. As long as I do that in the right ratio, as a market maker, I'm hedged. I've got a short position in IWD and a long position in this underlying basket. So I'm hedged as a market maker. I don't have to worry about anything, but I've got this big drag. I've got a huge position, 4 million shares that I'm short of IWD, and I've got a huge long position of this underlying basket. So what do I do at the end of the day? I call up iShares and I say, hey, I need to collapse this position. I need to create a IWD position. I'm short and along the basket. And what happens is iShares, who's the asset manager, will go ahead and create more shares of the ETF, and that will expand the outstanding shares. So I'll surrender my short position, and they'll deliver me the ETF, and I will surrender my basket to them, and that will flatten out my position. And what you'll see at the end of the day, if I go to the outstanding shares on Bloomberg, you could see this big pop in outstanding shares. They only publish this once a day because the create and redeem market happens just once. You can only do this, and the fund will only adjust the outstanding shares at the end of the day. So there you go. So that is that big creation, or that is that big order taking the outstanding shares up. So I know this is a little bit of a complicated subject, and it does take a lot, but you could see the evidence in my spreadsheet. Look at this. Market value increased today by $523 million. It's pretty close to that big order that we saw. And that's the biggest creation. I have this sorted. This is all the US ETFs out there. And this tells me, you know, for 1,300 ETFs, I have them sorted by the market cap change. You could see, for example, SPY had a redemption. But this was actually the biggest trade of the day. So that was what I call the trade of the day yesterday, was IWD. Somebody purchasing a 440, actually ended up being $500 million, $500 million pre-FOMC. So really somebody pretty smart yesterday doing that ahead of that rate decision. And Simon, you can interrupt me at any time if there's any questions about this mechanism. But basically, what I'm going through with you is kind of the first leg in what I'm looking at in my three-pronged attack. I'm looking at to see what trends are going on in this space. Because a lot of times this buying is going to contribute, obviously, to the performance of particular areas of the market. If there's going to be steady buying, number one, I want to be aware of it, right? I want to know if a big fish is moving in the marketplace and they're saying, hey, I think now is the right time to go into gold. I think now is the right time to go into stocks. I think now is the right time to go into oil. All of these things I can track by tracking inflows and outflows and ETFs. And I put this up on Twitter every day for people. So if you follow me on Twitter, I will put in the biggest names that had creations or redemptions, biggest inflows, biggest asset changes on a day-to-day basis. So I analyze. I'm very keyed into this because this is what I used to do for years at Merrill Lynch. I used to actually perform these creations and redemptions, so I know that it's real buying and selling. And why, again, is this important? Because when I started trading ETFs back in 2007, 2008, they were mainly used for hedging. You know, hedge funds would come in and they would want to quickly hedge their portfolio, so they would go ahead and short some XLF, or they would buy some EM, but sell some SPYs. But over the last several years, what's happened is we've got into a low-cost environment, and registered investment advisors are using ETFs now as a full asset allocation model. And I'm going to give you examples of this. So you can see what they're up to. And a lot of them are really commanding. These are not small fish. Some of these registered investment advisors are commanding billions and billions of dollars and are using ETFs to allocate. As they get inflows into their portfolio, they're using ETFs as their asset allocation model. So I'm going to talk about spotting trends in this market. Sorry, let me just get some water. So a couple examples. I'm going to give you a couple of the examples that we saw so far in the beginning of the year, and then I'm going to talk about what we're seeing more recently. One of the things that we saw is in the beginning of the year, biotech was a huge, trade. One of the best performers, from 2013 to 2015. Well, all of a sudden, everybody started to get out of biotech very quickly. It became an overcrowded trade, and people started to look other places. There has been, a crazy reach for yields in the global market, as interest rates globally are very low. So funds have had to go, people have had to go into other places to get yield, like utilities, like REITs, like minimum volatility ETFs, like high dividend funds, because interest rates globally, you can't find yield. And a lot of the aging population wants to get yield. So they've been forced into equities and going into utilities. So that's been a big trend over the last couple of years. It certainly happened in the beginning of the year with utilities. So what I've done is kind of show you, this is what happened in the beginning of the year, and I was all over this. FBT, and this is an ETF that I'm tracking. So as I go back to this example of originally institutions using ETFs for hedging and registered investment advisors using them for asset allocation, there's a lot of ETFs that are not mainstream ETFs that people have never heard of before, like FBT. FBT, for example, for whatever reason, a big registered advisor liked this particular ETF. This is the ARCA Biotech Index, First Trust. It's not exactly weighted towards like market cap or equally weighted. I think they have their own homemade sauce. So that's why somebody said, hey, I can maybe get a little bit of alpha rather than doing, you know, a market cap weighted ETF or an equally weighted ETF. So nevertheless, somebody really, this was the outstanding shares. The white line is FBT. And you can see how there was a massive rotation out of this FBT ETF and into FXU, which is a utility ETF, all at the same time. They basically said, hey, I want out of high beta and into low beta, and I'm searching for yield now. Right? So that is the green line. This is, again, outstanding shares. This is not price. This is the investment. So all of a sudden, you know, something that had 30 million shares outstanding, the big holder said, I'm out. And they did this very quickly between January and February. And at the same time, they rotated right into utilities. So then the question becomes, why am I tracking these flows? Does this mean utilities are going to go up because somebody's moving a ton of money into utilities? So the second chart that I have for you is the same thing, the outstanding shares. You can see, it's the green line on this chart, it's the white line on this one, the outstanding shares of FXU, which again is a utility ETF. And you can see as they went into this, probably in about a week, right? A week's time, beginning of January or beginning of February, as they migrated into this, you could see what happened. It didn't, the price of FXU, you know, it bumped up right away, but look at what it did in the next coming months. They were right? They had a reason for going into utilities, and they massively outperformed the market. So this is the exact reason why I watch these particular flows. I want to see when big fish are moving around and getting out of biotech. Hey, if everybody's getting out of biotech, I don't want to be in biotech anymore. You know, I want to catch this right away, and I want to go into something where everybody else is going into to ride this performance up. Same thing in GLD this year, right? You know, we saw this and I'm going to get into how another phase of what I analyzed, but we saw this not only in GLD. This is the white line is the investment into gold, and the green line is GLD, you know, the performance of GLD. And you can kind of see it's mirrored it pretty well. As people have been piling in money, the performance has gone up in gold. You could see actually here, gold actually dipped and people were still adding money into it. And you could see, you know, and I was talking about this, I remember back in May and June, because I was long GLD and I got out of it probably around March. And I said, hey, I've made a lot of money. I've been following these. Not only have I been following the investment in gold, but I've also been following the option activity when we saw a lot of big, longer dated GLD call options go up. And I said, okay, boom, I've got great profits. I've rode, you know, gold all the way up here. It's now, you know, resting. It's now consolidating. And you can see gold take this other dip in May. And I said, wait a minute. People are still adding money into gold. So I got long gold again. And we also saw gold options pick up again. And gold made that next leg higher. It took a dip and then it went higher. Okay, so those are a couple examples of what we've seen in the beginning of the year. You know, another one, I don't have a chart for this one before I go on, but emerging markets. I guess I could show you my spreadsheet. I also have a year-to-date spreadsheet. Emerging markets, EM, VWO, emerging market bonds, EMB have really picked up. They've seen up for 11 straight weeks, emerging markets have seen inflows into those ETFs. So I look at the whole group. I don't just look at one ETF, just like I look for FBT and FXU. Many of you, I'm sure, may have never actually heard of those ETFs before. but I'm following every nook and cranny, and I'm kind of, I've got a major spreadsheet here, and I categorize the whole group to see if it's not just EM, but maybe it's VWO or some ETF that maybe is new and somebody likes for a particular reason. So 11 straight weeks of emerging market inflows, and I'm going to get into a little bit more analysis, but I see that I'm about 40 minutes into the presentation, or probably about a half hour because I was about 10 minutes late. So I want to keep going here. So I want to talk about... Yeah.
Just before we carry on, a couple of questions coming in, and they're both relating to the same thing, really. Most retail traders don't have Bloomberg terminals. Where can we get charts and info on ETFs? Are there any particular websites that you'd recommend?
Sure. Well, there's a couple different sites. You can follow this. iShares is the biggest asset manager, so you could go to the iShares. That will give you, as well as State Street. They manage the Spider product. That's your SPY, your XLF, your XLY, your XLE. All of your U.S. sector ETFs. So you could go onto their sites and you could see the holdings. So that's basic information about. Which you always want to see. Like in the beginning of the presentation, I said you want to know what you're owning, so you want to know what the components are. So that's step one. You could follow me on Twitter. I put this information out on a daily basis, and I talk about every week. I'll put out, not only what the daily flows are, but the biggest weekly flows. So my Twitter handle is at C. Fromhertz. There's a couple other places that put out this information. I think. ETF database is another one that puts out inflows and outflows. But I put this out on a day-to-day basis every day, 8 o'clock in the morning, U.S. New York time. As I'm located literally about 3 blocks from Wall Street in New York. I operate obviously on that time frame, but I'll put this information out every day, and on the weekends I put out the weekly flows. And there's a couple other, mutual fund companies like Lipper. They will put out their flows basically, I think, on Thursday night. A lot of the times, I don't mean to criticize them because I'm not trying to do that. They do a great job of putting mutual fund flows together. I have a little bit different spin. I do ETFs, and my personal opinion on mutual funds is they're a little bit of a dying product. Every week they have equity outflows in mutual funds. And you see people on Twitter kind of read into it, and they're like, oh, wow, that's a contrarian indicator. And I'm like, I don't think so. I think regardless of the market's going up or down, money's coming out of mutual funds because it's not the best product out there. And again, this is strictly from my opinion. So ETFs continue to grow year after year. I think you want to be following the money that's been going into ETFs. So I have up the next. So I hope that helps. I'll answer more questions as we get over. But I've got a lot of material here, so I want to keep going. Sector flows. This is eye-opening, right? Sector flows year to date. So I've put together everything, the inflows and outflows, and this is kind of a little bit eye-opening. As I talked about before, that flip into utilities. Look at what else is going on here. Materials. A lot of materials. Keep in mind is a lot of the gold miners, which have seen a big boost, one of the best performing groups year to date. So a lot of this is names like ETFs like GDX, big gold miners ETF, GDXJ, junior gold miners. Also another ETF called XME, that's metals and mining. Some of these have really had great performance this year. But then besides that, you've got REITs, $7.3 billion. And you can see this. It's basically been one ETF that's been doing this. It's not IYR, it's VNQ. Very, very similar, tracks the same, very, very similar index that IYR does. And you can see this is the investment. This is not the price action. Let me just put a smooth line on here so it looks a little bit. Don't need moving averages on here. But you can see the 5-year. This is the investment into VNQ. Since 2007, it's just exploded in investment. And you could see the assets that are following this now. The market cap is $35 billion going into this ETF. You look at the sister fund IYR, which people know because it was the first ETF that was out there, and it only has a market cap of 4.8. So VNQ, which is an ETF that, again, not that many people are that familiar with, has $35 billion versus IYR. Again, REITs. Why are they going into REITs? To get yield. So I'm going to circle back to this in a minute. What has seen outflows? We talked about healthcare. A lot of this was in the first quarter of the year. We talked about biotech having a lot of outflows. So healthcare and biotech, this sector really should be, because they're kind of a little bit different. Financials, a lot of outflows in financials, a lot of flows in consumer discretionary. If you look at a chart of consumer discretionary, it looks pretty ugly. You know, a lot different than a SPY chart. So, you know, a daily chart of SPY, which is not letting me zoom out here. There we go. Versus the consumer discretionary ETF, and you can see it's really underperformed here, especially the last couple months. And it's kind of been flat versus the S&P 500, which has a much, you know, a little bit better trajectory. So other things, you know, so you kind of look at these and kind of say, a little bit more low beta up here, massive inflows this year. Now, technology has been seeing inflows the last month or so. So this number was much worse. This was one of the worst in terms of outflows. This was around $6 billion about a month ago. Again, I look at this every day, every week, every month to spot trends. And money has been actually reversing. There's been money that's been going into technology over the last 2 months. Just to kind of give you a different flavor, year to date, the biggest changes per ETF. As I mentioned, gold, by far and away, biggest inflow, any US ETF out there. GLD, $13 billion. Again, most of this in the first 6 months of the year. If you go to that chart of GLD, the outstanding shares, it's still moving up. Right? Well, it's actually been tapering off. So like I said, first 6 months of the year, January to June, massive inflows. Last 3 months, not so much. Aggregate bonds, another SPX fund, you know, everybody knows SPY, VOO, Vanguard Fund, has actually seen $8.5 billion of inflows. VEA, which is the popular EFA index, also a lot of inflows. Outflows, number one on the list, HEDJ. That is Europe. This was a very popular product a couple of years ago when Mario Draghi started the quantitative easing program, and the euro started to go down and European equity started to go up. Wisdom Tree came up with a very unique product called HEDJ, which back in 2013, 2014, 2015 saw, you know, a very big amount of inflows. So there you go. This is the so a little bit later than I said, 2014, 2015. This was the investment as the quantitative easing really picked up, and since then, as the euro has been getting stronger, or at least moving sideways, there's been less of a need for this ETF because the yen. I keep saying the yen. The euro has not been depreciating any longer like it was, and that was also the feeling. A lot of investors thought that was going to happen. So you could see, you know, the biggest outflows, and this is something that I'm waiting for it to reverse. I'm waiting for this trend to stop, but you could see a lot of it is European equities and Japanese equities. Just a ton of outflows this year. Now, this is not, as I talked about, gold was mainly the first 6 months of the year. These outflows have been continuing. Japan has slowed down, but you know, I'm waiting for these flows, these outflows to stop, and they've been pretty consistent. It's basically been just about every week or every other week, there's large outflows in these types of funds. So again, I'm waiting, being that I think that these are getting to the point where they can only unwind so much further. I think eventually Europe gets a bounce once the money stops leaving these types of funds. Okay, so you know, I covered a lot of the ETF fund flows. it's very, very difficult for me to kind of gloss over this because it's a complicated subject. But that was just one portion of my three-pronged attack to trading ETF options. I very much will look at what the cash market is doing. I'm looking for the big fish. I'm looking also, a lot of these guys who are doing these asset allocation trades, they're not doing this for a one-week trade for the most of the time. They're staying in gold, they're staying in utilities, as I showed, for a while. So I'm looking to capture, in trading, you always want to look at the bigger trend. Then I'm going into and I'm looking to make sure my technicals agree. A couple examples that I have. We'll look at first an EM chart, which Apple is obviously not not an ETF, but I wanted to show you an example of how I use what's called the value area study, which again, it could be a whole nother webinar for me to give. But basically what the value area study is, if you look at a weekly chart, and you can see this volume profile. It's a little bit different than most people look at volume as a function of time on the bottom of their screen, but they neglect where buyers and sellers have met up. They've met up at certain prices before. And I know this as an institutional trader because sometimes, I have EM up, but a buyer will return. They have an axe at a particular price. They may say, hey, at $38, I want to buy 2 million shares if it gets back to 38. And sometimes the price drips up to $40. And then when it gets back, they're like, hey, if it ever gets back to $38, I want to buy more of it, right? That's where they think it's properly valued. So you'll see from time to time that there's support and resistance levels where buyers and sellers have a memory. So it's very important, and again, this is a whole other webinar, but I very much will use support and resistance levels using previously where buyers and sellers have met. So what we've done in this indicator, this is an indicator that we offer at Tribeca Trade Group, which is the company that I run, and I'm the founder of. And we sell this indicator, and it basically gives you an area that says, this is the level of the previous time frame. So this is on the weekly chart. This level between green and red is of this time frame where buyers and sellers have met. So if we've noticed, emerging markets have been a big underperformer for the last couple of years, but they're starting to waken up. So as I saw inflows going into ETFs, I started to look at the technicals and say, hey, this was last year's value area. This is where all the buying and selling occurred. You could use this technically to trade and say, once we're firmly in this value area, we've reestablished last year's trading zone where we were trading under it. This is bullish, right? So as soon as we were firmly in this value area, I went long emerging markets because it made sense. It made sense from, I see it being bought in the cash market. Technically, I could see that it's reclaiming an area that it struggled with before, which is very bullish. And number three, we started to see a lot of emerging market options go up. We started to see not even like the weekly options. We started to see longer dated monthly options being bought in names like EM, FXI, and so on and so forth in the emerging market space. So a couple other examples of this. What else do I have? Biotech, which is something that I've been onto as well. We've seen a lot of bullish option playing in biotech. Biotech is a very controversial area right now in the U.S. with the election happening. We've got two candidates that are trying to butt heads, and it's only going to get more interesting in the next couple months. So, if you're European, it's I think it's going to be great to kind of watch from the sidelines, to kind of get your popcorn ready and watch the spectacle that's going to happen in the next couple of months. But biotech is not to get political, biotech is going to be in the headlines. There's been various different political candidates who have voiced opinions about healthcare pricing. However, we've talked about this big upward trend in biotech, but it's starting to come alive. And, just as I said earlier, a lot of money has gotten just give me 1 second here. There we go. Sorry, I've got my my trading room going, and I could hear the talking in the other room. So just as we talked about before, the massive outflows, I wanted to go back to this. You can see healthcare, biggest outflows, right? So most of this, I've been watching this again. Most of this was in the beginning of the year, and it got out of it got all the weak hands. Some of those people who have just been in there for a short-term trade, have been in there, and they are now have exited. So now I think it's starting to look constructive. You could see XBI has made a real nice move this week. It's outperformed this week, and I think if it comes back in and kind of retests this green line, I really want to be long biotech. Okay, so that's basically two. There's a whole bunch of other things that I can go into. I could go into Apple. Have we been successful trading Apple, which is, I not only just trade ETFs, I also trade single stocks as well as an option trader. If you look at this in terms of, another thing on our indicator, which is really eye-opening, which is why I want to bring it to people's attention, is there's something called VPOX, version point of controls. A lot of people have never heard of this in technicals. But take a look at this chart in Apple. I don't draw these lines. These are drawn automatically in our indicator for us. And you could see back in August, right? Apple's kind of been in a downtrend. And every time it gets to one of these yellow lines, which is where buyers and sellers have previously met up before, and where price has never come back and touched before. That's why it's called a version point of control, because it's a point of control that's never been touched. You can see price sometimes wants to gravitate to these levels. As soon as it takes it out, it kind of fades it. And it's done this now 3 times in Apple. It's did this again in February. It got up to 112-ish. And it reached that and it faded. And it did this again. Now this is a little bit different, I think, this time, because we've taken out that level in Apple. We've hit this VPOC, we've rested a bit, consolidated, and now if you go to the weekly chart, it's also poking its head into the value area. So I think, I've been saying you can go long Apple as long as we stay above this, or as long as we're in this value area, it's a good thing. So I think you could be long Apple against the 113 handle. Okay, so that's the 2 legs of, I talked a little bit about the third leg, which is aggressive option activity. Some people call it unusual option activity. I call it aggressive option activity. I'm looking for really aggressive players in the market. And a lot of these things, and again, this confirms my thesis. And a lot of these examples of ETFs where we've seen inflows or outflows, seeing the call activity, when I see that, I'm like, it reinforces my view. We saw a lot of call buying in GLD. We've seen a lot of call buying in EM. The last couple of weeks on the, where GDX and the gold miners have been a bit weak, we've actually seen a lot of inflows going back into the gold miners. And we've seen a lot of call activity. Same thing in XLK. Right around when Apple was unveiling their iPhone, XLK is the technology ETF. Apple is actually the biggest weight in this ETF. But it's got a lot of other names, technology names. XBI and LABU, we've actually seen call buying in these 2 areas as well recently. And then single stock flow. I'll also look to see if people are buying individual names in these groups. That also tells me, hey, people want to buy. People are migrating in from areas that they shunned in the beginning of the year, like technology, consumer discretionary. Consumer discretionary, we're not really seeing any of that upside call activity. We are in technology. Financials is kind of mixed. I think there's speculation going on in some names where people are going out longer, buying some names like KBE and KRE long term, because they think the U.S. Fed is eventually going to raise rates. When that actually comes is another question. But so what I'm looking for is basically to see when people are going to start rotating into higher beta and out of some of these defensive names. Okay, so last thing, I know I'm running out of time here. I've got one more slide to go, so trying to just putting together those 3-prong attacked, what am I looking at now? I'm looking at you know, a couple different things here. Metals and mining, I could look at that chart as well. You know, this was a name that I've been long the metals and mining name up until the technicals tell me I don't want to be in it anymore. So this was the move in the beginning of the year. Another group, metals and mining ETF, is basically silver and mining names. Excuse me, not silver, steel. So names like MT, X, AKS, NUE, and then a lot of the mining names like NEM, ABX are in this ETF. But you could see we went all the way through this value area, and this was a great place to take profits. Or if you're a seller of premium, a great place to sell call spreads, to sell premium up here, because this was major resistance for the ETF. And notice we backed away from it. However, you know, on my charts I've got exponential moving averages. We're doing a little bit of a bounce here, and we're holding at this 20-period exponential moving average. So I like this. If it can hold here, you can look at this on a shorter time frame. You can look at this on the daily chart, and the value area here. I want to see this get back into value. So I want to see this get back above this green line on the smaller time frame. This also coincides with, if you look at the moving averages, the 50-day, the 100-day, the 200, you could see we're kind of caught in the middle right now between the 100 and the 200. So I'd rather wait. You know, in trading, you know, patience is one of the best qualities that you could have. You have to be very patient and not try to what's the right word I'm looking for? Not try to anticipate things. You know, you want to anticipate, but you don't want to necessarily buy until you get until you see confirmation. So I want to see this get above the 50-day moving average and hold, as well as my value area study get into there as well. So that's what I'm looking at. A couple other things. I want to be in the strength. I see a lot of strength right now. You know, for the last couple months, this is not new in semis. Semis have had a beautiful run already. We've seen just a ton of call buying in individual semi names. We see a little bit of hedging going on right now through ETFs right now. So, you know, this is one of those things where you have to be disciplined and patient. You know, you want to buy on the dip. SMH, you know, is your biggest semi names, like Intel is in here, Qualcomm is in here. But going back to our, you know, 50-day moving average, whoops, it's a little bit extended. So I want to wait till this comes back. This was a great buy. This was a trade that we did in our room, in the Tribeca Trade Group room, where, you know, I said if something's going to go, there's been great strength in the semis over the last couple months, and I actually, you know, went out and put a swing trade on in SMH. That was part of our swing trade program. In our room, and I went long SMH on the dip. And I said, you know, if we're going to rebound here, these semis just have had great strength. I said, if it gets below the 50-day moving average, I'm out. But I think we're going to hold here, and you know, we certainly held. So I'm actually out of that trade now. I got out pretty quickly. We saw some put buying in SMH. I said, you know what, I've got a nice gain here. I don't need to be a hero and hit a home run. Now, if it returns, if there's more weakness, we get back to that 50-day moving average, I'm back in. So that's on my radar. I think I talked about the Chinese internet names. They're a little bit overbought. Buying on dips in that name as well. If you look at that in terms of the chart, a little bit extended. They've been on a great run. So once this kind of dips a little bit, I don't know if it's going to get down to the 50-day moving average, but you know, maybe any dip, I think I would get back involved in Baba, Baidu, JD, you know, and you're starting to see a lot of the analysts come and kind of upgrade these names as well. And YY has been a name that has seen all kinds of call activity going on in it. Baba has seen, Baidu just got an upgrade, I believe, from Goldman yesterday. That name was shot through the roof, and you didn't have much time to do it yesterday. You had about 10 minutes from the open, and that thing was off to the races yesterday.
Christian, we'll need to start to wrap up there. I know you wanted to just mention your trading room.
Yep.
Could we do that? Just because time's ticking on, I'm afraid. Thanks.
Yeah, sure. And just the last bullet point here was, where I'm bullish, if we start to get interest rates, if global rates start to rise, I want to short some of those things that have seen these massive inflows. I view these as very overcrowded. However, I don't think they're necessarily going to go down unless we start to see interest rates rise. And once people feel comfortable with, hey, yields are going up, they don't need to necessarily be in the REITs and the utilities and minimum volatility ETFs. Yeah, so here's my little offer. Thank you again, Simon. I really appreciate being a part of the panel. Sorry to go over a little bit. The current offer that we're having right now, you can go onto my website. It's tribecatradegroup.com. If you're a full-time trader, I would recommend the trading room. You can watch us trade all day long. We take real positions. You can see all of our positions real time as I'm getting into positions. You can get text alerts as soon as I get into a trade, get out of a trade. We have full transparency. You could see all the moderators' positions. You could also talk to the other people in the room. We want to collaborate with people in our trading room. That's the whole idea. We're trying to make money together. And work off of each other. So if one of the traders in my room says, hey, look at this move going on in a couple of the mining names today, we want to all build off of that and all make money together. So that's the idea. What you get included as being a member of our full-time trading room, we do a comprehensive weekend newsletter, kind of sets you up for the next week, trade ideas. We do the text alerts. And we do a huge pre-market analysis between 8:45 in the morning till 9:30. All the upgrades and downgrades of every broker, stocks that you should watch, ETFs you should watch. As I mentioned, this was really about ETFs, but we trade everything. So the offer that I have is for the first month. You could use this coupon code on our website. Punch this in, TTGLD, and you get half off the first month. First month, $99. So again, thank you, Simon. Let me know if there's any questions. Happy to go over anything at all.
My pleasure, Christian. We're just excellent webinar. Chris says thanks, Bart. Excellent webinar, Excel. So there we are. People have enjoyed that. It might not be questions, but I think it's been a lot of information. Quite a lot of strange ETF names that a lot of the listeners in the UK won't be familiar with, but very, very interesting nonetheless. And thank you for shedding light on it. And I'm sure you sparked interest into some of that. So I will take the reins back from you now, if that's okay, and we're going to go right along because we've got another couple of speakers waiting to get started. So Chris.
Thank you, Simon. I appreciate it.
Tribeca Trade Group. Thank you very much again, and hopefully you can join us again at some point. So there we are. Thank you very much indeed. And my apologies to Bo Yoder, RBA, BJ Financial Group, and Roger Curry from RBJ, who are waiting patiently to go. We have just run on every hour. We've just added another couple of minutes. So unfortunately, we're just going to go straight across and bring them in as soon as we can. Unmute the mic and say hello, Bo. Hello, Roger.
Hey there, Simon. How are you?
I'm very well, thank you. We've got, I think we're all on, and as I say, my apologies that we just ran over a little bit later there, but we'll make that time up to you. So let me get the screen share. I believe I'm sharing with Roger, so I'll do that right now.
Just, and you can hear me okay? My audio's coming up loud and clear. Great, thank you. Well, while they go ahead and do that, I'll go ahead and just kind of introduce us here. So there are our pictures. I'm the one on the right. Roger's over there on the left. Welcome, everybody. As Simon said, my name is Bo Yoder, and Roger and I are partners at the RBJ Financial Group. I act as the head trader as well as the manager of our proprietary trading operations, so I'm very hands-on and trade pretty much every day that I have time to watch the markets. So certainly active each and every week. We're both very excited to be here, and again, thank you to Simon for the invitation, and thanks to you for taking some time out of your busy day to join us. I know you've heard a lot of different presentations, a lot of different opinions and looks at the market. What our goal today is to really not address what other people are thinking or traditional mindsets, but instead we want to interact with you directly to help you make a shift in perspective when it comes to your approach in the markets. So we're going to challenge you. If you're willing to open up your mind, our hope is that you'll have some very profound aha moments today that can very radically change both your relationship to and hopefully your experience with trading in the markets. Because many people will view the markets as a battleground where stress, aggression, and big equity swings are the norm, and we couldn't disagree more. We've engineered a lot of that out of our trading operations. And we believe that you can have a very positive, stress-free, and profitable market experience. And really the foundation of that kind of low-stress experience with the markets comes from superior information. And that's information about the odds for any given trade, success or failure, before you actually take entry and get stuck. And that's really where our analysis tools offer a unique value. And it's really important to note before we get started here that what we're going to be talking about, we call it the 3D Apex probability analysis layer, and it's just that. It's an analysis layer that sits on top of any setups or strategies that you may have developed or invested in. So many times when someone comes in with a new innovation, they want you to check out everything that you've had in the past and reinvent yourself to this new strategy or this new style. The probability analysis layer says, well, any profitable trading style will have a particular odds for success or failure. If you can understand what those odds are, you can now make a very informed decision about whether the odds are stacked in your favor, and then that allows you to be very, very controlled over choosing what level of odds are acceptable to you before any risk is taken. And it really enhances your trading, no matter whether you what markets you trade, whether you're trading U.S. markets, whether you're trading European markets, whether you're trading futures or stocks, equities, options, it doesn't matter. What time frame you like to trade in, it's all about the odds. It's about probabilities and an identifiable tool set that allows you to know when the best opportunities are. And that clear and objective knowledge of what the odds are really eliminates that sense of gamble from trading, and then that, of course, radically reduces stress. So with that, I'd like to introduce my partner at RBJ, Roger Corey. Now, as you probably know, I write a column for Simon. You've probably seen my market forecasts. We've correctly predicted the S&P recently, gold, and what was it, ExxonMobil. So you've seen the proof is in the pudding. I've got a pretty significant track record there. The engine that drives all of those forecasts is what we're about to tell you about. And in the past, I've done these presentations, but I'm lucky to have Roger free this time, and he's really the best voice since he's the creator and developer of the tool set that we use. So Roger invested over 8,000 hours developing and optimizing these tools, and we have, within our business, over 16,000 individual trade reviews with our clients and our in-house traders. So we really have enough data in our data set to prove that our edge in the markets is very robust. And also, we've had a very chaotic last 5 years, and so we're very confident, having seen our methodology be very stable during that time, that the odds that we are able to analyze won't waver or fade due to various changes in market conditions or seasonality. So, so that's pretty much it. We're very proud of what we do and very happy to answer any tough questions you might likely have. With that, I think I'll hand the mic over to Roger and let him kind of introduce the concept of the probability analysis layer.
Hey, Bo, thank you very much. Simon, thank you for giving us this opportunity, reaching out and asking us to be part of your event. Hi, everybody. Roger Corey. Yeah, you know, consistency and longevity are key. You know, if you don't have consistency and you can't have longevity in whatever it is you're doing, then you know, what's the point of starting when you know you're going to start over again? That's the worst thing you could do, right? So real quick before I get into it, I just need to flash that up as our attorneys tell us. We need to kind of make that disclaimer. And then, of course, also I want you to know this is copyrighted material. The concepts and perspectives in this presentation are proprietary and considered confidential information and shall not be used, disclosed, or reproduced in whole or in part for any purpose other than to evaluate this presentation for your own personal, non-commercial use without the prior written consent of the author, okay, which would be me. Okay, so let's get started, everybody. Seeking Profits on Demand is the name of our presentation. We're going to cover the 5 steps to trading the financial markets for income and building wealth, but without gambling on outcomes. And that's something that is unique. Before I get started, I want to just mention a quote by Mark Twain, and that is, "It ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so." Many of us have just, through our own experience, have come to believe certain things and have come to expect certain things and have made assumptions and have derived meaning to what the market is supposed to be and how it's supposed to work. And I'm going to challenge you today with a little bit of a counterintuitive perspective that's going to help you see how maybe by going about things a bit differently than what you've been taught to believe and have maybe felt like you've experienced, maybe that experience is really derived because of the approach. So if you come at the market with a different approach, you're likely going to get a very different result, and that's what we're going to aim for today. So real quickly, let me just cover who this is for, just to make sure that you're in the right place, and this is going to be for you. This is for anyone who is interested in accomplishing their financial and lifestyle goals by tapping into and leveraging the regular cash flow and wealth generating potential of the markets, but without the large levels of risk, the stress, or being glued to your monitor, and the lack of control that you feel, and that fear of loss and failure. Right? Having to endure the high-frequency trading algorithms that manipulate the market, the choppy volatility that tends to lead to the inconsistency and the uncertainty of profits. Okay? So if you recognize the need for a simple, reliable, principle-based approach, which remains stable despite changing market conditions, so you can avoid constantly seeking for more information and stuck needing the next new thing, and if you want a one-and-done process that does not require the time-sucking task of constantly watching the charts or gambling on outcomes while avoiding large drawdowns and losses, then this is for you. Now, in the next 45 to 60 minutes, guys, we're going to cover how to use a framework with just about a 10 to 15 hour a week commitment to the markets, whether you're experienced or especially if you're a beginner, and turn that into a meaningful monthly income, starting with just a small amount of money, even if that seems a little far-fetched right now. We're going to go over how to eliminate random results and how to seek profits on demand. Now, I'm talking about the kind of profits that you can capture regularly during any given week without the common stresses or negativity, all while having fun and feeling great doing it. I'm going to cover how this unique insight and the approach I'm going to cover with you, it allows you to trade short-term profit cycles that occur daily more conservatively than you would think that you could do with buying and holding long-term. You can see how to leverage this specialized knowledge to replace your income needs through a part-time effort so that it doesn't take over your life. I'm going to show you how to do all of this without taking big risks, feeling uncertain, guessing and hoping for profits, feeling stressed, getting stuck, or any of the common trader traps that you really don't want to experience. So I'm going to show you today a step-by-step strategy for generating meaningful trading income while avoiding all of the common negative experiences and stress. Okay? And actually, that's a little bit of a mistype. I need to address that. It's not really so much a strategy, but it's an actual methodology. It's a method. Okay? But I want to just lay down a foundation for us here as we continue. This is definitely not get rich quick. There's no such thing as get rich quick that's going to be anything that's meaningful or amount to anything for you. So let's get that right out of the way. There's definitely no lazy man's way to wealth. This will take a sincere, genuine, and deliberate effort. It takes hard work, and neither my results nor my clients' results are typical. The people you're going to hear about are extraordinary people, and what makes them extraordinary is that they work hard, they're diligent, and that's a key word, diligent, they're committed, they're teachable, and the most important part is they follow instructions and they earned the results I'm going to share with you. So your success or lack thereof is completely up to you. Okay? Now, don't worry, there's nothing for sale today, all right? But I do have a very cool gift. And, you know, we all know how asking the right questions in life can lead to the kind of answer that ends up becoming the single biggest factor to accomplishing whatever goal or objective you want to achieve and overcoming any challenge that may be holding you back. Now, after more than 4,000 hours of consulting, coaching, and mentoring clients on how to successfully trade the markets without gambling on outcomes, I found that there are 3 key questions that consistently come up and which you must answer in order to instantly turn your experience in the market at any moment from confusion to total clarity, from fear to confidence, from inconsistent to dependable consistency. Now, these 3 questions are included on one of the coveted 16 pages of my rules of engagement that I provide my private clients. And I don't sell this anywhere at any price because it's literally a game changer with the priceless information and the perspective that it imparts to those who use it. And it's truly amazing because I'm continually blown away by the feedback I keep getting from my clients who tell me how much it's positively impacted their experience and success in the markets. The level of clarity and the confidence the answers to these 3 critical questions provides them when assessing any trade opportunity. It's the foundation that turned their experience from making random, luck-based profits that they often gave back to the market anyway, to turning instead and making deliberate profits that they could be confident about before they even committed to a position in the market. So if you'll stick with me till the end, I'll give you the private link to get a copy of not only those 3 critical questions, but I'll also give you 12 out of my 16 proprietary pages that I've only provided my private clients with, which also includes my proprietary process and the structure that my clients use as their daily trading ritual and their live trading checklist. Okay? So you'll get this as a complimentary gift and a token of my appreciation for the time you're investing with me today. Hey guys, have you realized yet that all trading strategies, past, present, and future, are inherently flawed? See, this is what keeps you constantly searching for more information and for the next new thing, hoping to get ahead with some edge or some advantage that will last long enough to profit enough before being stuck going back to the drawing board to keep up with the market. So let's cover some common trading experiences. Do you have some months where trading profits just pour effortlessly into your account and then just as easily vanish like a puff of smoke as you experience yet another sustained drawdown and ultimately give your money back to the market? Are you often stuck, struggling to gauge market direction, finding yourself stuck with sudden changes in market conditions, right? Trying to figure out where's the market going? How long is it going to last? When will it change? Do you find yourself getting into the right trade but at the wrong time and then miss the profitable trades due to your uncertainty and fear that it might lead to another failure and loss, only to watch it run favorably in your direction without you? Do you secretly know deep down inside where only truth remains that your profitable trades could just be due to luck, but you wish you knew a way to eliminate the gamble so you could duplicate and repeat those profitable trades on a consistent basis? Do you see how other people in the market making the kind of money and income that you want to have, and you feel like if you just knew what they knew, maybe having the right strategy, a robust trading plan, with the right software or tool, then maybe that reliable income stream and wealth building potential would be yours too? Are you working and stressing way too hard in your trading? Too many hours glued to your screen with inconsistent results, letdowns from tools and strategies that don't work as you'd hoped, as frustration and stress burn you out? Do you feel challenged due to the limited time, maybe your market psychology, staying disciplined with your plan, your execution, your trade management, being patient, or having confidence in your method? Do you feel like technology or the big institutions are an unconquerable enemy with some insider or hidden knowledge that's a threat to your trading instead of an asset? Here's the big one. Do you feel stuck? Do you feel like the odds are stacked against you and that there's a limitation on your ability to succeed the way you desire? Guys, I'm going to tell you something. None of those are the real problem. The real problem is that you haven't made what I call the 5 odds-making shifts that are necessary to make the markets work for you. Now I'm going to go real quickly because I've got a lot to share with you, okay? But so stay with me here. If you want to take some notes, you can, but I'd advise you just hold on to your seat, because once you make them, you're going to have complete control over what you trade, how you trade, and the profits you can generate. You can seek profits on demand by using a specialized skill set coupled with superior knowledge and data that establishes you as the predator in the financial markets, and it'll flip the odds firmly in your favor. You'll realize that the limitation on your success as a trader was never even there to begin with. and you'll be free to push through to 5, even 6 figures per month if you want to, faster than you ever thought possible. And you'll do all of this while tapping back into the joy that you had when you first got excited about trading the markets. Now here's what you need to know. With the 5 simple shifts, you'll gain a new perspective on the markets so you can confidently start your path to creating better results from your trades while working and stressing less. And I'm going to walk you through exactly how to make those shifts today. And before I do, real quickly, I want you to know who I am and why do clients call me the market doctor, and frankly, why should you listen to me today? Well, first of all, I've been the behind-the-scenes specialist that investors, professional traders, and industry educators are quietly going to for mentoring and for solving any inconsistency and poor performance issues. I earn the highest fees paid to any expert in the industry for my ability to eliminate gambling on outcomes, removing randomness from a trader's experience through my proprietary market analysis and forecasting model. Over 90% of my private clients have been referral only. Think about that. Very few people can claim that. And clients using my method intraday routinely average double-digit monthly returns, risking only 2 to 3% of their entire trading capital, with at least an 80% or better average win rate with a 1-to-1 risk-to-reward ratio. By the way, all that data is based on over 16,000 trades that have been executed by a wide spectrum and very diverse group of clients using my method that I've personally reviewed over the years. So now let's go over the 5 shifts, all right? There are 5 key shifts you must make if you want to be confident about taking your trading to 5 figures per month and then even 6 figures per month while enjoying more freedom in your life. So let's walk through each of the 5 odds-making shifts now. The first one is you've got to stop looking for opportunities that are likely to make you money. That sounds a little bit odd, doesn't it? Because why would you be in the market if you aren't looking for opportunities to make you money? Well, guys, the bottom line is if you stop looking for opportunities that are likely to make you money and instead focus on identifying opportunities that are not likely to lose you money, everything will look different from that perspective. See, managing risk, not money, is at the heart of everything we do here at RBJ Financial Group, and it's how we achieve the level of success and consistency we're known for. Not making this shift is a fatal flaw because everything else is built on this foundational shift. The second shift I want you to make is only trade the odds. There are only 2 reasons why traders aren't confidently in control and don't have a positive experience generating meaningful returns with consistency. When you're trading, either you don't know when the market is shifting the direction or when the odds are not reflecting a favorable low-risk environment, or you've learned to identify when it's not favorable somehow, but you just don't have an unemotional approach, a proven process, and objective rules of engagement to guide your decisions. So let's address the first problem. You're never simply trading moves. You're never just trading opportunity for money. You're always trading the odds, whether you're aware of it or not. Hope is not a strategy, guys. Probability analysis is. The odds, whether in your favor or stacked against you, are always being expressed. And your job is to measure and value so that you know when the odds are stacked for or against you before you commit. And believe it or not, knowing the odds before you commit is the only way to reliably achieve your goals consistently. People who trade the odds outperform not only the market but also their peers with more dependability than people who don't. And of course, it's much easier to hit your income goals when you're trading with over an 80% of the odds stacked in your favor rather than the odds randomly falling in your favor. Your success can be luck-based, which is based on some condition in the market that happens to be favorable that you can't control, right? Some random occurrence, or your success can be very deliberate and consistent. You get to choose the kind of experience you want to have. Now, here's Dr. Dave as an example. He's been an active trader for many years, and like most market participants, the randomness and inconsistency of his experience was very frustrating to him. When he put probability analysis to the test, he found that he could know objectively when the odds of a trade opportunity were actually stacked in his favor before committing to a trade and potentially getting stuck. His results were life-altering because applying probability analysis to his trading strategies took the stress, the guess, the negativity, and the gamble right out of the market for him. His experience with the markets became extremely consistent, where in the past he'd make money and give a lot of it back. After applying probability analysis, he found he could achieve a win rate average of approximately 90%, never risking more than 2% on any position, with a minimum of a 1-to-1 risk-to-reward ratio or better. Imagine the confidence and freedom he feels with that kind of control. Guys, would that kind of control make you feel a lot better trading the markets? See, this isn't just for professionals. Recognizing the fallacy in common trading knowledge and identifying the serious gap in proper trading education, I decided to share this information with non-professional clients to prove that anyone can succeed in the markets. Cindy is a great example of that. She's a proud grandmother and a complete newbie to trading. As a beginner, she learned from the start that trading the odds was the only way she could reliably make money in the market. Knowing what the probability of success or failure was before committing to a trade with just 15 hours per week trading enabled her to be profitable from her very first month trading her money, while avoiding the common stresses, fears, and the emotional roller coaster effect that almost all beginners go through. Her experience with probability analysis is producing a consistent win rate of approximately 80 to 90%, never risking more than 2 to 3% on any position with a minimum of a 1-to-1 risk-to-reward ratio or better. Applying probability analysis to her trading strategies is giving her literally a new lease on life and a lot more to confidently look forward to for her retirement. Guys, what would an 80% win rate mean to you? Would you want to operate with that kind of a confident outcome? The third shift I want you to make is to use an all-encompassing superior level of data. Today's markets require data analysis that encompasses all of the major factors that move the markets. There are 8 main factors that must be considered, and there's no way around that. Otherwise, you're operating in the dark and you're just stuck hoping on random outcomes. I bet you've never done that, right? Most traders never even had a clue as to the relevance that this had on their trading experience. Are you beginning to realize why you'll always struggle without understanding the information I'm providing you today? Now, the one thing is it's not enough to just know what those 8 factors are. You need to compile that data to produce 3 very necessary outputs. And those are market condition, market direction, and the duration of the market condition before it's likely to reverse its posture. And you don't need to do, you do need to do that probability analysis on that data, right, to know the odds of success or failure of a trade before you're committed and stuck. So, because that's the only way that enables you to produce an odds-based approach to trading that will finally make everything work for you. So that's critical when you use the data to get those 3 critical factors. You have to put that through a probability analysis to give you the odds of what is going to be likely happening versus what you think or hope is going to happen. And it's literally the missing key and the point where everyone fails. Once you get this down, you'll have the consistency, stability, and the confidence you need to accomplish your financial goals without the negative stress, the random results, and the risks you're currently stuck with. If you fail to do this, you'll always struggle with inconsistent results, constantly searching for more information while still trying to figure things out, gambling on outcomes. So let's quickly go over the 8 major factors that you must consider for any trade opportunity. They are the fundamentals, geopolitical, central bank, and macroeconomic effects, volatility, market sentiment, liquidity levels, prime liquidity pools. Now, these are essentially hidden to the untrained eye, which is where the high-frequency trading algorithms and the market makers love to target. Right? Ever got whipsawed out of the market and then watch it go in your direction? There's the reason why. Understanding where the prime liquidity pools will help you avoid that. The imbalances in supply and demand, and of course technical analysis and its effects on the market as it provides a self-fulfilling prophecy. So these 8 factors are critical. And probability analysis is the most powerful way to make money because it avoids most of the common negative experiences of inconsistent results, paralyzing uncertainty, taking big risks, stuck enduring huge drawdowns, consistently guessing and hoping that you're right, and gambling on outcomes, which is basically you're just being out of control. Instead, when you behave as a casino would, controlling the parameters and the conditions that you choose to work within, deliberately stacking the odds in your favor, and when you only trade the odds using probability analysis, it enables you to build a full-time lifestyle income with a part-time effort. Are you realizing that now you have the power and the choice to continue behaving as a gambler, where you're constantly hoping on outcomes, randomly making money, dependent on circumstances that are seemingly beyond your control, or begin behaving as a casino would, where you're controlling your circumstances and setting up the parameters that create an environment where you're only engaging conditions on your terms. Because that's the only way to deliberately stack the odds in your favor for a consistent experience. Guys, here's the old way of people trying to make money in the market. It takes a long, laborious learning curve. Then it takes a strategy with an edge that lasts long enough, because remember, all strategies are flawed due to the ever-changing conditions. In fact, let me explain that for a moment. If you have a strategy, let's say, let's use bring it home to your own personal life. Let's say you have a strategy where you want to wear shorts and a t-shirt and flip-flops, right, sandals. Well, that depends on a condition of warm weather. So if you don't have warm weather, being out in the freezing cold is not going to help you to wear shorts and a t-shirt, right? You're going to have to bundle up and wear a jacket and warm up. So every strategy in the market really is dependent on conditions that are favorable in the market to allow it to follow through and work out. And since the market's always changing, it's the reason why strategies never last long enough. You're constantly going back to the drawing board, finding and looking for more strategies and other ways to adapt to what you've invested in. And that's a frustrating but necessarily evil, right? It's the nature of the beast of the market. And I'm showing you how you can eliminate that finally. Part of the old way is that it takes a lot of research, which includes trial and error and failure, figuring things out. It takes multiple moving parts, trading a statistical edge, not knowing when it's working for or against you. Remember, every strategy has a statistical edge. So when the conditions are right, that means a statistical edge of 60% means that that strategy will work 6 out of 10 times or 60 out of 100 times on average when you see that, as long as the conditions are in your favor. And you have to know when they are and when they're not. And that produces a constant need for more information and buying more strategies and courses. And that also produces the short-lived success that you've probably been experiencing due to the ever-changing and deceptive market conditions, because of that one point that all strategies are inherently flawed. Now, when I say deceptive market conditions, what do I mean by that? Well, when you see a setup, it says, oh, here you go, this is a qualified setup, like a head and shoulders reversal pattern. I've qualified it, I've verified it's a head and shoulders, and so that's just no different than spotting looking outside your window, noticing that there's blue sunny skies outside, and you associate that with nice warm weather, and yeah, therefore I could probably go out with shorts and a t-shirt, when in fact it could be freezing cold outside, right? So that's deceptive, because on the surface it looks one way, so you assume one thing, but then after it's too late, you go figure out, oh, it didn't work out the way it hoped, right? It also produces an inconsistent, emotionally charged experience, which just feeds into a negative downward spiral. And after all of that, maybe you're hoping that you get some success, right? That's just the nature of the beast. Guys, this is cross your fingers trading. Here's what I want you to look at and see if this makes sense to you. You wade through all this information, study and study and study all this information, new things, the most cutting edge concepts and proprietary indicators and this, that, and the other thing, right? And what does that lead to? There's some complicated analysis that you've got to try to follow and make sense of, and hopefully not get paralysis analysis along the way, which leads you to just fighting the market all the time. It's like a war zone, right? Which then has you crossing your fingers, guessing it if this is going to be the one, and then hopefully that's going to come up with some, end result that you're going to be happy with, right? Guys, that's a recipe for success. Is it? No, it's a recipe for failure. So folks, if you put all that together, you can see how that's really a very complicated way to try to go about trying to succeed. It should be obvious to you by now that that is absolutely the recipe for failure, and why you're probably stuck figuring things out constantly and not achieving the results that you'd hope to with any consistency. So let's talk about the new way of approaching the markets. You don't even need to do research. Watch the media, subscribe to special services, keep seeking more new information, or any of those things, actually. An objective, principle-based probability analysis layer can replace all of them by uniquely filtering the market with a simple process that measures true supply and demand like this. You identify an opportunity. You apply a simple probability filter for confident analysis of the market's direction and condition. You get an objective, emotionless, yes or no based on the odds of success for follow-through. And then you manage your trade for consistent, worry-free profits. Guys, the new way is really that simple. You can easily track an opportunity through this entire process. There are only 4 major steps. Plus, the probability analysis layer does most of the hard work for you. Now, a powerful probability analysis layer identifies the total balance and imbalance of supply and demand in any time frame, and this is key. It delivers clear and objective data for directional bias, market condition, and duration, and it shows you the statistical relevance or probabilities of the information actually working out. And that builds a risk-to-reward profile that you can depend upon because it provides objective data in real time for clear trade management decisions, which is adaptive to market conditions. See, the lack of knowledge, lack of confident information that you can rely upon is why you have fear. It's why you have greed. It's why you don't have the patience. It's why you struggle to maintain your trade psychology with proper trade management. It's because you're really always guessing and hoping, but when you have clear objective data, it takes all the guesswork out, and now you can operate very mechanically without emotion because you have very clear signals, right? If you have a red light, you stop. You have a green light, you go. You don't have to guess at whether you should cross the intersection, right? It's very clear information that you know what to do with. And it's all within a visual layout that's easy to understand, just like reading your car speedometer or the oil or the RPM reading in the dashboard. So you see, that provides you a simple scan for visual markers of opportunities, and there you have a quick review for anything of interest in the market, and that provides an easy, objective identification of trades where the odds are actually already stacked in your favor before you even commit, because you easily filter what qualifies as something worth your time. And then you're never guessing and hoping for profits. You always know exactly when it's optimal to profit and when to walk away without ever gambling on outcomes. That same filter tells you when things are no longer in your favor. And that's what eliminates the constant need for more information or the next new thing. Does that make sense, guys? You know, you always hear about the success stories that focus on the flashy toys and material wealth, which is usually an unsustainable pie-in-the-sky dream anyway. Okay, we call those bull market geniuses, right? As soon as the market shifts and changes posture, all of a sudden these guys disappear. But how about the average Joe who just wants a better way with more options, freedom, and flexibility in life, who doesn't care about being rich and famous, knowing that the success achieved can be built up as big as someone wants it to be? But what if someone wants instead, they want to focus on keeping their life simple, having a consistency, right, to be able to have favorable options and choices for quality of life? Well, here's your average Joe, quite literally. This guy's name is Joe, and he's a personal trainer. His wife works as a web designer, and they have a young boy who they'd like to enjoy more time with and provide a better life for than the daily grind they both are in. And with only 5 to 8 hours a week available for Joe to work towards building a better and brighter future, I taught him my probability analysis layer, and he used it to grow $2,500 into over $7,300 within 5 months, all from trading the odds using the probability analysis layer. And that's almost 3 times the money that he started with, but without the common negative effects of guessing, stressing, random results, or the roller coaster effect. Now he's compounding his profits. In fact, we just talked to him here recently, and his account is up to 9,000. So these numbers were given to me, I think, about just a month or so ago. So he's grown and increased that quite significantly since then. But he, again, like I said, he's compounding his profits, and he expects to replace his full-time income within the next year. And the best part is that he's able to accomplish this confidently with less than 8 hours a week of trading, thanks to the consistency of the clear, objective data the probability analysis provides him. Guys, do you want clarity in the market once and for all? A recent client used the probability analysis layer I taught him to generate 415% on his account with just 67 trades in the first 3 months. Let's take a quick moment and listen into his trade review session.
Yeah, it's pretty awesome. I'm flabbergasted every time I go through and do this. So.
Well, that's awesome. Well, if you have trades consistently like the one you showed me here, then you're going to be very happy with your experience.
It was 67 trades, and it did 415%.
Wow, that's so wonderful. God, that's fantastic. And what was your trading background before this? Did you have trading?
Actually, you know what? Zero in regards to this stuff. We ended up at one time, oh gosh, 20 years ago, I had was involved with some currency trading.
Gotcha.
Personally, this kind of stuff didn't do.
So that's awesome. So, and then say again what you did. You did 67 trades.
67 trades, yeah.
So and 0 to
415%.
So from 0 to 67 and 415%. Can't beat that with a stick. That's awesome.
No, I was pretty, and wanted to prove it to myself to make sure that this is what it seems to be, and that definitely seemed to verify everything that we've been looking for.
So guys, principle-based probability analysis is the backbone to any successful and sustainable interaction with the financial market, regardless of the market traded, what the condition of the market is, or the time frame. You must get this right. With a principle-based approach, utilizing the 5 odds-making shifts that we're covering, you're no longer limited to trading a specific market, an asset class, or a time frame, or some condition, whether it's trending or non-trending, in order to confidently achieve your financial goals. With a principle-based approach, whether it's stocks, commodities, right, any of the futures markets, currencies, right, forex, ETFs, which are exchange-traded funds, the indexes, bonds even, the E-minis, or even any of the options markets, you're finally free to leverage any area of the markets within any time frame that best suits your needs and circumstances. So let's quickly recap. Now, we know that we must stop looking for opportunities that are likely to make you money. You only want to trade the odds and use all-encompassing superior data, which is the probability analysis layer, to achieve whatever we desire through the markets. Next, let's look at how to leverage our time and scale our trading without becoming slaves to the market and losing our minds in the process, okay? So the 4th shift I want you to make is process over results. With process, here's what you're doing. You're setting process goals, not financial goals, right? This is very, very important. When you prioritize a proven process for trading the odds through probability analysis, you will know whether any setup is likely to succeed or fail before you commit any time or capital. Trading is a business where you make more money by working less. In other words, you're working smarter, implementing a principle-based probability analysis process, and not through longer hours or working harder, right? It's understanding what it is that you're dealing with and working with it deliberately and with intent to be to have an odds-based outcome rather than a random-based experience. And with our common culture of work more to make more, I know it can be a difficult concept for some of you to separate the two. But trust me, when you put a process goal rather than a financial goal in front of you, then you'll be focused on the right things that you'll be doing in the right order at the right time for the right reasons, and that's where you're going to get the right results. So you guys know Bo by now. So let's take a before and after look real quick at Bo's life, okay, and his own experience. So before he met me and before we got him to do the probability analysis layer, he was trading a statistical edge like every one of you are, right? Bo is a professional career trader who traded the markets with a statistical approach, which yielded 5 to 10% per month for him, with win rates of approximately 65%. His average drawdowns were between 5 and 8%, and as the edge wore out, He was stuck, like you are, constantly going back to the drawing board to find yet another strategy that would work in the next iteration of the market's continually changing market conditions. Now, that statistical reality defined the limits of Bo's income. 65% average win rate, so that, in other words, 65 winners out of 100. If you subtract the 35 losers out of 100, you have a net total of 30 winning trades, okay, out of a total of 100. And that was acceptable for him, right? He was consistent, he was profitable, and he was happy with that, and he thought that was basically what the nature of the beast was. And it really was up until the innovation of what we're sharing with you today. But his workload on top of that was 120 hours per month. So keep that number in mind. After using the probability analysis layer, Bo realized that by using the probability analysis layer to filter out and know which setups were likely to succeed and which would likely struggle or fail, objectively identifying when a statistical edge is no longer favorable, he could avoid the majority of his losing trades, thus avoiding losses and reducing drawdowns while working smarter through the process that the probability analysis layer provides. He was able to dramatically reduce his stress, the workload, and the time he spent glued to his monitors. So Bo made a radical shift in his trading, abandoning the strategies that had been his main source of income for 15 years to focus on 4 simple reversal patterns. And this shift in simplicity was made possible by the probability analysis layer and has allowed him to produce a lot more profits with a lot less time, stress, and effort. So his outcome, right, Bo's first experience after implementing the probability analysis layer was a 50% return produced in just 10 days of trading. The total workload went down to 10 to 15 hours per week. So that workload dropped from 120 hours per month to just 40 to 60 hours per month. And now, Bo can produce win rates of up to 90%, in other words, 90 winners out of 100, and if you subtract out the 10 losers out of the 100, he has a net winning trade total of 80 versus the 30 he used to be experiencing. So think about that. That's more than, what, almost 3 times, right? More than twice, certainly, of what he used to make by working less and being more confident with less stress. Okay, and his average drawdowns have dropped to 3% or less. Think about that. And that's always utilizing a one-to-one risk to reward or better. And Bo used the extra time and freedom from the trading grind to move to vacation land, Portland, Maine. And now he's got the time to race sailboats, hike, ski, golf, and enjoy life in Maine. And based on the success of the probability analysis layer and the extra time that resulted from implementing it, Bo partnered up with me, and together we launched a rewarding consulting and educational business in 2011, helping people realize their own dreams through the world's financial markets. So, you don't have to trade the odds using probability analysis, but it is the fastest way to leverage yourself and secure your success. Bo has a vibrant life outside of trading again. He's getting better results than he ever thought were possible, plus more money, and he went from working 120 hours per month to just 40 to 60 hours per month in the markets, and that's leverage. When you use the odds-making shifts revealed to you today, you can leverage the process, your time, and a newfound perspective to make up years of financial productivity in a very short period of time. So let's talk about the 5th and final shift that you need to make, and that is to invest in mentoring. Everyone should have a mentor. Mentoring brings 2 things, guys: new ideas and accountability. And that's probably the biggest one. There are new ideas in your head right now that would not have been there if you didn't make the time for this presentation. A good mentor will give you great ideas and make sure you act on them to confidently get you from where you are now to where you want to be, so you avoid wasting your time and resources. A great mentor will also put together a powerful group of people all working toward the similar goals, and that multiplies everyone's effectiveness exponentially. In our program, we have people earning $40,000 a year working around alongside people earning $1 million a year, so everyone wins. A mentor is going to help you accelerate and increase your fulfillment, to get you out of being stuck, create the right focus, and cut through all the clutter. And the right mentor will identify the blind spots and help you figure out what you don't know and clue you into the things you may not be able to see. They'll bust destructive myths, help open your eyes to the myths of conventional thinking that you may have accepted, but in fact have been the underlying reason to why you're still stuck. They'll hold you accountable. Mentors keep you on track and moving forward toward new levels of achievement. For many of us, having someone we answer to motivates us to act. They'll help you focus your development efforts. The right mentor will help you know the difference between weaknesses you need to fix and those that are best just left as they are. This can help you invest time and energy only in the most fruitful opportunities. They'll also provide a measurable advantage. A mentor can help you get from point A to point B faster than you could on your own. They'll turn confusion into clarity, turn frustration into confidence, and turn chaos into results. That turns stress and tension into being relaxed and having a smooth experience with consistency. So you'll feel happier when you're no longer left to your own devices, struggling alone in silence. You'll no longer be losing precious time and resources out of your life, ultimately affecting your loved ones and your own health. And that's a cost most people discount. Now today I demonstrated how you can use a framework with just about a 10 to 15 hour week commitment in the markets, whether you're experienced or beginner, and turn that into meaningful monthly income starting with just a small amount of money, even if it seemed far-fetched at the beginning of the presentation. I covered how you can seek profits on demand, the kind of profits that you can capture regularly during any given week without the common stresses or negativity, all while having fun and feeling great doing it. You went over how this unique insight and approach allows you to trade short-term profit cycles that occur daily more conservatively than you would with buying and holding long-term, and how you can leverage the specialized knowledge to replace your income needs through a part-time effort so that it doesn't take over your life, and how to do all of this without taking big risks, feeling uncertain, guessing and hoping for profits, feeling stressed, getting stuck, or any of the common trader traps you don't really want to experience, regardless of the ever-changing market conditions. So as a recap, here's what you need to win. First, stop looking for opportunities that are likely to make you money. That just blinds you to all the risks that you should be paying attention. Only trade the odds. Use all-encompassing superior data, and that's having a probability analysis layer. Prioritize process over results, and invest in mentoring. Guys, these 5 shifts alone are enough to propel you to 5 figures per month. Now, when you get this right, you're going to set yourself free. You're never going to have to deal with the stress of the guessing and the hoping and the fear that you deal with what the market's going to hand you today, because you'll know ahead of time what's the likelihood of success or failure before you commit. It's kind of like having the instruments that you need to tell you what the weather's going to be like today, so you know whether it's going to be hot or warm or cold, and you can address appropriately, and basically that's how you dress as a strategy to what the conditions outside are, right? So once you have that, you're set free. You no longer have this emotional roller coaster where the market's actually a even, stable, consistent experience. But guys, if you get this wrong, you're going to keep struggling. You're going to keep feeling like this clouds over your head, and you just seem to like be the unlucky guy that the market keeps gunning for, right? And if you don't burn yourself out, you're going to look back at your life, and you will have spent so much time and money with nothing to show for it. Life is a mirror, guys. Let me explain this concept to you. Over 16,000 trade reviews among dozens of clients over the last few years have highlighted an important principle for success. And that is that it doesn't matter how good your trading strategy is. There is no escaping cause and effect. Trading is more about consistency of approach and maintaining a stress-free, objective attitude than it is about aptitude or technical analysis. This requires a principle-based approach using probability analysis. It's the only way to get there. And guys, if you want to experience decisive profits, you need to be decisive. You must be willing to make a radical change from what you've been doing to get from where you are now to where you want to be. To be in the driver's seat, remember, attitude is everything. You're the cause of your success, not external forces. To allow yourself to continue to struggle, that's a choice. That's, hey, I'm going to keep doing it my way. I'm going to keep going over the next new thing, chasing the next new shiny object. That choice is usually rooted in your own ego or some fear which you must overcome to get you to where you want to be. So now you have a choice. So how can I help? My team and I have set aside some time this coming week to speak to you personally about how you can apply these ideas to your trading starting today. The cost, it's free. Now let's go over who this is for. Number one, you must be absolutely committed to hitting your income goals with total integrity to the process provided and a true commitment to seeing it through. You must be driven and have a real desire and a passion to accomplish your goals. If you're going to just try this instead of do this, then this is absolutely not for you. You're wasting both our time. Now here's why we're doing this. On the call, we'll help you get total clarity about exactly what you want your trading experience to look like, address any roadblocks, and then give you the exact steps that you should take to confidently achieve your goals. Then, if you want us to help you, upon your request, we'll evaluate the feasibility of working together, and if we think it's a good fit, we may invite you to become one of the new clients we'll take on this month. And if we work together, here's what you can expect. We'll put you through the same programs we put our seven-figure earners through. The curriculum is designed to get you to 5 and even 6 figures per month and beyond with maximum leverage, so you can start enjoying your life and doing the things that bring personal value and satisfaction and meaning to you. We'll expect you to learn from us how to make high returns with extremely low risk and great accuracy and consistency within your first 1 to 2 weeks. Now, our long-term vision and motivation, we're confident that some of our clients will want to take their success beyond their own individual ability for something a little more personally satisfying and rewarding than just making more money, and for the sake of just simply making more, right? Because there is a lot more to life than just making money, guys. And I think once you get there and you've approached a level of success where you can just cruise, you start to look for things that are more meaningful in your life, because money just isn't it. Money doesn't buy you happiness. Trust me on that. But those clients can ultimately go on to prove themselves as ideal candidates for us to consider and evaluate further down the road, potentially having a chance at joining our cloud-based firm to help us grow and diversify our trading operations. Now, this could also include opportunities to work with our growing list of private consulting clients that are continually referred to us and who depend on our specialized analysis. And that really creates a win-win scenario, right? So, if this sounds like anything of interest for you, go ahead to profitsondemand.com/getmygift, and right there you're going to get your a chance to get your copy of my little 12 out of my 16 pages of avoiding gambling on outcomes. The 3 most critical questions you must answer before you commit to any trade, and that also includes my daily trading ritual and live trading checklist, and that whole structure that my clients use. It's at profitsondemand.com/getmygift. I promise you, I'll give you the link to get a copy of that. But at the same time, when you're there, you're going to see you have 2 options. You can either simply get a copy of the complimentary gift, or option 2, you'll automatically get a copy of that gift if you want to go ahead and apply for your complimentary breakthrough strategy session. This is not a sales call. This is not a sales pitch. There's nothing awkward or pressure-filled in that. It's going to be a conversation. We're going to get to know about you. You're going to get to know us. We're going to become friends, and we're going to find out exactly what it is that you're dealing with in your situation and help you get exact clarity on the exact steps on how to get from where you are to where you want to be. Now, guys, spots are necessarily limited, right? There's only 24 hours in a day, and there's time for sleep, there's time for family, there's time for everything else, right? So please make sure not to procrastinate. Go to profitsondemand.com/getmygift. The page looks like this. You've got option 1, option 2. Option 2, if you want to apply for that complimentary breakthrough strategy session, you automatically get a copy of your free gift. But over there, you're going to want to go ahead and schedule a time with us because we can only do these for so long before we shut that down and spend time working with clients that we're currently in our community. Okay, so again, that's profitsondemand.com/getmygift, and we'll see you there. We'll look forward to speaking to you soon. Simon, thank you very much for your time. Hopefully we came in at on time for you.
Roger, thank you very much indeed. Yes, we've just been running a few minutes over for the last few hours, so apologies to everybody that's waiting, and especially to our final speaker, Matt Golden. But in the meantime, Roger Curry, Bo Yoder, thank you very much indeed. RBJ Financial Group, thank you for going through that.
Thanks, everybody.
We will be in touch again shortly. I've posted that link in the chat box. I think I may have just posted it to one person. I'll correct that now, so that it goes out to everybody, and we will move swiftly on, if you don't mind, to our final speaker. So, Roger Curry, Bo Yoder, RBJ Financial, thank you very much for joining us.
Cheers. Have a great night. Thanks for the opportunity. Thanks for your time.
Thanks, Bob. Thanks, Roger. Okay, well, we are now just an hour away from finishing our event, and we have, as our final speaker, someone brand new to the event, which we haven't heard from before, Matt Golden, joining us from Vantage Point Software. We're staying in the US, so let's go across and see if we can unmute Matthew's microphone.
Hello, Simon. How are you?
Matt, I'm very well. I'm so sorry to keep you waiting.
No worries, no worries. It was good hearing everyone speak, and thank you, obviously, for inviting me to share what I have with you guys. So I do appreciate it.
Oh, fantastic! Well, we've had a long day. I mean, we're predominantly a UK audience, so most of us are moving into the evening here. But it's been a fantastic day. We've had lots of different speakers, lots of different ideas. And of course, it's interesting times in the markets, as it always is. So it's been interesting. Using global confirming markets to increase profitability. I think I can guess where you might be going with this, but I'm going to hand over to you to get started and tell us what it's all about. Let me make you the presenter. I'll make you.
Okay, I'm somewhat familiar with this here, so I imagine you all see this using confirming markets for profitable trading slide here. So I'll go ahead and get started.
Wonderful.
Are we good to go, Simon?
Just good to go in your own time. Thank you.
All right, excellent. So again, good afternoon, everyone, for joining us. Obviously, this is a great honor for me to be participating, and obviously I'm here in Florida, here in the United States, so glad I can be with you all in the UK. So now we're going to be talking about using confirming markets for profitable trading. If you're not really sure what I mean, or that sounds a little bit unfamiliar to you, don't worry. We're really going to dig into this step by step and really help you understand, how you can really start, trading more profitably by really using the technology that's available to you nowadays. Now, before I go ahead and get too ahead of myself here, let me tell you a little bit about myself. My name is Matt Golden. I've been a trader for about 5 years so far, and I've really just transitioned over that time. I started in the currency markets, because I had the affordability of the leverage offered there, and just sort of built my my business here. I moved into the commodity markets and also stocks. So I do trade absolutely everything. And then one of the great things about me really moving into this industry was one of my first jobs out of college was working at this firm, Market Technologies here. So they produce software called Vantage Point, which is the world's leading market forecasting software. They've been around for 3 decades, actually over 3 decades, about 37 years the company Market Technologies has been around. About 15,000 traders worldwide utilizing this approach to be more consistent and accurate in the market. So one of my jobs when I got a job in college was, one, learning how this software works, but one of the great benefits was talking to traders, and this is the whole gambit of traders, people who are just getting started, guys who've been trading crude oil for 30 years. So you really learn a lot by talking to a lot of people, the struggles they're having, the guys who are being successful, and this is certainly something that I needed to pursue for myself. Just was not going to work for me. Really, even mentally and emotionally, being in an office, I really had to trade and learn how this all works. So this is a great passion for me. I absolutely love the markets and love trading, and when I'm not trading, which I am really doing every day, but I'm talking to traders, really working on educational content, and then also speaking at live seminars and things like that. So I've kind of just devoted my whole life to this, and so for the next 30 years I've really got everything planned out as far as how the campaign moves forward. But a little bit of housekeeping though, obviously, to take care of before we go ahead and start digging into this. Now, as always, guys, trading comes with a certain level of risk. Should never be trading with money that you cannot afford to lose, but the strategies that I'll be talking and sharing with you today, they're based off of the time-tested and true technologies behind our program, which are proven to be up to 86% accurate. Now, not every trade is a winner, but we're definitely here to help traders become better than they are. That's really all we can do, is improve on what we're doing. This is not trading advice. Ultimately, trading decisions are up to you, the individual trader, which is what we all signed up for getting into this business. So if consistently trading with up to 86% accuracy sounds good to you, sounds something like that can help you, we're definitely going to show you how this works and how we've really been doing this over the past several decades here. Now, one of the things that I love about the markets, and especially the technology and all this, is the markets really are global. I mean, right now I'm talking to all of you, out in the UK. I'm sure there might be some people out in Asia and spread all over the world. I do, webinars every day with people all over the world, and so the markets truly are global, not just the information that we're able to share, but the way that everyone's interacting with markets. The amount of participants that now with the internet have access to the markets is a definite change that has occurred. So, when we mean a global economy, what does that really mean? Well, the crux of it is that what happens in Japan with the Nikkei and the Japanese yen and their markets is going to affect you guys over in the UK and the European markets. And so that's going to trickle over, and then the US markets are going to open, and it's all goes around in a big circle, right? So our markets close down here in the next 45 minutes. We're going to get a little bit of a break, and then Asia is going to start trading again. But the reality is that everything's playing off itself. The dollar index affects what's going on with the yen, affects the indexes, and so this is what we really need to be paying attention to, and make sure that we're incorporating this sort of information into our strategies and our approach to the market. Because the reality is that a lot of methods and strategies out there, they do approach the markets as if they do trade in a bubble or something, that they're not affected by interest rates and metal and energy markets. And so this is really the trouble that traders have, is not incorporating this information. And so what we really have to get right as traders, regardless of where we're trading, if we're in commodities, if we're in forex, if we're in stocks and equities, we have to get two things down if we really want to be successful on a consistent basis and make money. Now, those two things are, of course, timing and direction. Talking to so many traders, you always get the first question that traders ask, what about an option strategy, or what about the forex market, or what about? None of that matters yet. I mean, obviously, the first thing you need to do is get a handle on, how you determine timing and direction, because that's what's going to make or break you in the market. When you have periods of volatility, things start getting, volatile, but become very emotional for traders. You have to have the confidence to stay in your position, execute your game plan. But the problem is that a lot of the tools out there, like I mentioned, and analysts and a lot of these methods, they only have this single market approach. And so one of the best ways that we can get clues to help us in these two areas, which we know will improve our P&L, improve our trading after every week, month, and year and session, really, what we can do to get clues here is to get those clues from related markets. And this is very, very important. And like I said, what a lot of traders end up really either just superficially doing or completely really ignoring to their detriment here. So I want to go ahead and go through some really basic charts here to drive home the concept so you can understand where we're coming from, how we apply this technology, and how traders are actually able to incorporate it into their approach and use it every day, because without that we got nothing. So The S&P 500 and the DAX here, I'm sure you're all familiar with these markets, but we have the American exchange, the index here, and also the German index. Now, we can see very plainly here on the chart that when we get a downward move in the S&P 500 and the DAX, they share that relationship. We're getting a similar move in both of these markets. Now, conversely, on the right-hand side of the chart, as we're moving up through those months of March, you're getting the DAX moving higher. Now, this is a relationship that is consistent. It has very valuable information there that we can use to then make trades on either one of these given markets here. Now, so that's a correlation where markets are moving together. But obviously, that's not the only way that things work, right? We do have markets that share completely inverse correlations. So you have situations where the S&P 500, same period here, moving lower. Well, what's happening to the volatility index? We've certainly seen that over the past couple of weeks as the S&P moved lower, volatility index came up. You're going to have that consistent relationship play out, and that's what we want to look towards to get these clues as to timing and direction, help us be better and more efficient traders in the market. So obviously here we have an inverse correlation, these markets moving in opposite directions of one another. And, anyone who's been in the market understands that, it's not just limited to these larger index markets, these larger global indices. A lot of these relationships play out between, indexes and individual stocks and individual shares here. So we see the S&P 500, and I'm sure a lot of you out in the UK familiar with Apple, and these shares trade in tandem. So you get the move down in the S&P 500. We're seeing those gap downs and similar price action in Apple, and conversely, obviously on the right-hand side of the chart, the same thing. Now, what we're doing here, guys, and this is very, very important, is what we're doing is what's called intermarket analysis. So we're analyzing those relationships between markets, those very important relationships, but not just between, a couple of markets at a time. We're looking at interest rates, commodities, other related stocks, and then incorporating that into our analysis so that we can actually use this information every single day to help us be more consistent, more accurate, and make better trading decisions regardless of the markets that we're trading in. So let me go ahead, and I'm going to go ahead and open up my Vantage Point software here. And so some of you may be familiar with the software, I'm not really sure, but let me go ahead and open this up and explain everything about how this works, how our customers are utilizing this approach. And me personally, this is a software and approaches and tools really that I'm using every single day to run my scans and look for opportunities throughout futures, forex, ETFs. And so it's really about using the technology, leveraging it to your advantage. A lot of those things in the last presentation were really great, but we obviously want to be more specific on how we're drilling down and what tools are we using and really setting up that process that we understand. And so let me go ahead and thoroughly explain everything that we're looking at here, how the software works, and then how traders are utilizing that process to go ahead and, how I like to say it, crank the machine every single day to find these opportunities here. So we have a chart here for Fifth Third Bank here, an American financial firm. And one moment here. So we have a stock here for Fifth Third Bank, and I'm going to go ahead, I've typed in the symbol inside the market tree here. Now, this technology that I'll explain here, we apply it to all different types of asset classes, and you'll see why we're able to do that here. But I'm going to type in the symbol. We're going to be able to look here, and I'm going to need to open up this Properties tab here to explain what's really going on here and how this software works. Now, Vantage Point utilizes a technology called neural networks. Now, this is actually a type of artificial intelligence used in applications like weather forecasting and really predictive modeling. Now, the great thing about neural networks is they produce extremely accurate short-term forecasts, but the further and further out we go, the less reliable you're going to have there. But what we're doing here is we're able to analyze the 30 most closely related markets. So we're using that neural network process to identify the 30 markets that are known to drive, influence, and impact the target market that you're trading. So in this example, the target market being Fifth Third Bank. But you see here, if we look at these intermarkets, what's going into essentially these predictive indicators, and I'll explain how all these work. But this is really what's going on behind the hood. You see we have things like the Financial Spider ETF, the Japanese yen, dollar index, crude oil prices, natural gas, S&P 500, interest rates, the gold market. Things that I think every single trader should have a way of incorporating into their approach. But the great thing about this software is it's able to identify identify a lot of those important market relationships that are a lot more subtle. that aren't going to be as obvious as the DAX and the S&P 500, but are extremely important to anticipating future price movements. So you see here that there's actually markets here, Charles Schwab, Huntington Bankshares, KeyCorp, other financial firms, services companies, technology companies. And so there's actually 2 patents on this technology and on this approach. And those 2 patents are that neural network process that identifies all these 30 markets that are known to drive the target market, and then also the weights. So to what effect is each one of these markets having on that target market that you're getting ready to trade? Because we know that these markets, some have positive relationships, some have negative correlations, some markets lead, some markets lag other markets. And we really have to be able to understand where are those important relationships and how are they really affecting me and my trading, and what should I expect in any given market moving forward through time. So, you know, that's the secret sauce going on behind the hood there, guys. But that's really the technology really doing the heavy lifting for us as traders. And what's important is that we develop our strategies to make sure that our actions, our interactions with the marketplace, match the highly accurate output of this neural network driven, you know, forecast here. So I got a lot of charts to go through here and a couple features to show you here, but looking here at Fifth Third Bancorp, you saw those intermarkets here. So let me go ahead and explain everything on the chart and what we're looking at here. Now, these are all daily bars and candles. Important to understand the software works off of end-of-day data, and it needs to do that because when we're analyzing markets like, you know, the Nikkei and the Japanese yen and the crude oil market and maybe even the wheat market and all these other related markets, you know, you want to get all that data from the end of day, have that neural network process run, but then that artificial intelligence is able to essentially generate a prediction and a forecast. And one of the great things I've heard said is, you know, artificial intelligence, it's really the ultimate tool of preparation. And that's a great thing in markets. When you're prepared ahead of time, knowing what to expect makes it a lot easier to go in there and express your trading idea without any emotions, but also be able to adapt with changing market conditions, because we know that there's no way to predict out what's going to happen 2 weeks, 3 weeks, a month from now, right? But as traders, we need to manage these positions appropriately, and that's what will help us be in the position at the right place at the right time and make sure that we're making money here. So these daily bars and candles, you see that we have a black line and a blue line against that price data there. So let's start on this black line. Now, the black line here, guys, is a simple moving average, just a regular lagging indicator. It's a 10-day simple moving average. So you just take the last, 10-day closed prices, whatever they were, you average them together, divide that value by 10, and it's going to plot the value of that black line on the chart. Now, I'm sure a lot of you are very familiar with that, and really the problem with this is that it really is a lagging indicator. It's only looking at past prices of the one market, so you're only getting a very small amount of data points, and it's obviously always just going to be reacting to what the market has already done, essentially smoothing out that price data there. Now, the blue line, though, that you see against that price action as well, that blue line is Vantage Point's proprietary predicted moving average. Now, what's happening there is before that value is plotted, so before that blue line can be given a value and plotted on the chart, it's analyzing those 25 to 30 market relationships, how they're affecting, driving, and influencing that target market, and then essentially creating a comparison between a predicted moving average generated via the technology and the actual moving average, which we know is just actually summarizing what's already occurred in the market. So as traders, what we're looking for are trend shifts in the marketplace. Traders, what we have is actually a great feature called the IntelliScan feature here that really picks out all of these fresh crossovers for us. So our timing is excellent when we're paying attention to these opportunities. But the key here is recognizing these trend shifts in the market via these predicted moving averages. Now, a couple of things that you need to keep note of is, when you have a lot of separation between essentially that prediction and the actual, that represents a very strong trend. I mean, if our prediction of where the moving average is headed is separating and becoming much stronger, that represents a lot of strength in that trend. Now, when the blue and the black line essentially pinch close together, that signifies that a trend may be losing some of its steam, but you want to essentially to determine direction. Obviously, if that blue line remains above the black line, the overall direction is still forecasted to keep moving higher. Now, that's very straightforward. The tools are really developed to be really designed for traders and very intuitive. So, we don't have to do, have a million different indicators and a million different types of analysis and approach. What we really need to make sure is that we obviously are being consistent with how we're interacting with the data here. So let me go ahead and, aside from the predicted moving average, which obviously gives us our direction, let me explain this predicted neural index here at the bottom of the chart, because it's really the combination of these indicators that produce the forecast for us to make trading decisions here. Now, the predicted neural index, and you can see P index right here, runs from a value of a 1 or a 0, very binary output, right? So it can either be a 1 or a 0, yes or no, right or wrong. Has an extremely high level of accuracy. And what it's able to do is it's incorporating that neural network data, that predictive data from that neural network process. And this is a highly accurate short-term forecasting tool. And it's really looking ahead 2 trading days. I mean, the nature of the indicator is forecasting a technical indicator 48 hours ahead of time. So 2 trading days, 48 hours into the future, or 2 candles in this case, because we're looking at daily bars and candles here. So this indicator works extremely well for trade management, but also confirmation for our directional shifts in the market, so that when we have that fresh opportunity, essentially this predictive data has anticipated a trend reversal for us, and we look at our highly accurate neural index, which has that high level of accuracy across all different asset classes, very high, near towards 80% and higher, but again, that's spread out of all different asset classes, stocks, futures, forex. That's really confirmation for this directional shift in the market. And so that can help us confirm, which market trends are expected to move. But also, what we really want to do here is make sure that we're staying in markets if we're truly a trend following or a trend trader here. So as long as that blue line remains above the black line, traders are going to want to hold out on their position. And so why this is really helpful is because this intermarket data really helps to not have traders get tripped up during those times of volatility and sideways price action where traders can really get hurt. Now, if we look at this chart, we see it got about a 19% rally so far, but you see we've had these instances where the predicted moving averages pinch close together, but we never get that crossover. So you really never get that confirmation that this market's expected to go lower, and you actually see that short-term forecast getting very, very bullish, saying, look, expect strength. So whether you're a trend trader, a short-term trader, you have to have tools that can get either timing and direction. And so the predicted moving averages here really helping us with our direction, knowing what side of the market we really want to be biased towards, and then that neural index helping us with our timing of, do we want to be buying over this next 48-hour period? Do we want to be bearish or bullish to guide our decisions there? So in essence, it's really how the software works. I mean, it is designed to be very, very simple, and the benefit really comes from the accuracy of these indicators. Now, one thing I want to mention before we start moving through more and more charts is a common question that we get is about the neural index, because it flips from a 1 to a 0. But what you want to pay attention to is, like I said, is the combination of these 2 approaches. So you see our direction from the blue over black line, neural index is still up, right? It's still very clearly that blue line is above the black line. Your neural index at times will drop down, to a 0. But we get that weakness over that subsequent 48-hour trading period, but you see that the direction is still up. And so once that short-term forecast gets bullish again, that's when you really see that excessive strength starting to come back into a given market. So we'll go ahead and go through some more examples here and some more opportunities in the marketplace, and additionally how this feature works for traders, so their ability to scan for opportunities, and that really gets back to the process. I heard some of these speakers earlier talking about, it is all about that process, taking the emotions out of it, and that's what Vantage Point as a tool really allows you to do, is suck out all these emotions out of the process, really regiment this as far as scanning for your opportunities via that neural network process, and then focusing on even the markets you trade based off the forecast that look the best, because that's what's going to garner the best probabilities and possibility of getting the type of trade and type of move that you're looking for. Now, one of the biggest things, guys, is, depending on your trading style, and even if you trade options or anything like that, is, it's critical to understand when you need to go ahead and, take your profits and move on from a given opportunity. And you can always get back into a market. It may trade lower and represent a new opportunity later on, but when you have consistent tools, it's going to allow you to, first and foremost, and one of the most important things is, take those profits at the right time, because the market takes a heck of a long time sometimes to creep up, and gives back half of a 2 or 3 month sort of cycle in a week or so. So we really need to be very conscientious, and again, make sure that our actions model our highly accurate tools here that we have with the Vantage Point software. So financials and techs had a great rallies all through the July and August here, but we see how this forecast really holds up here. So our predicted moving averages giving us crossovers all the way back at around $65 a share back in July, and you really see how this works. With that crossover and the short-term strength, you get that initial push in the market that you should expect off of this very straightforward interpretation of the tool. So you can get that initial entry into the market. Now, you notice your neural index drops down to a 0 here, and you get this sideways action. But this is the key, guys. I mean, these are really these periods of time where a lot of traders do get tripped up here. The direction is still up, but the market has moved sideways for about 2 weeks, and that's where you really need to practice that patience. And so what happens, and what you'll recognize with some of these scanning features and these organizational tools here, is that when you can get into markets at the right time, have that good timing, get into the trade, recognize some possible weakness, but since you've got such a good entry, you can keep running that process. So have new opportunities come through where you can enter into those markets, get good entries, and then just manage that position moving forward, in line with obviously what the software indicates for the market there. So you see, as long as we're maintaining that position from where that blue line and black line stay on top of each other, we're getting the best part of this move, about an 18.5% move higher, with those really strong rallies coming when not only our directional predicted moving averages were signaling the direction up, but when these neural index signals, these 48-hour forecasts, were becoming very, very bullish, indicating this is really now the time where we want to go ahead, set these positions regardless of trading style. Day trading, you'll be pushing those positions. Options trading, you'll be trading towards those strikes, but then recognizing clearly that about a couple weeks ago, things had definitely changed in the short term, and in that at least directional shift there. Wise to go ahead and look for new, better, clean opportunities where there's that strong directional and short term factors working in your favor, right? So about 18% move here. You see some really great tools here as far as this profit calculator here as well. I like to go ahead and use it to see previous trades. You can see the percentage gain, about 18.5% move here, but also setting your stop loss target. So understanding, working in different markets, hey, how much of a percentage move is this? You can easily use that tool, figure out exactly how big these moves on the chart are. So there's Motorola, something that's been very interesting over the past couple weeks, and I'm sure a lot of traders out there who understand, when you've got a portfolio and you've got a lot of different positions, you obviously want the ability to hedge that portfolio, so that when you get a lot of volatility in things like the S&P, your positive positions will, really break even, maybe move down a little bit lower, but you can set some shorts and be making a lot of money during those really volatile periods of time. Now, what we really noticed was the healthcare spider here in these ETF markets showing a lot of these pharmaceutical companies getting very, very weak. And so it really became very obvious that, okay, well, mid-August, leading into August, look towards these pharmaceuticals for opportunities to short the market and obviously trade in line with the software output here. We see here Abbott Pharmaceuticals here, and you see the accuracy of the forecast here, and this is really critical here. Here's your directional shift, neural index confirming that, okay, well, direction has changed. We want to go ahead and look for these opportunities to the short side. That blue line remains below the black line there, that predicted moving average, but you'll notice that neural index does quickly come up to a 1 there. So what it's saying is expect strength over the next 48 hours, but directionally, the direction is still towards the downside. You want to maintain that bias, and so once we get that neural index back down to a 0, then you really see that excessive weakness in the market with trend and obviously that 48-hour indicator being excessively weak over this entire time period, signaling go ahead, set those shorts, keep shorting the market, and eventually having those positions be covered very recently. And these markets now trading up towards about 42. So, really the tools that are going to point you towards, hey, where should I go ahead and set some shorts to try to hedge any of my long positions you took in July and August? Where can I go ahead and hedge some of those positions? There's some great opportunities here in some of these financial or healthcare markets as these financial and tech stocks just keep moving higher here. Here's another example in Mylan. these very clear crossovers to the downside, and excessive weakness allows traders to really understand, okay, now's the time to be short, definitely not be long the market. Regardless of your trading style is, you're going in and setting those shorts, and you see some of the strength coming back into the market, and directionally, the shift obviously occurring several days ago, getting you out of, again, trying to push any sort of short positions in the market there. Moving forward, let's go ahead and I'll go ahead and move over. I think I have a currency trade market picked up here, and then I can show some of these scanning features found within the Vantage Point software. So it is really a complete tool. Not only do you have this unbelievable sophisticated technology producing these highly accurate forecasts, so you can obviously have a tool to make these trading decisions, but all the organizational tools are there as well to make sure that you're able to shift through these charts and really have a wide breadth of opportunities to look at and focus on where's the strongest opportunity to deploy my trading capital. So let me go ahead and British pound yen here. So I thought I'd bring up a British pound currency spread since we're dealing with our UK traders over here. But regardless of the markets you trade, this is a huge advantage of this approach and these sorts of analytics, because we're performing intermarket analysis. You imagine every target market that you're forecasting for, in this case, the British pound Japanese yen, we're looking at those 30 most closely related markets. Now, obviously trading a spread like the British pound Japanese yen, you're going to need to do more than single market analysis. We need to know, hey, what is the British pound doing? What are those other European currencies doing? What is the Nikkei doing? What is the yen doing? I mean, there's a lot that goes into this. But by utilizing this technology, we don't really have to be actively burning ourselves out, really, trying to figure out all these relationships. I mean, our brains are really not equipped for this sort of problem solving. But you see, as traders, as long as we have the signals, we can make at least intelligent trading decisions off of, again, those probabilities, which is really what it's all about. It completely takes the emotions out of your approach here. So you see British pound Japanese yen here. Here's your crossover to go ahead and get long, and you really just see how accurate this neural index is over as a 48-hour forecast. So you know that your trading decisions in those 48-hour windows are guided by these very high probability analytics here. Now, I love this software for obviously these moving averages I've showed you and the neural index as well. But it really is a complete tool even for intraday traders and things like this. If you actually look at the right-hand side of my chart here, all the way here on the right, you see that there's a candlestick, essentially. That's actually a predicted trading range for the trading day that has yet to occur. Now, this is obviously the 22nd. We're going to get a new forecast in the next few hours for tomorrow's trading day. But every day you actually get an actual prediction for what are the expectations for the high and low, which are great for setting profit targets, stop loss targets, to go ahead and manage those trades. So I'm going to actually hit F5 on my keyboard, and what we're actually going to see is those predictions against the actual market data that occurred that day. And remember, what's going to happen here is we're going to have a new candle of whatever actually occurred in the market today is going to populate that area, and we'll see how accurate that prediction is. But you see just the benefits here, guys. When you have this neural index up at a 1, you're targeting the predicted high levels for the day. You're trying to buy at these predicted low levels. When that neural index gets negative and you're looking to short, well, what are you doing? Trying to short at those predicted intraday high levels, trying to target those predicted low levels. So, these are the tools that are allowing traders to really be ahead of the market, because when you're getting ready to essentially short the British pound over this time period, not only do you know, hey, the direction's changed, my neural index is weak, you also even have individual levels to go ahead and set those limit orders, be ahead of the market, and execute your game plan. So, you don't want to be spending all day in front of the computer looking at these things. There really are the tools to help you be prepared and anticipate, exactly what you want to do each and every trading day without the emotional intraday, wheeling and dealing of it. So,
Matt, could I just interrupt you for a second?
Yes, of course, yes.
Just on this chart, you've gone over quite a lot of information there.
I apologize. Yeah.
It's great. No, it's very good. I'm just interested if you could just rewind a bit again and just explain. You've got the black line, you've got the red. One of them is a predictive line, an indicator.
Yeah. Let me just I'll briefly sort of summarize a lot of this in a very kind of clear and concise sort of way here. So, as I mentioned, starting out, Vantage Point, and what you should really think of Market Technologies here is really a technology company. The company over the past 37 years has been using that artificial intelligence technology of neural networks to analyze these intermarket relationships between the markets and then forecast future price. So essentially you're taking this data that's essentially has predictive data in it and using it to improve upon these indicators, make them more accurate, more able to anticipate price movements rather than lag behind them, because we know a moving average that's only based on information and data from one market is always going to just lag. It's just going to be summarizing what's already occurred in markets. Now, what we're looking at between here, this blue and the black line here, is it's a comparison between a actual moving average, so that very simple simple data metric there of just taking the however many close price, 10 close prices, average that together, divide by 10, that's single market and going to lag behind past price. Now, that calculation, that very simplistic calculation, plots that black line on the chart, and how we can think of that black line as a summary of what is occurring in the market. I mean, we're simply just smoothing out 10 days of price action, and that's what it is. Now, for that blue line, though, this is being the predicted moving average. This is the proprietary moving average generated via that process, that neural network process, to plot that value. Because remember, this essentially, this line that we're looking at every day is really a value. It actually, you get essentially a price of where that moving average is expected to move forward into time. So what we can actually see, if we look really closely at the top here to kind of push this point home of the moving averages. So right now, and again, what we're comparing in this situation is the 5-day simple moving average, but this is the predicted exponential moving average forecasted a day ahead of time. I know that's a little complicated to think about, but what's essentially happening is it's taking that predictive data generated via the neural network process, so looking at all those intermarkets, what's going on with British pound, what's going on with Nikkei, what's going on with FTSE 100, what's going on with S&P, dollar index, analyzing all those intermarket relationships and using that data to essentially predict out future price of this currency pair. So when we're plotting that line, it isn't just a value created from simplistic, a lot of these technical indicators are standard averaging and standard deviation. Simple averaging and standard deviation, is a lot of these indicators really fall into those groups. What we're really doing is taking this separate data set of these intermarket relationships and using that to determine the value of that line. And so it's predictive. I mean, it is really looking forward a day ahead of time and anticipating where the price trend is expected to go. So when you're looking at it, it looks like a normal moving average because it's right against the current candle. What this is actually doing is it's a couple days ahead of time, essentially, and predicting where that moving average is expected to go. Now, when we combine that with the neural index that you see at the very bottom of the screen, the neural index is strictly a 48-hour indicator. It's actually, I don't want to get terribly complicated here, but it's predicting a moving average, a short-term moving average based on typical price. So that's including the high, low, and the close, bringing volatility into the mix a bit here. Bringing all that information in and letting us know if, with a very high level of accuracy, up above 80% on all different asset classes, whether it's expected to be higher or lower 48 hours into the future. So that's what this neural index is doing, is constantly looking out 48 hours in the future and saying whether that short-term moving average, that real actual moving average that we can plot very simply in a charting system, is going to be higher or lower. That's why we have a binary output here, higher or lower, yes or no, right or wrong, and that's how we're able to compute that very high level of accuracy statistic, because we know we're either going to be right or wrong, right? So what this neural index is doing is constantly looking out 48 hours ahead in price and saying, hey, is that moving average expected to be higher, 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 48 hours ahead, 48 hours ahead, 48 hours ahead. So, I don't doubt that we have a lot of traders using the neural index and trading very short term straight off of that indicator along with these predicted high and low levels. Me personally, I'm a longer term trader. I look for longer term setups, kind of like running those filters, kind of like the gentleman previously talked about. And then I love using the neural index as a throttle. So knowing over that 48-hour period, do you want to be heavier on a given position, or do you want to be, getting defensive, cutting your losers, and things like this? And so, trading in the market, it's all about being able to adapt. The markets are constantly changing and shifting on us, but this approach was really phenomenal about it, is that regardless of bear markets, bull markets, FOMC statements, earning reports, any list of fundamental things that are going to slam into these markets, the software still has this extremely high level of accuracy. So regardless of the market conditions, you really have a tool that's quite robust and going to hold up. And how I like to think of it is, because this approach is very unique to a lot of what you see out there, how I view the markets is that the markets are a battle between all different traders doing all different trading styles, right? You got all these different styles that work, shorter term, longer term, options guys, and it's all summarized in the price. And so what we have to do is really summarize that price and essentially be able to lean with the winners with a high level of accuracy here. And so what the neural network process really does is sort of summarize that battle, summarize all of those different strategies, and give us a consistently accurate forecast regardless of market style, type, whatever, because on the yen, there's people trading Fibonacci retracements and Elliott wave and moving average breakout and all this stuff. So it all gets summarized into the price, and so that's what I want to stay true to, is anticipating price over these given periods of time with these highly accurate tools, and that's really what gives us the edge, is this inter-market approach, because when market conditions change with a couple of regular moving averages, things really break down rather quickly, and you realize your tools aren't really able to adapt. Maybe worked really well in a bull market, but aren't working in a bear market because they're not really analyzing maybe what's happening with the dollar index or gold or oil prices, which is really the reason why your trade isn't working out so well right now or at any given time. So just a little bit of summary on one single chart there that I think is hopefully a little bit more helpful. But that's one thing I understand is so many traders come with different approaches, different perspectives, different markets that they're trading. But with a tool like Vantage Point, it works the same on all different asset classes. So I tend to not look at markets as entirely different things. I mean, I look at my correlations in a portfolio context, but every market is this battle between the bears and bulls, and I want to make sure I'm leaning with them in line with my analytics, of course, here. So one of the other, like I mentioned, the organization is very important for markets and traders. We want to trade off of this output, but we want to be able to make sure that we're identifying the best opportunities possible so we get more of the types of moves we're looking for. So there's some great tools as far as some scanning features in the software, so that not only are you going to have a really robust tool here to help you scan for new opportunities, but it's really going to cut down a lot of the time that you're going to spend doing this type of analysis, and really just have you focusing on, hey, what's happening in the market, at this given time. So let me go ahead. I'm actually going to open up, I have technology here. I'm going to go ahead and open up my services portfolio because it has more markets for the scan here. So what I tend to do every evening is the futures and the forex markets are going to trade overnight. And as I mentioned, the software works off of end-of-day data. So what happens is at 6 p.m., all of these new forecasts for the next trading day come through the software. So the futures and forex trade overnight, but because you have a process and these scans already in place, it really only takes about 10 minutes or so to look through those about 68 or so futures markets there. The forex market with the cross pairs and the major pairs as well. So that's very quick. You can find, hey, is my criteria being met? And focus on those individual opportunities, 10 or 15 minutes. Then I get up in the morning before our equity markets open here in the States and run through the hundreds of markets for individual stocks, because then we're talking about, I have my U.S. stock sector here. We have all these different sectors, a huge amount of individual companies inside of each area that we forecast for with an extremely high level of accuracy on, all of these stocks here. So what I do here is I set up these scans, and it allows me to filter out all of these opportunities. So if I click on IntelliScan here, we can actually see, medium-term cross days ago. So this is our crossover condition here. Let's say, for instance, we wanted to look for just fresh crossovers, right? A one-day occurrence, whether it's to the upside or to the downside here. You can see what I love about the software too is it's they've been doing this for 30 years developing software, it is so snappy. I mean, once you got things loaded up, I mean, you are just flying through these filters and able to get through whatever you want. But we can set that condition to 1, so fresh crossover. We see we have some to the upside, some to the downside here. But that condition alone, 159 markets scanned, we're down to about 32. Let's go ahead and look to the upside here, because our S&Ps are actually having an upward crossover to the upside here. And so this is how we identify, again, these new opportunities in the marketplace. So you're going to have 159 markets. We're down to about 26. So you can set some additional criteria if you like. Maybe you work off of some fundamentals. Maybe you have a longer-term technical setups that you like to use. I don't really care what the approach is, but I certainly want to make sure, again, that my actions are in line with the accuracy of this software. So, I may have a fundamental view about a market and what I think may occur, but I'm not getting in there until these analytics give me the go-ahead for that shorter term or longer term strategy off of these neural network and the predicted moving averages. So, this is, again, what I'm using every single day, and again, cuts down on the time to have you really just, again, focusing on, okay, where are those opportunities that are just fitting right into my wheelhouse, exactly like what I want to see. And in my opinion, this is one of the most important things that traders need to do just for burnout. You got to get your approach in place, and then, like I say, crank that machine, and that's what we're really doing with Vantage Point every day. Running these scans in a very regimented way every single day. And finding those, 1 or 2 opportunities that are just perfect for you, and where you have not only, your analytics all on your side, you've got that high probability of the indicators, but then they're going to be consistently accurate moving forward. So managing that opportunity moving forward, you're going to know, hey, is there going to be a dip here? Should I be trying to buy on this dip? Should I be pushing, hitting these predicted highs, levels, output from the software? And you'll be able to develop those strategies much easier because all that heavy lifting and analysis is really done, and most importantly, done in a way of how the markets, really work. Because, the dollar index, the S&P, these ETF markets, where a lot of these markets are trading now, critically important for any sort of analysis you're doing on a single market when you go in there and start trading. So, that's about all I have for you guys here. I think they put in a nice link here for you guys inside of the chat box here. I believe what it allows for is a $1,000 discount on any package that you decide to add here. Now, how the packages work is really straightforward. Just the more forecasts essentially have the more markets you have access to, the higher the cost there. But again, regardless of the markets you're trading, the analytics, the approach, and the accuracy all work exactly the same way and all at that very high level. And that's really the edge, is the high accuracy on all different asset classes. It means we're really tapping into how humans are interacting with these markets on a consistent basis. And so, that's very important to me as far as using indicators and tools. I want to make sure that they work on, stocks in America, stocks in the UK, futures markets, currency markets, and things like that. So that's, like I said, it's about all I have for you guys. Again, thank you guys for, obviously allowing me to be here and share this information and our technology with you guys. And thanks, Simon, for having me here. I know, if there are any questions that people have in the room, I'd certainly be willing to, answer any questions or, go over anything or anything at all you guys love. I mean, I love talking about markets and doing this stuff. So.
No, that's been very interesting actually to see that. I haven't actually seen it before. I haven't seen it demonstrated. It's interesting stuff. What I like about the platform is that it's a very clear layout. You've got a very uncluttered desktop here.
Yeah. One thing that and traders, that is one of the difficult things about trading is, there's so many different indicators, and obviously, if you bring too much stuff into the equation, you really do more harm than good. And so, when we have computers and technology and all this, available to us, trying to manually, integrate several, different indicators, kind of leads to that sort of friction, in trading, where you're not really as efficient as you could be. And so, when you're trading straight off of this output, but then also, those predicted high and low levels are quite good for intraday levels that you can expect to be taking profits and then adding the positions on. To me, that's what really makes all the difference, is that being able to adapt and manage positions moving forward. Because, how many traders are, the adage here. You got to ride your winners and cut those losers short. So you may have an idea and think, yeah, this is a great idea, let's go trade it. But when you need to get out and it's not working, you need to recognize that as soon as possible. So that's what the tools really help you do as well, as obviously staying in the market when you need to. So.
That's fantastic. And the time frames obviously go down to, is it every minute? Is it minute charts?
Well, here's how I like to view it here. I actually do look for, I have indicators that I look at, to me, are 3-month indicators. I look at them on a 6-month chart. And then I've got, overbought, oversold indicators as well, sentiment tools, essentially. But then when you're using Vantage Point is a very accurate short-term forecasting. With neural networks, and this is true even for, weather forecasting, right? They get a lot more accurate with weather forecasting as far as what's going to happen tomorrow, because they're able to analyze, what's the pressure doing, what's the wind looking like, what's the, the tides, and all this stuff that meteorologists do with their craft. They use these tools. But the further and further out you go using neural networks and any sort of predictive technology, the less reliable that forecast is going to be, right? So what's great about Vantage Point is it's extremely accurate in these smaller time frame windows, and that really helps with that management. I mean, imagine, in the trading, when we have a 48-hour indicator, if we know whether we essentially want to be buyers or sellers over a 48-hour period, that's pretty much all we need to be doing. And any sort of, even a longer-term strategy, I mean, you get in there on the right day, you should really be good for that trade. And obviously, if you know what to expect moving forward with some accuracy, you should be getting good entries on those positions there. So how I view it is, you can use every time frame. I use these longer term tools, but then you get to the moving averages. Those are really 2 to 3 days essentially. Neural index, 48-hour forecast, and then you get to things like the like I said, the predicted highs and lows, which are literally intraday levels predicted ahead of time. So rather than looking at a 5-minute chart or a 15-minute chart, you're just looking at the daily chart, but you already know the level where you should want to participate. You know what I mean? So, and instead of trying to look at the market in these, smaller and smaller time frames, I feel it's very helpful to, again, I get to that point of artificial intelligence is the ultimate tool of preparation. I want to know what price I want to be a buyer or seller before the market's even there. And that's really what we're doing with Vantage Point, is really being ahead of these things as far as our trades. One of the issues too is, when the volatility enters into the markets, it's already too late, for trades. There was that Friday, 2 Fridays ago, where the S&P dropped 2+% or something like that. There were great opportunities to short the market, but you almost needed to be short a couple weeks before that happened. I think actually this chart for Cheesecake Factory is a good example of this. Here's all the volatility of that Friday, but there were tons of these opportunities were coming through weeks ahead of time. So, when your timing's, accurate, but then all your decisions are in this broader, time frame of this 48-hour indicator, whether you're buying or selling, and obviously you've got your, risk management in there and how much you risk on each opportunity, you end up recognizing that when the fundamental news and all these other things hit the market, you're already in position. And you've already been there because you're really just following a process. So, it's kind of hard to explain. A lot of people, I think, traders feel that, they're going to see some news or they need to have access to the news to take advantage of it. And in my experience, I mean, one of my best trades this year was buying, options on St. Jude Medical. And, I bought it down at 53, 54. There was a buyout 2 months after I bought it, and it shot up, 30%, 40% overnight. But it was the process that got you into the position, got the good entry, had you trailing your stops up with the market, that had you there ready for it. So that's where I really see the unbelievable benefit and Vantage Point is. It really helps you set up that process, just crank the machine, as I like to say. You're just going to not worry about any of this news and information, all this stuff. Just focus on your trading, your risk management, and you'll find yourself in these really nice trending markets and opportunities, regardless of if it's in stocks. Sometimes the great opportunities in stocks, sometimes I'm in currencies and futures. It's just rolling around with where are those nice setups I like to trade, and then I've got the short-term analytics to ride the winner, cut the loser, and keep cranking and cranking.
Thank you. Keep cranking. Tell me, just the full UK stocks. Do you cover sort of smaller companies as well? We've got the main market, London Stock Exchange.
Yeah, I of course should mention this. I'll be completely honest here. I'm an American. I am not very familiar with stocks in the UK at all. So we do forecasts for the UK stocks, and they're split up exactly like our, United States stocks, essentially split up by the sectors of the economy here. But none of these, really look all that familiar to me at all, so it's kind of hard to say. But we apply this technology to UK stocks, Australian stocks, and you can go to our website. Probably I don't know if you click the link, it'll take you. I don't know if it takes you there, but tradertech.com is the website, and you can actually see all the individual companies that we forecast for, and also actually the accuracy statistic tied to the neural index there. So I mean, all that information is there. I mean, literally a list of every single market that we forecast for, and you can see that is thousands and thousands of markets when you bring in these UK stocks, even India stocks. We have some customers in India, Canada, and even like the international ETFs. So things like the Brazil and emerging market ETFs and all that sort of stuff. So that's what's really phenomenal about this is you can take. It works like a network, right? So for every target market, this technology is able to find those 30 inner markets, analyze those relationships. So as long as you can take that target market, you can apply this technology to it, because it really is the neural networks that are scouring these huge amounts of data, finding those significant relationships, because it's actually a type of learning machine, learning those relationships, and then again incorporating essentially predictive data into these indicators and turning them into predictive indicators to make better trading decisions off of more, obviously that high level of accuracy. So we're ahead of these trades. So obviously with a predicted moving average, helping a lot with timing for any sort of, trend reversals that you want to get to trade. A day or two can make a huge difference, especially in stocks with their, have a tendency to gap around, when they really start moving. So.
Amazing, fantastic. Well, Matt, you've talked non-stop for 50 minutes, and it's been excellent. You've given us a full tour. There's no questions at the moment, so either people are tired or you've covered everything.
I would encourage everyone just visit our website at tradertech.com, and there's actually a website. Me personally, I produced for a video series for the past about 2.5 years of trading on traderplanet.com. You can go there and you type in traderplanet.com, Matt Golden, my name, and you'll probably find all my videos showing, how I utilize this literally for my trades. It was like a 2-year period of me just, here's what I'm looking at, here's how I'm managing it, and just sort of rolling it through time to demonstrate the approach and how people see it working over time, because that's sort of the difficulty, right? You may get into a trade, but you need to see, hey, how'd you manage that over the last month to get the most out of it? So that was really the attempt there. It's a really long period of time of going through all different asset classes, but with this general approach of using these tools to find these trends and ride them as long as possible. It's really my goal.
Oh. Fantastic. Well, Matt, it's been a pleasure having you on. Hopefully we can have you on again at some point in the future. And I think we'll take the reins back now and let you carry on, because it's still right, the afternoon for you.
Thank you, Simon. You have a great night, guys. Bye.
Thank you very much indeed. There we go. So thank you to Matt Golden for showing us Vantage Point software. Interesting, fantastic, very clear, looks pretty straightforward. Obviously, if you want to go for a demonstration of that, a one-to-one, there's a link in the chat box for you to be able to go and sign up for that. So that brings us to the end of today's Round the Clock Trader, and it's been super. Thank you to all the speakers who have taken part today, and thank you to you all who have attended. Still. The diehards are still with us, and it's been great to have the support. We will get the recordings out to you in the next day or so, hopefully before the weekend. We'll have a GoToWebinar recording, and thereafter we'll follow up with the recordings at the London School of Trading. So thank you very much again, and we will be back with more webinars very shortly for you. Thank you very much. Good night.